Hello, all boys and girls. Welcome to the DT Marathon or Revision Series. This is your tax guru, CMA, Manidhi. See, first of all, there are hardly 12 to 13 chapters. If you could learn properly those 12, 13 chapters from each and every corner, you're gonna get exemptions for sure. Second thing, sir, I'm already filtering these 12, 13 chapters. From this 12, 13 chapters, in any rare case also, we're gonna get 5 questions. I mean, 5 14 marks questions in exam. Okay, now if you pick again choice from this 12, 13 chapters also, then you only making your exam complicated. It's in your hands. Sir, there are 25 plus chapters. Out of that, I filtering and saying like this 12, 13 chapters are like A category. Don't do again separate filterings from those chapters. Point number 2. Point number 3. I'm very much confident that these parts, like I'm gonna release it in like 3 parts. If needed, I may release even the 4th part also. These parts are gonna give you proper conceptual knowledge in the DT along with the problem solving, and you'll know also like, okay, these are the areas I'm doing mistakes and all. Okay, this is something which is truly beneficial for you. So what I'm expecting from you, don't forget to like this video, immediately like this video, share with your friends, put that comment also from where you are watching, like which part you liked or what else you needed to be covered in marathon also. Okay, you definitely comment on this video, sir. Okay, then quickly I'm going to discuss about the important chapters, okay, which you should not fail to cover. First 3 chapters are basics, deductions, written off income. These are the foundation. Okay, only these 3 chapters are there, then we can go to next chapter. So these are foundation chapters. Okay, then question number 2, mostly it is from PGBP, assessment of companies, assessment of trust. Okay, 14 marks question. But trust, sir, last attempt already they asked a question 7 marks. So this attempt, okay, I think there are less chances from trust, so I kept it as like what, B category. Then question number 3, tax planning. Sir, tax planning, everybody think like easy chapter only. But if you don't have this basics, deductions knowledge and PGBP knowledge, then you cannot answer tax planning chapter. The beauty of the chapter is like, you think like you solved it correctly only, but I tested in classroom, sir. Okay, even in EO series I tested, even in the classroom regular classes I tested. For every question, I'll take answer from each and every student in the class. I'll get easily 10 different answers for each and every question. Why that is happening? Why that is happening? You'll miss the small minute points like tax calculation mistakes, rebate mistakes, forgetting to add cess, forgetting about TDS, TCS, okay, some PGBP adjustments and all. So that's why PGBP is not just for question number 2. It is even linked to question number 3, tax planning. So learn this chapter. Okay, you don't do anything extra. Completely trust me and completely watch this series alone. I'm gonna assure you that you learn PGBP and you're gonna thank me later also. Okay, so tax planning 3A, 3B. Okay, one is from individual perspective, then the next one is like company perspective. Question number 4, 4A business restructuring, 4B NR tax. Sir, I am again saying NR tax is one chapter where most of the students feel tough and they leave that. But I am giving you an assurance, sir. Listen for this NR taxation chapter, then you will see like, oh, this much only NR taxation. Okay, the only thing is like, for remembering rates, you should put some effort. Rest all, leave it to me, listen to this series completely, you'll understand. Okay, and the beauty of the notes, sir, because I wrote notes so beautifully for NR taxation chapter also. I did so much of like extensive research and then wrote the new notes also. Then question number 5, advanced tax and ICDS last attempt there's a question, sir. So this attempt I'll think it as B category, advanced tax A category. 5B always appeals and advanced ruling. 6 to 7 you already know, these 2 are like important chapters, DTA and transfer pricing. Transfer pricing, sir, everybody targets transfer pricing, but still you confuse us with cup method, resale price method, okay, cost plus method, right? But I covered the questions, I explained beautifully the logic also, and then come to APA points, come to secondary adjustment points, come to thin capitalization points, whatnot, everything is covered detailedly. The only thing is like, you have to allocate time to me and watch these videos. Okay, so then the other B categories are like assessment procedures, such Caesar and TDS. Okay, these are the chapters you focus first. Rest of the chapters, even if you leave, okay, sir, from there MCQs are coming now, sir, I'll release a bullet MCQs video also. There, all the MCQs I gonna cover. From the rest of the chapters like offenses and penalties, GAR, black money, equalization levy, from these chapters and all, MCQs are only being asked. That too, which we cover in bullet sessions only, bullet MCQ sessions only mostly coming. So with this series, I am assuring you, if you could follow that, sir, this is not like a normal marathon. Marathon, I usually cover it in like 15 to 18 hours. But this one, I'm giving actually around 60 hours of content. Okay. But to make it little small, I added speed also in some videos and all. So what I'm going to see is like, from the basics deductions, you can watch at normal pace. From PGBP onwards, if you feel the speed is little high, you adjust the speed in YouTube to 0.75 and you can comfortably watch the lectures. Okay, so my only expectation from you is like watch all the classes, all this series completely. Second thing, don't forget to share with your friends. And then third one, comment on this from where you are watching, because I wanted to know personally where this marathon has been reached. Okay, thank you all. We'll meet soon in the presentation ceremony once you qualify and all. Okay, sir, why I'm doing all this, sir? I want to make sure that you guys clear within the new old income tax act 1961 only. Once the new income tax act 2025 releases, you have to study that as a professional only, not as a student. So June attempt you should clear, and even if any December student is there also, you can also watch this, sir. You should buy, okay, without any second chance, you should clear the group 3 by June or December 2026. Then new income tax act you have to study, because we professionals we need to learn income tax, but as a professional you have to study, not as a student. Okay, so thank you all. We'll be quickly going into the chapters without any waste of time. Thank you. So okay, come on boys and girls, let's jump into the basics chapter quickly. Fatafat, we're going to finish off the basics chapter very quickly. Okay, the other chapters and all, like I may take time, but basics deductions I'm going to finish off like no time. It's okay, so you already know which finance act applicables for the June and December attempts. Finance Act 2025, financial year 25-26, previous year also 25-26. Then the applicable assessment year is how much? 26-27. First one, Article 265. What does Article 265 says? Like, except authority of law, no one else can levy taxes. Okay, if authority of law means what? Government, state government, central government, both are authority of law. In which government can levy tax? That was mentioned in Article 246. Okay, Article 246, 7th schedule consists of 3 lists. What are those? Union list, state list, concurrent list. Union, state, concurrent list. If any matter is mentioned in union list, on those matters central government can frame law. Any matter mentioned in state list, state government can frame law. Any matter mentioned in concurrent list, both central and state governments can frame law. Okay, so now income tax is mentioned in union list. That means income tax law can be framed by whom? Central government. Entry 82 gives the power to frame income tax law. Then components of income tax law. So we're gonna study income tax here. Okay, so what does the total income tax law consist of? So there are total 5 components. First one is like the act, the base one. Income Tax Act 1961. It consists of sections, subsections, clauses, subclauses, provisos, explanations, all these. Okay, so the detailed outline we have in the act. It applicable to whole of India came into force on 1st April 1962. It has 298 sections divided into 14 chapters. Sir, 14 chapters now, not our syllabus chapters. The act was divided in 14 chapters. Okay, all this is even given in section 1 of the act. Then Annual Finance Act. What is Annual Finance Act? Every year budget will be introduced. That itself is called as what? Annual Finance Act. So every year the amendments are made through Annual Finance Act. Then Income Tax Rules 1962. Okay, who will issue the rules? CBDT. Why rules? To implement the act, rules are step-by-step guidelines. Step-by-step guidelines. Let's say, sir, simple example. Income Tax Act requires like, so certain people should have PAN. Okay, PAN should be there, but where to apply PAN, which form, what is the fees, all these are mentioned in the rules only, step by step guidelines, circulars. When there is any ambiguity means like no clarity. It's okay, there is like 2-3 opinions are there, you can take that way or even this way. Then in such cases, to provide you some clarity, to provide the intent of the income tax department or authorities, they were gonna give circulars. Okay, notifications. What is notifications? So just like as our mobile notifications. Okay, if something happens, you get notified, right? WhatsApp, Instagram, someone texted you. Okay, if someone shared your reel, you are getting a notification, right? Same way, there is a change in amendments in income tax law or rule. How do you get to know? Sir, you already said Finance Act, Annual Finance Act will be there, through that amendments will be made. Yes, what I am said is correct only, but they will be made effective. Okay, it's not like all the amendments will be made effective from 1st April only. Some may be made effective from 1st June, some may be effective from 1st July, like that. Because once they propose the amendments through Annual Finance Act, Okay, they'll actually make them effective by notifying them. Okay, depending on the practicalities and all. Understand? So once they want to bring effect any amendment and all, again they need to give a notification. Sir, these days now mobiles are there, they can send notifications, but back then how? Okay, that's why they're gonna publish them in the official gazette. Once they publish it in the official gazette, it is equivalent of notifying it. So with respect to rules, CBDT will notify. With respect to act, central government will notify. Even judicial decisions are also part of the income tax law. Total 5 components. What are those? Income Tax Act 1961, Annual Finance Act, Income Tax Rules, Circulars, Notifications, and then judicial decisions. Section 1, title of the act. What is the title of the act? Income Tax Act 1961, applicable to whole of India, came into force on 1st April 1962. Definitions. Then previous year. Sir, you already know. What is the previous year? The year in which income is earned. The year in which income is earned is called as previous year. Okay. So previous year usually means a period of 12 months starting from 1st April. Previous year means what? The year in which income is earned is called previous year. It's usually a period of 12 months. Let's say year 25-26. The year end. I mean, typically the financial year and previous year are one and the same. Okay, so you prepare P&L for a financial year, right? That itself will call it as what? Previous year also. Okay, but there is an exception to this rule. What? When you are having income, new source of income, then sir, first time you graduated and you got your job first time, that's the first earning you are having. Then your previous year will not start from 1st April. It starts from the day when you have that new source of income first time. From then the previous year starts. Or else you have a new business or profession. Then also the previous year starts from the day when the new business or profession has been commenced. Usually 12 months. But in this exceptional cases, when that new source of income is came to you, or when that new business or profession has been commenced. Okay. Then assessment year. What is the assessment year? The year in which income is assessed to tax. What? Assessed to tax. What does it mean by assessed? Computation. When the tax will be computed. Sir, typically if you earn income this year, next year only you will compute, you will arrive the final tax liabilities and all, right? So that's called what? Assessment year. This is immediately succeeding to previous year. Assessment year is a period of 12 months always, not like previous year. It's always 12 months starting from 1st April. Then charging section. Very important, sir. Section 4 is charging section. Take this into your brain. Okay, get it. Let it go into your brain. Section 4 is the charging section. Income tax will be charged. What is called charged? Levied, imposed. Okay, so income tax will be imposed for every assessment year. Okay, for every assessment year there will be income tax. On whom? On every person. On every person. Okay, sir, I am a person. On me income tax will be imposed. But what's the basis? My total income on the total income of previous year. Okay, sir, on me income tax will be imposed. Okay, on me on every person income tax will be imposed for every assessment year. Then by using what? By using the rates given in, tax rates given in Annual Finance Act and considering all the provisions of this act. So in simple, income tax will be imposed on the total income of previous year, and this imposition will be there for every assessment year on every person using the rates notified in the Annual Finance Act. Okay, person includes, you already know, individual, HF, firm, company, AOP, BOI, local authority, AJP. Firm even includes LLP. Then total income. Sir, why to explain total income? Sir, I already know total income. That's what you will say, right? But there are students, even today, even in the recent certified copies also I have seen that total income itself they are doing mistakes. Okay, let me tell you, sir. 5 heads. How do we do total income? Take incomes from all the 5 heads. What are the 5 heads? First, salaries or property. Salaries, income from salaries. Okay, do all the salaries related computation. That salaries chapter, like the basic interlevel salaries chapter, that final answer will be there. Na? That's income from salary. Income from house property, PGBP, capital gains, income from other sources. Take them. Then clubbing provisions you should do. What's called clubbing, sir? If income of some other person has to be included in your total income, that's called clubbing. That's called clubbing. But understand, sir, here clubbing has to be done headwise. Clubbing has to be done like what? Headwise. What does it mean by headwise? What does it mean by headwise, sir? The income of, like let's say, sir, minor son income has to be included in the hands of father. Let's say if minor is having interest income, where interest is taxable, IFOS. So even to the parent also included in IFOS. Minor has rental income, included it in the house property head only. So headwise clubbing. Then set off and carry forward of losses. Set off and carry forward of losses. Then the total is called as what? Gross total income. From there, avail chapter 6A deductions. What are chapter 6A deductions? That 80 series deductions are there, right? ADC, DD, ATU, all those. And then 10AA exemption. Sir, 10 series, usually exemptions. But this 10AA exemption alone, even though we call it as exemption, it works like a deduction. So here only chapter 60 deductions, 10AA exemption subtract. Then you will get what? Net total income. On this net total income, there may be special rate incomes, normal rate incomes. So first calculate tax on normal rate incomes excluding special rate. Okay, only on separate the special rate incomes. On the normal rate incomes, calculate tax. Then on special rate incomes like capital gains, lottery and all. Then surcharge, rebate, whatever applies. Then cess a rate of 4%. Then you'll get what? Total tax liability. From total tax liability, in the question, this is one important point. If there is already advance tax paid, TDS, TCS, that has to be subtracted, then you will get the total tax payable. Okay, then what are the tax rates applicable for assessment year 26-27, sir? Very important, sir. Now on the first amendment, sir, actually this is one applicable for June 2026 exams. The first amendment is what? Change in the tax rates in the default regime. Whom? Individual, HUF, AOP, BOI, AJP. Individual, HUF, AOP, BOI, AJP. 115 DEC. It is the default regime. In question, nothing is mentioned. You should take what? Default regime. So what are the tax rates? 0 to 4 lakhs, nil. Total income 0 to 4 lakhs, tax rate is nil. 4 to 8 lakhs, tax rate 5%. 8 to 12 lakhs, 10%. 12 to 16 lakhs, 15%. 16 to 20 lakhs, 20%. 20 to 24 lakhs, 25%. Above 24 lakhs, 30%. So depending on your total income, tax rate is applicable. Sir, this is very easy to remember. Up to 4 nil. Then again for every 4 lakhs multiples, 5% has to be increased. Okay, same slab rates irrespective of whether SSC is resident or non-resident, normal individual or senior citizen. But one thing you have to remember, sir. Okay, so take this example, sir. Sir, I'm gonna take them little quicker, but you solve when you are doing for first time. Total income 11 lakhs. Calculate and do. How much? 50,000 should come. Total income at 18 lakhs. You'll get 1,60,000. Solve this. Okay. Then total income 24 lakhs. Total income 24 lakhs. This you need to remember. Total income at 24 lakhs. Why also I'll tell. Okay, see, 0 to 4 lakhs 0, 4 to 8 lakhs 5% 20, 8 to 12 lakhs 10% 40,000, 12 to 16 lakhs 15,000 15% 60, 16 to 20 lakhs 20% 80, 20 to 24 lakhs 25% 1 lakh. So total how much? 3 lakhs. So at 24 lakhs total income, your tax liability will be how much? 3 lakhs. Sir, why only at 24 lakhs? Because from 24 lakhs onwards, the tax rate is 30%. 30%. Sir, why? Let's say 30 lakhs total income. First 24 lakhs how much? 3 lakhs. Balance 6 lakhs how much? 30%. So 3 lakhs plus 1 lakh 80, 4 lakh 80. So without a calculator also you can calculate. If you remember the tax liability at 24 lakhs, how much? 3 lakhs. Now surcharge rates. Where the total income is like up to 50 lakhs, then the surcharge rate is nil. Total income is like 50 lakhs to 1 crore, then the surcharge rate is 10% of income tax. Understand, sir? Tax will be levied on total income directly, but surcharge will be levied on tax calculated. So, okay, 0 to 50 lakhs, nil. Sir, to whom this surcharge rates applicable? These surcharge rates are applicable in default regime to individual, HUF, AOP, BOI, AJP. 0 to 50 lakhs, nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. Above 2 crores, 25%. This restriction I'll again discuss separately, sir. This restriction point. Okay. First remember this. Up to 50 lakhs, nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. Above 2 crores, 25%. Now marginal relief. Sir, when marginal relief will come? Sir, marginal relief comes into picture only when the total income of the SSE is nearer to the surcharge limits. What are the surcharge limits here? 50 lakhs. Because once it crosses 50 lakhs only surcharge applies. 1 crore because the rate is changing. 2 crores. So 51 to 2 crores. When the total income is nearer to that surcharge limits, that also upward side. Sir, for 50 lakhs, 51 also nearer, 49 also nearer. But you will not consider 49. Only upward side nearest. So 51, 50 lakh 50. 1 crore na 1 crore 1 lakh, 1 crore 50,000 like that. Okay, the upward side and closer to the surcharge limits, then marginal relief may be applicable. That you need to check. Okay, so what are the steps for marginal relief, sir? See, with example, sir. Example, computation of marginal relief along with example, individual age 45 years, total income 1 crore 1 lakh. What we have to do? Compute tax on given total income including surcharge. What is the tax, sir? 1 crore 1 lakh. What is the tax? 30 lakh 1,500. Do quickly also. Step 2. What is the nearest surcharge limit to 1 crore 1 lakh? 1 crore, right? On 1 crore, calculate tax plus surcharge applicable. 28 lakh 38,000. Step 3. difference between the total income you have taken, how much? 1 crore, 1 lakh, and the nearest surcharge limit, 1 crore. What is that? 1 lakh. Now marginal relief is simple. 1 minus 2 minus 3. 1 minus 2 minus 3, marginal relief. Only when the answer here is a positive number, you had marginal relief. If the answer is like 0 or negative number, there is no marginal relief. So marginal relief is step 1 minus step 2 minus 3, only if it is a positive number. Okay, so final tax equals to how much? Step 1 minus marginal relief, will get the final tax liability. Okay, and understand, sir, marginal relief concept applies to everybody, not only to individual HUF, AOP, BOI, AJP, to companies applicable, firm applicable, local authority also applicable. And then it applies in default regime, even in the old regime. The steps are same. What are the first step? Step 1 what, sir? Compute tax plus surcharge on given total income. Step 2, identify the nearest surcharge limit and calculate tax plus surcharge if applicable on it. Step 3, difference between the total income given in the question and the nearest surcharge limit you are taken. Okay, so that if you do, then step 4, marginal relief, 1 minus 2 minus 3. Okay, now tax rates applicable to individual HUF, AOP, BOI, AJP under old regime. What are those? Individual HUF, AOP, BOI, AJP. And the total income is up to 2.5 lakhs, nil. 2.5 lakhs to 5 lakhs, tax rate 5%. 5 lakhs to 10 lakhs, 20%. Above 10 lakhs nowadays, 30%. Okay, so to whom, sir? Individual HUF, AOP, BOI, AJP. Up to 2.5 lakhs, nil. 2.5 lakhs to 5 lakhs, 5%. 5 lakhs to 10 lakhs, 20%. Above 10 lakhs, 30. So you should remember the tax at exactly at 10 lakhs in old regime. How much, sir? Shiva, age 45, total income 10 lakhs. How much? 1,12,500. Sir, default regime, remember at 24 lakhs. How much? 3 lakhs. Old regime, at 10 lakhs, you remember how much? 1,12,500. Okay. Then, individual is a resident, age greater than or equal to 60 years but less than 80. Individual, he is what? Age greater than or equal to 60 years but less than or equal to 80. Then he is called as what? Senior citizen. And he is a resident. Sir, senior citizen has a special slabs available, but those applies only when he is a resident. Sir, if he is non-resident, then these slabs not applicable. The original one, up to 2.5 lakhs, nil, 2.5 lakhs to 5 lakhs, 5%, those only applicable. See, for non-resident senior citizen, non-resident super senior citizen, these slabs only applicable. Okay, so okay, if he is a senior citizen, then what is this point? Sir, whether he attained the age of 60 or not has to be checked on the first day of assessment year. So that means for your exam turn, which day? On 1st April 2026, if he attains the age of 60, that day only his birthday, he is attaining age of 60, he'll be counted as what? Senior citizen. So for senior citizens, up to 3 lakhs, nil. 3 lakhs to 5 lakhs, 5%. 5 lakhs to 10 lakhs, 20%. Above 10 lakhs, 30%. Okay, so for senior citizens, on first 10 lakhs, the tax liability will be 1,10,000. Then, individual being a resident, age greater than or equal to 80, super senior citizen. Whom? Super senior citizen. Total income up to 5 lakhs, nil. 5 lakhs to 10 lakhs, then the tax rate is 20%. But the total income is more than 10 lakhs, then the tax rate is how much? 30%. 30%. Super senior citizen. Then surcharge rates under old regime. What? Surcharge rates under old regime. Total income up to 50 lakhs, surcharge is nil. 50 lakhs to 1 crore, 10%. Sir, previously I said in default regime, now under the old regime. Total income up to 50 lakhs, surcharge rate nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. Okay, above 2 crores to 5 crores, 25%. Above 5 crores, 37%. Sir, in default regime, above 2 crores, it's always 25 only. But here there is one more slab. 2 to 5 crores, then the surcharge rate is 25% of income tax. Above 5 crores, it is 37% of income tax. This restriction point we'll discuss again separately. Okay. Here also marginal relief concept as it is applies. What is step 1? Compute tax on given total income. Step 2, identify the nearest surcharge limit, on that calculate tax plus surcharge. Step 3, identify the difference between given total income and the nearest surcharge limit. Step 4, 1 minus 2 minus 3. If it is a positive number, then only marginal relief is there. So what we have to do with marginal relief? Subtract from the tax liability you computed in step 1. Okay. Then special tax rates. What are the special? Sir, understand. These special tax rates applies to every class of person. So previously the slab rates we set are applicable only to whom? Individual HUF, AOP, BOI, AJP. But these special tax rates, not just for this 5. Even for company, firm, local authority also these are applicable. Capital gains. First one is what? Capital gains. Capital gains are of two types. Long-term capital gain, short-term capital gain. Long-term, short-term. Fine. Within long-term, there are two sections. 112, 112A. Short-term, 111A, 111. So these section numbers should register in your mind. These four. 112, long-term capital gain. 112A, both are long-term only. Short-term, 111A, 111. Sir, now about this A series, 112A or 111A. Which assets will fall under this 112A, 111A? Listed equity shares, listed in India, listed equity shares on which STT paid. Units of equity oriented fund, units of business trust. See, listed equity shares, listed India, units of equity oriented fund, units of business trust. These three. If they are held a long term, then the resulting capital gain is taxable under 112A. If these are short term, then the resulting capital gain is taxable under 111A. Then the other long term capital gain 112, other short term capital gain 111. So 112 other long term capital gain, 111 other short term capital gain. What about 112A, 111A? Gains arising from listed equity shares, units of EOF, units of business trust. What are the tax rates? 112A, the tax rate is 12.5% in excess of 1,25,000. How much? 12.5% in excess of 1,25,000. Then 111A, the tax rate is how much? 20%. So 112A, 12.5% in excess of 1,25,000. 111A, the tax rate is 20%. 111, these are taxed at normal rates only, whereas 112 taxed at 12.5. Sir, capital gain important, sir. 112A, tax rate 12.5% in excess of 1,25,000. 112 taxable straight at 12.5%. 111A taxable at 20%. Other short-term capital gain, this is important, sir. Many think this also special rate. No. Other short-term capital gain are taxed at normal rates. That means what? Individual na slab rates only. Company na, then the company applicable rates. Okay. Then casual incomes. What are casual incomes? Lottery, gambling, puzzles. These are special casual incomes. Taxable at what rate? 30%. Net winnings from online games. 115 BBJ. Taxable at what? 30%. Undisclosed income. Taxable at tax 60%, surcharge 25%, cess at a rate of 4%. So rebate under section 87A. Sir, rebate, again, there is the next amendment is like rebate, sir. First amendment, slab rates, right? The second amendment is about rebate. Very important amendment, sir. I guess this point will be tested in tax planning chapter. Okay, so in tax planning chapter, there's a question being asked like from basics only, the tax calculations and all. So I think this attempt rebate point could be linked there. Okay, so be more cautious. Rebate under section 87A. It applies only to resident individual. Rebate applies only to resident individual. Sir, in tax planning, there will be two questions, 3A, 3B. 3B, they are asking specifically from individual. 3B, they are asking from the perspective of 3A from individual. 3B, they are asking from the perspective of company. So, since it is applicable only to individual, so under 3A, there is high chances of linking it to the rebate. So, be clear. Rebate applies to resident individual. First, I complete old regime, sir. Easy. Total income should be less than 5 lakhs. Net total income. Resident individual. Total income should be less than 5 lakhs. Rebate amount is tax payable or 12,500, whichever is lower. Tax payable or 12,500, whichever is lower. 3 points. Resident individual. Total income less than or equal to 5 lakhs. Rebate amount is 12,500 or tax payable, whichever is lower. And then rebate not applies. Rebate can't be claimed on 112A income. Can't be claimed on 112A income in old regime. Only on 112A. What is 112A income, sir? Capital gains on listed equity shares. Okay. Capital gains on listed equity shares, units of EOF, units of business trust. Okay. On them. There is no marginal relief concept here. Now, rebate under the default regime 115 BSC. This is the amended, sir. Very important for this attempt. Total income should be within 12 lakhs. Total income should be within 12 lakhs. Fine. Second one, the rebate amount is 60,000 or tax payable, whichever is lower. Resident individual, total income should be less than or equal to 12 lakhs. 12 lakhs. Rebate amount is 60,000 or tax payable, whichever is lower. One more important, sir. Rebate not applicable on special rate incomes. Rebate not applicable on special rate incomes. And even there is a marginal relief concept also. This marginal relief, even there in the last attempt also. I'll tell it much more easily, sir. Instead of by hearting, I can explain it much more simple also. Okay, first these points, rebate points. Rebate applies only to resident individual. Default regime, sir. Okay, resident individual. Total income should be within 12 lakhs. Okay, rebate amount 60,000 or tax payable, whichever is lower. Rebate not applies on special rate incomes like all this other than 111 income, all 112A, 112, 111A special rate income, then casual income, betting income, okay, on them rebate is not available. Then there is a concept of marginal relief for rebate also. Even for rebate also, sir, when surcharge applies, there is marginal relief concept. Even when rebate applies also, I mean up to 12 lakhs only rebate na, above 12 lakhs you are having total income, then also this marginal relief rebate concept applies. That means technically rebate applies even the total income is above 12 lakhs, nearer to that of, okay. So what are the steps, sir? Same marginal relief steps only, sir. In marginal relief, what we'll do? Step 1, we'll calculate tax on given total income. Here also same thing. Assume the total income is 12 lakh 50. Step 1, tax on given total income 67,500. Step 2, sir, in marginal relief, what we are doing? We are identifying the nearest surcharge limit. On nearest surcharge limit, we are calculating tax. Here, rebate related, na? So what is the rebate limit? 12 lakhs. So calculate tax on 12 lakhs. Sir, 12 lakhs, na 60,000, sir. Everybody will tell. But 12 lakhs, na rebate applies. How much is the rebate? 60,000. If you apply that, 0. Then step 3, difference between given total income and rebate limit. Given total income 12 lakh 50, rebate limit 12 lakhs. What is the difference? 50. Now obviously marginal relief, what? 1 minus 2 minus 3. 1 minus 2 minus 3. So this is what? The rebate relief. Rebate marginal relief. Sir, section call this marginal relief also as rebate only. But for you to understand, I am using the word marginal relief. But actually this also is called as what? Rebate only. Marginal relief rebate. Understand? Okay, for our convenience. How much? 7,500. So final tax is how much? Out from 67,500. If you subtract this rebate amount, 50,000. This is before cess. Same like marginal relief, sir. Step 4, we'll consider it as rebate only if it is positive. Negative number na will ignore. Okay, sir. This is an example to show that this kind of rebate applies. Marginal relief concept applies when the total income is up to 12,70,585. We even tested by calculating at 13 lakhs. See, 13 lakhs, what happened? Step 4 became negative, so not applies. Okay, so these are certain examples, sir, where see some basic points, sir. Majority students, okay, even in the recent Hyderabad EO batch I taken also, majority students, I'll ask this basic kind of questions and all. Okay, in this basic questions, what happening? Like the students, okay, when they're solving this kind of points and all, they'll give, okay, if there are 40 students in class, I'll ask each and every student to give an answer. Okay, you will not trust me, there will be minimum 10 different answers, even this kind of basic questions also. Okay, that means what? Sir, every student thinks like he is doing correct only, right? 10 different answers even in this basic questions also. So you are missing some minute points. These require extensive revision. So please be focused on it. Compute tax liability of Mr. Sanjay has the following incomes. Compute tax under both the regimes: house property, PGBP, 112A income, 111A income, lottery income, net of TDS. If any income given net of TDS, what we have to do, sir? Basic inter rule. Gross amounts we should take. 70,000 you cannot take. Okay. On lottery income, what is the TDS rate? 30%. So you should take 100%. Now then it is how much? 1 lakh. So, okay. So if you take house property, PGBP, capital gains, lottery income 1 lakh. What is the gross total income? 9 lakhs. Net total income also 9 lakhs. But out of this, which are normal rate, which are special rate? This 3 lakhs normal rate, 2 lakhs normal rate, capital gain both special rate, lottery income special rate. Okay, what I said, first we should compute tax on normal rate or special rate? Normal rate incomes. What are the normal rate incomes? 5 lakhs. On 5 lakhs, okay, what is the tax liability, sir? 5 lakhs. Okay, up to 4 lakhs nil. How much is there extra? 1 lakh is there. On 1 lakh, 5%, 5,000. Then special rate income, 112A. Sir, 112A, what is the tax rate? In excess of 1,25,000, taxable at 12.5%. So on 75,000, 12.5%, 9,375. 111A income, 1 lakh into 20%, 20,000. Lottery income, 1 lakh into 30,000. So how much? 64,375. Okay. Now everybody says like, sir, 64,375, 64,375. Who will look after rebate? Okay. Here what you have to check? Rebate also, because he's an individual. Sanjay. In nothing mentioned, na, he's resident only. Okay. So, sir, rebate not applies, na, sir. Why not? He is under default regime. Total income how much? 9 lakhs. Obviously rebate applies. Okay. Sir, how much rebate? Sir, rebate I remember, sir. Up to 12 lakhs rebate applicable. Rebate amount is tax payable are 60,000, whichever is lower. Here tax payable is 64,375. Now someone will shout like 60,000. Damn, okay. Okay. So understand here. rebate not applies on special rate incomes. So on this 3 rebate not applies. So that means only on this 5,000 rebate is applicable. So claim rebate, how much? 59,375. Okay, then some students will do this till here and say like, sir, this is the answer. Who will calculate cess? Cess at a rate of how much? 4%. 2,375. How much? 61,750. Not at done. Sir, TDS already deducted. So TDS amount subtract 30,000. So what is the final tax payable? 31,750. Question, when they ask final tax liability, you have to do this here. But majority are sugar patients only. Okay, they'll do it like, okay, till here they do correctly. Then from here on, okay, 10 different answers, 10 different chances of doing mistakes. Okay, there are some students where they do gross total income itself mistake, where they'll take 70,000 only here. That's one mistake. Here 112A, what they do, first 1,25,000 above 1,25,000 only taxable at 12.5. So they'll take that 1,25,000 as an exemption. Here they'll take only 75,000. That also a mistake. Okay, these two mistakes they'll do. Gross total income itself will be wrong, so they'll get different answers. Next, this calculation some people will do wrong. They are mistakes. Some people will do mistake of this rebate. Okay, rebate itself 2-3 versions of mistakes can be done. Okay, then rebate itself 2-3 mistakes can be done. Okay, and then some people will not add cess. Some people forget about TDS. So like this mistakes will be there. Okay, then the same ones are old regime also. Okay, old regime, if you do what, on 5,12,500, 112A, 111A, lottery 71,875. Now old regime, sir, rebate applies. Yes sir, previously applied. How much? 12,500. Again be cautious. What? Here total income 9 lakhs, rebate not applies in old regime, so no rebate. Okay, add cess, tax, subtract TDS, you'll get this. Okay, so now tax rates applicable to companies. Which regime? Old regime. Sir, understand sir, new regime is the default regime for individual HUF, AOP, BOI, AJP. For companies, new regimes are not default. Old regimes only default. For companies, old regime is only default. Okay, for companies, domestic company turnover in previous year 23-24. Sir, take it as like amendment 3, and this is a regular amendment. Every year this year changes. Turnover in previous year 23-24 is up to 400 crores, tax rate 25%. Above 400 crores turnover in 23-24, then it is like 30. So for domestic companies, what is the tax rate? 25%, 30%. What are the surcharge rates? Total income up to 1 crore, nil. 1 crore to 10 crores, 7%. Above 10 crores, 12%. Surcharge rates up to 1 crore, nil. 1 crore to 10 crores, 7%. Above 10 crores, 12%. Sir, this optional regime companies related I am not discussing here, because in assessment of companies, in this part only, okay, the last chapter, okay, you will find assessment of companies. There you will get this more detailedly. Okay, foreign company, the tax rate is how much? 35%. Surcharge rates, total income up to 1 crore, nil. 1 crore to 10 crore, 2%. Above 10 crores, 5%. Sir, even for companies also marginal relief concept applies. Same steps. Okay, then tax rates applicable to cooperative societies. Cooperative society total income up to 10,000, 10%. 10,000 to 20,000, 20%. Above 20,000, 30%. Up to 10,000, 10%. 10,000 to 20,000, 20%. Above 20,000, 30%. Surcharge rates up to 1 crore, nil. 1 crore to 10 crores, 7%. Above 10 crores, 12%. Surcharge rates up to 1 crore, nil. 1 crore to 10 crores, 7%. Above 10 crores, 12%. Optional regime. 115 BAD. What? When a resident cooperative society other than that opted 115 BAE, the tax rate is 22%. 115 BAD, 115 BAE. Two optional regimes are there for cooperative societies. 115 BAD na 22, 115 BAE na 15%. Sir, 115 BAE applies only to cooperative societies which are manufacturing, registered on or after 1st April 2023, business started before 31st March 2024. Such charge is like 10% fixed. Okay, then tax rates applicable to firm including LLP and local authorities. Tax rate how much? 30%. Surcharge rates are up to 1 crore, nil. Above 1 crore, 12%. Above 1 crore, 12%. Cess for everyone on tax liability. Cess is what? 4%. Rounding off. 288A, 288B. What does it say? Total income and tax payable both has to be rounded off to nearest multiples of rupees 10. What is nearest multiple? Let's say 423, 420, 428, 430, 425 also 430. Then this point is relevant while calculating 234 ABC interest. While calculating 234 ABC interest, Sir, what is 234A BC interest? If return is filed delayedly, 234A interest. If there is like advance tax not paid in time, then 234B and C interest. Okay. So there, what does it says? For that interest calculation, whatever is the tax due, the tax due has to be taken only in hundreds. Okay. If any fractions are there, ignore. Okay. It's not rounding up, sir. You should take them only in like hundreds only. Okay. That units place, tens place, ignore. 423, take it as 400. 480, take it as 400. 450, take it as 400 only. Okay. Then maximum amount not chargeable to tax. What is maximum amount not chargeable to tax? Nothing but the basic exemption limits. Until then, till that amount limit is reached, there won't be tax rate. So that is called as maximum amount not chargeable to tax. Okay. In new regime, sir, for all these people like individual HUF, AOP, BOI, AJP, resident, non-resident, senior citizen, super senior citizen, always like 4 lakhs. But in old regime, for individual HUF, AOP, BOI, AJP, in general 2 lakh 50. Individual senior citizen plus resident 3 lakhs. Individual super senior citizen plus resident 5 lakhs. Then, sir, unexhausted basic exemption limit. This is from capital gain, sir, but a basic point, that's why I brought here. Unexhausted basic exemption limit. This concept applies for resident individual and HUF. Sir, rebate for only resident individual, but unexhausted basic exemption limit applies to resident individual and HUF. Has income chargeable to tax under section 111A, 112 and then 112A. From the basic exemption limit available, what you should do? Adjust the incomes taxable at normal rates. From the basic exemption limit available, adjust the incomes taxable at normal rates. After adjusting them, if any balance is there in basic exemption limit, that's called unexhausted basic exemption limit. Understand, sir? See, look at this example, sir. Okay, you'll understand much more better through example. Pravilka, 45 age, has following incomes. Pension 2 lakh 40, assume salary 2 lakh 40, interest 1 lakh, long-term capital gain under 112, 2 lakhs. Sir, what are normal rate taxable income? Normal rate salary, interest normal rate, long-term capital gain special rate. Okay. What is the gross total income, sir? 3 lakh 40, 5 lakh 40 total. But normal rate incomes total, if you take how much? 3.4 lakhs only, 3 lakh 40. First, this normal rate incomes related, sir. What is the basic exemption limit? 4 lakhs. Slab rate up to 4 lakhs. From their income only is how much is there, sir? Normal rate taxable income 3 lakh 40. After adjusting that, still you have 60,000 in your basic exemption limit, which was unused. Okay, you not even used. You have 60,000 in your basic exemption limit. That's called unexhausted basic exemption limit. Now, what does this provision says like? If SSC is resident individual or HUF, with this unexhausted basic exemption limit, special rate capital gain incomes like 112A, 112, 111, these three incomes, 112A, 112, 111A, 111A, these three incomes can be adjusted. Sir, why not 111? Sir, while 111 is normal income only, directly it gets adjusted with the basic exemption limit. That's why special rate incomes under capital gains alone can be adjusted here. So see, long-term capital gain 2 lakhs na, from there adjust unexhausted basic exemption limit. You'll have 1 lakh 40 into 12.5, 17,500. There won't be any rebate, cessation rate of 4%. Okay. Capital receipts, simple, sir. When on house, you'll regularly get rental income, which we call it as revenue receipt. If you sell this house itself, you'll get capital gains, which we call it as what? Capital receipts. Okay. Then this point, sir. Usually, previous year income is assessed to tax in assessment year. I mean, if you have income in previous year, that is taxable, the tax computations will be made in assessment year. But there are some exceptions. First one is what? Non-resident engaged in shipping business. He is a non-resident engaged in shipping business. Then, person leaving India for employment outside India. Then, AOP, BOI, AJP formed for a purpose and such purpose is accomplished or such event is completed. Person trying to dispose or pledge property to avoid tax. Then also previous year income will be assessed in the previous year itself. And then discontinued businesses. So all these cases, sir, if they delay the assessment till next year, the government may lose revenue. That's why they won't wait till next year. Previous year income will be assessed to tax in the previous year itself. Maximum marginal rate. What is MMR? Take the highest tax rate applicable. On that, apply the highest surcharge rate applicable. Apply cess. Default, sir. 30% is the tax rate highest. Surcharge rate highest is 25%. On that cess 4%. Total 39. Sir, how can 30 plus 25, 55 plus 4, 59, sir? Don't you know basic max, sir? Okay. Don't act like that. So on tax, how much? 30. On tax, you have to apply surcharge 25%. So on 30%, you apply 25% and then add. Not straight away like this. Okay. Old resin. Tax 30%, surcharge rate 37%, cess 4%. Okay. Fine, na sir. Then surcharge rates. That restrictions I said, na sir. This is important, sir. Sir, if you remember default regime, the surcharge rates are like how much? Up to 50 lakhs, nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 50 lakhs to up to 50 lakhs, nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. Above 2 crores, 25. But there at 25%, there is a restriction. What does the restriction says like? The restriction says like, okay, the restriction says like on capital gains 112A, 112, 111A and on dividend income. 4, sir. What are those 4? Capital gain under 112, 112A, 111 and then dividend income. On this 4, the surcharge rate is restricted to 15% only. Okay. Sir, in old regime, what are the surcharge rates? Up to 50 lakhs, nil. 50 lakhs to 1 crore, 10%. 1 crore to 2 crores, 15%. 2 crores to 5 crores, 25%. Above 5 crores, 37%. Right. Now, what does this provision here says like? It says means 25 and 37 are there na? At those places, the surcharge rate on these 4 incomes. What are those 4? 112A, 112, 111A, dividend income. On this 4, it is restricted to 15%. Sir, simple only, sir. Why you thought? Why you delayed here? No, there is one more thing, sir. Understand. However, if because of dividend and special incomes only, okay, if because of dividend and special incomes only, the total income pushed to higher slab of surcharge, then surcharge rate on other incomes would be the rate that applies if no dividend on special rate income. Sir, understand? Sir, if there is no these 4 kind of incomes, you might be at a lower surcharge limit. But because of these incomes, the other incomes were pushed to higher surcharge rate. But these incomes are enjoying a lower surcharge rate. See, understand, sir? See, case 1, if you see. Okay, look at case 1. So look at this example. What's happening, sir? So dividend 120 lakhs, special income 100 lakhs, other income 210. So total how much? 430 lakhs. Okay. So now here what is happening? Other income already 210 lakhs. That means on other income also more than 2 crores. Na? So the surcharge rate is how much? 25%. Okay, even though there is no dividend income, special income also, still it is taxable at, still the surcharge rate applicable is how much? 25%. So because of dividend and special income, there is no push under. Okay, so now what happens? Total 430, 25. If there is no dividend and special income also, 25 only. So on this other income related tax, on that apply 25% surcharge rate. On these 2 dividend and 112 incomes related, on the tax you apply 15% surcharge. Now come to case 2. Dividend 70, special income 150, total how much? 220. Whereas other income, if you see 110, what? 1.1 crore. Sir, 1 crore to 2 crores, what is the surcharge rate? 15% only. Okay, so if there are no this dividend and special income, this would have been taxed, and on the tax only 15% surcharge only will be there. But because of these 2 incomes, the total income became 330. If total income is 330 lakhs, 2 to 5 crores, surcharge rate is how much? 25%. So because of these 2 incomes, this other income was pushed to higher surcharge rate and it's getting penalized because of the other 2. Okay, but the other 2 are enjoying a lower surcharge rate of 15% only. So that's why it is injustice. So what the provision says, okay, because of these 2 only you have been pushed, right? And these 2 already enjoying again 15% only. So that's why on this 110 lakhs related tax also 15% only applies. Case 3. These 220. Other income how much, sir? 60. If there are not there these 2 incomes, then how much is the surcharge that would be applicable? 50 to 1 crore, 10% only. Okay, because of this 2 only, it was pushed to 25%, from 10 to 25% surcharge rate. So if these 2 are not there, 10. So now this other income cannot say like, sir, I will also, for me, if these 2 are not there, 10% only applicable, so I'll apply only 10%. That's not correct, sir. Minimum 15% applies. Why? Because the total income exceeded 1 crore. But because of other incomes, okay, since these other incomes are getting 15%, whereas, this dividend and special incomes are enjoying 15%, the other income, which was pushed to higher because of these 2, okay, may get taxed at a higher rate. So to avoid that case and all, what is the provision says? If only because of special rate incomes like 111A, 112A, 112 and dividend income, the other incomes were pushed to higher surcharge rate, then the other income also, the surcharge rate would be only that rate if only those incomes are available. I mean, in simple, sir, if no, these four incomes are there, like dividend, special rate incomes, three. If these four are not there, how much surcharge rate applies on the other income? That surcharge rate only has to be applied, provided minimum 15% applies when it exceeds 1 crore. So you cannot come down beyond 15%. Okay, but if it is more than 15%, like 25 and 37, then this restriction is applicable. See here, sir, only if it is there 60 lakhs, that means 10 only applicable now, but still we are applying how much? 15%. Here 110, originally also how much? Originally 15, but the total income 330. I mean, this 110, 15% one is pushed to 25, but still how much? 15 only. Okay, here 60, only 60, that means originally it should be at what rate? 10%. Total 280. I mean, 10% one pushed to 25. Okay, but 25 you cannot again restrict to 10%, sir. Minimum restriction how much? 15%. This two in old regime. Okay, then undisclosed income. If you have any undisclosed incomes like cash credits, unexplained investments, unexplained money, bullion, jewelry, unexplained expenditure, amount of investment not fully disclosed in books of accounts, amount borrowed or repaid through hundi. Okay, for this, when they are called as unexplained, sir, you have these cash credits, investments, expenditure. For that, SSE offers no explanation, or the explanation provided by SSE is not satisfactory to AO. Then the tax rate is like how much? Tax 60%, surcharge fixed at 25, cess 4%, overall 78%. Average rate of tax. How do you calculate, sir? Tax payable including cess divided by total income into 100. Then tax on other incomes. Okay, so this is what we already calculated. Then old versus default, sir, certain points I want to highlight. Okay, what are those? Sir, these exemptions are only available in old regime. What are those? HRA exemption, leave travel concession, children education allowance, children hostel fee allowance, travel allowance for disabled. Okay, these 5 exemptions are available only in old regime. Default regime, these are not available. Then standard deduction. In old regime, it is only 50,000, whereas in new regime, it is 75,000. These are like related to salaries chapter. Then house property. Sir, house property and till NAV calculation, no difference. Old regime or new regime, till NAV. From NAV, in old regime, 30% standard deduction, new regime also 30% standard deduction. Then what? 24B, interest also eligible for deduction. With respect to that interest, there are certain differences. See, old regime, self-occupied property also eligible for interest deduction up to 2 lakhs. Let out property, no limit. Okay, old regime, sir, self-occupied 2 lakhs. Let out property, no limit. How much our interest itself, it can be claimed as deduction. Then in default regime or new regime, sir, interest related, self-occupied property, you can't even claim anything as deduction. No deduction at all. Let out property, no limit here also. So let out, no change. Old, new. But self-occupied property, old regime up to 2 lakhs interest eligible for deduction. New regime, nothing is available. Sir, important points are these are like in DTA chapter, and then in tax planning chapters, these are like carry forward and set off of house property loss. Usually, sir, house property loss, first you do intra-head set off, then you'll do inter-head with other heads also set off. House property loss can be set off with any other head income except with casual incomes. With any other head income, you can set off, but maximum of 2 lakhs. This is where old regime. But in default regime, new regime, house property loss is eligible for set off only intra-head, only intra-head. Inter-head set off is not possible. I mean, house property loss is not eligible for set off with other heads. Carry forward of loss, same, ADS. PGBP and capital gains, sir. Capital gains, there won't be any differences. PGBP differences in the next chapters like PGBP and assessment of companies, I'll discuss this. IFO is related. Family pension related is the only difference. With respect to family pension means what? Employee expire, his widow or children, disabled children if any are there, they are getting pension. Then it's called what? Family pension, taxable under IFO is it. Old regime, sir, the deduction available is 15,000 or actual pension, whichever is lower. I mean, that can be. Sir, deductions. Chapter 6A deductions. What does deductions chapter says? Like, aggregate of all the deductions shall not exceed gross total income. I mean, your total deductions cannot exceed gross total income. The next point. Chapter 6A deductions cannot be claimed from 112A, 111, 112 special rate income. So, deductions are eligible to be availed only on normal rate incomes, not on special rate income. See, Here long-term capital gain 3 lakhs, 112A 1 lakh 50, lottery income 1 lakh, salary 2 lakh 50, overall 8 lakhs. But here if you see, these two long-term and lottery income are special rate income. So on this you cannot claim deductions. Only to the extent of salary you can claim deductions. Here you have total deductions up to 8 lakh 20, but you can claim only to the extent of 2 lakh 50 normal rate income only. So the net total income becomes 5 lakh 50,000. Then the following deductions can be availed only when the return of income is filed on or before the due date. What are those? ET, I series, JJA, JJAA, LA, M, P, QQB, RRB. These deductions you can claim only when the return of income is filed within the due date. Audit reports, sir. Actually, audit report has to be filed 1 month before the due date. So, audit report may be filed belatedly, but return has to be filed within the due date. Then, ATCC. What does ATCC says? Like the total deductions that can be claimed under ATC, CCC, CCD subsection 1. All these three together cannot exceed 1,50,000. The total deductions that could be claimed under ATC, CCC, CCD subsection 1 cannot exceed 1,50,000. Now ATC. Sir, ATC deduction is available only to individuals and HF. Who? Individuals and HF. First one, life insurance premium paid. Life insurance premium paid is eligible for deduction to individual HF. Premium may be paid by individual for himself, spouse, and children. Himself, spouse, children. HF for the purpose of any member. Okay. How much is eligible? When the policy is issued before 31st March 2012, up to 31st March 2012, then the deduction is like sum insured into 20% or actual premium paid, whichever is lower. If the policy taken on or after 1st April 2012, premium paid or 10% of the sum insured, whichever is lower. If the policy is taken from 1st April 2013 and assessee is a disabled person, then the deduction is like premium paid or 15% of sum insured, whichever is lower. Then contribution to unit linked insurance plan, deferred annuity. Then this one important, sir, again. Employee's contribution to PPF, SPF, RPF. If employee contributes to his provident funds like PPF, SPF, RPF, those are eligible for deduction. But understand, for PPF contributions, deduction available to both individual and HF. HF may contribution for the benefit of any member. Individual may contribute for the benefit of himself, spouse, and even children. Contribution to superannuity fund, contribution to Sukanya Samriddhi account, subscription to National Savings Certificate, contribution to any annuity plan of LIC, contribution to notified fund units of mutual fund. Then again, this is important, sir. Payment of tuition fee. Sir, what is tuition fee? When any school fee, college fee is being paid, out of that, education related whatever is the fee paid. Like building funds paid, uniform fee, van fee, school bus related, those are excluded. Only for education, how much ever is the fee paid to university, college or school. It should be a full-time education in India. Up to 2 children, the deduction can be availed. Then housing loan related. Sir, housing loan related interest repaid na. That interest can be availed as deduction under house property head only. 24B. Okay. But here what? Principal is being repaid. Such principal is also eligible for deduction repaid if it is taken from government, bank, society, LIC or from a government employer. Subscription to certain equity shares and debentures. Investment in 5-year term deposits. Subscription to notified bonds of NABARD. Contribution to National Housing Bank term deposit. Investment in 5-year post office time deposit. Deposit in senior citizen savings rules. All these are eligible for ATC deductions. Now, you want important points, right? LIC. Contribution to LIC. 1st April 2012, before policy has been taken. Premium paid or 20% of the sum insured, whichever is lower. On or after 1st April 2012, premium paid or 10% of the sum insured, whichever is lower. From 1st April 2013, if he is disabled, premium paid or 15% of the sum insured, whichever is lower. So understand, LIC premium by individual should have been paid for himself, spouse, children, not for parents. Okay. Then contribution to PPF, SPF, RPF. Then repayment of housing loan, payment of tuition fee in a university, college, school, that one, fourth one. Contribution to Sukanya Samriddhi account, subscription to bonds of NABARD, 5-year term deposits, 5-year post office savings deposits. These are certain important points which are eligible for ATC deduction. Then ATCCC, contribution to pension fund of LIC. If any contribution is made to pension fund of LIC, eligible SSC is like individual, maximum deduction is like 1,50,000. Then important one, sir. 80CCD. Sir, 80CCD is about contribution to NPS. Contribution to what? NPS, National Pension Scheme or Pension Scheme. Here three sections are there. 80CCD subsection 1, 1B, 80CCD subsection 2. What? 80CCD subsection 1, 1B, 80CCD subsection 2. 1 and 1B are related to employees' contribution. 2 is related to employer's contribution. Okay, first employees' contribution. Sir, employee contributed to NPS. How much is eligible for deduction? See, SSC salaried employee, actual contribution or 10% of salary, whichever is lower. How much, sir? Actual amount contributed or 10% of salary. What is salary? Salary means basic plus DA forming part. Basic plus DA forming part, whichever is lower. If SSC is others, then others now like self-employed under. Then actual or 20% of gross total income, whichever is lower is eligible for deduction. So 80CCD 1. How much, sir? Employees contribution to NPS. How much? Actual amount contributed or 10% of salary. Employee self-employed, actual or 20% of gross total income, whichever is lower. Salary means basic plus DA forming part. Sir, 80C, CCC, CCD subsection 1. 3 sections are there. But all the 3 sections together, there is a cap. 80CCE. How much? 1,50,000. Sir, this many investments you said, sir. But overall deduction is how much? 1,50,000 only. That's why if any amount that couldn't be claimed as deduction under 80CCD 1, you contributed to NPS, but that couldn't be claimed as deduction under 80CCD 1. Why? Because of this percentage cap, like 10%, or because of exceeding that 1,50,000 limit, then the additional amount, that excess amount can be claimed as deduction under 80CCD 1B up to 50,000. Up to 50,000. See, sir, salary here 25 lakhs. Contribution is how much? 1,80,000. So what is the deduction, sir? Salary 25 lakhs into 10%, 2,50,000. Contribution 1,80,000. Whichever is lower, na 1,80,000 is allowed. But actually contributed 2,50,000. How much allowed, sir? 1,80,000. Now understand, sir. Here they can claim only 1.5 lakhs because of 80CCA. Balance 30 lakhs not able to claim as deduction. That can be claimed as deduction under 80CCD 1B. Okay. Then here, salary 10 lakhs. Contribution to NPS is how much? 1,30,000. So 1,30,000 or 1 lakh, whichever is lower now, only 1 lakh allowed. The other 30,000 contributed, but still can't be availed as deduction because of what? Because of the percentage cap. So because of percentage cap or 1.5 lakhs cap, if an amount cannot be availed as deduction under 80CCD subsection 1, then the excess amount, here 30,000, here, okay, how much, sir? This 30,000 can be claimed as deduction under 80CCD 1B, where deduction under 80CCD subsection 1 is restricted because of 1.5 lakhs cap or percentage cap, that can be claimed under 80CCD 1B. Okay, then there is an amendment here, sir, important. Under 80CCD 1B, amount deposited for minor benefit under NPS Vatsalya to the maximum of rupees 50,000. Okay, how much, sir? Amount deposited for minor benefit under NPS Vatsalya to a maximum of 50,000 by parent or guardian, that also can be availed as deduction under 80CCD 1B. What is the amendment, sir? Previously, under 80CCD 1B, only contribution to NPS, which can't be claimed under 80CCD 1, can be claimed under 1B. Now extra under 1B, one more point also added. What? Amount contributed to NPS under NPS Vatsalya account. Now 80CCD subsection 2, employer contribution. Sir, employer contribution is also eligible for deduction. But old regime or new regime? Sir, in old regime, government employer, non-government employer. Government employer, actual or 14% of salary. Other than government employer, actual or 10% of salary is only allowed as deduction. Actual or 14% of salary, actual or 10% of salary. Whereas in new regime, sir, new regime, I mean 115 BAC, new regime, actual or 14% of salary, whichever is lower, allowed as deduction. No 1.5 lakh cap, sir. Only percentage cap for employer contribution. So understand, employer contributed is also eligible for deduction. Old regime, government employer, actual or 14% of salary, whichever is lower. Other than government employer, actual or 10% of salary, whichever is lower. Then new regime, actual or 14% of salary, whichever is lower, eligible for deduction, irrespective of government employer or non-government employer. Sir, did I mention about new regime in ATC, ATCCC, CCD subsection 1 and all? No. Sir, only under ATCCD subsection 2. Out of all the deductions we discussed, only under ATCCD subsection 2 deduction available even in the new regime. Okay. Then contribution to Agnipath scheme. Agnipath scheme. Who are Agnipath scheme means to Agniveers, army people. Okay. So to Agnipath scheme, either that army people being individual contributes eligible for deduction, employer central government contributes that also eligible for deduction, and that is available in both the regimes. So 80 subsection 2, 80 subsection 2, both these two sections are available under old regime as well as under default regime. Which two, sir? 80 subsection 2, 80 subsection 2, these two available in both default regime and even in the old regime. Then 80D, deduction in respect of medical insurance premium paid or contribution to National Health Scheme. Who is eligible as a C? Individual or HEF. The donation is, the premium is paid for the benefit of himself, spouse, child, parents also. Individual, spouse, individual for himself, medical insurance premium, spouse, child, parents also. Life insurance premium does not cover parents, but here parents also. HEF, any member. What is the deduction? For individual, spouse, children, one limit, parents, another limit. So two limits are available. How much, sir? For individual, spouse, child, maximum deduction available is 25,000. That means premium paid or 25,000, whichever is lower. For parents also, premium paid or 25,000, whichever is lower, eligible for deduction. However, if either parent or in his family, like he or his spouse, any of them are like senior citizens, then the deduction available is like 50,000 instead of 25,000. So normally how much? 25,000 for his family, parents another 25,000. If senior citizens, then it is like instead of 25, we need to take it as like 50 and 50. Okay. However, if senior citizen is non-resident, then the deduction is only 25,000. Then amount spent on preventive health checkup. Even the amount spent on preventive health checkup is also eligible for deduction to an extent of 5,000 for him and family, parents another 5,000. Now the point is, sir, this 5,000 extra in excess of 25,000 and 50,000? No, this 5,000 is not additional limit. It is within 25,000 and 50 only, a sublimit. Okay. Mode of payment. The payment has to be made in any mode other than cash. However, for preventive health checkup, it could be paid even in cash. Then premium paid in lump sum. If the premium is paid in lump sum, what to be done? Take the total premium paid, divided it by number of previous years to which the premium is related, divide it. Okay, then you'll get what? Lump sum premium, you divided by number of years, you'll get yearly premium. That premium or the limit 25 or 50, whichever applies, whichever is lower can be claimed as deduction. Then for senior citizens who are not able to get medical insurance up to rupees 50,000, actual medical expenditure also can be claimed as deduction. Then 80DD, medical treatment for a disabled. Eligible SSC is resident individual. Okay, medical treatment of disabled. Sir, disabled related two sections are there, 80DD, 80U. If SSC himself is disabled, claim deduction under 80U. If SSC is fine, but is dependent na spouse, child, parents, brothers and sisters, if any of them are disabled and dependent, then 80DD. So disabled person, he himself want to claim deduction, 80U. No, he is not working anything, sir, he is dependent on someone. Then that SSC on whom he is dependent, okay, that person can claim deduction under 80DD. Okay, the payment may be made for medical treatment or even for insurance for maintenance of dependent disabled. Deduction amount is how much? 75,000 or 1,25,000. 75,000 in case of disability, 1,25,000 in case of severe disability. Okay, understood, na sir? But understand, sir, for 1% disability, deduction can't be claimed under both 80U and 80DD. At only one place deduction is available. Then 80DDB, deduction in respect of medical treatment of specified diseases. What are specified diseases? Which are like chronic in nature. I mean, which can't be cured in like 10 days, 15 days, chronic in nature. Then, for eligible SSE, who is eligible SSE, sir? Same. Sir, for disabled person, SSE himself disabled na 80U. Dependent disabled na 80DD. But for specified disease and all, okay, even SSE is suffering with specified disease or dependent suffering, only one section, 80DDB. Eligible SSE, resident individual, himself, spouse, child, parents, brothers and sisters. Resident HUF, any member. Deduction is how much? Other than senior citizen, 40,000 or actual, whichever is lower. Senior citizen, then 1 lakh or actual, whichever is lower. Then 80E, deduction on loan taken for higher studies. Sir, understand. Loan taken for what? Higher studies. Who is eligible SSE? Individual. Loan taken for higher studies. Whose higher studies? Higher studies of himself, spouse, children, or children to whom SSE is acting as a legal guardian. Loan for whom, sir? Himself, spouse, children, and children to whom he is acting as a legal guardian. Higher studies means what? About 12th. Loan should be taken from charitable institutions, financial institutions. Okay. Then the interest paid is eligible for deduction. How long, sir? The initial year in which interest starts accrues plus 7 years, the interest is eligible for deduction. No limit at all. Then 80EE and 80EAA. Both these are related to house properties only, sir. 80EE, who is eligible? Individual. The deduction is up to 50,000. What are the conditions? Loan taken in financial year 16-17 from bank financial institution. Purchase price of the building is within 50 lakhs. Loan amount is less than 35 lakhs. What are the conditions, sir? Up to 50,000 to an individual. Loan taken in 16-17 from bank financial institutions. Purchase price is within 50 lakhs. Loan amount also within 35 lakhs. 80EA. Deduction available to individual up to rupees 1,50,000. Loan is from financial year taken in financial year 1920, 2021, 21, 22. Loan from banks, financial institutions. Stamp duty value is less than 45 lakhs. And then, sir, EE how much, sir? Up to 50,000. EAA up to 1,50,000. You might have a question. Sir, interest on house property already eligible for deduction under house property head 24B na, sir? Yes, that is eligible. How much is eligible, sir? Sir, let out property na no limit, sir. How much ever it can be availed as deduction. So for let out property, there is no need of 80E and EAA. Sir, self-occupied property, there maximum up to 2 lakhs only can be claimed as deduction. But the interest is in excess of 2 lakhs. So up to 2 lakhs claim under house property head only. Balance you can claim as deduction here if the conditions are satisfied. EE 50,000 only, EAA 1,50,000. What are the conditions, sir? Here loan in 16-17, here 19-20, 21-22. Okay, bank financial institution, bank financial institution. Here purchase price within 50 lakhs, here stamp duty value within 45 lakhs. And then under both these sections, sir, SSE should not own any other residential house property on the date of sanction of loan. If he owns any other house property, then he is not eligible for this deduction. 80EEB, interest on loan taken for purchase of electric vehicle. Eligible SSE individual. Deduction 1,50,000 or actual interest, whichever is lower. What are the conditions, sir? Sir, you purchased electric vehicle. On the purchase of electric vehicle, interest is there. Such interest eligible for deduction to individual. How much? 1,50,000 or actual interest, whichever is lower. But the vehicle should be purchased within 1st April 2019 to 31st March 2023. Loan sanction from financial institution. Then 80G, sir. Sir, 80G, there are 4 categories. Category 1, Category 2, Category 3, Category 4. What is 80G? Some donations are made to certain funds and charitable institutions. Those are eligible for deduction. Category 1, Category 2, Category 3, Category 4. If you make donation under a fund which is mentioned in Category 1, 100% of the amount contributed is eligible for deduction. You contributed to Category 2 fund, 50% of the amount contributed is eligible for deduction. You contributed to Category 3, 100% eligible for deduction, subject to qualifying limit. Subject to qualifying limit. 100%, but subject to qualifying limit. Category 4, then 50% of the amount contributed, subject to qualifying limit. 50% of the amount contributed, subject to qualifying limit. See, Category 1, 100% of the amount contributed. Category 2, 50% of the amount contributed. Category 3, 100% subject to qualifying limit. Category 4, 50% of the amount contributed, subject to qualifying limit. Now the important thing is like which covers under category 1, which covers under category 2, category 3, category 4. Category 4, sir, PM relief funds, Clean Ganga Fund, Swachh Bharat Fund, Army Defense related fund, if any National Development Fund is there, National Children Fund is there, if any like disaster related, earthquake, cyclones, those related if any funds are created, all those are in category 1. Sir, category 1 is a big list. We cannot remember. So I am giving you just hints. PM Relief Fund, Swachh Ganga, Clean Ganga Fund, Swachh Bharat Kosh, Army Defense related, National Development related, National Children Fund, okay, any cyclone disaster related, that is covered under category 1. Category 2, only one fund is there, sir, PM Drought Relief Fund. Category 2, only one fund is there, PM Drought Relief Fund. Category 3, what are there? 2, sir, government or local authority for promotion of family planning or donation by companies to Olympic Association or Sports Authority. Donation to whom, sir? Olympic Association or Sports Authority. Then category 4, it may be for charity, renovation of temples or protection of minority interests. Charity, renovation of temples and then protection of minority interests. Okay, so what is the category 3, sir? 100% of amount contributed. Category 4, 50% of the amount contributed. Okay, so ETG deduction is available to every SSE, sir. However, deductions if they are made in other than cash, okay, more than donations in kind, not allowed. I mean, if you do donations in the form of other than cash, not allowed. Even in cash also, up to 2000 only allowed. About 2000, it should be paid through account pay check or check draft and all, not through cash. Okay. Then what is qualifying limit, sir? Qualifying limit is like 10% of adjusted total income. Sir, how to calculate adjusted total income? Take gross total income. From there subtract capital gains 112A, 112, 111A. Then all other chapter 68 deductions except ATG and even exempted income under 10AA. Subtract all this, you will get adjusted total income. From this adjusted total income, multiply 10%, you will get qualifying limit. Okay. Now, sir, deduction under category 4. Sir, what we thought deduction under category 4? 50% of amount contributed, right? But there is a question. There is a little litigation here. See, qualifying limit is how much? 3 lakhs. The 10% of adjusted gross total income straight away calculated 3 lakhs. Then amount contributed to government for promotion of family planning. Category 3. It's okay. 2 lakhs. First avail this. After availing this, sir, they even had contribution to temple for renovation. Category 4. So out of qualifying limit, first claim category 3. How much balance is there? 1 lakh. So what do you think? Qualifying limit 1 lakh is there. Amount contributed 2 lakhs into 50% now. 1 lakh you think as deduction? No. Deduction under ATG is like category 3. First avail. Category 4. How much is there, sir? Amount contributed into 50%. 2 lakhs into 50%. 1 lakh. Next point. Balance in qualifying limit. You cannot straight away take amount contributed into 50%. You should multiply 50% with amount contributed into 50% and even balance in qualifying limit into 50%. Out of these two, whichever is lower only eligible for deduction. See here. Deduction under category 4, amount contributed into 50% or qualifying limit minus category 3 deductions into 50%, whichever is lower. Then 80GG, deduction with respect to rent paid. If any rent paid, that is eligible for deduction. Whom, sir? Eligible SSE individual not receiving HRA. Deduction amount is how much? Actual rent minus 10% of adjusted total income, 25% of adjusted total income, rupees 5,000 per month, whichever is lower. Adjusted gross total income. You should take gross total income minus capital gains, chapter 68 deductions. You will get that. Based on that, you have to calculate. What are the conditions? Accommodation occupied by SSE, spouse or minor children or HF shall not own any other accommodation and should file a declaration that he has actually paid rent. Then, donation for scientific research or rural development. Any SSE who does not have a PGBP income. Sir, PGBP income if he is having, then he'll avail deduction under 80GGA only. Okay, sorry. If he is having PGBP income, then for scientific research and rural development, within the PGBP head only he can avail deduction. Okay, that's why again here not available. So SSE does not have PGBP, then he can claim 80 GGA deduction. And the contributions are made for scientific research or rural development. How much? 100% of the amount donated. Condition: more than 2000 amount, it should be paid in any mode other than cash. Up to 2000, even cash also eligible. About 2000, it should be paid in other than cash. 80 GGB, companies contributing to political parties. Eligible SSE is whom? Indian company. Deduction is how much? 100% of the amount contributed to effect public support to political party or any expenditure incurred on advertisement to political party. Directly you contributed to political party, that also eligible. Expenditure incurred on advertisement to political party, that also eligible. Okay, condition: the contribution should be other than cash. Sir, GGB is for whom, sir? Companies. Then 80 GGC, deduction in respect of contribution given by any person. Deduction in respect of contribution by any person to political party or electoral trust. Eligible SSE is whom? Any person other than domestic company. Deduction: 100% of the amount contributed. 100% of the amount contributed. If any expenditure incurred on advertisement to political party, not available under 80 GGC, but available under 80 GGB. GGB, I mean for companies, even advertisement related also eligible. For other than companies, advertisement related not eligible. Okay, sir. So then 80 JJA deduction. 80 JJA deduction is with respect to profits and gains from business of collecting biodegradable waste. Sir, this person, any person, he collects biodegradable waste and process them. By processing them, they generate power or produce biofertilizers, biogas, fuel for organic manure. Sir, they will collect the waste and from the waste they generate power, fertilizers, gas and all. How useful it is for the country, environment and all. That's why to encourage this business, 100% of their profits are eligible for deduction. How long? 5 consecutive assessment years starting from the year business has been commenced. Then 80 JJA, deduction with respect to additional employee cost. Sir, to encourage business people to hire more people, this additional employee cost deduction is available. SSE engaged in business plus for him tax audit is applicable. Those people are eligible. What is the deduction? 30% of additional employee cost. How much ever additional employee cost they incur, out of them 30% they can claim as deduction here for a period of 3 assessment year. See, what is additional employee cost? Additional employee cost means total emoluments paid to employees, to the additional employees. Emoluments means it could be salary, allowances, perquisites paid to the additional employees. So here there should be an overall increase. What does it mean by overall increase? In a year, if 100 employees are hired and 70 employees left, then you cannot say like 100 employees are the new employees. No. Overall increase is how much? 30 only. See, year beginning 500 are there. Okay, then during the year 100 people joined, but 120 left. Closing 480. So there is no overall increase. So here there is no additional employee cost. So additional employee cost means what? There should be an overall increase of employees on last day. Then there are certain conditions, sir. So here in indirect way the conditions are there. I'll tell it in direct way. If any employee total emoluments, I mean salary allowances are more than or equal to 25,000, he is ineligible. Okay, he is ineligible. Okay, more than 25,000 ineligible. Not participating in PF, ineligible. Worked for less than 240 days. If it is like footwear, apparel, leather industry less than 150 days, then they are ineligible. Salary paid in any mode, salary paid in cash, then also they are ineligible. Who are ineligible, sir? Salary more than 25,000. Not participating in PF, employed for less than 240 days, footwear, apparel, leather industries less than 150 days, salary paid in cash. So these people are not eligible for 80 JJAA deduction. Then 80 LA, deduction in respect of income of offshore banking units and IFSC. IFSC means what? International Finance Service Center. We have only one thing, one IFSC, that also in Gujarat. We call it as Gift City. Eligible SSC, scheduled bank having an offshore unit in SEZ. Sir, bank has a unit in SEZ. Foreign bank has a unit in SEZ. Unit of an IFSC. So these are eligible for a deduction. How long? Scheduled bank and foreign bank 100% of profits and gains for 10 assessment years from offshore unit. From that offshore unit, whatever the profit they get, 100% is eligible for 10 assessment years. If it is a unit of IFSC, 100% of their income, okay, for 10 assessment years eligible. Then there is one more point, sir, newly amended. Transfer of an aircraft ship leased by a unit in IFSC and such unit has commenced operation up to 31st March 2030, that also eligible. Sir, most of the airline companies will not buy aircrafts, they'll take it on lease. Ireland is one country where more these companies are there, where they buy aircrafts and they lease them. Okay, now to bring them to India and to make sure more accessible, those companies came and started their business in this IFSCs. Okay, international finance service centers. Okay, these are more like SEZ areas but related to finance sector. Okay, so what they did, they have aircrafts, ships. Okay, so they have transfer of an aircraft ship leased by a unit in IFSC, so they have been leasing them. Through that they are earning income. Such income is eligible for deduction for 10 years out of 15 years, and they should have commenced operation up to 31st March 2030. So this date is extended. ATM, deduction in respect of intercorporate dividend. A company receives dividend, pays dividend. Then dividend received, okay, gross dividend minus expenses. That means net dividend received or dividend distributed on or before due date, whichever is lower, eligible for deduction. Okay, section 57 says like interest expended for earning dividend alone can be claimed as expense for dividend. Okay, interest expended for earning dividend alone can be claimed as expense. Okay, sir, understand, from dividend no other expense is allowed, only the interest incurred for earning dividend income is allowed as deduction. That also, how much, not how much ever interest earned can be claimed as deduction, 20% of dividend or interest expense, whichever is lower. So this point from IFOS, but they link ATM and this point, that's why I'm asking. Dividend received, net dividend received or dividend distributed within due date, whichever is lower, eligible for deduction. Section 57 says like what, from dividend income only interest paid for earning dividend income alone can be claimed as deduction. That also not fully, actual interest paid or 20% of dividend, whichever is lower. Deduction in respect of income from cooperative societies, not an useful section, sir. 80 QQB, deduction on royalty income. Eligible SSE is like resident individual when he is having royalty with respect to work of literature, artistic, scientific nature. Okay, royalty is receiving from what, writing books, they are like literature related, artistic related, scientific nature related. Sir, I wrote a DT book, I also may get royalty, but that is not eligible for deduction. Okay, because those are textbooks, newspapers, magazines related, no deduction. They should be literature related, artistic related, scientific research related. Okay, then what is the deduction amount? If the royalty amount paid lump sum, then 3 lakhs or actual royalty, whichever is lower. If it is like yearly payment, gross royalty received or 15% of sale value of books, whichever is lower. Then 80 RRB, deduction with respect to royalty on patent. Sir, SSC is a scientist, he has a patent on his name, so resident individual, and he is the true and first inventor of the technology or for that particular thing. Then actual amount are 3 lakhs, whichever is lower, eligible for deduction. Sir, understand? Sir, if this royalty is earning from outside India, still eligible for deduction? Yes, eligible for deduction, but the amount should be repatriated into India within 6 months from end of previous year, within 6 months from end of previous year, that also in convertible foreign exchange. Then 80 TTA, 80 TTB. Sir, 80 TTA eligible SSE is like individual HUF. 80 TTB, resident individual who is a senior citizen. TTA, any individual, sir. TTB, resident individual plus senior citizen. Okay, under 80 TTA only savings bank interest eligible. TTB, savings bank interest and FD interest. Okay, the deposit may be made in bank, cooperative society, post office. Understand, sir? Deposit may be made in bank, cooperative society, post office. TTA na individual and HF. TTB na only for resident individual, senior citizens. Okay, TTA only on savings bank deposit interest eligible. TTB even on savings and FD interest also eligible. What is the deduction? Here 10,000, sir, under TTA. TTB maximum 50,000. Sir, AOP BOI firm made deposit in a bank and then out of this deposit, if any interest comes, that cannot be claimed as deduction by a partner of the firm or by a member of the AOP. 80IA, deduction in respect of PGBP undertakings enterprises engaged in infrastructure development. Sir, that infrastructure development is like roads, bridges, rails, highway projects, water supply projects. Then 100% of their profits are eligible for deduction out of 10 out of 20 years. If any other infrastructure project, then also 100% profit eligible for deduction 10 out of 15 years. Then 80 IAC, deduction with respect to PGBP income derived by an eligible startup. Eligible startup. What is eligible startup? It could be a company or LLP incorporated in between 1st April 2016 to 31st March 2025. But this date extended, sir, up to 31st March 2030. So eligible startups up to 31st March 2030 eligible for ADIAC deduction. Okay, what are the other conditions? Their turnover should be less than 100 crores in previous year. They should have a certificate that they are eligible startups from their Ministry of Commerce. Then 100% of their profits are eligible for 3 consecutive years out of 10 years. For eligible startup, how do we decide as eligible startup? They should get a certificate from Ministry of Commerce. Then turnover should be within 100 crores in the previous year. It has incorporated in between 1st April 16 to 31st March 30 with extended date. It could be company or LLP. Then 100% of their profits for 3 consecutive years are eligible for deduction. Deductions available when opted for new regime. Sir, if he is individual, 80 CCD, CCH2, CCH subsection 2, 80 JJA. Only these 3 deductions are available if he has opted 115 BAC, CCD subsection 2, CCH subsection 2, JJA. Okay. Sir, then for companies and all, we'll discuss in assessment of companies also. Then 10AA. Sir, 10AA deduction is available for units established in SEZ. If a new unit is started in SEZ and it is engaged in manufacturing or producing any article or thing or even a computer software, commenced its operations by 31st March 2021, approval received by 31st March 2020, then their export profits are eligible for deduction under 10AA. First 5 years, 100% of export profit eligible. 6 to 10 years, 50% of export profit eligible for deduction. Then 11 to 15 years, 50% of export profit or amount debited to P&L or credited to SEZ reinvestment allowance reserve account, whichever is lower. First 5 years, 100%. 6 to 10 years, 50%. 11 to 15, 50% of export profit or amount debited to P&L and credited to SEZ reinvestment allowance as a reserve account, whichever is lower. How to calculate export profit, sir? PGBP, the profits and gains from SEZ unit into export turnover divided by total turnover. The export turnover, whichever is realized in convertible foreign exchange within 6 months from end of previous year alone has to be considered. 10AA is available. Sir, there are Chapter 6A deductions, 10AA deductions. First claim Chapter 6A deductions, then only come to 10AA. SEZ unit should be a newly formed one. It shouldn't be formed by way of splitting up of existing one or reconstruction. However, up to 20% of the total plant and machinery can be used once. Okay, so this is about what? Deductions and 10AA deduction.
PGBP. Sir, first PGBP you will learn. Okay, how many of you are good at accounting? Accounts మాకు పర్లేదు అంటే అట్లీస్ట్ డెబిట్ టు క్రెడిట్ వీటితో మాకు పెద్ద ప్రాబ్లం రాదు. Okay, we know properly when it has to be debited, when it has to be credited. In P&L, if it is debited, what does it mean? In P&L, if it is credited, what does it mean? Okay, so if a debit entry has to be reversed, what to do? Sir, if a debit entry has to be reversed, what to be done? Sir, you already debited, but it's a wrong debit. So then how do you correct it? You'll pass a reverse entry, nothing but it gets credited. Understand? So these kind of rectification of mistakes will be there, right? So those kind of points and the basic P&L, if you know, then PGBP is like some chapter, like just like as a deductions chapter only. But the problem is like, you should mix both of them here. You should know that logical understanding, like how a particular item will be treated in P&L, what is its nature, how it impacts the profit. These things you should know. Then you should even remember the conditions also. Okay, so mostly you try to remember conditions and you will not apply that in questions so much. So the problem comes, sir, even how many times you read PGBP, you will not understand how to apply it, or else you will be doing a wrong adjustment and all. So first understand, sir, it's purely based on accounting. Sir, why accounting? Because it's a business. They'll already prepare. Sir, you are a tax auditor, sir. Maximum, you are a tax auditor or tax consultant. Company will not ask and post you everything. A company or business person will not call and ask you, sir, whether I have to pass debit entry or credit entry. I'll ask everything. No, he'll first pass as per his accounting requirements. Why he is doing accounts for tax purpose? No, to present it to the shareholders. The main purpose of maintaining books of accounts documents is not for tax purpose. The main purpose is to show to the shareholders what we have did. This profit, this much profit we have made. So to tell them, to explain them what are the transactions or what are the affairs of the company, they are preparing P&L. Okay, that P&L they will give it to you. So based on that P&L, you need to calculate what? Tax profit and should compute the tax liability. Okay, now the basic problem starts with accounting profit or those accounting profit is computed based on following the accounting standards or the general accounting principles. Now, at all the places, these accounting standards and accounting principles may not be same in the tax also. So, tax may have some different principles, okay, with respect to tax. Then, with respect to those adjustments, you need to do corrections. Okay, so understand, you will not reconstruct again the P&L of the company or the balance sheet of the company. You will have already the accounting P&L. Taking from the accounting P&L as base, you will go with the tax profit. So you should understand what they did in accounts, what it has to be done in the tax. For that, what is the impact? That difference, what we should do. This is the basic logical understanding here. Okay. So to make it, sir, the PGBP chapter, we can divide it into. Okay, like let's say step 1, if you take. First, we should recognize incomes which are chargeable to tax under that PGBP. Step 1 is about incomes. Okay, you should know which incomes are chargeable to tax under that PGBP. Okay, if this is clear, then step 2 is about expenses. Expenses, you need to find out whether they are allowed or not. Allowed or not. Allowed or not. Here there are certain sections which explain this expense you can allow. Allow nothing, but it can be debited to P&L. Okay. Then there is step 3, sir, which says even though expenses are allowed, they shouldn't be disallowed. Expenses allowed and then not disallowed. Sir, expenses first stage will take out whether they are allowed or not. Allowed is different, not disallowed is also different. Sir, these disallowed concepts came for making sure that you follow certain tax compliances properly. Example, you have to deduct TDS, but you are not deducting TDS. Then how do they penalize you? Or how do they can pressurize you to deduct TDS and all? For that, they are saying like what? Only if you deduct TDS, claim it as an expense. If you don't deduct it as TDS, then you can't claim it as an expense. For that reason, they have kept certain conditions. If those conditions, sir, that is a business expense only. It has all the conditions to fill it as a business expense. But certain conditions are not met. Then it will become what? Disallowed. So for an expense, you should check whether it is allowed or not. And subsequently, you should check what? Whether it is disallowed or not also. So to qualify, to be under the P&L debit side, it should be allowed and not disallowed also. Two things has to be satisfied, sir. If it is just allowed, not enough. It should be allowed and shouldn't be not disallowed also. Okay, sir. For how do we know which incomes are chargeable to tax under that PGBP? For that, we have two sections, section 28 and section 41. These two sections, if you study, you will understand which incomes are chargeable to tax under that PGBP. Then expenses allowed. Sir, how do we know which expenses are allowed? Then further, you need to read section 30 to 37. Section 32, 37. These set of sections will explain us which expenses are allowed. Then expenses are disallowed. These are under section 40, 40A, 40B and 43B. So these are the major sections, okay, which will explain us which are the expenses not disallowed. Okay, this is the core PGBP, sir. Okay, in that, again, section 34 is not there. 34 is not there, sir. It doesn't have any relevance. But we have 30, 31, 32, 33, 35, 36, 37. Here 40, 40A, 40B, 43B. This is the core PGBP. Okay, it gives you when an expense has to be, first the income side you will take, then expenses when it is allowed, when it is not disallowed, you will understand by referring to all these sections. Okay. In this also, sir, if you are a beginner learning for the first time PGBP, you can leave aside for the time being section 35. I mean, don't introduce 35 in the first itself. First you learn the basic structure and all, then go and check even the 35 also. 35 is also about allowed expenses only, 35 and 33. But why I am saying like 35 and 33 we can study even at a latter part also. Leaving 35 and 33 you just learn. 28, 20, 41, 28 and 41 talks about what? Incomes. Then 30, 31, 32, then 36 and 37. These sections will tell you which expenses are allowed. Then you will go and check what? Which expenses are not. I mean, even though they are allowed, they shouldn't be again disallowed. Okay? So you will check which sections 40, 48, 40B, 43B. By referring to those sections, you will get clarity whether they are disallowed or not also. Sir, why 35, 33? Na? Sir, 35, 33 will not talk about a general business. They will talk about specific segment of businesses like tea, coffee, rubber, dar business, or else related to telecom business, or related to scientific research. Okay, so these two sections will not talk about the general expenses. Sir, for a normal business, what will be the general expenses? Raw material purchase, salaries, rent payment, advertisement expenditures, or something like depreciation will be there. Okay, so whatever interest will be there, salaries will be there. So any bonus commission paid to the salaries, PF contributions made to the employees, or any other payments made to employees. So the general expenditures which we look for all the business in common will be there in 30 to 37, whereas in 35 to 33, specific. Okay, they'll talk about every subsection is about a specific business. Okay, so 35, 33 are like specific in nature. So even if you skip 35, 33 in the beginning also, you'll understand the whole PGBP logic. Once you understand the logic, once you know how it is behaving or how it has to be done, then you can even learn 35 and 33 also easily only. So, okay, the first thing in PGBP is like, it's not about, sir, it's a combination chapter, sir, where it's not enough if you can tell a provision easily. Sir, let's say I ask like a multiple choice question. Most of you can tell. But to apply that one, again, you should apply the logic also. So both combination things are logic. Na, this chapter, most of the cases, it's like a reconciliation statement. You'll start with accounting profit and ends with tax profit. Sir, in reconciliation statement, what you'll do, either in BRS or in costing reconciliation statement, what you'll do, you'll start with one profit and you'll end with another profit. Na? You check what are the differences. Those differences either you'll add or you will subtract. For adding and subtracting only, many times you guys have confused in BRS or even in the reconciliation statements. The same logic is even there in PGBP also. So that is the first thing of confusion. So for that confusion, the problem is not tax, your accounting basics. If you know BRS properly, if you know reconciliation statements properly, then PGBP statement is simple only, sir. You can summarize all the provisions into 3 or 4 pages, one-liners kind of. Okay, those conditions you remember and start doing again the reconciliation. But most of the students will fail with doing this reconciliation. In the place where they have to add, they will subtract. Okay, that happens. Okay, so first we'll start with how do we solve a problem only. Then we'll go into the PGBP actual concepts. So most of today's class, sir, will not go into the section or into the provisions. We'll mostly discussing on how to solve a question. Okay. So I know, sir, many of you, especially if you are Telugu students now, I can understand, I can feel you that how much hate you have towards PGBP chapter. Inter level, you not yet learned this chapter. Final level only, maybe even if you have given attempts also, you never tried PGBP chapter. But this time, if you are planning also, see, understand PGBP question. If at all they ask for 14 marks, I'm not saying that we'll try for 14 marks. See, there will be several adjustments. Even if I go and write an exam, not only me, any faculty go and write an exam also, there is always a chance of doing 1 or 2 adjustments wrong. It's not that we don't know that provision. It's because of interpretation. We may think in another way, the suggested answer may think it in some other way. So 1 or 2 points, or in let's say there are 12 points in a PGBP question, 12 adjustments. You doing adjustments, 8 adjustments correct is completely okay. So out of 14 marks question, our target is within the range of 8 to 10 marks only. So don't think like you'll get a perfect solution for the PGBP question. So most of the adjustments, okay, you should do correctly. Okay, sir. So don't think like you should want perfection in the PGBP chapter. Perfection you can try in DTA, transfer pricing, those kind of chapters, sir. But in this chapter you should not work on perfection because it takes much more time for you. Okay, sir. It happens sometimes. Okay, in the natural process only, with the normal preparation only, if you could do correctly all the adjustments, then fine. But don't disappoint or don't get demotivated if you could do only 8 or 9 points correct only out of the 12, 14 points which they ask. Okay, that is absolutely fine. And many a times, sir, again, even in choice or selecting question also, many students leave PGBP as a choice question. They think like by solving some other 2 questions, they get more marks, sir. Sir, in PGBP question, you can see any exam question, sir. There will be 2 or 3 tough points. Rest all the points are familiar points only. 14 marks question. You don't know those 2, 3 points. 3 marks gone. Your totals will not be correct. So another 3 marks gone. Minimum how much you will get? 8 marks. Out of 40, you will get how many marks? 8 marks. For a 14 marks question, for one question getting 8 marks is still okay. 8 marks means you are still getting 60% of the marks for that question. Okay, in PGBP, okay, which we think like much more lengthy chapter and all. If you know PGBP or if you learn PGBP properly, then tax planning questions you can do much more correctly and accurately. There, for 14 you can get 12 marks also. Okay, so understand, that's why. So I'm not saying like PGBP itself will give you 14 marks, 20 marks and all that false promises I'm not making. Keep your expectations also low. But it is important to learn. This chapter is important to learn. Okay, but don't think like PGBP alone can clear your exams. PGBP you have to learn because of tax planning chapter and this chapter also. But this question getting 8 marks is absolutely fine. And last time, sir, they asked math related question 7 marks, and that is one of the easiest question they have asked. I don't know, okay, because many people will leave, okay. There are certain questions which are tough also in last attempt paper, but PGBP and math question is one of the easiest question, and tax planning question is also easiest question. So if you leave PGBP, these 3 7 marks questions are easy questions out in the whole paper, and those questions you cannot solve properly, okay. So basically in PGBP, they make you receipts and payments model question or P&L model question. Sir, receipts and payments model, they'll not give us a P&L statement. They'll just give what are the receipts they have in a year and what are the payments they have in a year. Okay, so there is no accounting profit also. They just give an information, these are our receipts in the last year, these are our payments in the last year. From based on that, you should compute our tax profit, or especially the business related tax profit you need to calculate. Okay, see what happens here, there will not be any accounting profit given in the question, just gives the incomes and expenses. From that we should calculate what? Tax profit. So how do we start? From the total receipts, sir, first we shall identify incomes. Sir, why again we should identify incomes? All the receipts will be incomes only, no. Sir, in accounting, we don't have 5 different accounting heads. If it is an income, whether it is related to house property, capital gains, PGBP, IFOS, all incomes will do what? Sir, you have interest received. Where you will show in P&L? Credit side only, right? Dividend received. If any profit on sale of fixed asset. credit side only. Okay, so now all these are whether taxable under PGBP head. Profit on sale of fixed asset, it is related to capital gains head. Interest related to IFOS head. Dividend related to IFOS head. Even if you had some lottery winnings, that also will credit to what? P&L only. That is also related to what? IFOS head. So in our receipts, there are so many receipts which are not related to PGBP. Okay, so first thing is what? Okay, not only receipts, sir. In receipts, there may be sometimes certain receipts which are not even incomes also. So let's say, sir, in the current previous year, you received 10 lakhs as loan. You received 10 lakhs as loan, whether it is a receipt or not. You received 10 lakhs. Sir, forget about P&L. Receipts. Whether it is an inward, receipts are nothing but, sir, they'll give you the cash ledger. So when you receive 10 lakhs as loan, that is also a receipt. But is it an income? 10 lakhs loan if you took, is it an income? No, it is not an income. So first, that's why from the total receipts, you shall identify what? Incomes. You shall identify incomes. And then take only those incomes chargeable to tax under the head PGBP. Sir, how will I know? Sir, identifying income, I cannot teach you now. Because by the level you are now currently, you should already know whether it is an income or not. So first thing you should identify what it is an income. If it is you can know, I mean, if at least you can identify it as an income, then we'll go on discuss what section 28 and section 41, which will help us in deciding which incomes are related to PGBP. Okay, so out of the list of receipts, we'll take only those incomes which are chargeable to tax under the head PGBP. Okay, receipt side we got. Then we'll go to the receipts and payments. Then we'll go to what? Payment side. Again, sir, payment side also we'll check whether they are expenses or not first. Payment side also first we'll check what? Whether they are expenses or not. Sir, what else could be there, sir? Other than expenses, sir. Sir, let's say they have paid for purchase of plant and machinery. That also will be there under what? Payment side. But is it an expense? What you will do? We'll capitalize that to the asset and we'll claim depreciation. So like that expense wise also, I mean payment side also we should check whether those are expenses or not. Then we should go and check under 30 to 37. From section 30, 31, 32, 36, 37, all these sections we have to check. Why? Then you can understand whether it is allowable under the head PGBP or not. First level. Then the second level for expenses is like you should again check 40, 40A, 40B, 43B also. Then you can understand whether it is not disallowed or not also. So to claim an expense as deduction, first it should be expense nature. Second one, it should have been satisfying, I mean it should have covered at any place under 32, 37. Third one, it is not even disallowed under 40, 40A, 40B, 43B. Okay, then such expense what you will do? You will simply reduce. See, from the total payments, take expenses that are allowed under PGBP and not disallowed under section 40, 40A, 43B. Not disallowed under section 40, 40A, 43B. So you'll subtract, then you'll get the PGBP profit. Okay, so comparatively, receipts and payments model is easy. Okay, logic wise it is simple, sir. Out of all the receipts, you just identify incomes and which are chargeable to tax under the head PGBP. Then you'll go to the payment side and all, and you check which are called expenses, whether they are covered under 32, 37, and check whether they are disallowed or not. If they are not even disallowed, then subtract those expenses. You'll get the tax profit. It is simple to solve. Okay, and even in exam also they'll not ask frequently this model, sir. Very rarely we'll see this kind of model, but mostly we'll see what? P&L model question. Question gives us incomes credited to P&L and expenses debited to P&L as per books of accounts, and even they will give what? Accounting profit. Okay, sir, this is a P&L. P&L for financial year 25-26 as on 31st March 2026. Okay, look at the credit side, sir. What they are having? Sales, closing stock, interest, dividend received, agricultural income, rent from house property, profit on sale of land. Then they have certain expenses, and finally here they given what? Net profit 40 lakhs. Okay, now tell me, sir, out of all these items which are credited to P&L, tell which are not related to PGBP. You need not to learn the chapter also. By the knowledge you have till now also, you can tell these are related to PGBP and these are not related to PGBP. Tell, sir, out of all this which is not related. Okay, let me, it is already written, right? So now tell, sir, out of all these, sales related to business only, right? So business is nothing but doing sales. If you are having closing stock, that is also related to business only. Interest received, taxable under which head, sir? IFOS. Dividend received, agricultural income, exempted first. Agricultural income not even taxable, it is what? Exempted, assuming it is from the land situated in India only. Rent from house property, taxable under that, house property. Profit on sale of land, capital gains side. Okay, sir, in P&L credit side, if you have made anything, then it is equivalent to, sir, you know T-shape P&L and even the statement kind of P&L. The same T-shape P&L, if you visualize in a kind of statement of kind, what we'll do? All these credit side items will add. Then all the debit side items we will subtract. Okay, then you'll get the profit. Yes or no? All the credit side items you will add, and the debit side items you will subtract. Okay, so all these items are what? Already added. All these items which are debited are what? Subtracted to arrive the profit. To arrive this 40 lakhs profit, all these items are added and all these debit side items are subtracted. Then we got the balancing figure as what? Profit. Yes, sir. Now interest is related to which head? IFOS head. But it was already included in the accounting profit. But as per tax, interest is taxable under which head? Shall it be included in tax profit? We should exclude. Then what to do? What we should do, sir? Everybody answer this question, sir. Sir, interest is related to which head? IFOS. But it is already included in the 40 lakhs accounting profit. We want a tax profit. So, okay, tax profit now we want only related to PGBP. In this 40 lakhs, already this 5 lakhs also included because it was added. So now, what we should do this interest? We should exclude. Exclude now, what we have to do? Add or subtract? This interest we should subtract. Then we are ignoring the impact or removing the impact of this 5 lakhs from accounting profit. Understand, sir? Are able to get this point? Then, okay. Dividend received. IFOS. Again, not related to PGBP. So again, this 4 lakhs, what we should do? What we should do, sir? Subtract only, okay? Because this 4 lakhs is also part of 40 lakhs. So we should remove that impact also. So we'll subtract. Then agriculture income. Again, agriculture income is exempted. So not related to PGBP. But because of this agriculture income also, our profit was increased. So this also we should what? Subtract. Then rent from house property. Which head? House property head. Is it related to PGBP? No. So that also what we should do? Subtract. Then profit on sale of land related to capital gains head. That also shall not be there in this 40 lakhs. So you'll subtract. So out of all these items, which items you'll subtract, sir? This 5 lakhs you have to subtract. Dividend received you have to subtract. Agriculture income you have to subtract. Rent from house property you should subtract. Profit on sale of land also you should subtract. Why we are subtracting? Because this interest is related to which head? IFOS. This dividend is related to which head? IFOS. Agriculture income is what? Exempt. Then rent from house property is what? Which head, sir? There itself there. It is what? House property head. Profit on sale of land. Capital gains head. Since these are not related to PGBP head, in the profit these amounts should not be there. Okay? But already these were added. Credit side now these were already added. Now what we should do? We should subtract them to nullify the impact. Right? Sir, clear on this one? Everybody? Credit side there won't be much big adjustments also, sir. This is the only logic we need under the credit side. Sir, if you understand this one, then our total problem solving will become easier. So, question gives incomes credited to P&L. Yes, we have. Expenses debited to P&L and even accounting profit also. From here, we should calculate tax profit. It goes more like a reconciliation statement. What we'll do? We'll take profit as per books of accounts. How much? 40 lakhs in our example. With that 40 lakhs, what we'll do? We'll do plus or minus adjustments. We already got the adjustments to be minused. The dividend received, interest received, agricultural income, house property, profit on sale of fixed land, all this what we'll do? Subtract. Then debit side we'll find certain items which has to be adjusted also. Okay, now we'll go to debit side also. Sir, debit side. So by applying our common sense only. Opening stock related to what? Business. Purchases. Conversion cost, manufacturing cost, business related. Salary wages, business related. Advertisement, business related. Depreciation. Sir, the problem with depreciation is like accounting depreciation principles and income tax depreciation principles are different. Many of the cases, unless in question they say like both in accounting also they are following only as per income tax only. Otherwise, the accounting depreciation methods, principles and the income tax depreciation methods and principles are different. That's why this depreciation is not correct. This accounting depreciation. But already they did what? Sir, debit side, if you have mentioned any item, the impact on profit is what? It has already subtracted the profit, reduced the profit. If you debited anything, it has reduced the profit. So accounting depreciation already reduced what? Profit. Now you want to reverse it. So reverse now what you will do? You will add back accounting depreciation. Sir, able to understand, sir? Why depreciation? Then if there is income tax depreciation given, that income tax depreciation again you will subtract. Why? Sir, why again income tax depreciation we need to subtract? Sir, basically incomes has to be added, expenses has to be subtracted. Okay. But a wrong expense has been subtracted. What is the wrong expense? Accounting depreciation. So to nullify that impact, what we'll do? We will add back and then again income tax depreciation we will subtract. Understand, sir? Okay. Then municipal tax paid for house property. Sir, this expense related to what? House property. We have house property income. To that this expense is related. So now tell me whether this expense is related to PGBP. Sir, here relevant income if you are not taking, relevant expense also can't you take, right? Incomes what you did, since they were added, to reverse them you already subtracted. But expense this is already subtracted. Debit side it is there now what? It was already subtracted. So to reverse that what to do? Add. So if any, so the logic is simple, sir. Any expenses which were not related to PGBP or exempted incomes related, those expenses are related to an exempted income or related to an income which were not chargeable to tax under PGBP. So those expenses we will not consider under PGBP. But since they already debited to P&L, what we'll do? We'll add back. We will add back. Okay. Then interest paid on earning dividend. Sir, this expense is related to what? IFOS. So this also what we should do? Add back. Then provision for income tax. Sir, first tax profit why we are calculating? Why we need to calculate income under that PGBP? Tax purpose only. Okay, for tax purpose only you are calculating profit. Will that profit should be after tax or before tax? Before tax it should be, then you can calculate tax. If already provision for income tax they debited, it is becoming PAT. But we want what? PBT. So this expense shall not be allowed. So what we should do again? Add back. Provision for income tax also you will add back. So simply, sir, on debit side every expense or every item will check whether it is related to PGBP or not. If it is related to PGBP, fine, no issues. If it is not related to PGBP, okay, sir, how can I know, sir, it is not related to PGBP? You will understand much more better when we go to section 30, 31, 32, 36, 37. By referring to those sections, you will understand which are related to PGBP. Related to PGBP, na? Fine. Then second thing, they shouldn't be disallowed also. They shouldn't be disallowed. Which sections will tell us which are, whether they are disallowed or not? 40 has subsections, sir. 40 subsection A, clause 1, clause 2, like that will be there. And 40 subsection B also will be there, 40B. Then there is a 40A. Not subsection A, sir. 40A, the section name itself, 40 capital A, 40A. Then third one is, fourth one is 43B. These are the 4 main disallowance related sections. You'll refer those sections, then you'll understand whether it is allowed or not. Okay, so now I'll give an example. Sir, whichever is given in this statement, we understood how to do. When it has to be subtracted, when it has to be added. But it doesn't go always the same, sir. They will give some other extra adjustments in the additional points. They'll give some other extra points in the additional points. So first you should understand the basic principle to do the accounting profit. Sir, we have whatever is the accounting profit, this X amount of accounting profit, how we arrived? This arrived by adding all incomes and by subtracting all expenses. Now what we have did, in this all incomes we have problem with some incomes. In all these incomes which were added, we have problem with some incomes. They shouldn't be added as per tax logic or as per tax principle, but they were already what? Added. So to nullify the impact, what we are doing? Subtracting. Then here we should subtract all the expenses. Again, here also in all these expenses we are having problem. Certain expenses may not be related to PGBP or not satisfying the conditions to call it as an expense under income tax. So what are those expenses we should do? Since they already subtracted, to reverse the impact, what we should do? We should add back. Okay? But basically income has to be added, expense has to be subtracted. But if a wrong income added, now we are reversing by way of subtracting. If a wrong expenses is subtracted, now to nullify the impact we are adding. Right? Okay. Bad debts recovered. Bad debts recovered. Sir, if you have bad debt recovered, is it an income or an expense? Bad debt recovered, sir. You thought that money will not come also. Okay, you claimed as an expense also. But later on, that fellow, okay, his fate has changed and again he became a billionaire, a millionaire. So again he came back, he remembered you, he came back and paid you the bad debt also. So now, is it an income or not? It is a income, but it is not credited to P&L here. Is it credited to P&L, sir, bad debt? Bad debt recovered. Sir, it's not like always it will give in note points. I'm giving as an example. There is an income in the information, additional information, but it was not credited to P&L. But you tell whether it is an income or not. Bad debt recovered, it is an income. Even as per tax also, tax provisions also say like it has to be recognized as an income only. But to arrive this 40 lakhs accounting profit, did they consider this 1 lakh? No. Now what we should do? We should consider this 1 lakh. Is it of income nature or expense nature? Income. So income to be included, not included. It has to be included, but it was not included. So what we should do? You include now, so add it now. You should add it now. Logic, you should add it now. Sir, I know you feel, some people you may feel it heavy, sir, in the first class, but don't worry. I'll take it number of times. We'll solve examples. Okay? We'll solve 1 or 2 examples. See the first page. Then again, we'll write down this. I have written down the same thing clearly. Then again, we'll solve with the second example also. Okay? So you'll understand, sir. Don't worry if any point you are getting, you got stuck also. Okay? I'll repeat it a number of times until you get the logic. Then depreciation point already done. Accounting depreciation we have reversed, adding back, and income tax depreciation what we are doing? We are subtracting. Okay, then. Customs duty of earlier year paid in current year. Sir, customs duty, which year related it is? Last year. But it was not paid in last year, it is paid only in the current year. So this is linked to a section called 43B. So what is the nature of section 43B means? Expenses are allowed only on payment basis, not on accrual basis. So since customs duty, even though related to last year it was not claimed as an expense. Why? It was not paid in the last year. Okay, 43B lists out certain payments. These expenses are allowed only on payment basis, not on accrual basis. One among them is customs duty. So now customs duty of earlier. So actually earlier year expense, now earlier itself they have claimed expense and all. But it was paid in the current year only. So what happened in the last year? Since it is not paid, last year this customs duty is disallowed. But it is paid in the current year. Since it is paid in the current year, it can be claimed as expense in the current year. So then why it was not taken in accounting P&L? Sir, in accounting there is no such rule. 43B is there, in accounts or tax? Tax. So in accounting, last year expense they claimed in the last year only. So that's why we will not see in the current year P&L. It is a tax related point. What happened? Last year, this customs duty 50,000 was disallowed. Why? Because in last year it was not paid. But it has to be allowed in the current year because it was paid in the current year. So this is an expense to be claimed. This 50,000 is an expense to be claimed. But is it debited to P&L? No. So I mean, even though it is not debited, still we have to claim it as an expense. So what to do now? Sir, everybody, are you able to get the logic? So don't think of others in the class, sir. Whether you individually can get that logic or not think. Okay, మీ పక్కన వాళ్ళకి అర్థమైపోవచ్చు లాజిక్ ఫాస్ట్గా, మీకు అర్థం అవడానికి టైం పట్టవచ్చు, కానీ మీరు తీసుకోండి, యూ టేక్ యువర్ ఓన్ టైమ్ అండ్ అండర్స్టాండ్ అండ్ ఫిగర్ ఇట్ అవుట్ వెదర్ యూ ఏబుల్ టు నో వెదర్ ఇట్ హాస్ టు బి యాడెడ్ ఆర్ ఇట్ హాస్ టు బి సబ్ట్రాక్టెడ్. Again, I'm explaining, sir. Sir, it is an expense for current year. As per tax principle, since customs duty is paid in the current year, it can be claimed as expense in the current year. But is it debited to P&L? No. Even though not debited to P&L, but still it can be claimed as expense. Sir, debited to P&L, now what? Those items already subtracted. This item also has to be subtracted, but it didn't. So what we should do? We will subtract. We will subtract. Then the last one, sir, commission paid to agent. Commission paid to agent, 50,000. Not included in P&L. I mean, it was not debited to P&L, but the point is it is paid fully in cash. Paid fully in cash. Sorry, most of you, even without reading PGBP also, you know one disallowance commonly. What is that disallowance? Cash related. cash related disallowance, sir, how many of you don't know? In excess of 10,000, if they make payment in cash in a day, then that amount is disallowed. This basic point you know, right? Okay, if this point you don't know, now you not only did CMA enter, you didn't even did articleship also. Because in any place, at least for 1 month, 2 months, you did articles also, you know what? That cash expenses in excess of 10,000 are disallowed. Okay, sir, now tell me this point. Commission paid to agent, how much? 50,000. Not debited to P&L. Sir, commission means business expense only, na? Yes. So it has to be debited. It should have been debited to P&L, but they didn't debited. Okay. But what is the reason they given? Not included in P&L, but paid fully in cash. Sir, this is a allowable expense only because commission. But what happened? It became disallowed also because of 40 capital A subsection 3. Why? Because it is paid in fully cash. So this is an expense, but disallowed. Since it is disallowed, can we claim it as a deduction or can we claim it as an expense now? We can't claim it as an expense. Why? What is the reason for not claiming it as an expense? Fully paid in cash. Since it is fully paid in cash, we cannot claim it as an expense. Did they already claim it as expense? Accounting law already the expense. Did they already taken this item as an expense in accounting? No. Sir, if they already claimed that, they might have debited in P&L. They also didn't take it as an expense. We also need not to take it as an expense. Simply what we'll do? Ignore. Simply what we'll do, we'll ignore this point. We need not to add or we need not to subtract also. Why? This accounting also they didn't take it as an expense. Even in income tax also, we need not to consider it as an expense. Why? Because to consider it as an expense, first it should be allowable and not disallowable. It is satisfying the first part. It is allowed. But the next problem is what? The next problem is what? It was disallowed also, not disallowed. It was disallowed also. So we will not claim it as an expense. Okay? And even, so the same point. If it is already debited to P&L, na, what happens? In accounting, already they claimed it as an expense. But as for income tax, it shall not be treated as an expense. Then we will add back. But here, since it is not debited to P&L, we will not do anything. We will simply ignore. అర్థమవుతుందండి ప్రతి పాయింట్కి ఎక్స్పెన్స్ సైడ్ ఉన్నదానికి 3-4 వే లాజిక్స్ ఉన్నాయి ఇక్కడ. డెబిట్ అయితే ఏం చేయాలి? It is an expense point only. If it is debited to P&L, what to do? Not debited to P&L, what to do? Same way, income credited to P&L, what to do? Income not credited to P&L, but given in the foot lines or given in the additional information, what to do? So these 4 reasons you should understand. For a income side item, credit side item, given in the P&L, then what is the adjustment? Not given in the P&L, but was given in the additional information. What is the adjustment? Expense debited in the P&L. What is the adjustment? Expense not debited, but given in the additional information, then what is the adjustment? So these things you should have clarity. అర్థమవుతుందండి మీకు? మీ ఫస్ట్ బెంచ్ ఎక్స్ప్రెషన్ అసలు నాకు అర్థం కావట్లేదు, మాస్కులు పెట్టుకున్నారు కాబట్టి. Sir, the students who are listening online, yes, you will get even the recorded classes also. By today evening, all the recorded classes, even which were streamed in YouTube, also will be kept in the recorded folders. So don't worry about the recorded sessions. Every day they'll be uploading the recorded sessions also in the same course. But try to listen to the live class only, sir. When you listen to live class, you can watch live class, and then if you have any doubt also afterwards, you can go and watch the recorded session also. Okay, you have 2 views, 2.5 views, sir. If you directly watch recorded session, then you directly get, okay, the first time you watch, then your 1 view is counted, then you have only the other, like for 1 hour class, you'll have another 30 minutes only remaining to cover the class. So you will not have the option to revisit and relearn the same concept once again. Rohit, Mohan, Pavani, are you able to understand or not? Hafnida, Vaishnavi, Jageshwar. It's okay. Now tell. So now you should tell. Income credited to P&L. Okay. Now first thing. If it is related to PGBP only. Income already credited to P&L and it is related to PGBP only. What we should do? Nothing to be done. Income credited to P&L and it is even related to PGBP. Nothing to be done. So why nothing to be done? Because incomes has to be added. If it is credited, if it is there on the credit side, it was already added only. So we need not to do anything. Incomes credited to P&L and they are related to PGBP and they were already added. And we are also saying like what? Same thing only. So nothing to be done. No adjustment. Not related to PGBP or exempt. What we should do? Income credited to P&L not related to PGBP or exempt. Subtract. Why we are subtracting? Sir, it is a income. So if it is already credited to P&L, it was what? Added. But what we are saying now, not related to business or it is exempted. So it shouldn't be added. But they already did what? Added. So to reverse that adjustment, what we have to do? Subtract. This point clear, sir? Then income not credited to P&L but given in additional info. Income not credited to P&L but given in additional info. So now tell. Related to PGBP. It is related to PGBP only, sir, but what happened? It was not credited to the P&L. I mean, actually it should have been added. But whether they have added, sir? Sir, credit, na, remember it as like what? Adding only. So for the P&L credit side, na, we have added, debit side, na, we have subtracted. Okay, because revenue nature. When it goes to an asset, some modern approach, what? Okay, I learned accounting in such way only, sir. Asset, if a balance added, na, we'll debit. Asset value reducing, na, we will subtract, na, nothing but credit. Because those are assets. Revenue side, this is like a revenue side, na, P&L is like what? It's like a credit kind of trend. So, okay, where income is there, na, we have to credit. Where there is expense is there, na, we have to debit. Credit means what? Adding, debit means subtracting here, in this sense, in P&L sense. Okay. Now, income not credited to P&L. I mean, it was not added. But it was related to PGBP only. First day it was not added. But we came to know that it is also related to PGBP. What to do? Add. Add or subtract? Sir, it's not about... So until you are... Okay, it is waste also to learn the whole PGBP chapter. Until you learn this logic, it's time waste to learn the balance chapter also. Okay, sir, even the fast track students also. You spend second class, third class also. If you couldn't get this logic itself, then going forward and learning PGBP chapter is a time waste. Because ultimately you cannot solve the problem. You might know the disallowance means what and all. But ultimately you cannot solve a problem, you cannot get marks. So it's a time wasting only. So first thing to be learned is this logic only. Okay. Income created to P&L. Related to PGBP. Already created. Already created now what? They already added. And we are also confirming that it is related to PGBP only. So they did correct treatment only. Nothing to be done. Income created to P&L, but not related to PGBP. So what they did? It shouldn't be added. But they already what? Added. So we need to correct it. What to do? Subtract. Correct, sir? This one? Okay then. Income not created to P&L. It was given as an additional information. But still it is related to what? Related to PGBP. Since it is related to PGBP, we should add it. Whether they already added. Since they didn't already add it, what we should do now? Add. Second one. Not related to PGBP. Sir, income not related to PGBP means we should add or we shall not add? We shall not add. Whether they added already? Not created, they also didn't add it. We are also saying like not to be added. So simply what we should do? Ignore. Ignore or no adjustment. Clear, sir, this part. So income side, if these 4 rules, if you remember, then income side almost done. Income side. Sir, but you cannot by heart, sir. You have to understand it only. You need to understand the logic only. If you by heart it as a rule, then it will be gone. Somewhere you'll do mistake. You should understand credit side incomes were added. So we are checking whether all these incomes are related to PGBP. If they are related to PGBP, then no problem. Because it has to be added. Already they added, no problem. If they are not related to PGBP or they were exempted, then they shouldn't have been added, but already added. So that's why what we'll do? Subtract. We'll do what? Subtraction. Got it. Not related to P&L. Given in the additional information. Just like as in the example, bad debt recovered 1 lakh is given. Bad debt recovered 1 lakh is an income or not? But not related to P&L. So what we should do? We should add. Then income not related to PGBP and even not related to P&L. Let's say, sir, in the footnote they given agricultural income. It is not even created to P&L. It is not even taxable under that PGBP also. Simply what we'll do? Ignore. Okay? It's okay. We'll see, sir, how much you understand also. Now, solve this answer, sir. Solve this answer. For this question, solve the answer. Start with accounting profit 40 lakhs. And then do which has to be added and which has to be subtracted. PGBP related only, no adjustment. Closing stock already created, PGBP related only, no adjustment. Interest created to P&L but is related to IFOS. So what we should do? We should exclude it. Exclude na. Since it is already added, to exclude it we should subtract. Then dividend received related to IFOS but already added. So we should reverse it, subtract. Agricultural income exempted. But since it is already created, that means added, we should what? Subtract. Rent from house property already included, added. We should reverse it. So what we should do? Subtract. Then profit on sale of land already included. That means already added. So we should do what? Subtract. Okay, so what are those? Interest 5 lakhs subtracted, dividend 4 lakhs, agricultural income 10 lakhs, rent 3 lakhs, profit on sale of land 5 lakhs. Then expense side if you come, depreciation. Sir, depreciation what we should do? Accounting depreciation we are reversing. Why? Because this is for tax purpose. We should allow the tax depreciation only. So whatever they took as accounting depreciation that we'll add back and the income tax depreciation again we'll claim it as expense. Sir, by reversing this we are ignoring the depreciation impact. By again subtracting the tax depreciation we are giving the depreciation impact as per tax principles. Okay, so accounting depreciation added back and income tax depreciation has been subtracted. Then municipal tax not related to PGBP add back because expenses are already subtracted, sir. So this municipal tax is already subtracted. So to reverse it, what we should have to do? Add back. Interest paid on earning dividend. Again, it was already subtracted but not related to PGBP. Add back. Provision for income tax. Sir, this profit itself we are calculating for what? Computation of tax. So that's why we want, nothing but we want a profit before tax, not profit after tax. That's why this tax expense also we should what? Add back. Okay, so what we have added, sir? Municipal tax, interest paid, provision for income tax. Then, in additional information, sir, we have bad debts record. This bad debts record is what? It is an income. So income now actually it should have been added, but this income was not added. So what we should do now? Add. So not credited now, it means what? Not added. Not added. So we should add it now. So that's why bad debt record has been added, considering it as an income. Then the same way, sir, already accounting depreciation adjustment we already did. Customs duty of earlier year paid in current year. So it is an expense to be claimed in current year, but not debited in P&L. I mean, it was not subtracted, but it has to be subtracted. So what we should do? Subtract customs duty. Okay. So then by doing all these adjustments, sir, we'll get what? Income under that PGBP 17 lakh 50,000. I even explained, sir, customs duty for 50,000 linked to 43B related to previous year 24-25. It was not taken as deduction in previous year 24-25. Why? Because 43B says like certain expenses are allowed only on payment basis. Since it is not paid in 24-25, it was not allowed. But in 25-26, it is paid now. It has to be allowed. So we should claim it as an expense in 25-26. So even though not debited to P&L, we'll claim it as an expense by subtract. Understood, sir? Now you got the logic right? Okay. So now look at these rules. The same thing I already explained. Treatment of incomes. If it is already created to P&L, such income already created to P&L and taxable under the head PGBP. Do we need to do anything? Nothing. One example is what? In P&L, sales will be created. Sales will be created. It is related to PGBP only. So we need not to do anything. Then credited to P&L, taxable under the head. So okay, credited to P&L, taxable under other heads, or they are exempted. Examples like dividend, taxable under IFRS head, agricultural income, it is exempted. So what we should do? We should reduce them from the accounting profit. Sir, you understand why we are reducing? Why we are reducing? Because since these were earlier credited means already these were added. They shouldn't have been added. But since they were already added, to reverse that, what we are doing? Reducing or subtracting. Then incomes not credited to P&L. We should check what? Whether they are taxable under the head PGBP or not. If they are taxable under the head PGBP, even though not credited to P&L, we should add them to accounting profit. What is the example, sir? Bad debt recovered. In the previous question, bad debt recovered is the example for it. The next one, they are not credited to P&L and not taxable under the head PGBP, or either they are exempted. Sir, P&L, what we are saying, not taxable under head PGBP or not exempted. So as per tax logic, it shouldn't be added. They also not created. That means what? Even in accounting also they didn't add it. So simply what? Ignore. No action. Then treatment of expenses. Treatment of expenses. So expenser. If it is debited to P&L, what we should check? We should check whether it is allowed under section 32-37. 32-37. Then it shouldn't be even disallowed under 40, 40A, 43B and even 40B also. It shouldn't have been disallowed under these sections. Then what? Nothing to be done. So what are those expenses? We didn't take any action. Opening stock related to PGBP. No disallowance also. So simply allowed. Purchases related to PGBP only. That means they are allowed under 32-37 and no disallowance also. Conversion cost, salary, advertisement cost, all these are covered under 32-37 and even not disallowed also. Depreciation. Sir, why depreciation we have added back? As per section 32, you can take only income tax depreciation, not accounting depreciation. That's why we have added reversed accounting depreciation and have claimed income tax depreciation. Then debited to P&L. We should check what? Not allowed under, sir, they were debited to P&L, but they were not allowed under section 32-37 or allowed, but they were disallowed under 40, 40A or 43B. Then what we should do, sir? We should reverse them. Sir, if either they are not allowed or if they are disallowed, now what does it mean? You cannot claim them as expense. If you already debited to P&L means what? You already claim them as expense, but you should not claim. So what you should do? Add back, reverse them. Okay? Same way, P&L footnote also not debited to P&L. It was not taken in the P&L, but still it is an allowable expense only. Then now claim it as an expense and reduce from accounting profit. It is not allowed, okay, not debited to P&L and not allowed, or either it is disallowed. So what? As per tax purpose also we are saying like it need not be taken as an expense. And even in P&L also they didn't debited. So simply what we'll do? We will ignore. We will ignore. Then sir, in this example too, sir, extra one more point I have included. Okay, what is that extra point? Opening stock, see, the question remains same, sir. Compute income under that PGBP for A Limited for previous year 25-26 based on the following. They have sales 70 lakhs, closing stock 50 lakhs, rental income related to which head? Profit on sale of shares. Able to recognize that or not, sir? Rental income taxable under which head? House property. Profit on sale of shares. Capital gains. Agricultural income exempted. Then opening stock PGBP. Purchases PGBP. Salary. Provision for income tax. Sir, it is related to business only. But we want before tax profit. That's why what we should do? Add back. So it is what? Disallowed. Then expenses related to agricultural income. Since income we are not considering, relevant expense also we shall not consider. Add back. Depreciation. Accounting depreciation will add back. And what will take? Income tax depreciation. Net profit we got. Then here. Bad debts written off previously recovered. How much, sir? 1 lakh. So what we should do this 1 lakh? Add, because we need to recognize it as an income now. Then they given another adjustment also, sir. Both opening stock and closing stock are undervalued by 10%. Okay, so the closing stock given here 50 lakhs is undervalued. Opening stock 30 lakhs given is also undervalued. So this opening stock closing stock adjustment doesn't have any relation to tax. This is pure your accounting knowledge. So now tell, it was learnt in foundation, it was learnt in inter, but it will be linked to a tax problem. So okay, as a tax faculty, it's not my job to explain the impact of opening stock adjustment on profit, impact of closing stock on profit. That you should have already learnt. So that's why I tell. If opening stock is undervalued by 10% and closing stock is undervalued by 10%, what is the impact of on profit? So because of opening stock reduction, profit increased or decreased. Because of closing stock reduction, profit increased or decreased. Now you tell the numbers also. Straight away you tell the number. Because of closing stock, how much profit reduced? Because of opening stock, how much it impacted? 5,55,000 closing stock related. 5,55,555 profit decreased. So to make it normal, what we should do? Add. Okay. Okay, 4,44,000 opening stock related. It was what? It should have been more expense, but okay, it should be 44 lakh 44,444. But since you claimed only 3 lakh, okay. It's okay. I'll explain. Don't worry. అర్థం కాలేదు లాజిక్ వైష్ణవి ఆలోచిస్తున్నావా? It's okay, sir. Simple logic. Sir, only opening stock and closing stock alone we'll talk now. Rest you can do. Okay, see first. Sir, here closing stock and profit are like friends. Closing stock and profit are like friends. If closing stock increases, profit also increases. Closing stock decreases, profit also decreases. Here we said undervalued or overvalued? Undervalued. Since closing stock undervalued, now closing stock was underreported. So profit also underreported. So to make it normal, what? Closing stock we should take to normal. So when you take closing stock to normal value, profit also has to be increased or decreased? Increasing. So the difference amount what we should do? Add. Okay. So the 50 lakhs given here is what? Underreported. That means this 50 lakhs equivalent to how much? 90%. So 50 lakhs into 10 by 90 if you do, you will get the amount to be added. 50 lakhs into 10 by 90. How much, sir? 5 lakh? 555. So this 5,55,555, what we should do? Add. This we should add. Then opening stock and profit are like enemies. Closing stock and profit are like friends. Both will grow together or both will fall together. Opening stock and profit are like enemies. If opening stock reduces, now profit increases. Since opening stock was underreported or profit was increased. So what is the underreported value of opening stock? Sir, this 40,000, sorry, this 30 lakhs is there, na? This 30 lakhs is equivalent to how much? 90%. We want how much underreported? So 30 lakhs into 10 by 90. How much? 333. So to the extent of 3,33,333, your profit was increased because opening stock reduced, profit increased. To make it normal, what we should do? The 3,33,333 has to be reduced. So 5,55,555 we should add. 3,33,333 we should what? Reduce. We should reduce. Sir, understand, sir, this logic? This point was tested in 2 times in the exam question. Opening, closing stock adjustments already. Okay? But normally in our tax books will not find how to solve a opening stock adjustment and closing stock adjustment. But in exam they are asking that point also, and you will not even think of how to solve opening stock, closing stock adjustment also. Sir, it doesn't mean you don't know. You didn't expect at that point, so you'll not able to solve that point immediately. You'll be thinking of multiple ways, whether I have to do 100 by 110 or 10 by 1. Okay, different ways you'll calculate. You may add or you may subtract. Differently you'll do. It's okay. So simply, sir, closing stock, profit are like friends. Closing stock undervalued now, profit also reduced. So to make it normal, what we should do? The difference amount we should add. Closing stock overvalued. Closing stock overvalued, profit also increased. So to make it normal, the difference amount what we should do? Subtract. Then opening stock and profit are like enemies. Okay. So opening stock reduced, undervalued. Profit was increased. So to make it normal, the difference amount we should subtract. Opening stock overvalued. Sir, when opening stock overvalued, now profit reduced. To make it normal, difference amount we should add back. Okay. Now solve the question, sir. If you complete this question, we can take break. So okay, everybody got same answer? Okay. Sir, we already wrote here adjustments related to stock. Closing stock undervalued, profit reduced. So difference amount add. Closing stock overvalued, profit increased, difference amount reduced. Opening stock. So okay, these adjustments we wrote. Now stock adjustment also. Closing stock 50 lakhs given, which equals to 90%. Since it is undervalued, profit reduced. So correct amount is how much, sir? 100% is 55 lakh 55,555. So it was undervalued by 5 lakh 55,555. So this amount we should add. Opening stock also 30 lakhs given, which is 90%. 100% is how much? 33,333. So the difference amount 3,33,333. What we should do? Reduce from accounting profit. Now accounting profit, how much is in the question, sir? 32 lakhs. So for 32 lakhs, closing stock adjustment we have added. Opening stock adjustment we have subtracted. Then provision for tax added. Agricultural expenses added. Depreciation as per books of accounts 5 lakhs added, and as per income tax subtracted. Then bad debts recovered, sir, it is an income but not credited to P&L. So we shall recognize it as an income. So 1 lakh has been added. Then rental incomes are not related to PGBP, subtract. Profit on sale of shares not related to PGBP, subtract. Agricultural income exempted, subtract. So if you do all that, you got PGBP income 24 lakh 22,222. Okay. See, 28 and section 41 together will help us in deciding which incomes are chargeable to tax under the head PGBP. So first, the main role of charging section is what? Sir, for every head there is a charging section here. For salaries chapter there is a charging section, house property there is a charging section, PGBP, capital gains, IFOS. For every head there is a charging section. So ultimately, what is the role of charging section? Charging section helps us in deciding which income is chargeable to tax under which incomes are chargeable to tax under a particular head. So by referring to 28, we can understand what incomes are chargeable to tax under head PGBP. First one, profits and gains from any business or profession carried on by SSE during the previous year are chargeable to tax under that PGBP. However, profession includes vocation as well. Profession includes vocation as well. Profits and gains from business or profession includes vocation as well, carried on by SSE during the previous year. Exceptions. Dividend income, sir. Profits and gains from business or profession are taxable under that PGBP. Dividend income, sir, even in the course of your business also, if you receive any dividend income is always taxable under what? IFRS income. Interest, sir, majorly. If it is for bank, na PGBP only. Sir, interest we should earn, we should understand whether it is active income or passive income. For banks, interest is an active income because their main business itself is what? Lending and all. So banks, NBFC, financial institutions, for them interest is taxable under PGBP only. But in general, for normal businesses, if they get any FD interest or any on loans and advances, if they get interest, that is taxable under where? IFRS. Then any winnings are there, taxable under what? IFRS. Income from let out of residential house property, that is also taxable where? Under the income from house property. Profits and gains from business or profession carried on by SSE during the previous year. Dividend income under IFRS, interest IFRS, winnings IFRS, whereas house property na let out rent related na taxable under house property. Then this is important, sir. Partnership firm pays any interest, salary, bonus, commission to partner. Interest, salary, bonus or commission. All these incomes are to partner. Interest na it will not be taxable to taxable under IFRS set to partner. Salary na not under salary set. All these incomes which are paid by firm to partner were taxable to partner under the PGBP head only. If you are a partner and you receive interest from your firm, salary from your firm, bonus or commission from your firm, all these are taxable to the partner in the PGBP head only. Okay. For any other normal interest he receives, that taxable under IFRS set. If he receives any other normal salary, taxable under salary set only. But if he receives them interest, salary, bonus, commission from partnership firm, then they are taxable under that PGBP. Then partnership firm even gives share of profit to partner. It not only pays interest, salary, bonus, commission, it even gives share of profit also to partner. Sir, but share of profit, yes, to partner, this share of profit also has to be treated as what? Business income only. But understand, this share of profit which is received by firm to partner is exempted. If only when, if the firm is registered in India. If the partnership firm is registered in India, firm pays any. If the partnership firm is registered in India, if firm pays any share of profit to partner, such a share of profit, it is business income only. But still it is exempted. If the firm is registered outside India, then taxable under PGBP head only. No exemption available because it is registered outside India. So are you able to understand, sir? From firm, partner receives any interest, salary, bonus, commission. That is chargeable to tax under that PGBP only to partner. Then firm has profit. That profit will be distributed to partners. So partner got his share of profit. His share of profit is also business income only. But if it is a firm registered in India, then to partner such share of profit is exempted. If it is firm outside India, then that share of profit is taxable. Understand, sir? Okay. Sir, why only for profit it is exempted? Because in firm capacity already the profit is taxed. After taxing only, the surplus money they are distributing to partners. Again, if it gets taxed in the partner capacity, there will be double taxation. Firm capacity already taxed, same amount when it is given to partner, again it is getting taxed. So to prevent that, what they said, since it is already taxed in the firm head, any distributions to partner will not be taxed. Once again, it will be given as what? Exemption. Okay, then. Interest, salary, bonus, commission, sir. With respect to this interest, salary, there is a disallowance or there is a limit given. Why? So let's say for example, so BCCA has to give share of profit to me. So the problem is what, sir? Let's assume BCCA is a firm. So now what? BCCA has to pay 30% tax on its profit. On paying 30% of tax, if it still has any profit, out of that profit, it gives share to me. So this is the point. Now the problem is what? Sir, if this profit, sorry, I'm not talking about, okay, share of profit. Sir, already the profit is getting taxed at what rate? 30%. Let's say some tax planning has to be done. So what is happening? So BCCA is paying whatever the profit, it has to be given as share. It was giving it as interest on capital or as like salary to me. Instead of giving the profit share, they are giving it as interest and salary to me. Then what happens? BCCA, sir, it will claim interest and salary as an expense. So what happens? BCCA profit will come down, it will pay less tax. So to my extent of money, sir, let's say I have to receive some 70 lakhs. Okay, my share of profit. Now this 70 lakhs, if they give us share of profit, first it gets taxed in BCCA hands, then only the balance will be given to me. Right? Now to avoid this, what they are doing, they are giving they are not giving it as share of profit, sir. 70 lakhs, they paid it as like what? Either interest or salary. Now what? BCCA profit also reduced by to an extent of 70 lakhs, and ultimately BCCA paid less tax. Yes or no? Okay, this has happened. Now, this interest and salary is not a genuinely interest and salary which I should get. Why they are paying like that? They are diverting profits to me in the name of interest and salary. Here the firm is just diverting profits in the name of interest and salary. It's okay. Profits and gains from business or profession, we already discussed, sir, is taxable under what? PGBP. Dividend income is taxable under IFOS. Interest income is also taxable under IFOS. Winnings also taxable under IFOS. But understand, sir, interest, if it is an active income, like for banks and BFC financial institutions, it is taxable under PGBP head only. Then when partnership firm pays any interest, salary, bonus, commission to partner, that is a business income to partner. And even if it gives share of profit also, that is also a business income only. But share of income is exempted when the firm is registered in India. Now, we thought of discussing something. Sir, here what? I said like, when BCCA is paying interest salary to me, instead of paying it as a share of profit, why they do so? Or why it has to be done in such a way? If it is given as share of profit, now already BCCA has to pay tax, and that profit after tax only will be given again as share to me. Okay. Sir, again, I can claim it as exemption, because already since it is taxed with the BCCA hands, I can claim exemption. I already said the exemption also. But still, sir, for me, I can enjoy slab rate benefit. But for now, it has to be taxed at flat rate benefits. And okay, flat rate and all. So that's why it is better to claim it as what? It is better to pay it as interest and salary only to me, so that I can enjoy what? Slab rate benefits and all. Okay, and then to that extent, firm can claim it as, what? Expense. So in firm's capacity, that amount is not being taxed. So when it is taxing in my capacity, I can enjoy what? Slab rate benefits and other deductions and all also I can claim. So it is better, instead of giving it as profit share, to root the profit in the form of interest, salary, commission, or some other way. But tax will not allow it, right? So it's like something like tax planning. So then they introduce a provision to control these kind of practices, because many firms started doing that. They were diverting profits from the firm in the name of interest, salary, commission to the partner. Okay, more than that of the actual commission they'll pay, so that the profits will be diverted to the partner in the name of interest and all. So that's why they introduced the section called 40B, which gives the limit on interest to be paid to the partner or salary to be paid to the partners. Interest to be paid to the partners or salary to be paid to the partners. Interest, bonus, commission to the firm, it is allowed as deduction. Interest, bonus, commission to the firm, if it is allowed as deduction. Let's say, sir, for interest, they'll give 12% as the cap. I mean, maximum if any interest is being paid, how much percentage can be paid maximum? 12% only. Okay, it is how much? 12% only. But okay, sir, then let's say for me, interest paid at 18 lakhs at a rate of 18%. But what PGBP 40B is saying, like only to the extent of 12% is allowed. So firm cannot claim as 18 lakhs expense. It can claim only how much? 12 lakhs as expense. Let's say, sir, to firm 12 lakhs is allowed as deduction, right? Then to partner, that 12 lakhs is taxable. The interest element which is disallowed to the firm is not taxable to the partner. Let me show you, sir. P&L account. Sir, interest salary debited to the firm is how much? 10 lakhs. Out of this, 40B has given a cap and said only 7 lakhs is allowed. That means what happening, sir? The other 3 lakhs is being taxed in the firm capacity only. Even though firm paid 10 lakhs, it can claim it as expense only to the extent of 7 lakhs. So only 7 lakhs was reduced from firm profit. The other 3 lakhs is being taxed in whose capacity? Firm capacity. Since that 3 lakhs already taxed in firm capacity, again it won't be taxed in my personal or partner capacity. The 7 lakhs which was not taxed, which was allowed in firm capacity, has to be treated as my income. Are you able to understand, sir? Total paid 10 lakhs only, but firm can claim as deduction or allowed as deduction to the firm only to the extent of 7 lakhs. Since in firm capacity that 7 lakhs is not being taxed, to me in partner capacity that 7 lakhs will get taxed. The 3 lakhs which is disallowed to the firm, 3 lakhs is being taxed in whose capacity? Firm capacity only. So that's why the 3 lakhs is not taxable to me. See, firm allowed as deduction, taxable only to the extent allowed as deduction to firm. Even if it is allowed as deduction, taxable only to the extent it is for both interest, bonus, commission or salary, allowed as deduction to firm. Then to partner also, not the full amount he received is taxable. Only to the extent which was allowed to the firm is taxable to partner. Sir, why the balance is not taxing? Because the balance is already taxed in. Sir, I got 10 lakh rupees, sir. But for firm didn't claim 10 lakh rupees as expense. My income should be expense to whom? Firm. But firm is not claiming the 10 lakhs as expense. How much it is claiming? 7 lakhs only as expense. Then my income also should be how much? 7 lakhs only. That's what we are saying here. If firm can claim 7 lakhs as expense, I can also, being a partner, I can also claim as income as 7 lakhs only. If firm can claim 10 lakhs, I can also consider income as 10 lakhs. Understand? Since 3 lakhs is disallowed there, 3 lakhs is being taxed in the firm capacity only. Since it is already taxed in firm capacity, it won't be again taxed to me. Okay. Then any compensation or other payments received in connection with business or profession. What does it mean? Sir, I have an agreement with vendor to supply raw material. Now that fellow supplied wrong quality material. By using that wrong quality material, all my machines also got damaged. Okay, because there is a specific quality standards, then the machine can process it. Because of a low quality material, it's not only affected my production, even my machines also get damaged. So I sued him, and from him I got compensation. So now this compensation is related to business or not? Yes, since it is related to business, that compensation is chargeable to tax under PGBP head only. Any business related compensations I get, all that are chargeable to tax under that PGBP. Okay, then export incentives received. If you are already listening to IDT class also now, you know export incentives, like in FTP we'll discuss so many things like duty drawback received, RODTP, advance authorization, any other. Okay, DFIA is a transferable license. From sale of that DFIA, if you got any money, all these export incentives are taxable under where? PGBP head only. Because of doing business only, you are getting those export incentives. So they are related to business and they are taxable under that PGBP. Then trade, professional or similar associations providing services to members. Then the amount received is taxable under that PGBP. Okay, sir, understand. There is a golf court. Golf. We see, right? You know golf? Okay, there'll be a big ground, almost 10 times of cricket ground, but there won't be that many players. Okay, there'll be only one player. He will hit the ball. Then he has to travel through a vehicle. Okay, so you know that game, right? So usually, sir, why only few people are playing? Why can't we also can go and play that game? Because for them, sir, mostly they are maintained by some associations. That membership itself will be in lakhs. Okay, since we cannot pay that much membership, we are not going into those kind of places and all. So now, sir, this golf court is maintained by an association. They are providing services to everybody, only to their members, only to their members. So what is the service? Access to that ground is the service they are providing. For that, member has to pay membership fee like 5 lakhs or 10 lakhs, it depends. That membership fee is the amount received by those associations, and those fees are taxable under the head PGBP only. Understand? So those associations for providing services, privileges, if they get any consideration from members, all their money received is chargeable to tax under the head PGBP only. Then value of any benefit perquisite arising from business or profession. Value of any benefit or perquisite arising from business or profession. Sir, let's say you have been appointed as an auditor of company. So now, for you, audit fees fixed is 5 lakhs. That 5 lakhs is your professional income only, no doubt about it. But to go to client place, let's say you are in Hyderabad, your client place is in Mumbai. To and fro, the flight ticket is also booked by your client only. Their accommodation is also provided by your client only. Food also provided by client only. Now, all these to and fro, flight travel, accommodation, food amounts to 50,000. That is a perquisite to you. Because he's giving extra benefit to you rather than that of 5 lakhs audit fee. Now what to be done? This 50,000 also has to be included in your business income only. So your business income, professional income is not just 5 lakhs audit fee. Even this perquisite you received 50,000 also has to be counted as audit fee. Then some received for not doing an act, restraining to do an act, or for not sharing any patent, know-how, etc. Sir, some received for not doing an act. So let's say, as of now I'm taking classes only at where? BCA. Okay, let's say if I have time, another 6 months if I'm idle, and I wanted to take class some other place also. Okay, but BCCA wants me to take classes only in BCA so that they have that exclusivity. Okay, but I'm compromising my option right. So I have the option to take classes somewhere else also, and I could earn more. Since I'm compromising that option, then BCA has to pay some extra amount for me. Sir, for receiving that extra amount, I'll not do anything. What I'm doing, for not doing anything only, I'm getting money. Understand? Some received for not doing an act. What is the act? Taking classes in elsewhere is the act. For not doing that act, if I receive any money, or restraining to do an act. Not doing an act, or restraining myself from doing an act, or for not sharing any patent, know-how, if any money is received, non-compete fee, such kind of amounts, these are also chargeable to tax under the head what? PGBP only. Okay. However, sir, where some is received for transfer of patent, know-how, copyright. Sir, here you are what giving? You are getting money for what? Not sharing patent and know-how, but you are selling your patent. You are selling your know-how. Then it is patent know-how is also a capital asset. Here we are referring what? Getting money for not sharing or for giving your patent for use. If you receive any money, that is taxable to tax under that PGBP. If you are selling your patent itself, then it is a transfer of capital asset. The amounts are chargeable to tax under capital gains. Then Keyman insurance policy. Who is Keyman, sir? Spider-Man, he'll have Spider and all, Superman, Batman, just like him, Iron Man. Keyman, he'll not be wearing any key. So Keyman means crucial person to the organization. If these key persons leave an organization suddenly, okay, then business has to suffer the loss. Okay, there is a risk of business suffering loss. Wherever there is risk, there will be insurance. Wherever there is risk, there will be what? Insurance. So our risk, sir, these kind of risk cannot be controlled. In any organization, key person may leave the organization because of 100 reasons. He might have any reason, but he may leave. But the organization has to sustain even when this key person leaves the organization. So to cover that risk, usually what the business will do, sir, they'll take a Keyman insurance policy premium. Or Keyman insurance policy they'll take. Okay. Now how this policy works? So this policy, just like as normal life insurance policy also, only, this also, they have some fixed term. Let's say 10 years. If within this 10 years, that key person left the organization, then already organization is having some loss. To cover the loss, the policy amount will be given. Or else, 10 years completed, employee didn't left, so there is no loss to the company. But still, the policy gets tried since the policy term is completed. Just like as sir, you took a life insurance policy up to age of 60. you'll get sum insured at the age of 60 or before 60 if the person expires, then also his family will get the sum insured. Same way here, instead of expiry of the person leaving the organization, if within this 10 years employee leaves the organization, then also policy gets struck, or the policy term 10 years completed, then also the policy of sum insured will be given. Okay, now three options. One thing, employee left the organization, this key person left the organization. Second one, key person didn't left, he continuing only. Third one, key person not only left the organization, he left the whole world itself. Okay, he was expired. These are three kind of situations here. First one, key man left. Sir, key man left na, then company is having some loss, organization is having loss. To cover the loss, organization itself will retain the money. So then the key man insurance policy proceeds received by the company are taxable under the head PGBP. Sir, just because I am referring company na, it's not only for company, for any SSC. If key man insurance policy received and it is retained by the business person or the employer himself, na, then it is taxable under the head PGBP. Second case, key man didn't left the organization. He is there only 10 years. Now that means what? He is loyal to the company or loyal to the business. Then what employer did? Whatever the money he got from key man insurance policy, that money he given it to that employee only or key man only. So now it is an income to whom? Key man. Since it is an income to key man, it is chargeable to tax to him under the head salaries. It is chargeable to tax to him under the head salaries. Third one, sir, key man not only left a company, left a family, everybody, and he went to heaven. So in such case, sir, the key man insurance, sir, the loss to the company and loss to the family also. Maybe the loss to the family is much more than compared to the loss to the company. Then in such case, whatever the key man policy, insurance policy proceeds are there, they might be given to the family of key man. So when it is given to the family of key man, they are not employees of company. So for them it is not taxable under salary, it is taxable under the head IFOS. Okay, so key man insurance policy proceeds are there and they were retained by the business itself, then taxable under the head PGBP. They were given to that key man itself, taxable under the head salaries to the key man. They were given to the family members of key man, then they are taxable to family members under the head IFOS. Then fair market value of inventory on its conversion of capital cost. Okay, so Vaishnavi is a contractor. She construct these buildings, these kind of buildings she'll construct and sell them. Okay, commercial plots and buildings she'll construct and she'll sell. She is into that construction real estate business. Then she also believes in astrology and then this Vastu Shastra, all this she believes. Now they said like this particular block, if she keep it as her office, then her business will go now tenfolds also. Okay, then what she did, sir, actually she planned or she constructed this building for what? To sell each and every flat, either for commercial or for residential purpose. But now what they said, her astrologer said like, if this particular block, okay, this corner block, if you keep then you'll get married immediately, then then your business also will grow 10 times, 20 times, like that they said. So what she did, sir, till now it is her stock in trade, because her business is to construct buildings and sell. So when it is like her raw material, work in progress, finished good. So it is nothing but stock in trade. But now what she is doing stock in trade, she is converting into her office. So when it is converted into office, it is becoming a capital asset. So when stock in trade is converted into capital asset, what to do? So the problem is, for this construction, whatever the expense incurred, she charged it to P&L. For this construction, whatever the expenses incurred, she charged it to P&L, debited all those expenses. But since it is not being sold, the corresponding revenue is not there in the P&L. If they were sold, the sale profits will be created to P&L. Since it is not sold, converted into capital asset, expense you booked, but there is no corresponding income you have booked. So what the provision is saying, like when inventory is converted into capital asset, the flat was not sold, no money realized, but still the fair market value of the flat you consider it as sale value and consider it as the income. So why we have to consider it as income? Because for the construction of flat, whatever the amount incurred, you already claimed it as expense. So the relevant income also you should book. It is not a real income, but still the fair market value of the building or the inventory which is converted into capital asset has to be considered as your income or sale proceeds. Understand, sir? Okay. Then sum received or receivable in cash or kind on account of any capital asset where whole expenditure is allowed as deduction under section 35 AD. So there is a section called 35 AD. For certain specified businesses, to encourage such kind of businesses, 100% of the capital expenditure is allowed as deduction. So no depreciation. Sir, I purchased plant and machinery for 30 crores. 30 crores I can charge it to P&L in first year itself if I have 35 AD benefit. Okay. Sir, I claim 35 AD benefit. I claim 100% of capital expenditure as deduction. Now what will be my asset cost? Sir, usually plant and machinery you purchase for 30 crores. Every year what happens? Depreciation. So when you charge depreciation, asset value remains same or decreases, sir? Decreases, right? But here what happened? Plant and machinery 30 crores. But the total 30 crores you charge it to P&L in the first year itself. Now what is the asset cost? Asset cost zero. Asset cost zero, right? Sir, why they allowed to claim you the total expenditure in the first year itself? They believe that you gonna use this asset for a certain period of time instead of postponing the benefit. Sir, depreciation also same impact only. But instead of getting the whole 30 crores in first year, every year you will get some benefit. First year some benefit, second year some benefit, third year some benefit. Here what happened? The total benefit you got in the first year itself. Why they given like that? Because they trust you that this asset is going to be used for the business only for the coming 5 years, 10 years and all. So there's a lock-in period of their 8 years. So they're expecting that you will use that machinery for 8 years. But what you did? You claimed deduction first year. Second year you sold. Second year you sold for a benefit. So now what? Do you follow lock-in period or violated lock-in period? Violated lock-in period. Since you violated lock-in period, whatever sale profits you got has to be again considered as income. At the time of purchase, they given 100% capital expenditure as expense. And they kept a condition like 8 years you should use it for the same business. Then the next year, immediate next year, you sold the asset. Since you sold the asset, you are violating the lock-in period. Since you are violating lock-in period, whatever the sale proceeds you'll get, again treat them as income. Okay? Clear, you understand, right? There is extra point also here. The extra point is, so first year, 30 crores plant and machinery. You claimed a deduction how much? 100% capital expenditure, 30 crores you are claimed. What is the asset cost? 0. Since asset cost is 0, you are not able to claim depreciation. So you lost what? Depreciation benefit. Now, what is happening, sir, in the next year? Whatever the benefit you got, they have been reversing that benefit by way of considering the sale proceeds as income. Are you able to understand, sir? Whatever the sale proceeds you got, they are considering it as income. In another way, whatever the benefit they given in first year, since you are violating lock-in period, second year they are reversing your benefit. But understand, by getting 35AD benefit, you lost depreciation benefit. By getting 35AD benefit, what you lost? Depreciation benefit. Now, if 35AD they reverse, they should give again what? Depreciation benefit. So, see, capital expenditure, 500 lakhs. 35AD deduction, how much they claimed? 500 lakhs. Asset cost became what? 0. Then in 26-27, such asset was sold for 450 lakhs. Okay, this 450 lakhs we should recognize that what? Income only. But the thing to be understand is like, sir, now you are foregoing 35AD benefit. So what benefit should be given? Depreciation benefit. If at all, first itself there is no 35AD benefit, you might have claimed depreciation. That depreciation benefit has to be given now. So what? Depreciation that might be availed if no 35AD deduction. How much? 500 lakhs into 10%. 50 lakhs is there na? Subtract this 50 lakhs. Balance 400 only you should recognize as income, not the total 450 lakhs. Why, sir? Out of 450 lakhs, you are reducing depreciation impact also. Balance only you are recognizing it as income. So are you able to understand or not? 35AD benefit given. So depreciation lost. When 35AD is reversing, then again the depreciation lost has to be given. Okay, so that's what the depreciation lost has been given. That's why we are subtracting 50 lakhs and the net 400 lakhs is only taxable. So these are PGBP points. Let me once again tell you. 10 points are there under the charging section. First one, you are doing any business or profession. From that you got any profits or gains. Those are taxable under which head? PGBP. Okay, but incidentally from your business you got dividend income. Taxable under IFOS. Interest you got IFOS. Winnings you got winnings lottery IFOS. Income from let out of house property. House property and it is taxable. Okay. Then partnership firm is paying interest, salary, bonus, commission to partner. It is taxable where? It is taxable under that PGBP only. Firm is giving share of profit to partner. It is also business income only, but exempted if the firm is registered in outside India. Registered outside India. Taxable only, taxable under which head? PGBP head. Okay. Then I said one more point. Interest, salary. If these are allowed under 40B, firm can claim as expense. Partner head, it is taxable. How much are allowed? That is taxable. In firm capacity, it is disallowed. Then to the extent of disallowed amount, partner capacity, it is not taxable. Then any compensation or payment received in connection with business or profession. Then any export incentives received like cash assistance, duty drawback, profit on sale of license. Then where any association providing services to members and from members it is collecting any fee, that fee is also taxable under that PGBP. Value of any benefit or perquisite received in the course of business or profession. Sir, let's say I have started a car showroom. Okay, I'll be selling Tata Motors car. In a particular month, I have sold 500 cars. Okay, none of the other showrooms or dealers of Tata Motors couldn't sell 500 cars. I have performed extremely well. I sold 500 cars in a particular month. Now they want to appreciate me. So that's why they've given me some non-monetary asset. So maybe they have given me some Jaguar car as gift or some Range Rover car as gift, which is worth Range Rover and all, maybe it worth like some 1 crore or 2 crore, 1 crore, let's say. So now that 1 crore is what? It's a perquisite to me, which I received in the course of business only. So it is taxable under which head? PGBP only. Okay. Some received for not doing an act or restraining to do an act. So this happens in so many times. So let's say Intel is manufacturing a processor. The same processor, Intel is manufacturing a processor and supplying it to Apple. Now Apple wants their uniqueness. That's why what they are saying to Intel, for giving the processor, will pay, let's say, some 30,000 crores. For not sharing the same processor with any other company, will pay extra 10,000 crores. The extra 10,000 crores is for what? Not doing an act or restraining to do an act. The 10,000 crores is also taxable under which head? PGBP head only. Then Keyman insurance policy profits retained by business only, taxable under PGBP. Given to employee, taxable to employee under salaries. Given to family members of employee, taxable to them under that PGBP. Then inventory converted into capital asset. Okay, so the fair market value of that inventory has to be considered as the PGBP income. Even though it is not credited to P&L, we should realize that amount as income and add. Then some received or receivable in cash or kind on account of capital asset, but after allowing the 32 depreciation. Then sir, section 41, it is about, this is also incomes related only. 41 subsection 1, remission or cessation of a trading liability. Remission or cessation of a trading liability. What does it mean? Sir, in previous year 24-25, you made purchase of 30 lakhs. And it was allowed as deduction on accrual basis. You didn't pay 30 lakhs, but still on accrual basis you claimed it as what? Expense. Now current year, in 25-26, you are making this 30 lakhs payment. What you said? You asked the Sir, you ask the creditor saying like, sir, I'll not pay 30 lakhs because the quality of goods are not as per my requirements. So that's why I'll not pay 30 lakhs. I'll pay only 20 lakhs. He also agreed. Now what you did? Creditor agreed to settle the liability for how much? 20 lakhs. Now the difference, sir. Sir, last year you already booked as expense how much? But you are paying 30 lakhs, huh? You are paying only how much? 20 lakhs. For payment of 20 lakhs, you claimed expense of how much? 30 lakhs. Now the difference 10 lakhs. You have to claim it as income in the current year. Because since you already claimed 30 lakhs as expense in the year, but originally you paid only 20 lakhs, that extra 10 lakhs, you need to reverse it. Reverse it now, nothing but what you are doing, you are again claiming it as an income in the current year, which we call it as remission or cessation of a trading liability. Now the difference 30 minus 20 lakhs, 10 lakhs, treat it as a business income for previous year 25, 26. See, remission or cessation of a trading liability. Claims deduction for certain loss or expenditure and later on some benefit or amount received with respect to that benefit or amount received. Then this has to be treated as what? Business income. The 10 lakhs we have to recognize as what? Business income. Then balance charge on depreciable assets to power sectors. Sir, actually in income tax, you have to follow only WDV method for depreciation. WDV method. What is WDV? Written down value method. However, for power sector undertakings alone, there is an option to follow SLM. They can either follow SLM or WDV. Sir, what is WDV and SLM based difference now here for the purpose of tax? In WDV system, we'll follow block system. In SLM system, we'll follow individual asset wise, not a block system. Sir, what does it mean by block? Assets of similar nature and which are chargeable to depreciation at a similar rate will be grouped, and such group is called as block. Sir, in BCCA, there are like some 500 benches. In different campuses, all those are counted to 500 benches. Now, not only benches, then this kind of tables, chairs, the office room furnitures, all these are chargeable to tax at what rate? 10% only. Now, all these will be grouped, and this group is called as what? Block. And there are several air conditioners, electric equipments, TVs, all these are chargeable to depreciation at a similar rate. So all these electronics will be valued and will be grouped, and such group is called as what? Block. So usually block system has to be followed. But power sector undertakings has the option to follow even SLM method. I mean, instead of treating all of them as a single asset, we'll see each and every asset as a separate item. Okay? This applies only when SLM depreciation is followed. See what happened. Example, Lanco Power. Plant and machinery, sir, it purchased for 10 lakhs. Now, every year it is depreciating. Now, WDV came to 7 lakhs. This 7 lakhs asset sold for 6 lakhs. WDV how much? 7 lakhs. Sold for how much? 6 lakhs. Loss or gain? 7 lakhs of WDV value asset you sold for 6 lakhs. How much is loss? 1 lakh. This 1 lakh is allowed as terminal depreciation under head PGBP only. That loss 1 lakh, you can claim it as expense. What is the name for that expense? We'll call it as terminal depreciation. Okay? Then, example 2. Cost 10 lakhs. WDV 7 lakhs. Sold for 8 lakhs. How much gain? 1 lakh. This 1 lakh gain also treat as deemed income under the head PGBP. Deemed income under the head PGBP. Third scenario, see. Cost 10 lakhs. WDV 7 lakhs. But sold for how much? 12 lakhs. I mean, more than cost value you have sold. So up to cost, whatever is the benefit, that is income under that PGBP. Above cost, whatever the benefit you got, that is taxable under that capital gains. See, 3 lakhs gain. Cost minus WDV is business income. 2 lakhs gain. Sale value minus cost has to be treated as what? Short-term capital gain. Sir, why short-term? On sale of depreciable assets, the gain is always short-term capital gain only. This point you are able to understand, sir, here. Nothing but balance charge on depreciable asset. What is balance charge? Then an asset is sold. When a depreciable asset under SLM is sold for power sector undertakings, we should look at what value it is sold. The difference between cost and sale value. Sorry, the difference between, if the sale value is above cost, then the difference between cost and WDV has to be recognized as PGBP income. The benefit above cost you got has to be recognized as short-term capital gain. Then, sale of asset used for scientific research. Sir, this is something similar to that of 3580 point. Previously under 28 I have explained 3580 point. What? You claimed 100% capital expenditure, but later on you are not fulfilling the lock-in period condition. So whatever the sale proceeds are there, that you will be again recognizing it as income. Same way, under scientific research also, if any asset acquired for the purpose of scientific research, then 100% deduction can be claimed in the first year itself. But later on, you are using it for a different purpose or conditions were not satisfied. Then what? Whatever is the benefit given, expense you claim, will be again treated as income in the year of violation. That's what. Then, recovery of bad debts. Recovery of bad debts. I already said, we already did also, sir. Recovery of bad debts. Previously you claimed as an expense, but again you are recovering back that amount. So that recovery of bad debts also what? We should consider it as income. Recovery of bad debt. So let me show you the example, sir. Bad debt 10 lakhs written off in books of accounts allowed as deduction fully under section 36. Okay. Out of such 10 lakhs bad debts, how much recovered in current year? 6 lakhs. Then this 6 lakhs we should recognize as what? Deemed income. This point very important, sir. Already I kept as start. Bad debts in P&L you debited 20 lakhs. But as per income tax, out of this 20 lakhs, only 12 lakhs was allowed to be written off. In the past, you have, as per accounting, you realized how much as bad debt? 20 lakhs. But income tax they allowed only to the extent of 12 lakhs as bad debt. I mean, as per income tax, how much bad debt you have written off? 12 lakhs only you have written off. Now you realized the 15 lakhs. Does the whole 15 lakhs has to be treated as income? No, sir. See, out of 20 lakhs, how much was written off in PGBP, sir? As per income tax, how much is written off? 12 lakhs. That means still you have debt of how much? 8 lakhs. Now if you recover 50 lakhs, first you consider this amount 15 lakhs as the 8 lakhs debt received, which is still pending only as per tax books, that 8 lakhs received. The balance 7 lakhs only we should consider as recovery of bad debt. We should not consider 12 lakhs or 15 lakhs as income. అర్థమవుతుందండి? మనకి రికవరీ జరిగితే రిటర్న్ ఆఫ్ అయిన అమౌంట్ మొత్తం వచ్చేసినట్టు కాదు. ఫస్ట్ ఏదైతే రిటర్న్ ఆఫ్ చేయలేదో అది ఫస్ట్ వచ్చినట్టు. Are you able to understand, sir? When you received bad debt, any money, that money first you should adjust for the debt existing. Then the excess money if you have received, that you have to consider as bad debt written off which has been recovered. Here, even though as per accounting 20 lakhs bad debt written off, as per tax, how much is the bad debt written off? 12 lakhs only. That means still you have how much debt? 8 lakhs. Now if 15 lakhs received, this 15 lakhs first you should think like what? That 8 lakh debt received, the balance 7 lakhs is only the bad debt written off has been recovered. So only 7 lakh has to be recognized as income. Sir, important points are these also. Okay. Then, not much important points, sir. These are like simple points only. Any amount withdrawn from special reserves, sir, for bank, financial institutions, tea, coffee, rubber developments, all these for them, separate special accounts will be created. Every year they'll transfer certain amounts to their reserves. Okay, separate amount. Sir, site restoration, there is a coal mining company. They do mining for 30 years. After 30 years, the total mine has been extracted. Now, will they leave the place like that and go now? What they have to do? They have to again make the place normal. They should again fill the total mining area with sand. With sand only they should fill it everything and make it as a normal land. That's called what? Site restoration fund. But when restoration has to be done, when? After the completion of business. That restoration also takes a lot of money. For that, every year they'll make some appropriations. Every year from profit, let's say this year 10 lakhs, next year 10 lakhs, like that. Every year they'll keep funds separate to do the site restoration. Every year, whatever you keep for separate site restoration, allowed as expense. Now, towards the end, you are not using that money for site restoration. You are using that money, which is set aside for site restoration, used for a specific purpose. Other than specific purpose, then whatever the money given as an expense previously, now again has to be treated as income, and it is taxable here. So any amount withdrawn from special reserves other than for the specified purpose, if it is for the specified purpose only, no problem. Utilized for wrong purposes, then it has to be treated as income. Then last one, sir, brought forward loss of discontinued business can be set off with deemed profit. Sir, your business already discontinued, that business, but that business related, sir, you have 3 businesses. One of them is like iron related business. In this iron business, you have some 70 lakhs loss. It is being carried forward only. Still, that loss is there. 8 years also completed. Maximum loss can be carried forward for how many years? 8 assessment years. That 8 assessment years also there. But still how much loss you are having? 70 lakhs from iron business. Now that iron business related, some bad debt which was written off 10 years back was paid now. 30 lakhs bad debt which was written off some 10-15 years back was been paid now. Now whether the 30 lakhs is taxable with respect to a discontinued business. Sir, what they are saying, even though it is a discontinued business, you got bad debt recovered, right? Deemed profit. How much? 30 lakhs. But you have loss also. Loss how much? 70 lakhs. Even though 80 years expired, still you can adjust the deemed profit with the discontinued business loss. So effectively still you will have loss only, nothing will be taxable. Brought forward loss of discontinued business can be set off with deemed profit, can be set off even after the expiry of 8 assessment years. Understand, sir? So this is about what? Section 41. So by referring to 28 and 41 thoroughly, you will understand which incomes are chargeable to tax under the head PGBP, most of the cases. Okay? Sir, again, I don't know how can you make time, but if you don't revise and come, sir, PGBP throughout the chapter, it has to be studied cumulatively. If 28 and 41, you cannot remember, you cannot forget now. Sir, deductions chapter, it's already done. Even if you don't remember deductions chapter today, no problem with PGBP. But today's class has to be retained for the coming 4 or 5 classes also until I complete PGBP chapter. So I cannot take every day as like a new chapter, sir. This is continuation part. Only when you revise number of times you can retain. Only when you can retain and give the answers quickly, we can go forward quickly. Understand? Revise and come PGBP. PGBP నేర్చుకోవాలంటే మాత్రం ఖచ్చితంగా రివైజ్ చేశారండి, లేదంటే మీ ఇష్టం. 8 years you can still set off the discontinued business loss. Till here we have discussed in the last class, sir. Format for computation of PGBP, sir, we already did yesterday with examples. Format for computation of PGBP is nothing but what? We'll start with accounting profit. We'll take certain items which has to be added and items which has to be subtracted. Ultimately we'll get tax profit. Then section 45. 45 is about what? Method of accounting. Sir, under PGBP, under IFOs. Okay, salaries chapter there is no method of accounting and also. Okay, salary is chargeable to tax on due basis or receipt basis. Okay, now here, sir, they are giving 2 options for us. If you want to follow, you can follow even cash system of accounting, or even you can follow mercantile system of accounting also. Anything. What is the difference between cash and mercantile, sir? Mercantile na accrual basis, cash na only on payment basis. Anything can be followed. Okay, but sir, cash mercantile mostly they are not testing in interlevel, in final level, because PGBP the question is mostly framed from company's perspective. Mostly framed from company's perspective. Since companies, I don't think accounting standards will allow to follow cash system and all. So that's why companies mostly follow accrual system only. So most of the questions at final level will see accrual based system only. But in inter level, sir, there can be a chance of asking even cash system also. Okay, cash system, mercantile system. Sir, all the rules we have discussed again accordingly to be adjusted based on cash system and mercantile system actually. Okay, and whichever the system he has to choose, that has to be regularly followed by SSC. Then The next one, sir, we are moving on to section 30. 28 charging section, 29 format, then we are going to section 30. So from 30, we're going to start about what? Expenses which are allowable. Okay. First one, rent, repairs, taxes and insurance with respect to building. Rent, repairs or taxes or insurance for building. Used for what? Business or profession. Repairs. Sir, on building, repairs has been incurred. SSE is only owner. His building, he's carrying out business or profession from that building, and to that building there are repairs. Those repairs, if SSE is a owner, those repairs can be claimed as deduction if they are revenue expenditure. If those repairs are capital repairs, then they are not allowed as deduction. What we should do, sir? Basic accounting thing only. Capital repairs we should add to asset cost and we should avail depreciation, capital expenditure and all. Revenue expenditure, now it is allowed to be charged to P&L. Same thing they are also saying. Revenue expenditure in with respect to repairs allowed as deduction. Capital expenditure you cannot claim it as deduction. What you should do? Add to asset cost. Okay. SSE is a tenant. He don't own building. He's just acting as a tenant. Sir, normally will tenant incur repairs or owner has to incur repairs? Sir? Normal. Owner only has to incur repairs. But if there is an agreement between owner and tenant, and that agreement states like any repairs has to be paid by tenant only, then in such case who is responsible? Tenant only responsible. Rent, sir. Repairs part is done. Then with respect to building, what can be there? Rent also can be paid. You took the building on rent, you are a tenant, you have to pay rental expenditure. Now, you took 5 floors building, sir. You thought all the 5 floors might be needed for you. But since the business didn't pick up that much speed as you expected, you thought the top 2 floors are not needed for you. So what you are doing, the 4th and 5th floor you are giving sublet to someone else. So for 5 floors you are paying 5 lakhs rent, and by way of subletting 4th and 5th floor you are getting another 2.2 lakhs as rent. So how much you are paying? 5 lakhs. How much you are getting as rent? 2.2 lakhs. So what is your net rental expense? 3.8 lakhs. So only 2.8 lakhs. 2.8 lakhs. So only the 2.8 lakhs can be claimed as deduction. The balance part has to be disallowed. But in accounting P&L, what they might have did? This side they might have credited 2.2 lakhs, and this side what they might have did rental expense they have did 5 lakhs. Okay. So what we should do, sir? This 2.2 lakhs we should what first subtract. And here out of this 5 lakhs will be allowed total 5 lakhs. Sorry. Out of this 5 lakhs what we should do? 2.2 lakhs we have to add back. Impact remains same, but still we should write the same entry. Sir, impact remains same. The profit will not have any change. Why? Because this side they credited 2.2 lakhs minus is okay already added, and here they have subtracted 5 lakhs. So what you are doing? 2.2 lakhs you are subtracting and 2.2 lakhs you are adding. Actually both will set off and there will not be any impact, but still those line items you have to show them separately because they'll check for that adjustment. Understand, sir? If there is any subletting has happened, then the rent you received actually will be created in the P&L, and the rent you paid totally might be debited in the P&L. But what income tax provisions are saying, like which is allowed? Only the net rent is allowed as deduction. Net rent now how much, sir? 2.8 lakhs is only allowed as deduction. So the balance 2.2 lakhs on the debit side you should add back, and if any 2.2 lakhs rental income credited on the P&L, that also we need to do what? Subtract. Sir, understood now this point? Okay, so rent expense what you will do? Accounting, rental expense you have, what you will do? See, look at it. You have total 5 floors building. How much rent you are paying totally? 5 lakhs. So what you will do? In accounting, you will debit to P&L. But 4th floor, 5th floor you have subletted. From 4th floor and 5th floor subletting, you are getting 2.2 lakhs as income. So that income, forget about tax, where it has been reflected in account, credited to P&L. So expense side 5 lakhs is there, income side 2.2 lakhs is there. Now what income tax is saying? Rental expense you cannot claim total 5 lakhs and all, you can claim only 2.8 lakhs. Actually, if you see accounting also, that only happened. They claimed 2.2 lakhs income and 5 lakhs expense. Net, they claimed 2.8 lakhs expense only. But on expense side, having that 5 lakhs is a problem for us. So that's why what we have to do as per tax purpose. First, that income we should not recognize. So income reverse on the credit side. So what you should do? Subtract you will do. Expense side 5 lakhs is there. 5 lakhs is not allowed. How much is allowed? 2.8 lakhs is only allowed. How much is disallowed? That also add back. That only I said. Okay. So rent. Then sometimes rent, they claim notional rent. So notional rent means what? So I'm using my own building only for my business. But there is opportunity cost. If at all I had carried out a business in some other place, this building I might have given on rent. Then I might have earned rental income. Now because of me doing business in my own premises only, I'm losing that rent, right? That's why to get the true profit, from business, I'm even charging what? Notional rent. Notional rent, I didn't pay it actually. Okay, my building only. But still, I'll charge the rental expense as paid it to me, business paid to me. Okay, whether such kind of notional rents are allowed or not. No, such notional rents, if any, debited to P&L, all those are disallowed. Sir, accounting wise, that is not wrong. Why? Because why accounting we are doing, sir? We wanted to know the true picture of business. Okay, to know the true picture, even you should charge that opportunity cost also, notional rent also. So accounting wise it is correct only. But tax purpose, what they are saying, like those kind of notional rents are not allowed. Not allowed. So what you should do? If anything is debited also, you have to add back. Sole proprietorship charging rent on old building, then not allowed. However, if firm pays to partner, sir, it is partner building, but used by firm. So then there is no notional concept. Why? Because firm is different, partner is different. Since there is no notional concept, there is no disallowability or not allowability. It is allowed only. First, we shouldn't even call it as what? Notional rent, because firm is different, partner is different. Then on building, what are the other expenses could be there, sir? Municipal tax and insurance. Those are also how much ever you paid, that is allowed. Municipal tax and insurance. So with respect to building, what expenditures are there, sir? There could be repairs. Which repairs is allowed? Revenue is allowed, capital is not allowed. Then rent. Normally rent is allowed only, how much ever rent you pay. But if you did subletting, then the net rent is only, total rental expense minus income on subletting. Okay, the net rent alone is allowed. Then third one, notional rent. Notional rent disallowed only for sole proprietorship, because only for sole proprietorship there is a concept of notional rent. Then the last one is what? Any municipal taxes paid or insurance paid for building, that is also allowed. So with this we completed section 30. Then we are moving on to section 31. Then 31 is about what? Repairs and insurance of machinery, plant, furniture used for business or profession. Repairs and insurance of what? Machinery, plant, furniture used for business or profession. So what is the difference here? Machinery, 30 we spoke about building. Here we are talking about plant and machinery and furnitures. Plant and machinery and furnitures. Same kind of points. Repairs. Revenue repairs allowed. Capital repairs not allowed. However, sir, if they are renewal or renovation, they'll come under the revenue repairs only. They are allowed. If they are like replacement or reconstruction, then they'll be part of capital repairs, so not allowed. Revenue repairs. So revenue repairs includes renewal charges or renovation charges also comes under revenue repairs only allowed. If they are like reconstruction, replacement kind of charges, they'll come under capital expenditure not allowed. Then this plant and machinery can be in active usage as well as passive usage. What is active usage and what is passive usage? Sir, you are seeing like when you are climbing down the stairs, you can see these fire extinguishers and all. Those pipelines and all has been kept. Okay, not fully ready, but still those are kept. In many places, cinema halls and all also will see the usable fire extinguishers only will be there. But are they being used every day? Okay, to use them as cinema hall or the shopping mall, they will only lit fire, and again they'll use them for some period, like that they'll do no, right? So they are kept ready for use. We don't know when the need arises. So those are under what? Passive use. They are not under the active use. Sir, this tab, this kind of systems, benches are every day under active use. But those kind of fire extinguishers and all are under passive use. Let's say, sir, we have these cables, this kind of hard disks or else some other graphic cards and all. So they might be kept ready for them. Okay, whenever the graphic card doesn't work here, they'll bring some other graphic card or some other cable or some other this kind of connectors and connect them. So all those are under what? Passive use. They are not kept for use, but they should be ready for use, because they don't want, class shouldn't be disturbed, right? So they have to keep them immediately ready. So active use, they are on everyday use. Passive use, they can be standby equipment. Okay, so in a big manufacturing facility, if one machine fails, then they immediately routes the whole production chain to some other machine. Instead of completely shut downing the operations, they'll route it to some other machine. So that some other machine is only called as what? Standby equipment. So once, simply like the spare tire will have. So what we'll do, sir, when a tire got punctured, spare tire we'll use for 2-3 days only. Okay, then we'll get repaired the main tire, then again we'll fix the main tire only, and the spare tire again we'll keep there only. So spare tire is what? Standby equipment kind of. So they are in passive use. Then, so even it is used for passive use or active use, we can claim revenue repairs as a deduction. Then asset used for even part year, even though asset is used only for part year, still you can claim the full revenue expenditure incurred as deduction. With respect to this plant and machinery, furniture, insurance premium is paid. Such insurance premium is allowed as deduction only on payment basis, not on accrual basis. Should be paid actually. So only allowed on what? Accrual basis. For buildings, we didn't mention anything like that. But for plant and machinery, furniture, it was mentioned like what? Should be paid. Actually, it is allowed only on accrual basis, and the asset should be used by SSC, then they are allowed as deduction. Understand, sir? 30 is about what? 31 is about what? 30 is for buildings. 31 is about for plant and machinery and furniture. Most of the points are same only. Repairs. Revenue repairs allowed. Capital repairs not allowed. What we have to do not allowed now? Add to asset cost. Okay. Then rent paid for building allowed only. In extreme cases, we'll see subletting and all. Then the net rental expense we have to calculate, that only allowed. Notional rents not allowed. Insurance premium paid. For building, no conditions allowed. For plant and machinery, furniture and all, they should have been actually paid. Okay, not on accrual basis, they are allowed only on cash basis. Okay, and then this could be under both active use or even under passive use. Even the asset is used only for a part of the year, then still we can claim it for full year as deduction. Then section 38. So 38 is a general section which talks about all the sections related some conditions, like see, asset partly used for business and partly used for personal purpose. Let's say, sir, rent, repairs, insurance premium, depreciation, interest, any other expense. Let's say, sir, you have a car. You have a car. So for that car, repairs has been happened. But that car you'll use for both business purpose as well as personal purpose. The total repair cost is 50,000. Can you claim the total 50,000 as deduction? What you can claim? Only to the extent of business purpose alone can be claimed as deduction. Personal purpose related can't be claimed as deduction. Where it was said? It is said in section 38. It was said in section 38. See, not only about cars, sir. Any asset related rental cost, repair cost, insurance premium, depreciation, interest, or any other expense related to that asset. If it is partly used for business, only that part related to business is allowed. If it is partly for personal, then it is not allowed. Okay, na, sir? So now 32, 33, 34 section itself is not there now. Okay, no provisions at all. So 32, 33, 35 we are not discussing now. Straight away we are jumping to what? 36. Because 32 you already know. What is 32? depreciation, you know mostly, okay? And there is no great things we're going to learn in depreciation also. So again, like a practice only, so we'll learn depreciation afterwards. 33, 35 are not general businesses related. 33 and 35 will talk about a specific business. If it is a telecom business, if it is a oil exploration company, if it is a specified business, if it is into scientific research, okay, those are not general kind of expenses. It will talk about some special, specific nature kind of expenses. So these two we can talk afterwards also. So first we're going to discuss about what? Section 36, 37, we'll complete them. Then again we'll come back to the other deductions. Okay. Sir, the whole PGBP, sir, how we are doing the chapter? 28 and 41 is about what? Redeemed profit. 30 to 37, what we are discussing, sir? Allowable expenses, allowable deductions. Expend payment should be covered under this section to allow as deduction. Then section 40, 48, 43b, there will be what? Disallowed expenses. Even though expense allowed under this particular block, it again has to be checked under this block and it shouldn't be disallowed. If it is disallowed, again, they has to be reversed only. And the last block is what we are having, books of 44, procedural aspects, sir. Books of accounts, audit and presumptive taxation schemes. Now under section 36. Section 36. Hello all, those who are attending classes in live are able to follow. Sir, if you miss revising any day, the next day you cannot cope up. So every day don't forget to revise and come. I know you're already having so many classes, but still. Revise చేస్తున్నారు మీరు ఎవ్రీడే. అమ్మా చూద్దాం నానిత్ see problems you cannot follow. Going forward it will become much more tough. Allocate time. So I know you all are having hectic schedules than that of me, but still manage some time. పొద్దున్న ఇక్కడ ట్యాక్స్ బుక్ క్లోజ్ చేస్తే మళ్ళీ ఇక్కడే ఓపెన్ చేసేది. చూస్తున్నారు టైం దొరుకుతుందా? యూఆర్ రివైజింగ్ ఎవ్రీడే. మొత్తం గుర్తుండిపోతాయి నీకు చెప్తా. నువ్వు రోజు క్వశ్చన్లు కూడా అడుగుతాను ఇంకా నేను శివాసార్లాగా ఇంకా క్వశ్చన్ ఎవరు see just like what you said, I'll feel happy inside that if you say like sir what if you say that now I'll remember everything, it's okay, but it doesn't remain for so long. It's okay to retain it for a longer period. You have to revise. Okay, see how our neuron system works also. Simple things are, we all have these nerve connections are like different kind of roads only. If you are going to a new place, obviously we all use what now? Google Map. Every day you are going to the same place. First day you'll use Google Map, second day you'll use Google Map, third day what you'll do? You'll keep some points. Okay, this construction building, this building, under construction building, from there I have to take left. There you'll see one tree. From this tree again I have to go right. So like that, a brain will register some points which will act as checkpoints. So let's say even if you're thinking something and at a place where you have to take left, you took right also, then immediately your brain alerts and says like, okay, within seconds only again you will take the U-turn and will go in the right track. Okay, this whole process, one time only if you did not, you will not remember. See, once you went to that place and after 2 months, 3 months only again you are visiting the same place, then again you have to use what? Google Map only. If you are doing it daily basis, okay, the need of Google Map will come down and your brain itself will keep some points which will act as checkpoints. Okay, so first time you are taking help of me, I am a Google Map for you. Okay, but every time if you want, then it's your choice. Okay, whether you wanted to do on your own or else you want a Google Map always, you have to decide everything. Okay, so first time you did, second time, okay, at least record, second time again you need to help, you will take the help of me. Sir, the same thing, sir. First day, morning you took the same route. Evening, maybe without Google Map you can go the same route only. Okay, but if you delay it like for 4 days, 5 days and after 4 or 5 days only again you are visiting the same route, then obviously again you need help of what? Google Map. And you do it 3 or 4 times frequently within a quick time, then your brain registers much more quickly the route also. The same happens in our nervous systems also, even with the concepts we read also. Okay, the connections will be formed and the connections will be more strong. Okay, Navneet had a breakup last year. He couldn't forget his girlfriend even now. Every day he'll put those depression status and all. Why? Because with that person he has so many nerve connections, because every day he used to think of her only. Okay, family, then just like as Mandeep, my IDT class I said now for you, same Navneet also did the same way. Okay, he imagined marriage, kids, building, okay, retirement, everything he planned. Now everything collapsed at the time of breakup. Okay, so every day he has visualized about that, right? So there's a strong nerve connections in his brain. Every day he thought about that only. So a strong nerve connection. Now those connections are not breaking easily. Okay, that's why every day he's again going there only and again facing the whole problem. Okay, so the whole how our system works now, when you do or when you think of the particular thing multiple number of times now, subconsciously it get registers to you. Okay, so that's why I'm asking you to do what? Revise number of times. Only when you revise more number of times, then you'll remember. There is no other rule for direct taxation. Direct taxation 20-30% is only application. The balance 60-70% is okay. 20%, 25% is application. 25% is like understanding the concept. The 50% is completely about memorizing only. 50% is completely about memorizing the points, because there will be n number of conditions in a day. In a class of 2.5 hours, I may tell some 30-40 conditions roughly in every class. Okay, you need to remember all those conditions. You're not robo. Okay, to remember everything in one go. So, okay, only when you revise number of times, then you will remember. Okay, if I ask Navneet his girlfriend name, he will tell quickly. His girlfriend's pet name also he can tell quickly. Why? Because he has thought about it so many number of times. Okay, he can tell her when he met first. Okay, when he saw first, what dress she is wearing when he met first. All that he'll remember because he thought about it so many times. Okay, when you think of it, okay, obviously subject now you cannot think always, but if you do revision now, obviously your training is focusing on that, it will get registered quickly. Do revision, and if possible, every day do cumulative revision. Section 36 is about other deductions. Section 36 is about other deductions, sir. We have a list of expenses we're going to see. Okay, we're going to discuss about each and every expense here, which are there under 36. What are the conditions to be satisfied? First one, insurance premium. Sir, we already covered 2 insurances. Building insurance covered under 30. Plant and machinery, furniture related covered under 31. What else? On what else you can take insurance? You are a business person. You took insurance already on your building. You took insurance already on your plant and machinery, furniture. Then on what else you'll take insurance? Employees. Okay, then. Stock insurance. Okay, because stock is much more major for you, right? Okay, so on stock, we didn't cover it under 30 or 31. So first one we are discussing is about 36 subsection 1 clause 1 is about insurance premium paid with respect to stock and stores which are related to business or profession. That is what allowed. Okay, so insurance wise, sir, clear. Building related insurance allowed. Plant and machinery, furniture related also allowed, but only on payment basis. Stocks and stores related also allowed. Maybe different sections, but insurance premium is allowed. Then insurance premium paid by Federal Milk Cooperative Society on life of cattle owned by members. Sir, how these milk cooperative societies will work means, sir, you know, in rural areas there will be a milk collection booth. So all the farmers who are having cattle will take 2 liters, 3 liters, 5 liters, whatever the milk they get from the cattle, that milk will be deposited every day, and that milk will be taken by these cooperative centers, those federal cooperative societies. They'll process them, they'll pack it, and then sell. Okay, even out of those milk products only, they'll manufacture some other paneer, cheese, all these things they'll manufacture and sell. Okay, now, sir, most of these farmers will be appointed as members of the society. But society is different, members are different. Cattle is owned by whom? Members. But the cattle owned by members, society will be paying insurance premium. So actually the cattle are not owned by society. Cattle are owned by whom? Members. But still, society may take insurance on the cattle owned by members. Whether such insurance premium is allowed or not is the question. That is also allowed. Insurance premium paid by Federal Milk Cooperative Society on life of cattle owned by members. It is allowed to society. Then paid by employer for health of employees. Okay, paid by employees for the health of employees. Health insurance premium paid by employer on behalf of employees. If it is paid in other than cash and approved by central government IRDA, then it is allowed as deduction. Okay, you cannot take any random policy, sir. You should have taken something approved policy only by IRDA or central government, and it should have been paid in any more other than cash. Then it is allowed as deduction to the employer. So this is about insurance. Total 5 insurances came, sir. Building related came, plant and machinery related came, stock related came, Federal Milk Cooperative Society taken with respect to cattle, and then health insurance, All those are allowed as deduction. Then 36 subsection 1 clause 2. It is about what? Bonus and commission paid to employee. Bonus and commission paid to employee. Sorry, if any bonus and commission paid, it is an expense only, right? Why will pay generally bonus and commission to employees? For a good and extraordinary performance, we'll pay bonus. Commission. He's a sales executive now. For the sales orders he bought, generally commission will be paid. That is related to business only, allowed as deduction. But sometimes, if you remember, sir, yesterday I said a partnership firm example where firm routes interest, bonus, commission to partners. Instead of declaring it as a profit share, they may sometimes route the interest, they may sometimes route the profit in the name of interest, bonus and commission to the partners. Same way, private limited companies also can do. Why, sir? Private limited companies will do much more than that of firm. Why? Because in firm case, firm profits are taxable in firm hands. But if they are distributed to partner, in partner hands, it is again exempt, not taxable. But in company status, if you see. So let's say BCCA has profit. On the profits of BCCA, first, it has to pay taxes. Then if it has declared any dividend to me, again on the dividend, again I have to pay tax at a rate of 30%. So on the same profit, BCCA is paying tax, again I also have to pay the tax. Sir, that is what. So there is a double taxation. To eliminate that, what we can do, whatever the profit that has to be, or whatever the dividend that has to be given to me, that may be given it as salary to me, or else like bonus to me, commission to me, in the name of bonus and commission. So private limited company routes dividend in the form of bonus and commission to employee. Generally bonus and commission na allowed. If there is something like routing happened, the bonus and commission is not a genuine bonus and commission, sir. They are just diverting profits in the name of bonus and commission, then deduction is not allowed. Sir, how do we know? Sir, we will not know. Okay, assessing officer job that is. Okay, when he came for assessment, he figures out that it's not a genuine bonus and commission. It was rooted in the form of, the profit rooted in the form of bonus and commission. Then he can say like such bonus and commission is not allowed. Then contribution to PF and other employee welfare funds. Sir, again, this point also came 2 or 3 times in exam question, this point. Contribution to PF and other employee welfare funds. Sir, generally to employee welfare funds, who will contribute? Employer will contribute as well as employee will contribute. Okay. Let's say you all are employees, I'm employer. You all are employees, I'm employer. Okay. There's a welfare fund. On your salary, each of you contributing 10% of salary. Equal amount I'm also contributing to the welfare fund or PF fund. No. Sir, how do you contribute to PF welfare fund? You are contributing 10%. Will you go on directly deposit in the fund? What happens? Sir, every employee, most of the employees are having PF participation, right? But does those employees separately depositing that money or their share of money in the PF accounts? Then how it works? Sir, let's say I have to pay 1 lakh salary to you. And your share of contribution to PF is how much? 10%. That means how much? 10,000. So what I will do? Actually, na 1 lakh salary I should have been paid to you. Then out of 1 lakh, your 10,000 you should go and deposit in the PF account. That's the actual thing to be done. But how it works now? Out of the 1 lakh paid, I'll deduct 10,000. Sir, even though I deducted, it is something like I paid 1 lakh and taken again 10,000 from you. Okay? And that 10,000, can I use it for my own purpose? That is whose money? Your money, employee's money. Okay? I have taken saying like I'll deposit on behalf of you in the PF account. Okay? So, and not only this 10,000, I should add my share of 10,000 also. On total 20,000 I have to deposit in PF account on behalf of you. 10,000 is my share, 10,000 is your share. Right? So the total 20,000 ultimately deposited in the PF account by employer only. Even employee share also has to be deposited by employer only. Even employer share also has to be deposited by employer only. See, employee transfers his share of contribution to PF also to whom? Employer. Then employer contributes his contribution as well as employee's contribution. Both he will be transferring to the PF or other welfare accounts. Now see, employee share. First we'll talk about employee share. Employee gives his share of contribution to employer. Sir, first I paid 1 lakh salary to you and you given 10,000 rupees to me saying that what? Deposit this 10,000 rupees on behalf of you in the PF account. Once I receive that 10,000, I have to recognize it as my income. Once I receive 10,000 from you, I have to recognize it as an expense. When I again deposit in the PF account, I can claim it as an expense. So it offsets the income. So 10,000 you given, right? The 10,000 when I received, I'll claim it as an income. When I deposited in your PF account, again I'll claim it as an expense. Sir, actually, I'm acting as a bridge only. Your money, you can go and directly deposit. But what I'm doing, I'm acting as a bridge, collecting 10,000 from you and depositing in the PF account. No profit, no loss for me. But what provision says to act as a check mechanism? When I receive 10,000 from you, I should recognize it as an income. When I pay again, I can claim it as expense. Then also what happening? 0. 10,000 income, 10,000 expense. But why they are doing that? To act as a check mechanism. Okay, what is the check mechanism? See. Once I collected from you, I should recognize it as income. Then I should deposit in the PF account within the due date of PF acts. Within the due date of PF acts. What are the due date of PF acts? Are every month 15th. Okay, so January month related, I collected from you on Jan 3rd. Jan 3rd. So on Jan 3rd, I'll recognize it as my income. If before Jan 15, I deposit that money in PF account, I can claim it as expense. If I don't deposit by Jan 15, then I cannot claim it as an expense. So what happening? Okay, let's say I deposit on Jan 20. 5 days delay I did. So on Jan 3rd, I am claiming it as an income. Jan 20, I actually paid, but still I cannot claim it as an expense. So here what happening? The 10,000 unnecessarily being taxed on me. Unnecessarily being taxed on me. So to avoid that, what I'll do? I'll deposit by due date. So to make sure that me being an employer, timely deposit your money in PF account, they are introduced this kind of section. Okay, saying like what? When I collect from you, it is my income. When I deposit within the due dates of PF Act or the Welfare Act, then again it has to be claimed it as an expense. Understand, sir? Okay. See, employee gives his share of contribution to employer. When received by employer, consider it as what? Income. Income by whom? Employer. Then employer has to deposit within the due date of PF or respective act. When it is deposited, then claim as expense and allowed as deduction. If it is not deposited within the due date of PF Act, then not allowed as deduction. Income remains to be like income only. So income added, corresponding expense is not increasing. So what? The 10,000 will get taxed in my hands unnecessarily. Okay, to avoid that unnecessary tax, what I have to do? I am forced to deposit the money within the PF Act due dates. Understand, sir? This is for whom? Employee's share, employer share, employee's share. Okay. Sir, that is your money, na? I cannot do delay. Second one is about what? Employer share. My share. Again, I'll be depositing what? In your PF account. This contribution, sir, I have to make the payment by Due date of filing the return of income, not due date of PF Act. Sir, here also due date will be there, here also due date will be there. So you often confuse like both as same. No. Employee share na, it has to be deposited within due date of PF Act. Whereas employer's share na, it has to be deposited by due date of filing return of income. Sir, assume tax audit is applicable. What is the due date for me to file return of income? 31st October of assessment year, January month. Okay, financial year, previous year 25-26, January 2026 related we are talking. January 2026 month related PF money, employee's share I deposit on Jan 20. Whereas employer's share I deposit in September 2026. Sir, employee share, even though deposited by Jan 20, it is after the PF Act due date. So that is not allowable as expense. Whereas employer's share I deposited when? September. Still there is due date for filing return of income. So even though I paid in September, that is allowed. But employee share not allowed because it was missed by the due date of PF Acts or Welfare Acts. Understand, sir? Hello all. Students listening online, respond. Are you able to understand this or not? So there are high chances of you going zone out because we are not writing anything. You have to listen only. So do some activity, take a pen, paper, and just do scratching or something so to be attentive. Otherwise, early morning class, you may get sleep, you may get diverted. Okay? Now Mandeep na is thinking of the names for his two kids. Except Chintu, Bintu. నువ్వు ఫిక్స్ అయ్యావు సరే ఆ పేరు నవనీత్ వాడు ఫిక్స్ అయ్యాడు పాపం బ్రేకప్ అయింది అందుకే ఇప్పుడు కొత్త పేర్లు ఆలోచిస్తున్నాడు పర్లేదు ఏం కాదు How many of you received books and how many of you had to receive books? Okay, I'll create a poll. Okay. 60% received. Yes, handwritten, had to receive. I also know. Handwritten, not even dispatched. Okay, frankly speaking, not even sent for print also. Okay. Today evening, from today afternoon, actually I don't have classes. I had to finalize and today I'll be sending it for print. So it takes, by Friday, you can expect like dispatch. So, handwritten, you cannot expect in the coming 7 days, 8 days also. Sorry, it takes another 9-10 days. Sir, and DT na, there is no much difference between handwritten and pulse because pulse was, designed based on my handwritten only. So most of the concepts, except in some miscellaneous chapters only, there will be, you'll find, for miscellaneous chapters, I don't even have a handwritten. Okay, for all the chapters which we have handwritten, the thing we wrote in handwritten and the pulse will be 95-96% will remain the same only. Will remain same only. Only 3 or 4 places, like there will be some 3 or 4% chance of difference is there between the pulse and handwritten, where I'll give extra examples in the handwritten. Considering like in the classroom, if I thought you're not able to understand, then I might have given extra examples in the regular class. Those extra examples will be there in the handwritten. Rest all is covered in the pulse. So don't worry about handwritten being you getting it after 7 days or 10 days. It doesn't impact your preparation. Go with pulse, no issues. Okay, don't delay your revision or preparations for waiting for handwritten. If you have doubt at any place now, I'm sharing the PDFs, which are the chapter I discussed in the group. So you just open that PDF and refer back. So okay, it's not like, I also know that you cannot read everything from PDF only. So when you are having any doubt or issue, that place you open the PDF and just refer them. Okay, so contribution to PF and other welfare funds. Contribution to PF and other welfare funds. Employee share received by employer. Once he receives, he has to consider it as what? Income. Then again, if he deposits that amount within the due date of PF Act or the respective welfare act, then it can be claimed as expense, allowed as deduction. Employer share. With him only, he need not again collect. When employer share, employer deposits in the PF Act by when? Due date of filing of written off income. By due date of filing of written off income. Okay, sir, actually, it is a point employer share linked to 43B. What does 43B section says? Na? It lists out certain payments or expenses. They may be already allowed under 32, 37. But what 43B says, like, these kind of expenses, if they are paid by the due date of filing written off income, then only allowed. Otherwise, disallowed. So, employer contribution to PF actually allowed only. But 43B comes and says like what? It is allowed only when it is paid by the due date of filing of written off income. By due date of filing of written off income, if it is not paid, then it is disallowed. Okay? So, this is like along with 43B, we are saying. Employee share of contribution has to be deposited by when? Due date of respect to PF Act or Welfare Act. Whereas employer's contribution within the due date of written off income. Due date of written off income. Okay? Then, employer contribution to pension scheme. Sir, pension scheme na ATCCD pension, NPS under. Okay? There, when employer contributed to employee, we discussed about what I said, ATCCD subsection 2. To employee, first recognize as income and then you can claim as deduction also. Government employer or non-government employer. Government employer, 14% of salary or actual, whichever is lower can be claimed as deduction. Non-government employer, then again, old regime, default regime, 14% or actual, whichever is lower. Old regime, 10% or actual, whichever is lower can be claimed as deduction. That is under their ATCCD subsection 2. Now here, employer contributed to NPS, National Pension Scheme. This NPS is covered under ATCCD. Whatever employer contributed to NPS, that is allowed. But to what extent it is allowed? Actual or 14% of salary, whichever is lower is allowed. Here salary means what? Salary means basic plus DA. Basic plus DA forming part. Actual or 14% of salary. Salary means what? Basic plus DA forming part. Then, interest on borrowed capital. Borrowed capital, nothing but loan. Interest on borrowed capital, nothing but interest on what? Loan. So on loan amount, we should classify it into two types. Borrowing cost. So what we call as borrowing cost usually? Interest. In any case, interest we call it as borrowing cost. Huh? There is an accounting standard for it, which defines what is called borrowing cost. So what is the accounting standard for borrowing cost? 16 on. Okay, Ind AS. Okay, I don't know about Ind AS much. I know only Ind AS 10. Okay, because that is same. Ind AS 10 anything? It's okay. So forget about that. Come back to the point, sir. AS 16. It about what? Borrowing cost. What does it say? If it is a qualifying asset. What is qualifying asset? If it takes substantial period of time to complete, then it is called as qualifying asset. For that qualifying asset, during the construction phase, until it is ready for use or started using, that time, during the construction phase, if any interest is accrued, that interest element will charge it to P&L, will add to asset cost. We will add it to asset cost, right? Same way, in income tax also what we should do? Up to the date of put to use, whatever the interest is accrued, that interest you need to add to the asset cost. After put to use, if any interest is there, that expense, interest expense is allowed as deduction. See, borrowing cost. Let's say, sir, this is the date of loan. When the date of loan? 1st June 2024. Then, up to date of asset put to use. 1st June 2024 to 1st February 2026. How many months are there, sir? 1st June 2024 to 1st February 2026. Total 25 is that 12 months. In 26, 2 months, 14 months. In here actually, how many months, sir? 7 months are there. Then it would be 21 months, right? Count. Okay, 1st February, na? 20 months only, sir. Count. 1st June 2024 to 1st February 2026. How many months? 20 only, na? In 24, 5 months already completed, another 7 months. 25 total, 12 months. 12 plus 5. Sorry, 12 plus 7, 19. In 26, another 1 month. So total how many months is there? 20 months. So this period is what? Date of loan to date of asset put to use. This period, for this 20 months, whatever is the interest accrued, we call it as what? Borrowing cost. What to do borrowing cost? Capitalize. That means add to asset cost. You cannot claim it as deduction. You cannot claim it as deduction. So what is called borrowing cost, sir? The interest accrued on a loan from date of loan till the date of asset actually put to use. That period, whatever the interest accrued, that is called as borrowing cost. Borrowing cost is not a revenue expenditure, so you cannot claim it as an expense or allowed as deduction. So it has to be done what? Capitalize. Add it to asset cost. From 1st February, if any, 1st February, March. This 2 months is what? After asset put to use. So this is what? Normal revenue kind of general interest. This is allowed as deduction. So any other interest, if it is notional interest, not allowed. General actual interest, it is allowed as deduction. Sir, what is notional interest? Sole proprietorship form only, sir. I have given some capital into my business. So what I am thinking, if at all, even I don't do business also, this money I might have kept FD or given loan to someone, then I might have earned interest. So now my business should perform more than that of the interest I earn. So to know the true position of my business, I even charging what? Notional interest. So notional interest means what? You didn't pay actually, but still it's like an opportunity cost you are charging. Okay, such kind of notional interest is not allowed as deduction. Notional rent also not allowed. Notional interest also not allowed. Actual interest is allowed as deduction. Understand? Interest, if it is specific, loan specific to an asset, and then From the date of loan till the asset put to use, how many months are there? That months related interest we should do what? Capitalize, add to asset cost, not to be claimed as deduction. The other interest, if any is there, you can claim it as deduction or expenditure. Okay. If it is notional interest, not allowed as deduction. Clear, sir, everybody? Interest on borrowed capital. Then we are discussing about discount on zero coupon bonds. Discount on zero coupon bonds. Zero coupon bonds. Sir, coupon means interest. Here in zero coupon bonds, coupon refers to interest. That means what? Zero interest bonds. Sir, you purchase the bond and it pays zero interest. Who will buy that bond? Or if at all bought, why it has to be purchased? Sir, why you will buy generally bonds and debentures? Income, what income you will get from bonds and debentures? Interest only, right? But here they are saying like what it's a zero coupon bond. It doesn't pay any interest. Then why we need to buy this bond? Or what benefit we can get? Sir, what benefit we'll get? Now they'll issue at discount price. 100 rupees bond, they'll issue at 80 rupees only. Discount. Then it will be redeemed at par. Redeemed at 100 rupees. Then the 20 rupees is benefit only enough for you. Okay. Actually the 20 rupees is nothing but interest element only. But every year you will get interest. Let's say the tenure of the bond is 5 years. Tenure of the bond is 5 years. You purchased for 80 and it redeemed for 100. How much interest you earned aggregately for all the 5 years together? 20 rupees. Whether this 20 rupees related to one single year, related to all the 5 years, but you received only in the 5th year. Okay. This is from the purchase of the one who invested in bonds. Look at from the company perspective also, the which issued bonds. It took loan of 80. Nothing but bonds issued. Now it got a debt. It took loan of 80. Whereas it has to pay after 5 years how much? 100. So how much interest accumulated? 20. Whether it is not related to one particular year. The 20 is related to all the 5 years, but it is going to pay only in the 5th year. Okay. So what the provision says like, no, don't claim the total interest expense in the 5th year. Apportionate it over the tenure of the bond and claim proportionately every year. That's called the concept of zero coupon bond and its allowability of deduction. See, discount allowed as deduction. It is proportionately throughout the tenure of bond. So look at this example, sir. Zero coupon bond issued on 1st September 2023 for rupees 800, whereas redeemed on 31st August 2026 for rupees 1000. So what is the tenure of the bond? 3 years. What we think usually 3 years now, every year. How much discount they got? 200. So 3 years only there. Sir, 800 rupees issued, redeemed at what? 1000. So how much discount they got? 200. Bond tenure is how much? 3 years. So you think like 200 by 3 every year 66.67, 66.67, 66.67. But this 3 years was not exact 3 years. It was issued on 1st September 2023, redeemed on 31st August 2026. So they were not exact 3 years. They were spread across multiple years. See, in previous year 23-24, because 1st September 23, in previous year 23-24, how many months is there? 7 months. So take 200 into 7 by 36. Why 36? Total tenure 3 years, 36 months. Out of that here 7. So 200 into 7 by 36. In previous year 23-24, you will claim how much? 38.89. Whereas 24-25 full year is there. So 12 months, 200 into 12 by 36, 66.67. 25-26 also fully is there. 200 into 12 by 36, 66.67. Whereas 26-27, sir, it is redeemed on when? 31st August. So it is there for April, May, June, July, August, 5 months. So 200 into 5 by 36, it is how much? 27.78. So proportionately, this way we need to claim the deduction. Yes, that's lump sum medical insurance also. That's what we said in 80D also. In 80D, that's what we said, right? When medical insurance premium is paid lump sum, you remember, sir? Then it has to be apportionated throughout the tenure of the policy and can be claimed as deduction. And such deduction should be within the limits given there, 25,000 and 50,000, whichever is applicable for that. That's what I said. Even there also. Sir, here we took what? 1st September. Sometimes it could be what? 13th September. So if it is more than or equal to 15 days, count it as a full month. Less than 15 days, ignore. Then, sir, deduction on bad debts. Sir, in cash system, will there be bad debts? In cash system, if SSE is following cash system, will there be bad debts? Why? First, you will recognize as a sale only when the payment is made. In cash system, there is no concept of debtor at all. Because when you book a credit sale, then there is a concept of debtor. Once debtor is there, then we can think of bad debt. In cash system, first you will recognize it as a sale only when you receive payment. So there is no concept of debtor at all. When there is no concept of debtor, then there is no question of bad debt. Okay, so in cash system, we cannot see bad debts at all. In accrual system, yes, we'll recognize income based on credit sales also. What is the credit sale entry, sir? A debtor account debit to sales. Debtor account debit to sales. So you didn't receive money, but still you recognized it as sale, and that income is already taxed. Last year, credit sale made. What is the entry you made, sir? Debtor account debit to sales. Sales will go where? P&L account, credit side it sits. Okay, that sale amount already taxed in the previous year only. Preceding year only. Okay. Now, whether that money realized, sir? That money not yet realized. You just recognized as debtor, but the relevant sale value already taxed. Okay, sale value already taxed, but you didn't receive any money. Understand or not, sir? Sir, in previous year, 24-25, 1st June 2024 it happened. You made a credit sale. What is the entry, sir? Debtor account debit to sales. So this money, whatever the sale you recognized here, 10 lakhs or 20 lakhs, it was already taxed in which year, sir? Previous year, 24-25, but that money is not yet realized. Even though you didn't receive money, that income was taxed and you paid tax also. But current year in 25-26, you came to know that that fellow became insolvent. That fellow became insolvent. Now, will that money be realized anyhow now? But last year you already paid tax also on that income. Assuming what? You may receive that money in future, assuming that you have already paid tax. But current year what you are realized? That fellow will never pay back that money. Without realizing money only you paid tax. Whether is there any certainty that you will realize now? No, because it became bad debt. So, since previously it is claimed as an income, now to offset that income claim, you are again claiming it as what? Expense. అర్థమవుతుందండి లాజిక్. మనం సేల్ చేసినప్పుడు ఆ క్రెడిట్ సేల్ని ఫస్ట్ యూ రికగ్నైజ్డ్ ఇట్ యాజ్ అన్ ఇన్కమ్ అండ్ ఇట్ వాస్ taxed. But that money is not going to be realized anyhow now. That's why we need to reverse that income. Reverse of income, nothing but you claim it as an expense. So, where any bad debt is there and it is written off, then you can claim it as an expense. Understand, sir? But only when, see, debt should be related to business or profession. Okay. Debt should have been taken into account while computing total income of any of the previous years. I said that now in 24-25, you passed a credit sale entry. In the total sales amount, this credit sale amount also included. That amount also already taxed in previous year 24-25. But in 25-26, you understood that you cannot realize that money because the debtor became insolvent. So you are writing off the debt. Okay, bad debt written off is happening. Nothing but what? You realize, you assumed it as an income, but now it is no more an income. So what? You should reverse the income. So how do you reverse income? By claiming it as an expense. Understand, sir? Sir, income na, you will add to income. You will add. Expense na, you will subtract. So an add item to be reversed now, obviously you will do what? Subtract only. That's why we are claiming it as what? Expense. That debt related to business or profession, that have been taken into account while computing total income of any of the previous year, then debt must be of revenue nature. This is much more important, sir. Many times you do mistakes regarding this. Debt must be of revenue nature. You purchased a plant. Okay, you sold a plant and machinery. You sold your plant and machinery. You sold stock. Two things you sold. You sold plant and machinery. You sold normal stock also. Sir, when you sold plant and machinery also, you made a credit sale only. There also you have debtor. You sold stock. That also credit sale. There also you have a debtor. Both are debtors only. But one is a revenue transaction, the other one is a capital transaction. With respect to revenue transaction, if you have bad debt, consider it as expense now. If with respect to capital nature, if you have a bad debt, don't consider here. Sir, why like that? Sir, capital receipts, you don't even consider it as income under that PGBP. When you sold plant and machinery, if any income is there, gain is there, you will tax it under which head? Capital gains head, not related to PGBP. When it became a loss now, why it is related to PGBP? That's why bad debt with respect to capital nature, income also not related to PGBP. The relevant bad debt also not related to PGBP. That's why what they are saying clearly, debt must be of what? Revenue nature. Debt must be of revenue nature. So only with respect to stock sales and all, if any bad debt is there, such bad debt can be claimed, bad debt if written off can be claimed as expense or deduction. Bad debt should be actually written off in the books of accounts. So what are the conditions, sir, to allow bad debt as a deduction related to business or profession? Have been taken into account while computing total income of the previous years. Nothing but it was considered as income in any of the preceding years and it was taxed. Debt must be related to revenue nature and bad debt should be actually written off in the books of account. If all the conditions are satisfied, then it is allowed as deduction. If you create any provision for bad debt, provisions are not allowed. Only the actual bad debts written off are allowed as deduction. But in P&L there is a provision for bad debt also, sir. Not allowed. Simply what you will do? Add back. Then, sir, look at this point. A Limited is a company which has recorded it as a sale, credit sale, debt recognized, included in total income and was taxed. But later on, it was merged with B Limited, successor. Now, when the business went into successor, B Limited, then the debt which is in the predecessor capacity has become bad. Understand, sir? Before amalgamation, you made a credit sale, recognized as debt. After that sale, that was recognized as a credit sale and that sale amount, everything got taxed. Later in next year, this company merged into some other company. Now when the some other company is carrying out the business, they came to know that previous debt became a bad debt. Can the successor company claim deduction or not is the question. Predecessor debt became bad debt in the hands of successor. Can successor claim that as a deduction? Previous A Limited debt became bad debt. Yes, even successor also can claim deduction for bad debt. Then, same bad debt only, sir. Previous year 21-22, you recognized as 30 lakhs debt. I mean, the 30 lakhs is already taxed, included in income and it was taxed. Previous year 23-24, debt became bad and written off how much, sir? 20 lakhs. So 20 lakhs is allowed as deduction. Now, in the previous year 25-26, you recovered how much? 25 lakhs. Sir, now this 25 lakhs, with what first we should adjust? First the 10 lakhs, because out of 30 lakhs debt, only 20 is considered as bad. Still there is a debt of how much? 10 lakhs. First this 25 lakhs, adjust with this. Balance how much is there? 15 lakhs. That 15 lakhs you recognize as income, bad debt recovered as per income under section 41. Deemed income, deemed profits under section 41. We have discussed this point. Clear, sir? Okay. So in 36, what are the points we have discussed till now, sir? Insurance premium with respect to stocks and stores. Federal Milk Cooperative Society with respect to cattle. health insurance of employees, bonus and commission paid to employees, contribution to PF and other employee welfare funds, employer contribution to pension scheme, interest on borrowed capital, then discount on zero coupon bond, deduction with respect to bad debts. Okay, so after the break, sir, we can quickly complete this 36 and we can even complete 37 also. So 36, 37, and then this example. Okay. So again, I'm repeating the same thing, sir. 2-3 days if you don't revise, PGBP chapter itself will get completed, and then you'll not have again time to revisit the PGBP chapter also. Okay, every day, stretch yourself and then do revisions. It's okay, sir. Now it is 8:04. Again at 8:19 we'll start our session. Provision for bad debts for banks, financial institutions, and NBFCs. Provision for bad debts for banks, financial institutions, and NBFCs. Sir, for normal people, provision for bad debts is not allowed. But for banks, financial institutions, and NBFCs, provision for bad debt is allowed. Okay. If they are scheduled banks, Indian, or cooperative banks, other than agri societies and rural development banks, for them, they can create a provision up to 8% of gross total income. This is before giving Chapter 68 deductions. Gross total income is generally before giving. Okay, before giving this provision, sir, because we don't know how much provision we're going to create here. So forget about this provision and calculate the PGBP income and calculate the gross total income also. From that gross total income, 8% plus 10% of aggregate advances made by their rural branches. 10% of the advances made by their rural branches plus 8% of their gross total income. Total this amount they can create as provision. Okay. If it is a foreign bank, public financial institution, or NBFC, then maximum 5% of gross total income they can create provision. Indian scheduled banks, cooperative banks, other than rural development banks or agri banks, 8% of gross total income plus 10% of the advances given by their rural branches. Total they can make it as provision, create as provision. If they are like foreign banks, public financial institutions, or NBFCs, they can make 5% of gross total income as provision. Then, family planning expenditure. Sir, this section we feel like senseless or no point now. This was a section which was introduced long back in 1980s and all, where when Indira Gandhi is Prime Minister. That time in India there is extreme growth of population. It's okay. So maybe like during our father's age, okay, that time there is extreme. There was no control about population in India. So they're having like, every family is having like 5 children, 6 children, 7 children and all. We don't have that many resources. If the population is grown at the same rapid growth, okay, at the same rapid growth, then slowly we may become, we will be already, that time we were into poverty. They cannot, even government also cannot control poverty and all. So the government thought quickly they should act on this population control and all. So they did what? They introduced this family planning. Okay, actually the intention is to explain the importance and to encourage the people to do this family planning and all only. Okay, that time, sir, even in the same period, in India, most of the companies or most of the businesses are owned by government only. Public sector companies are only there. No, private sector companies are not there. Private investments were not encouraged also. Only public companies used to be there. That time they introduced and said like, since government only has to be done, so they asked even government companies also to involve in this family planning procedures and all. So that's why they said like, okay, since for the betterment of the country we are doing this, what are the family planning related expenditures you are incurring through your companies, that would be allowed as deduction. But the misfire, what happened? Actually, first how it has to go? It has to be taken care by, first it has to be taken by those public sector employees first. Then they should educate the common public and then get it, and then it has to be done in such a way. But those days, because of lack of much awareness and education, they used to believe it is something complicated which may affect their lives also. First, these influential people, instead of they getting it first and encouraging others to do, these influencing people, first they escaped from this whole system and they thought of bringing the underprivileged people and get that operations or surgeries with respect to family plan. Now, they also, since they don't have awareness and education, they were forcefully brought and did these kind of things. So with this forcefulness and all, even though they were kept in the hospital, let's say they have to stay for 3-4 days also, they didn't used to stay. They go immediately in the panic and all, they used to go rush and all. So what happened? Many people said many cases like the surgeries failed and the people got deceased also. So many incidents has been reported such a way. So because of this, lot of negativity formed towards the government. Okay, so actually that was a idea wise it is a good idea, but implementation wise they did so wrongly. But if you see in 1990s also, during all our childhood also, we have seen so many times that there was a family planning control has been made, but through awareness and education. Okay, so many times in almost all the worlds I could see when I'm going to school, Chinna Kutumbam, Chintalayan Kutumbam, small family is only. Even in our social books also they introduced like small family, big family, benefits of small family, all these things. So they created what? Awareness, and then they encouraged the public to do. Here in the first case what happened? They didn't create awareness, that's why it has been misfired. So that time they introduced this provision. Family planning related, if any. Otherwise, why for companies family planning expenditure will be there? Okay, that time, in that specific circumstances, only public sector companies only used to be there. Mostly they only used to do business. Companies now, they only are there, public sector companies. Now all the other businesses, company style is not familiar by the time. Mostly sole proprietorships are partnership firms only. Private limited, public limited companies are not familiar that time. All the other companies are government companies only. So that time, so they are actually incurred for the public purpose only, and government companies only, government is only asking to do now, so they kept this kind of deduction. They are actually not related to business, but still government kept the year and allowed it as deduction. They are revenue expenditure. Revenue expenditure na normal treatment related day-to-day expenditure. Capital expenditure na for building those hospitals needed and the equipment to be purchased, capital expenditure. Revenue expenditure allowed as deduction in the same year, whereas capital expenditure is allowed as deduction in 5 equal installments. Transfer to special reserve. SSE is a finance corporation like LIC, IDBI, which are engaged in long-term finance. Okay. Sir, these finance companies or finance corporations, sir, they have to keep some reserve amounts. Why reserve amounts, sir? Otherwise, total income, they may use it for, sir, reserves are kept. If majority of their loans are being unpaid, the bank is in such a position where they cannot recover money from the lenders or recover money from the debtors, whereas the depositors are forcing them for the money and all. So in such cases, they'll have some special reserves which can act as a buffer for them. At least 1 year or 6 months, it will act as a buffer, so that in that time they can escalate the issues. Even government may involve and try to get or remove the pressure from the banks. Okay, so for to act in such kind of emergency situations and all, in those pressure kind of situations and all, they will create a special reserve. Okay, which will be used only in extreme cases. Every year they'll transfer certain amount to these reserves. Okay, how much they can transfer every year, sir? Or if the transfer, how much is allowed as deduction? Actual amount, 20% of PGBP income, or 20% of paid up share capital general reserve minus opening balance of these special reserves. Out of this, whichever is lower can be claimed as deduction. How much, sir? Actual amount, 20% of PGBP income, or 20% of paid up share capital plus general reserves other than, excluding, from general reserves, subtract this reserve related opening balance, rest all has to be included. Securities transaction tax. Sir, when securities transaction tax has to be paid? When shares, debentures, units of mutual fund, if they are listed in stock exchange and they are getting traded, then securities transaction tax has to be paid. The question is whether securities transaction tax can be availed as an expense deduction or not. So first, when you sell shares, the resulting gain, taxable where? Capital gain. So then why here we can claim it as expense? Okay, but you are a speculator. You are under the speculative business. You buy shares, sell shares. Okay, intraday trading you do. Today morning you will buy shares expecting Reliance share price will jump today itself some 100 rupees. By evening, if it jumps, you'll get profit. If it doesn't jump or if it falls below, now you'll be having loss. So on the day itself, the settlement will happen. So you're doing what? Intraday trading. So intraday trading is a business, not investment. Sir, you're doing buying shares or selling shares or securities with an investment way, then taxable under the capital gains. With an intraday trading and all, then it comes under the business. Sir, how do we decide? Sir, sir, nowadays we do trading only with a demat account with this mobile application and all. Whenever you execute an order, they'll be always showing an option. You can click or change the option. Intraday na, intraday na. Okay, if it is intraday, then you are doing trading, speculative business. So then then the resulting gain or loss is related to business. Even security transaction tax also can be claimed as expense or deduction. If you claim it as an intraday na, today itself it will not get settled. So that means the intention is what? You wanted to keep the asset for some while. So it is like an investment. So the resulting gain or loss is chargeable to tax under capital gains. So security transaction tax is not allowed as deduction here. Okay, so securities transaction tax is collected by stock exchanges on listed shares and which will be again paid to central government. So SSE is a trader or broker. Trader. He'll trade in shares, buy and sell shares frequently. Then the gain or loss on sale of shares is taxable under that PGBP. Which business? Speculative business. Okay. Then the STT paid is what? Allowed. If SSE is an investor, he buys and sells shares not for the short-term benefit, sir. He wants to keep it for some time. Then gain or loss is covered by what? Capital gains. Even under capital gains, STT paid is not deductible. Then commodities transaction tax. Sir, what is commodities transaction tax? Just like as normal share securities related stock exchange, we have commodities stock exchange also, where gold will be traded, metals, gold, silver, iron, copper. Okay, all these kind of metals will be traded, which is called as what? Commodities stock exchange. There, if you do any commodities trading, then there will be CTT, commodities transaction tax. Same way, sir, there also. You are an investor or trader. Investor na, taxable under capital gain, CTT not allowed. If you are trader, then your business, whatever the gain or loss is there, that is taxable under PGBP, then CTT paid is also allowed as deduction. Related income on sale of commodities taxable under that PGBP, then CTT paid is also allowed as deduction. CTT paid is also allowed as deduction. Then purchase of sugarcane. Purchase of sugarcane. Sir, why it is na? Sir, sugar factories thought of diverting profits and pay less taxes. How? Sir, for a sugar factory, what is the major raw material? Sugarcane, right. So here there is a farmer. To farmers, sir, actually they are paying rupees 3,000 per ton. But on record, they are showing it as like 6,000 per ton. This is actual. This 6,000 is like on record. On record, they are saying 6,000. Sir, then the payment transactions will be there. Sir, we can check that now. Easily they can be caught. Sir, when the payment is made to farmer, you can make it even in cash also. There is no restriction on payment only through specified route channel. So what they say? The other amount where it happened, they'll simply say like we paid it through cash. So they are claiming more expense, right? When they claim more expense, what happens? Profit decreases. Then the tax also will decreases. So then government observed this. They wanted to put a check on claiming more expense with respect to purchase of sugarcane rather than what actually they have incurred. So what they said? Cooperative societies engaged in manufacture of sugar. Expense on purchase of sugarcane is allowed only up to the price fixed or approved by government. Look at this example, sir. Government fixed per ton 2,000. Whereas cooperative society claimed that they purchased each ton for 2,500. But how much is allowed as expense, sir? Only 2,000 is allowed as deduction. The excess will not be allowed as deduction. Okay, to put a cap or to put a restriction on them, claiming more expense and reducing their profits. Then, sir, MTM, Mark to market loss. Sir, what is Mark to market loss? Mark to market loss now. Let's say, sir, you hold some future contract, forward contract, or you hold any option, future. On 31st March, it was not settled. It was not settled. But the actual price you purchased is for 100. On 31st March, it is only 80. You have loss of how much? 20. But is it a realized loss? It is not a realized loss. Why? Because you didn't dispose of the transaction or you didn't settle the contract on 31st March. It was alive only. Maybe 1st April again it may jump to 110. 2nd April it may go to again 120 also. So on 31st March, you purchased for 100. But on 31st March, the traded price is 80 only. But you didn't settle. You didn't settle or you didn't sold the asset or sold the share or security. So whatever the loss you are having is like notional loss only as of now. That only we call it as what? Mark to market loss. On the closing day, you are marking it to market and realizing that loss. But that loss is not a real loss, not a realized loss. Maybe tomorrow the share price again jump, there may be again gain. So whether such kind of mark to market losses are allowed as deduction or allowed to be claimed as an expense or not, we should refer ICDS. Most of the ICDS will not allow it. So if any ICDS says like income computation and disclosure standards, ICDS now. For accounting standards, for computation of tax profit, we have ICDS. If any of the ICDS allow, then claim as deduction. Otherwise, in general, they are not allowed as deduction. Mark to market losses are not allowed as deduction. So with this, we completed 36, sir. So we can try to recall whatever we have discussed in 36. First one is what? Insurance premium. Under that, 3 insurance premiums are there. Stock stores, Federal Cooperative Society, then employees related health insurance paid. The next one. Bonus commission paid, okay, by a private limited company. Sir, private limited companies can be called as even closely held companies also. Because most of the shareholders in private limited companies will be friends and family only. That's why they are called as what? Closely held companies also. So when the bonus commission is paid by any person, allowed as deduction. Whereas if it is a private company or closely held company paying bonus and commission with an intention to root profits in the name of bonus and commission, then it is not allowed, right? Then we discussed about contribution to PF and other welfare funds. Employee share. First income to employer, then when he deposits within the respective due dates of PF Act, allowed as deduction. Employer share, when he deposits within due dates of filing written off income, allowed as deduction. Then pension, contribution to pension scheme, how much is allowed? Actual or 14% of the salary, whichever is lower. Then interest, borrowed capital related, borrowing cost related, capitalized. What is borrowing cost? Date of loan till the date of asset put to use, that is borrowing cost, capitalized. The other interest it is allowed as deduction. Then discount on zero coupon bonds. Such discount is not allowed in a single year. You need to apportionate it over the tenure of the bond. Then we discussed about deduction for bad debts. Sir, deduction for bad debts allowed or not allowed? Deduction for bad debts allowed or allowed. But there are conditions, sir. What? First, should be related to business or profession. Then, in any of the preceding years, it should have been realized as first, considered as income, and that it was taxed, not related to revenue expenditures only, not related to capital expenditure, and it was actually written off in the books of accounts also. Then such bad debts written off are allowed as deduction. Provision for bad debts are not allowed. Predecessor booked a credit sale, considered as income and taxed. Then amalgamated, successor came, in successor hands it became bad debt. Even for successor also, bad debt allowed as deduction. Understand, sir? Then we discussed provision for bad debts with respect to banks, financial institutions and all. For Indian banks, okay, Indian banks, 8% of gross total income plus 10% of rural advances. Foreign banks, PFIs, NBFCs, 5% of gross total incomes. Then we discussed about family planning expenditure, capital expenditure, 5 installments, revenue expenditure, everything can be claimed in the same year. Then securities, say STD. STD paid, sir. STD only, straight away, before anything is there. Transfer to special reserves. Actual 20% of PGBP income or 20% of paid up capital plus general reserve, excluding this particular special reserve. Okay. Then securities transaction tax. SSE business itself is trading, then allowed. Otherwise, not allowed. CTT also same thing. Purchase of sugarcane. Actual or amount paid or amount fixed by government, whichever is lower. Mark to market losses not allowed unless specified by ICDS. Then 37. Sir, do you think it is possible to discuss about each and every expense? there are thousands of expenses. Okay, we don't even know what kind of expenses will be there. All those we cannot list and talk about each and every expense. Which are of significant importance, they listed in 36, 30, 31. Even though we didn't complete it, 32 is about depreciation. Even in 33, 35 also some specific expenses are claimed. But still, they don't cover each and every expenses. Let's say audit fee is there, nowhere covered. Advertisement expenditure is there, nowhere covered. Sir, even in 36 also, PF contributions covered, bonus and commission covered, but the original salary is not covered. Nowhere we discussed about salary. We discussed about what? PF contribution, bonus commission we discussed, but we didn't discuss about the salary paid to employees. So there are so many other expenses, sir, which we cannot talk about, which we cannot discuss each and every expense separately. It's not practically possible also. That's why they introduced section 37, which is general deductions. It gives you a general conditions. If an expense fits into these general conditions, then it is allowed as deduction. First one. Such expense is not covered under section 30 to 37. It is not 30 to 36. Not covered under 30, 31, 32, 33, 30, 34 not there, 35, 36 not covered anywhere. Not of personal nature. It's not any personal expenditure. Not of capital nature. Not covered under 30 to 36. Not related to personal purpose. Not a capital expenditure. Incurred with respect to business or profession only. And then it is incurred after the commencement of business only. Incurred by SSE only. It is not a violation or prohibition of law. Incurring such expense is not a violation or prohibition of law. So let's say, sir, you are into a business. You wanted to grow your business. Okay, that's why you paid some 2 lakh rupees to a government officer so that you will get that contract. Can that 2 lakhs be claimed as an expense? Not covered under 30 to 36. Incurred after commencement of business only. Not for your personal benefit, for the business purpose only. For business purpose only incurred. It is not of capital nature law because only it is related to only that particular contract. Okay. But what happens, sir? It is violation of law. Sir, if you pay to a government officer 2 lakhs now for getting a contract, it is called as bribe. Okay. Bribe is legal or illegal? It is an offense. Okay, it is an offense and it is prohibited by law. So it is not allowed as deduction. It is not allowed as deduction under section 37. Understand, sir? Okay. So 37 will not talk about any expense specifically. In explanations, they're going to tell, because by considering 37, sir, like the business raised so many doubts whether it can be covered under 37 or it can't be covered under 37. Like that, there were so many clarifications, explanations given. That part we'll discuss. But in general, 37 will not talk about a specific expense. It will say it is not covered under 30 to 36. Incurred by SSE. Not of personal nature, not of capital nature, after commencement of business only it is incurred, related to business or profession only, and if it is not a violation of law or not prohibited by law, then such expense is allowed as deduction. First one. Here, additional points. Expenditure incurred by SSE for CSR activities. What is CSR, sir? Corporate social responsibility. 2% of their profit has to be spent on CSR, applicable companies. Okay. Whether such expenditure can be claimed as deduction under 37. They clearly explained like no. Why? Because they are not related to business or profession. So CSR activity, now what you will do? You will lay a road. You will construct some bus shelters kind of, or you construct a water supply project and all, or you might have donated to a charitable trust kind of. All those are not related to business. Yes, there is a statutory requirement under Companies Act, but still those expense is no way helping your business to grow. Sir, just because you laid a road in a rural village, your company will not get more turnover or more profits and all. That's why it is not directly linked to the business or profession. That's why they said like what? Any amount incurred on CSR activities is not allowed as deduction under section 37. Not under 37. Any section it is not allowed. Then pharma companies, sir. Sir, let's say you are having fever. Which tablet you use? Dolo. Dolo is a company name, drug name. Dolo, paracetamol is a company name, drug name. Drug name only it is. Paracetamol, okay, let's say paracetamol is a drug name. Okay. Like that, for many drug names will be there. I mean, for this purpose, this tablet. Okay. But which company? So there are so many manufacturing companies here. Pharma manufacturing. There's Ranbaxy, there is like Divi's is there is like Reddy's is there. So there are so many laboratories are there which were pharma companies are there. Apollo is there. Okay, which were manufacturing the same kind of medicines. Understand, sir? Now, which company paracetamol is giving is the question. You went to doctor. Doctor prescribed paracetamol. But which company paracetamol? Whichever the company doctor prescribes, that company will get more profits. Yes or no, sir? Okay, because we don't check the brand also again. Which company paracetamol it is, that only trusted brand and all, we'll not checking, right? Mostly what we'll do, whatever doctor suggests, that medicine we are taking. Sir, Crocin is a brand name. Crocin is a brand name, but sometimes they'll be using even the drug name or the chemical composition name also they might be using. So pharma companies usually visit doctors and medical practitioners and ask or request the doctors to prescribe their company medicine. Same drug, but their company manufactured medicine. Why doctor has to do? No, sir. Doctor, he has to check the composition of the medicine, whether it is properly prepared or not. He has to think of it. Then he should suggest. Any company can suggest. But pharma company, sir, every company will try now. If you want your company to have an edge, what you will do, obviously? Some commission or some benefit, some incentive will give. Mostly these pharma companies will give freebies. They'll give gift items. Okay, sir, in your hospital, we'll give you the ECG machine. Sponsored by pharma company. Okay, 5 stretchers. Sponsored by pharma company. Stethoscopes, all these kind of things they'll be sponsoring or giving freely so that this marketing representative and the doctors will have rapport. Then they can slowly convince him to prescribe their company medicines, right? But the problem with here is that, sir, let's say a person started a pharma company. He is preparing low quality medicines which are not of quality, but he's giving so much or so many incentives to the doctors, and doctors also started prescribing his company medicine only. But at whose cost? The general public cost. Now, ultimately, the general public is going to be affected. That's why medical code of conduct says a doctor cannot accept freebies. Doctor cannot accept freebies. But still, pharma companies are spending so much money on giving freebies. So, pharma company, let's say, sir, a pharma company spent 30 crores in a year to give freebies. Can they claim that 30 crores as an expenditure? No. Why? Because giving freebies, maybe pharma company it is not wrong, but accepting freebies is a ethical or misconduct from the doctor perspective or medical practitioner perspective. So incurring this expenditure is violation of law. So the 30 crores can't be claimed as deduction by the pharma companies. So pharma companies will give freebies. Freebies, nothing but if anything is given for free, then we call it as what? Freebie. They are giving some medical equipments to doctors and medical practitioners. So expenditure on them is allowed as deduction to pharma companies or not. Providing freebies is against two provisions of Indian Medical Council regulation, so which is a violation of law, hence not allowed as deduction. Hence not allowed as deduction. Then, interest penalties levied for delayed payment of statutory dues. Delay payment of GST, delayed payment of customs. We'll have interest, right? For delay payment of GST, there is interest. Delayed payment of customs duty, there will be interest. Delay payment of municipal tax, property tax, also there will be interest and all. Sir, penalty na it is. Sir, usually penalties are levied for infraction of law. Sir, if you not paid within the time, then you are violating law. So penalties are usually levied for violation of law or infraction of law. So that's why what they are saying, like penalty kind of it is not allowed as deduction. But interest, sir, why interest is allowed? Why interest is charged by this government and all? They have to realize revenue on a particular day, but you are delayed. For the delay, they are also losing revenue. To compensate their loss, you are paying interest. So interest any paid on GST interest paid, GST customs interest paid, these are allowed as deduction only. But GST penalty, customs penalty, these penalties are not allowed as deduction because penalty is for violation of law. Interest is to compensate the loss of government. So interest is allowed, penalty is not allowed. See, income tax interest not allowed. Interest on loan taken for payment of income tax not allowed. Income tax related not allowed, sir. Anything interest also. But interest on GST customs other than income tax related allowed. Other than income tax related, other tax dues related interest is allowed as deduction. But income tax related, even interest is also not allowed. Then, sir, expenditure on advertisement of political party in pamphlets and brochures. Here not allowed. Where it is allowed? 80 GGB and GGC. You can just open and see, sir, 80 GGB and GGC. For advertisement of pamphlets and brochures, if it is a company, allowed under 80 GGB. If it is other than company, covered under 80 GGC, pamphlets, advertisements is not covered. Only direct contributions to political parties are allowed. Sir, understood, sir. Expenditure on advertisement of political party. What? So let's say Chief Minister is coming to this place. Okay, you kept hoardings, advertisement to political parties. Let's say Chief Minister birthday. The whole front page, you took in newspaper, the whole front page, you kept his full photo. There, you kept your business name also in small, and you are wishing him, promoting his political party also. Whether those kind of expenditures allowed as deduction or not. PGBP not allowed because they are not relevant to business. But you can claim such expenses if you are a company under 80 GGB. Direct political party contributions, those are also not allowed under PGBP, but you can claim under either 80 GGB or 80 GGC depending on the type of SSE you are. Then, Keyman insurance policy premium paid. Sir, in 28 we discussed about Keyman insurance policy proceeds. But to get the proceed, first you should do what? Premium has to be paid. Sir, why Keyman insurance policy is taken? For the purpose of business or not? Yes, that Keyman, if he suddenly leaves the organization may affect adversely. To cover that risk only, we are taking Keyman insurance policy. So the Keyman insurance policy premium paid is allowed as deduction under section 37. Premium paid with respect to personal accident policy. Sir, these mining companies or manufacturing companies where high risk is involved. The employees, laborers has to complete, every day has to involve in this process and all where risk are there may be chance of happening an accident. That's why employer will take what? Accident policy related to employer. That is for whose benefit? Employer business benefit only has taken, right? That's why such kind of premiums paid are also allowed as deduction. Then cost of production of an abundant film. So you are a film producer. In a year, you started producing 3 films. First film, super hit. Second film, flop. Third film, sir, you shooted 30% of the film or 40% of the film, then you thought it doesn't work and the film has been abandoned. Now with the film which got success has profit. With that profit, the loss of the second film can be adjusted and even the cost you spent on this abandoned film also can be adjusted. So cost of production of abandoned film can be claimed as what? Expense allowed as deduction. Tax audit fee, litigation fees related to IT case. Tax audit fee, litigation fee, all these are what? Allowed as deduction only. Settlement amounts. Sir, generally settlements when you do, instead of going to court, you'll do off-court settlements and all. But when you are doing settlements now, you are compromising the law. There might be some mistake. If there is some mistake, no violation from you, now why you do settlements, why do you make payments and all? So such kind of settlement-related compensations or payments you made, they involve infraction of law only. That's why they are not allowed as deduction. So you made a copyright infringement, patent infringement. So the other party is suing you. So to settle the issue, you are paying some compensation. That compensation settlement amount, if you are doing for what? For violation of a law. That's why it is not allowed as deduction under section 37. Then provision for loss of subsidiary. Provisions. These are not real expenses, sir. Provision you created for what? Subsidiary may get loss. For that loss, you are creating provision. That is not a real loss, right? So you cannot allow provision as a deduction. Provision for deferred tax, not allowed. Provision for a diminution in value of assets. The assets may get reduced their value. For that, you are creating provision. Or provision for unascertained liabilities. Sir, unascertained liabilities, you are thinking like maybe contingent liabilities kind of. Unascertained liability, it is something like a contingent liability. For all of them, if any provisions are created, those are not allowed under section 37. Then share debenture issue expenses. Sir, this point tested in June 25 exam, sir. So the point they asked is like, company wants to increase authorized share capital. Authorized share capital and wants to get new share capital. For that, to increase the authorized share capital, they incurred certain ROC fee. Then they asked for additional share capital also. For that, also there is some fee. Prospectus issued. All these charges are there. Memorandum has been changed. Articles also has been changed. Articles of association, memorandum of association, all these has been amended. For that also they have incurred certain fees. The question is whether those fees are allowable as deduction or not. So first, share capital nature or revenue nature? Capital nature. With respect to that share capital, if any related expenses are incurred, all of those are also what? Capital nature only. So they are also not allowed as deduction. So when there is a change in share capital, it is a capital nature. Related to such change, if any expenses incurred, all of them are also what? Capital nature only. So they are not allowed as deduction. Issue of prospectus, change in memorandum, change in articles of association, or any other related to issue of shares and debentures, these are of capital nature, hence they are not allowed. Sir, correct it, sir. In material, it won't be correct. This point, correct it in the pulse. Including issue of shares and debentures also capital nature, they are not allowed. Revenue only, but their debentures are written as like revenue. But debentures are also of what? Capital nature only, hence the relevant expenses are not allowed. So issue of prospectus, change in memorandum and articles of association, if they are related to issue of shares or debentures, then they are capital nature, hence they are not allowed. It's okay. So Prabhakar, you can put that message in the group. Any one of the students also can reshare that file. Okay. So when you want any file, when you are missing now, you just post a message in the group. Either me or some other person also, some of the students also will share if it is available with them. Then sir, we'll see this example. So we covered 36 completed, 37 also completed. So look at this P&L. This is a model P&L, sir. I have downloaded from Google only. Gross profit. Discount received, PGBP related. Commission received. So commission received also may be related to PGBP. But interest taxable under which head, sir? What we should do? Since it is already created to P&L, this is chargeable to tax under IFRS. What we should do? Subtract only, right? Yes. Rent received taxable under? What we should do? Dividend on shares. Dividend. Capital gain, sir, profit or loss on sale of shares, na capital gains. Dividend is a revenue income, so it is taxable under which head? IFOS. What we should do? Subtract, because taxable under a different head. Interest earned on debentures. What we should do? Profit on sale of asset. That also subtract. Okay, then this side. So you have to tell, sir, out of these general expenses, which expense covered under which section? Salaries. 30 covered. In 30 salaries we discussed. 31, 36. Then will it meet the requirement of 37? If you paid salary, will it meet the requirement of 37? What are the requirements of 37? Not covered under 30 to 36. Yes. Next. Not a salary you paid is of personal nature. For business, it is not of personal nature. Is it of capital nature? After commencement of business only. Related to business or professionally. Paying salary is a violation of law. No, then salaries is allowed. Covered under where? 37. Then office rent rates and taxes. Office. Building, na sir, it is related to what? Section 31. Allowed or not? Yes, allowed. Printing and stationery. Again, scan every time. 30 covered, printing and stationery. 31 covered, 36 covered, then 37. Check whether the conditions are satisfying or not. Generally, printing and stationery. Is it covered under 32, 36? No. Is it of personal nature? Sorry, printing and stationery, for your business related, some books, BCCA, sir, having printing and stationery cost. For BCCA only. 30, not covered. 31, not covered. 36, no specific point about printing and stationery. Then under 37, what are the points? For business purpose only. Not covered under 32, 36. Not of capital nature. not of personal nature, not a violation of law, then printing and stationery allowed or not? Which section? Okay, 30. Office rent 30. Yes. Telephone expenses. Telephone. 37 only again, not covered under 30, 31, 36, 37. Not of personal nature, capital nature, all the conditions will satisfy. So it is what again? 37. Postage and telegram. Discount. 37 only again, because nowhere we discussed about under 30, 31, 36. Do we discuss about discount? So then discount, why will give, sir? For the purpose of business only, right? Is it of capital nature? Is it of personal nature? Is there any violation of law? No. So discount under which section? 37. Insurance, sir. Here insurance, which insurance they didn't mention? Building na 30. Plant and machinery na 31. Stock and stores na 36. It's okay, but anyhow, it may be under any of the sections, but finally it is what? Allowed. Then audit fee. 37. Electricity charges. Repairs and renewals. Again, we don't know, sir, whether it is related to buildings or plant and machinery, but let's say building, 30. Let's say plant and machinery, 31. Assuming these are what? Revenue repairs, 30 or 31. Depreciation. This is not allowed, but we'll add back. And income tax depreciation will subtract as per section 32. Okay. Advertisement. Which section? Carriage outwards. Transportation. 37 only, sir. Carriage outwards also, because nowhere we discussed about freight, outward freight, inward freight. We didn't cover under 30. We didn't cover under 31. 36 also no point about freight, carriage, inwards and all. So this is covered under where? 37. Bad debt. If it is written off, sir, bad debt is covered under which section, sir? Section 36. Provision for bad debts. Not allowed. Okay, where it was said not allowed? 36 only. Selling commission. Allowed, sir. Bonus and commission allowed. Unless if it is rooted by a private limited company, like otherwise, in general, selling commission is what? Allowed. Which section, sir? Section 36. Bank charges. Bank charges allowed only, sir, but nowhere mentioned. 30 is it mentioned? 31? 36? No. So it is covered under what? 37. Interest on loan. 36, sir. Assuming it is not borrowed capital. Then loss on sale of assets, sir. This is not even related to PGBP. What we should do? Add back. Sir, a general P&L of a normal business will consist of these kind of items only. A regular P&L. Think of a grocery store. Think of if you get a client, a small and medium sized person. These kind of regular expenses will only be there. Okay. So every expense what we are doing, we are screening under 30, 31, 36. If it not covered, then it will be under 37. So expense side, first part we completed. What? We need to check first whether it is allowable or not. So we have decided whether it is allowable or not. But this itself is not the festival. There is another thing also. What? Okay, the next thing is what we need to check for even disallowance also. Disallowance is under which section? 40, 40A, 40B, 43B. If any, okay, the next. Yes, I could see number. Huh? Then disallowable expenses. Sir, with today's class, we can solve 80 to 90% of the PGBP questions, sir. Most of the, whatever we discussed are like a regular adjustments which we can see till now. Okay. So today's is also very much important, sir. All the disallowances. And again, sir, do we need to remember section numbers? Is the main question. Sir, section number you remember or not it is secondary. First, if you could identify whether it is an allowable expense or not, then is it disallowed or not? Till that place, it is fine. It is enough. If you are in doubt with section numbers, don't quote a section number, but you should be writing the relevant provision or explanation in the note points. So PGBP question, there are like 4 or 15 points. 14 to 15 points will be given. We need to add or we need to subtract. For every point, we should write an explanatory note. It's not just we doing plus or minus and finding out that PGBP income. For every point, even if you ignored, even if you subtracted or if you added, why you are doing, that reasoning has to be given. While giving that reason, if you know section number exactly, sure, then quote. Otherwise, vaguely you remember like this may be under 36. Fine. Subsections are not needed. This may be under section 40. That main section alone you could remember. That is also fine. You need not to remember the subsection wise also. Okay. See, if you see here, 40 subsection A clause 1, 40 subsection A clause 2, okay, clause 3. So this much subsection wise you may not remember and it is not needed also. If you could remember here, disallowable expenses, first 40 subsection A. That is fine. Okay. See, sir, what are the most disallowances will come under these 3 sections, sir? Section 40. Under section 40, we'll have section 40 subsection A within that subclauses only. Section 40 subsection A. Then section 40A. Then section 43B and then section 40B. These are the main 4 sections which talk about disallowances. Okay. If these conditions are to solve a PGBP question, these conditions should be on your fingertips. Okay. Only if you could immediately connect to these disallowances, you can solve a question. First, section 40 subsection A clause 1. Section 40 subsection A clause 2. Clause 3, not clause 2, clause 3. SSE is a payer who is making payment to a payee who is in outside India or non-resident. He is making payment to whom, sir? Payee outside India or to a non-resident. What amount he is paying? Interest, royalty, fee for technical service, and any other sum chargeable to tax. These are covered by with section 40 subsection A clause 1. Whereas if the payment is salary, then that is covered under 40 subsection A clause 3. So what kind of interest, royalty, fee for technical service? Sir, for interest they didn't say if it is chargeable to tax. For royalty they didn't say it is chargeable to tax. FTX also they didn't say if it is chargeable to tax. But any other sum, now what they are saying? if it is chargeable to tax. So in question, interest, royalty, fee for technical service or salary are given. Then straight away you can decide whether TDS deducted or not. If you don't explanation and you do only solving now, you will not get marks. You will get only half of the marks. Okay. Even if your complete question is correct, and if you don't write note points, out of 14, you'll get only 7 marks. If your question is wrong now, then the number will fall much more drastically, like 2-3 marks only you will get. But with writing these note points and all, even your final answer is wrong, still you can able to get 7 to 8 marks, because out of those adjustments, majority adjustments, you know, you will do wrong only at 2 or 3 places. Those 2 or 3 places and total will go wrong. For that you may lose 6 marks. Other 8 marks will get right. So you do adjustment and you should write points also. SSC is a payer. He makes payment to pay outside India. Sir, see, interest, royalty, fee for technical service, they didn't specify, and even for salary also, they didn't mention here if they are chargeable to tax. That means what? These are always chargeable to tax to non-resident. So when these amounts are there, and they said like TDS is not deducted, then disallowability will attract. But if they refer to any other sum other than interest, royalty, fee for technical service, salary, in the questions we have available, the other sum means commission will come. The other sum means commission will come. Sir, commission, they'll say TDS is not deducted. Straight away we'll say disallowed. No, sir. First, such commission should have been chargeable to tax in India. Only when it is chargeable to tax in India, then we should talk about whether TDS deducted or not. Sir, understand? Sir, why this disallowability is made? Non-resident outside India. If Indian government asks him to pay tax, he will not pay. That's why, who is there in control here? Resident. So they are asking this resident, whenever you are making payment to non-resident, deduct TDS and the balance amount only you pay. They are keeping a restriction on this local resident. Why? Because they cannot pressurize non-resident. That's why they started keeping pressure on whom? Resident only. Understand, sir? Sir, if such sum is not even taxable to non-resident, then why tax has to be deducted? Sir, the main problem of government is what? If non-resident has to pay tax, he may not pay, and government may have loss of revenue. To control that, they introduce this kind of provision. If they introduce this kind of provision, only the incomes which are chargeable to tax in India for non-resident, only on them TDS has to be deducted. If they are not even taxable, why TDS has to be deducted? That's why, okay, interest, royalty, fee for technical service, salary, these are chargeable to tax every time. Sir, where it is said? You didn't say. Okay, if you have studied interlevel residential status properly, then there is a concept called deemed to be accrued in India. There in deemed to be accrued in India, it was said clearly, interest, royalty, fee for technical service, and salary kind of things, if they are paid from India to a non-resident, they will be considered as deemed to be accrued in India only. Since they are accrued in India, they are taxable in India. So we need not to specify again them. If an Indian is paying, then these are considered as what? Accrued in India, taxable in India, so TDS has to be deducted. But for any other sum, we should again check where the income is actually accrued. If it is accrued in India, then taxable in India. If taxable in India, what has to be done? TDS has to be deducted. On these payments, TDS not deducted during the previous year. Sir, interlevel, we left total income tax choice. Don't we get all these points once again? Yes, sir. We'll get these points revision also one time, another time in the chapter non-resident. Okay, there we'll discuss once again the residential status. There we'll get this deemed to be accrued concept once again in the final level. Okay, but it will go super fast, sir. Okay. On these payments, TDS not deducted during the previous year. What is the mistake that it said? TDS not deducted, or TDS deducted but not deposited with central government on or before the due date of filing of return of income. Sir, both are of same thing. For government, non-deduction also government not getting money. They deducted but not paying to government also, still government didn't get money. So both are like same kind of thing only for government. That's why what they are saying, sir. If you made a payment on the TDS has to be deducted, but you didn't deduct TDS or not remitted such TDS to the government, the payment is to a non-resident, then 100% of such expense is disallowed. Not 30% or 100%. Let's say 5 lakhs you paid, then 5 lakhs is disallowed. What we should do? Sir, this 5 lakhs may be already allowed under 37, already allowed under 30, 31 or any of the sections, but still 40A subsection 1 and subsection 3 says what? Forget about what is said in 32, 37. Yes, it may be allowed. But here, if these conditions are not satisfied, then such expense is disallowed. Okay, for non-deduction of TDS or non-remission of TDS with respect to non-resident, 100% of such expense is disallowed. Okay. A Limited paid rupees 20 lakhs royalty to Josh Butler, who is a non-resident. In which year, sir? In previous year, 25-26. On this TDS not deducted. Sir, look at A Limited P&L. What they did? Royalty 20 lakhs, they debited. But on this TDS deducted or not deducted? Not deducted. What we should do? Disallow. Okay, it is disallowed. That means in P&L approach, what we'll do? Add back. Okay, continuation. In previous year, 27-28. Sir, in 25-26 this happened, na? Then in 27-28, the TDS on royalty paid in 25-26 was deducted and paid to government. 25-26 they didn't do anything. 26-27 whole year they was in sleep mode only. In 27-28 they woke up. Then they deducted the TDS on the first payment. Okay, sir, how can they deduct already payment made, na? Sir, in 27-28 also maybe they are doing a second payment. In second payment, they deducted TDS applicable on first payment as well as on the second payment. So now what they are doing, the mistake they did in the 25-26 is being corrected in the year 27-28. Now what government says, TDS on royalty paid in 25-26 deducted, now unpaid to the government. So in previous year 27-28 for computation of PGBP, such expense is allowed. So, but one thing, whether that expense will be already debited in P&L. In 25-26 accounting P&L, it was debited and it is allowed. In 27-28 accounting P&L, will they show again the same 20 lakhs? No, right? So we may not see that amount in the P&L debit side, but that expense will not be there because it is at 25-26 expense. Such expense, since they made the default correct now, it is allowed now. That means what? Even though it's not there in P&L debit side, we should debit it. So what we do? Now it has to be debited. That means what we should do? We have to subtract. This is something like a point given in the additional note kind of. Understand, sir? Okay, sir, understand. In the year of non-deduction of TDS or non-remission of TDS to the government, what we should do? Disallow. If it is debited to P&L now, what we should do? Add back. But next year it was paid. TDS was paid. The next year what to do? You should allow. But it won't be there in P&L because it is a last year expense. Sir, in accounting, while you passing accounting entry, you will not check all these disallowances and all. So last year expense only, it will show in last year accounting P&L only. But current year, income tax is saying like last year not allowed, in the current year it is allowed. So last year you add back. Now current year what we should do? You should subtract. Okay, even though it's not there in the P&L, you should again take it as a separate item and you should subtract. Okay, in previous year 27-28 for computation of such a PGBP, such expense is allowed. So now it has to be debited. You have to subtract. Understand, sir? This is about what? Non-resident, non-deduction of TDS or non-payment of, non-remission of TDS. So what are the payments covered here? Interest, royalty, fee for technical service, salary. These four are like specifically said. And the last fifth one is what? Any other sum chargeable to tax. Sir, interest, royalty, FTS, salary, easy only. If they ask about any other sum only, we have extra thing also to be checked. Whether that income is chargeable to tax or not. Only if it is chargeable to tax, then TDS should have been deducted. Understood? Okay. Then section 40, subsection A, clause 1A. Section 40, subsection A, clause 1A. SSE is into business or profession. SSE is into business or profession. He makes payment which is chargeable to tax to recipient. He makes payment which is chargeable to tax to recipient, and the recipient is whom? Resident only. So to a resident you are making a payment and such payment is taxable. Sir, loan prepayment is also a payment only, but that is not. Income on the TDS is not applicable. So what they are saying, like, if you make any payment, check whether that payment is taxable to the recipient or not. When it is taxable, if it is an income, it is chargeable to tax to the recipient. So when you make a payment, if it is chargeable to tax to the recipient, on this payment, TDS not deducted or deducted but not remitted to the government within due date, then 30% of such expense is disallowed. How much, sir? 30%. For non-resident now, how much is disallowed? 100% disallowed. For resident, 30% of such expense is disallowed. However, the same is allowed as deduction again in the year of actual payment or actual deduction and actual payment. So again, look at the example. Previous year 24-25. They wrote audit fee how much? 3 lakhs. So the audit fee na, it is paid to professionals. If it is paid to professional na, which TDS section will come? 194J will come. Audit fee. When you made a payment to professional, then TDS has to be deducted under 194J. On audit fee, TDS not deducted. 194J says, what is the TDS rate? 10%. Did you deduct it or not? No. So since you didn't deduct it, this audit fee 3 lakhs completely disallowed. 30% is disallowed. How much is 30% means? 3 lakhs into 30%. 90,000. So what we should do that 90,000? Add back to this net profit 20 lakhs. Yes or no, sir? Audit fee 194J applicable. TDS has to be deducted. They didn't deduct it. So how much? 30% of such expense is disallowed. So 90,000 disallowed. If you should add that amount to the accounting profit. Then continuation. In previous year 25-26, what they did with respect to audit fee of 24-25, TDS was deducted and remitted in 25-26. So now what we should do? You should allow it. Allow it now. What we should do? Is it debited in the P&L? No. But again, you should allow it. Allow it now. What? You should subtract it. Sir, expense originally of what nature? You need to debit nature. We need to subtract. Okay. So this year it may not be there in the P&L, but what we are saying, like, it has to be allowed. That means we should subtract, even though that it is not there in the P&L. Generally, it won't be there, but still we should do what? Subtract. Okay. So net profit 15 lakhs. From there we subtract audit fee 90,000. Understand, sir? Are you able to understand, right? Okay. Sir, I took an inter question, so I don't know for what purpose, but look at whether we can solve. Okay, this is a receipts and payments model question, sir. In final, we don't have receipts and payments model question. So, but to have knowledge about receipts and payments model question also, this is an institute study material question from CMA Inter. Okay. Sunil is a, sir, how do we solve receipts and payments question? Out of all the receipts, we should find out which are incomes and which are chargeable to tax under that PGBP. Those has to be identified. Then from payments, which are expenses allowed under 32, 37 and not disallowed. Okay. So first receipt set. Audit fee. Chartered accountant audit fee, sir. Professional income only. Taxable where? PGBP. Income from other professional work. PGBP. Coaching fees. Business only. PGBP. Interest on investment. Other sources. Examiner fee. Are you able to see, sir? Examiner fee. I mean, he's going for invigilation and all. IFOS. Rent from house property. House property. So which incomes we should take? audit fee 22 lakhs, other professional work 1 lakh, 23 lakhs, coaching fee 1200. So total what are his incomes chargeable to tax under that PGBP? 22 plus 1 plus 1200, 23 lakh 1200 is the total incomes that are chargeable to tax under that PGBP. Now we'll go to expenses. Office expenses. Tell whether office expenses are allowed. First, is it an expense or not? Okay, allowed or not? If allowed, under which section? 30 covered office expenses. Not specifically, they didn't say like rent and all. 31, plant and machinery, furniture. 32, depreciation. 33, 35, specific related. 36, do we refer anything about office expenses in 36? Then it will fall under what? 37. What are the 37 conditions? Not covered under 32, 36, then. Not a capital expenditure, not a personal expenditure. In the course of business, after the commencement of business, so it will fall under which section? 37. They didn't give any point like even TDS deducted or non-deducted, that thing is also not there. Okay, so what is this 18,000 allowed under 37? Let's say if in notes, separately they given point also. No? First level is what? We'll check allowed or not. Second stage is what? We'll check for disallowances. Even though it is allowed, again we'll check for what? Second stage also. Then municipal tax on property. Sir, there is rent from property. Rent from property taxable under which head? House property. Then this municipal tax on property also related to what? House property. Sir, that means this expense is not related to PGBP. So will we allow it? No. So simply ignore. Sir, this is not P&L model to add back. This is what model? Receipts and payments model. In payments, only related payments to PGBP you will extract. And related PGBP incomes you extract. From income subtract. Expenses. Simple only. You need not to stretch your brain or you need not to struggle also to add back or to subtract also. Which are relevant incomes, take. Which are relevant allowable non-disallowed expenses, take them and subtract. Okay. So this is municipal tax is not allowed. So simply what we'll do, we'll ignore this. Coaching expenses. Allowed, sir. Coaching fee, if you taken it as income, the relevant coaching expense is also allowed. So office expense allowed, coaching expense allowed. Personal expense, sir, okay. This coaching expense is covered under which section? 30, 31, 32, 35, 36. Specifically anything mentioned in 36 as coaching expense? Then where? 37. Okay. Sir, every time when you look at an expense, quickly you should screen through what? 30, 31, 32, then 36, 37. Okay. Then membership fee. Institute membership fee paid, sir, is a chartered accountant. Na? To do practice, you should pay membership fee. 30, is it covered? 30 is about what? Section 30? Rent rates and other rent repairs and other taxes related to building. 30 covered? No. 31. Plant and machinery, furniture and all. Not covered in 31. 32. Depreciation, not covered. Then 36. Insurance, there also no membership fee is covered. So again, it is covered under where? 37. Allowed under 37. For business only, sir, this is membership fee. Okay, if you didn't pay membership fee, you cannot sign audit report also. That's why he's doing. Then life insurance premium. Sir, see, look at 36. Insurance premiums paid to employees are covered. He is paying life insurance premium for himself, which is a personal expense. So 30 not covered by rent repairs related to building. 31 plant and machinery. 32 depreciation. Then 36. 36 also life insurance is not there, sir. Health insurance is there. Employee accident related insurance is there. Stock insurance is there, but life insurance is not there. 37 will come. 37 is what? Not covered under 32, 36. Yes, it is not covered. But not of personal nature also. But life insurance is a personal nature. So allowed under 37? No, not allowed under 37. Then income tax. Okay, sir, income tax, they nowhere it was said not allowed, but in 40A series only, the next coming section is about income tax only, which says like disallowed. Or even if you don't remember also common sense. You are calculating here PGBP profit for what? Tax computation only. For the purpose of computing tax, you are calculating a profit. How it could be after tax? It should be what? Before tax only. Na? That's why income tax not. Motor car purchased. First, it is not a revenue expenditure. It is what? Capital expenditure. It has to be capitalized. It has to be capitalized, and on that we should allow what? Depreciation. We should avail depreciation. So it is not an expense, but we should remember what? We should calculate depreciation on this. Motor car expenses. Motor car expenses. 30 not covered, sir. 31 it could be covered. If not 31 also, again it is covered under 37. Insurance on property. Sir, this insurance of property, if it is related to house property, not allowed here. Let's say we'll assume like not related to house property. Okay. Insurance of property. Sir, since here no other property is given, we'll think it of what? Related to this property only. If it is related to this rent from property only, then this rent from property is taxable under which head, sir? House property. This rent from property is taxable under income from house property. Then the relevant municipal tax also not allowed here, and then relevant insurance on property also not allowed, so ignore. Okay, so the given note points also, sir. 20% of motor car expense is only in respect of profession. That means balance 80% is related to what? Personal. So here in motor car expense, total 10,200 is not allowed. How much is allowed, sir? 20% means how much? 20% means how much? 2,000. 2,040 is only allowed. Yes or no? Then, sir, this is not only a straight point, this is a hint even to depreciation also. Motor car, they are indirectly saying like what? 20% is only for business purpose, 80% is for personal purpose. So what we should do? Depreciation also. On motor car, depreciation will calculate. What is the motor car value, sir? 1,80,000. On 1,80,000, 15% is the rate of depreciation. How much? 20, 27. Okay, they said, okay. Of motor car is 27,000 if wholly used for profession. But did they use wholly for profession? No, 20% is only for profession. So how much depreciation? 27,000 into 20%, 5,400. Then they given, sir, outstanding fees 2,000, whereas 500 is considered as bad. There is a bad debt. Then outstanding fee 10,000 of previous year 21-22 received in the current year. Then office expense include payment of 2,000 incurred during the previous year. But last line what they said, they maintains accounts on what basis? Cash basis. So these three lines does it have any impact? Because cash basis, now what you will do, you will recognize revenue only when it is received. You will recognize payment only when it is paid. What is it? Office expense of 23-24 was paid in the current year. Yes, then it is what? Which year expense? Current year expense only, no problem. Then outstanding fee 500 receivable is considered as bad. Sir, in cash system will not even consider about bad debts. So this point irrelevant, this point irrelevant. D point. Outstanding fee of 21-22 received in the current year. That is current year income only, since it is received in current year. So nothing, no adjustments to be done for all these 3 points, since they are maintaining accounts on what basis? Cash basis. So how do we compute profits or no? Income we already calculated. PGBP how much? 23 lakh 1,200. From there we should subtract expenses. What? 18,000. Do the calculator, sir. 18,000 plus 800. Then membership fee 500. Then membership fee 500. Then we have depreciation 5,500. Add 5,400. Then motor car expense 2,040. What is the total, sir? Subtract it from 23 lakh 1,200. 22 lakh 74,460. That's what we got also. Okay. Sir, everybody able to understand? Okay. Then we are moving on to section 40, subsection A, clause 2B. Sir, just like as normal people, even state governments also diverting their profits with different names. State government undertakings, like this power sector companies, APSRTC kind of. Okay, these are what? State government undertakings. These state government undertakings were not exempted from income tax. They also have to pay income tax. The state government corporations also. But majority equity is held by whom? Held by whom? State government. Sir, public sector, central government owned companies will not do about tax avoidance, because ultimately who is their owner? Central government. If they pay tax also, it will go to central government. If they don't pay tax, whatever the earnings they have, that will also they declare it as dividend and it will go to central government. So however you pay, the money will go to central government only in such case. But state governments, sir, if they pay income tax, that will go to central government. If they avoid income tax, then it will be given as dividend to state governments. That's why state governments also, just like as normal people, even state government also started diverting their incomes with different names instead of showing it as profit. Like what? State governments, the state government undertaking started paying royalty to state governments, license fee, service fee, privilege fee. Like this, they are paying certain amounts to state government. Nothing but their intention is what? Diverting profits. Okay, but not straight away, sir. All these are not real expenses, but they are saying for a sake. Okay, for the namesake, they are creating this royalty, license fee, service fees, privilege fee, and paid to state government. By charging all these, what happens, sir? Their net profit will come down, and the tax also will come down. Okay, to reduce their tax burden and to maximize the money that will be received by state government, they are making these kind of payments to state government. State government undertakings making these payments to state government. What are these payments, sir? Royalty, license fee, service fee, privilege fee. Are these allowed or disallowed? All these are disallowed. All these are disallowed. Okay, see, KSRTC P&L. They said, sir, actually KSRTC has 900 crores profit. Originally it should have 100 crores. Now how much tax will go to central government, sir? 30 crores will go. So they are worried about giving 30 crores to central government unnecessarily. So what they started doing in KSRTC P&L, they are charging license fee as 90 crores, which is paid to state government. So by charging this 90 crores expense, the net profit came to how much? 10 crores. Then the central government revenue tax is going how much, sir? 3 crores. Whereas state government will get how much? The 90 crores license fee they got, and the balance profit also belongs to them only. So 97 crores they are getting. In previous case, they'll get only 70 crores. So to maximize their revenues, they are doing such a way, they are charging royalty, license fee, service fee, privilege fee payable to state governments. Okay. But what 40 subsection A clause 2B says, all these kind of payments are, it is allowed. So here what we should do for this license, okay, for this net profit 10 crores, we should add back this 90 crores. Then the profit will again come back to 100 crores. Understood, sir? Sir, income tax was originated in 1961. So from then, okay, people have used so many alternatives to avoid tax or to plan the taxes and all. Okay, it's not about always avoidance. To plan tax effectively, they have found out so many alternative ways. But over a period of years, okay, how many years, sir? 1961, there are some 39 years. Here another 25 years. So total how many years are there, sir? At 40 plus almost 64 years is there. In the 64 years, every year, if they found out something, then they'll do a counter thing. So almost now, okay, for everything, if you feel like there is a chance of doing tax planning, they already introduce what? A counter mechanism also for that. So this is like, previously it is a tax planning tool, but now they have introduced a counter thing and said like what? If you did it in such a way also, it is what? Disallowed. Then perquisites. So what is called perquisite? Perquisite, salary chapter, interlevel. What does it mean by perquisite? Any benefit given to whom? Given by whom? Given by employer to employee. Monetary or non-monetary? Both are only non-monetary. Both. Okay. Perquisite could be both monetary as well as non-monetary. It is a facility or benefit given. Car given to employee. It's a perquisite. Rent-free accommodation given. It's a perquisite. Perquisite is an income to employee. Why? Because he's getting a benefit, so it's an income to employee. Same way it is an expense to the employer. So we are not talking about that expense. But sir, employer doing what now? Giving car is okay. Giving house also is okay. But by giving car and giving house, it is an extra income to the employer, right? It's a perquisite to the employer, right? So now let's say the car perquisite value and the house perquisite value together, it is 2 lakhs. Now employee income will increase by how much? 2 lakhs. On the 2 lakhs, he has to pay extra tax, right? That extra tax also paid by employer only. This is only extra. Okay, what he giving car is also fine. He giving accommodation is also fine. But because of giving car and accommodation, employee's salary will increase by, the overall, his income increase by 2 lakhs. Because we are assuming the value of car and accommodation is like 2 lakhs. So increase by 2 lakhs. If it is increased by 2 lakhs, now his tax will also increase. Let's say 2 lakhs equivalent to tax. 2 lakhs into 30%, equivalent tax is how much? 60,000. Who should pay the tax actually? Employee should pay. Because this is income, he has to pay. But that 60,000 also paid by whom? Employer only. This is over. Okay. He giving car is fine. He giving accommodation is also fine. But the tax applicable to employee on these perquisites is also paid by employer. Not only us, even government also felt like you are doing little extra. What they are saying like, employer given perquisite benefit to employee. That is not a problem. But on the tax also paid by whom? Employer. Then it is a benefit. Then what they are saying, sir? Sir, understand one thing. Car given is a benefit to employee. Accommodation given is a benefit to employee. If on this tax applicable and if such a tax is paid by employer only, then that is also a benefit to employee. Yes or no, sir? Sir, for me, car given, benefit. Accommodation given, benefit. On that 1 lakh tax has to be paid. That tax also paid by employer only. Then that 1 lakh is also a benefit to me. Otherwise, I should pay from my own pocket. Okay, now he is only paying. Now that 1 lakh is also benefit to me. So what I should do, that 1 lakh also I should add to my income. Okay, now what they are saying, see. Tax paid on non-monetary perquisite paid by employer on behalf of employee. For employer, it is an expense, but disallowed. Why disallowed? Because they felt this is over. You giving perquisite is fine. On perquisite related, tax also you only paying, na? It's not something, sir. Generally, sir, for any employer, this company will pay the tax applicable also. For normal employers, it will pay. It will not pay. Let's say, sir, I own a private limited company. Okay. In that private limited company, I'm a director and employee. Now, what company will do in private limited company? Sir, it's almost like my company only, right? So, what company will do? It will pay. It will give car to me. It will give accommodation to me, and the applicable tax also company is only paying. Sir, in general cases, does all the regular employees, normal employees getting these things? They may get car. For a IAS officer, yes, government may provide car. Government may provide accommodation. Or for senior level employees and all, they are giving car and accommodation. But the applicable taxes and all, they'll not pay. But if you are paying applicable taxes only, this is too over. That's why they're saying like that tax part will not allow as deduction. Okay, it is disallowed. You may argue like, sir, I am doing it for business only, sir. If I do that, employee will work much more happily. He'll do much more work for me. He'll be more committed. He'll be more loyal to me. Okay, but still they felt like this is little extra. That's why they said what? It is disallowed. It is disallowed. Sir, if it is disallowed now, it is taxable under whose capacity? Company capacity only it is being taxed. Since in company capacity only it is being taxed, employee it is exempt. Sir, అర్థమవుతుందండి సార్ ఏదైనా ఒకరికి ఇన్కమ్ అయితే ఇంకొకరికి ఎక్స్పెన్స్ అవ్వాలి. Technically, if you think the tax paid on non-monetary perquisite is an expense to employer, income to employee. So genuinely, it should be taxed to whom? Employer. Okay. It should be included as income to employee, and it should get taxed in employer. But what we are saying, like in PGBP, such expense is not allowed to employer. If employee cannot claim that as an expense, then it is being taxed under the whose capacity, sir? Sir, nothing but what you are doing, you are adding back that one. If you add back that one, employer profit increases now, so it is taxed under whose capacity? Employer or company capacity only. Now, since it is already taxed in employer hands, again it should be taxed in the employee hands. That's why what they are saying, like in employee it is income, but still it is exempted under section 10, subsection 10, clause CCC. So now see, sir, salary 24 lakhs paid. For employer it is an expense. For employee it is an income taxable. Any perquisite given, 40,000 given, it is an expense to employer. Employee it is an income taxable. There are no disallowances with respect to these two, sir. In general, salary is an expense to employer, income to employee. Perquisite given, expense to employer, income to employee. But tax paid on non-monetary perquisite by employer, how much? 12,000. Did they felt over? That's why, even though it is an expense, for employer, what they said? Disallowed. Since for employer it is disallowed, it is, sir, once it is disallowed, it is happening what? For employer only it is getting taxed. Since it is being taxed at employer hands only, for employee it was exempted. It was exempted. Sir, able to understand the logic, right, sir? Sir, what are, okay, then the last one under 40 subsection A, sir. Then again, we'll revise all the disallowances once again. Okay. 40 subsection A, clause 2. Sir, and remember this, late fee is not equal to penalty. Penalty is different, late fee is different. Any tax levied on profits and gains of business or profession. Sir, what tax is there, sir, currently? Only income tax is there, which is leviable on, the only direct tax is what? Income tax currently. So if any income tax related expense is there, it may be a self-assessment tax, advance tax, demand related tax, surcharge paid, cess paid, interest on delayed payment of taxes, all these are disallowed. Sir, you might be wondering, sir, why penalty is not covered here? Sir, penalty, why it is not covered now? First, penalty is not even allowed. We are talking about expenses. Originally, they are allowed. But again, this section is saying what? These are disallowed. Sir, income tax allowed. Sir, in 30 to 37, nowhere they clearly said like income tax is not allowed. If you go to 37, sir, you go to 37, this income tax, why you are paying? Because of business only, na? So not of personal nature. Not of every year you have to pay. Not of capital nature. Not covered under 32, 36. Incurred after commencement of business only. Paying income tax is not a violation of law. So actually income tax fits into the definition of, or fits into the conditions of section 37. But this section comes and says like what? It is disallowed. Interest, surcharge, interest on delayed payment of income tax, surcharges, all these are disallowed. Sir, what about penalty? Sir, if you remember the additional points under 37, there we clearly wrote penalty is for violation of law. Okay. Blind thumb rule, na? Income tax related, interest to penalty, okay, surcharges, cess, all these are disallowed. Okay. GST is related. If any GST or customs related, only penalties are disallowed. Rest all are allowed only. Okay, see, for indirect taxes or any other taxes paid, this section 40 subsection A clause 3 is not applicable. There, that means they are what? Allowed. That means they are what? Allowed. Okay. So under 40 subsection A, sir, what are the points we have discussed? First one is about what? Non-resident related. Person outside India or non-resident. What payments have been made? Interest, royalty, fee for technical service, salary, or any other sum chargeable to tax. On the day the TDS not deducted or deducted but not remitted to government, what happens then? 100% is disallowed. But in subsequent year, any year, if they fulfills or if they corrects the default, then what happens? In that year, again, it can be claimed as deduction. Sir, for us, questions will give in two ways. Okay. In one kind of question, they'll say like what? Current year, they made payment, TDS not deducted. Will disallow it. In some other question, they give like what? Last year, TDS not deducted. So last year, disallowed. But current year, the TDS was paid. So what you should do? You should allow it. You should allow it. Okay. Then amount paid to residents with respect to incomes which are chargeable to tax to such recipient. TDS not deducted but not remitted to government. Then how much is disallowed? 30% of such expense is disallowed. Okay, everybody. Then state government undertakings paying royalty, license fee, privilege fee. Okay, such kind of payments to the state governments, and they are also disallowed. Then we discussed about perquisites. Okay, any tax on non-monetary perquisite paid by employer, disallowed to employer. And same thing, actually it is an income to employee, but it is exempted under section 10 to employee. Okay, then last one what we discussed, sir. Income tax paid, surcharge paid, cess paid, or any interest on income tax paid, all these are disallowed. Now we are going on to section 40A, capital A, disallowance. Sir, 40 subsection A, how many points are there? Non-resident, 100% disallowed. Resident, 30% is disallowed. State government undertaking to state government, totally disallowed, those payments. Then non-monetary perquisite related tax paid by employer, disallowed. Then income tax point, 4 are there, 5 are there, under 40 subsection A. Then we came to 40A, the section name itself is 40A. That is 40 subsection A, this is 40A. Subsection A, clause 2. Payment made to a specified person. Who are called specified persons? Individual and his relatives. Who are them? Spouse, brother, sister. Lineal ascendants of individual. Descendants of individual and spouse. I mean, sir, lineal ascendants, na? Father, mother, grandfather, grandmother. Okay, of individual covered. Spouse side are not covered. Spouse, father, mother, spouse, grandfather, grandmother are not covered. But children commonly will be there. That's why descendants of individual and spouse, their children, grandchildren also covered. These are specified persons. HE of members and relatives. Their members and members related relatives. Relatives again these people only. Spouse, brothers and sisters, lineal ascendants, lineal descendants. Firm LLP, partners and their relatives. Company, directors and their relatives. AOPBO members and their relatives. Okay. Then SSE alone or SSE along with his relatives. SSE alone or SSE along with his relatives has substantial interest in any person. Has substantial interest in any person. Okay, sir, what we are saying, individual is a specified person. Okay, for individual, his relatives are specified persons. For HUF, its members are specified persons. Firm, its partners are specified persons. Company, directors are specified persons. AOP, its members are specified persons. But which members? Every member is not called as specified person, sir. 1% share, 0.5% share is there, they are not called as specified person, sir. Let's say I hold 3 shares in Reliance, sir. Do I call as specified person of Reliance? No. Okay, because I cannot control anything in Reliance, so I won't be called as specified person. So to call as a specified person, at least you could influence them, not control. Okay, me with my 3 Reliance shares, I cannot influence Mukesh Ambani, right? That's why such cases not counted. So these people, members, directors and all, if they are having substantial interest, if they are having what? Substantial interest, any person. Okay, what is called substantial interest, sir? It should be greater than or equal to 20% of voting power any time during the previous year, company. Or other than company, it should be greater than or equal to 20% of profit sharing ratio. Then they are called as what? Specified persons. Specified person. So all this is explaining who is called specified person. Okay, in simple, you are having substantial interest in a company, then you are specified person. Not you alone. You with your relatives can also hold more than 20, aggregately if it is more than or equal to 20%, then also you are called as what? Specified person. Let's say, sir, Mandeep holds 15%. His wife holds another 7%. So together they hold 15 plus 7, 22%. Then they are called as what? They are having substantial interest. He is called as a specified person to that entity. Okay, 15 plus 7, 27 అంటే నువ్వేనా మంది చెప్పింది? నువ్వు చెప్పాను, నువ్వే చెప్పా. నేను డాన్స్ బాగా చేశాను. మీరు జస్ట్ పర్యవేక్షణ మాత్రమే చేశారు అమ్మా. ముసలి అయిపోయారు మీరు అప్పుడు, ఎందుకని అట్లా? యూ బికేమ్ ఓల్డ్. ముసలి వాళ్ళు అయిపోయారంటనా? Okay, so what? Okay, SSE is a specified person to an entity, whether it is company, firm, is a specified person. So what now? When SSE is making a payment to a specified person, when SSE is making a payment to specified person and such payment is in excess of fair market value, then it is disallowed. Okay, so how? Sir, actually, let's say in BCCA, I kept my brother also as an employee, my wife also an employee, then my relatives also, someone like my father, my mother also as employees, and then to me or to my relatives, BCCA is paying payment in excess of fair market value. Let's say, sir, to my father, 10th past, BCCA is paying 1 lakh as salary. Excess of fair market value, within fair market value. Excess of fair market value. Let's say for him, how much could be paid? Maximum some 20,000, let's say. Okay, the excess 80,000 is what? Disallowed. My mother also has been included in the payroll. For her, another 1 lakh is being paid. Again, for her also. Okay, again, 10th qualified only. So for her also, how much could be paid maximum? 15,000-20,000 only could be paid. The other 80,000 would be disallowed. So understand, sir, where SSE is making a payment in excess of fair market value, then such excess amount is disallowed. And excess of fair market value is paid, then such excess amount is disallowed. Okay, let's say my brother owns an industry. Okay, let's say he owns a factory where he manufactures benches. Okay, now BCCA wants to buy benches. Each bench fair market value, let's say 4,000. But for my brother, BCCA is paying 5,000. Okay, so how much excess is being paid, sir? 1,000. That excess is disallowed. Understand? Sir, what if less amount is paid? Bench actual value is 4,000 only. Since the related person, BCA is paying only 3,000. Less expense is paying. Then no problem. Sir. If you pay excess only, problem. That excess is disallowed. If you pay less, then not a problem. It is better only. This entity profit will increase. You need to pay more tax only. Then there is no problem to the government. Okay? Understand, sir? But 92 will come to my brother entity. Transfer pricing provisions applicable. Why? Because he is selling at a price less than the market value. Then to my brother or my sister concern or my brother concern, what applicable, sir? Transfer pricing provisions will applicable. Why? Here BCCA wise no problem, sir, because they are lowering the expenses. Then what happens? Their profit will jump, tax also will be paid more. No problem. But to the sister concern, okay, their income is less. Okay, actually they should receive 4,000 per bench, but they are receiving how much? 3,000 only per bench. So their income got reduced. So to the brother concern or sister concern, transfer pricing provision will be applicable. Okay, we need to bring it at what? Arm's length price. So where SSE is making a payment in excess of fair market value, then such excess of fair market value is what? Disallowed. Then, sir, simple rule only, sir. Okay, they'll not test much about this relative definition also. Mostly you'll understand easily only. Okay, substantial interest point or relative point. You can easily understand. You need not to stress more about understanding and remembering this relative, all this situation of relative definition also. Mostly the point will be easy only. We could easily understand he's a specified person. 40 subsection A clause 3. This is about what? Disallowance with respect to cash payment. SSE is having income from business or profession or income under that IFOS. He is making a payment to a person or he is making or his aggregate of payments made with respect to an expenditure. Sir, which expenditure? Revenue expenditure only, not capital expenditure covered here. With respect to an revenue expenditure exceeds rupees 10,000 per day. In a day, you might have paid 4 times to the same person. 3,000, 3,000, 3,000, 3,000. Total how much? 12,000, which is more than 10,000. That way also counted. Or in a single time itself, you paid 12,000. So in a day, aggregately, the payments made to a person with respect to an revenue expenditure is in excess of 10,000. Then such expense is disallowed. While this provision is inserted to discourage cash payments. Because cash payments, now there won't be records and all. Okay, government could not verify them. There is no external confirmation there. That's why government wants to discourage cash payments and want to encourage the bank route only. That's why they introduce this kind of disallowance, where SSE is making any payment or aggregate payments with respect to revenue expenditure. With respect to revenue expenditure, and that exceeds rupees 10,000 per day, then such amount is disallowed. So then in what mode it has to be made? It has to be made in specified modes. What are specified modes? Account pay check. Sir, there is plain check, crossed check, account pay check. Plain check, it is paid through plain check, disallowed. Paid through cross check, disallowed. Only through account pay check. So what is account pay check? On the corner we should line, there'll be 2 lines and then we should write account pay. Then that is called as what? Account pay. What is a plain made payment through plain check also disallowed, crossed check also disallowed, account pay check is only allowed. Then account pay demand draft. Account pay demand draft, banker's DD or banker's check. Then electronic clearing system means what? NEFT, RTGS, or else you made through UPI, IMPS, debit card, credit card, then these are also allowed. If they are other than these 3 modes, then 100% of such expense is disallowed. Understand, sir? In a day, maximum how much? 10,000. It could be to a single person. The payment might have been broken into 3 or 4 payments in a single day and made, but still it is what? Disallowed. But what we'll do, sir, usually when you do in tax audit, you'll find so many of these transactions. Okay, you see 30,000 paid on a single day. Okay, then after again another 10 days, 15 days, you'll see another payment. What we'll do now mostly, the 30,000 will split into 4 or 5 days. The 30,000 will split into 4 or 5 days. This first day 6,000, second day 6,000, third day 6,000, fourth day 6,000, fifth day 6,000. Then what happens? Every day it is within 10,000 limit only, so no disallowability. So the problem is what? In a day you cannot make more than 10,000. In 5 days together you can make 30,000 also, then not a problem. Okay, so you'll do separate Excel sheet for all these cash payments. You'll figure out where in excess of 10,000 payments are made. Okay, most of the cases will not straight away disallow them. Actually, being a tax auditor, what has to be done? You should again record all these transactions in your audit report and submit. Okay, but if you don't know, that client will not come to you next time. So that's why what you'll do, you'll tell all these transactions to the accountant of the company and say, see, use some brain. From next time onwards, don't pass the 30,000 entry on single at a time. Break it into parts like 9,000, 9,500 and split it across number of days so that there won't be a problem. So now what he'll ask, what has to be done? So now again, pass the entries. Once again, change that or split it into multiple entries, and he'll make sure that there is no single payment in excess of 10,000. Okay, that's called tax audit. Different persons also. Are you aggregate 10,000 for a single person? For you, I can pay 9,000. For him, another 9,000. For Mandeep, another 9,000. For Dharmteja, another 9,000. I can pay each of them separately 9,999. No problem. Okay, in excess of 10,000, if I pay, then only problem. For every person, we need to check limit. Not for all the persons together, we have to check the limit. Okay, ఒక్కొక్కరికి 10,000 లోపండి, అందరికీ కలిపి కాదు. Okay, now this is much more important point. Sir, last year they booked an expense, raw material they purchased, but not yet paid. Okay, so what is the entry, sir? Credit purchase entry. What we'll do? Purchase account debit to creditor. So creditor is sitting in your liabilities. Purchases you already debited to P&L. You booked it as an expense, allowed as a deduction in the last year itself. Last year it was allowed as deduction. You didn't set any condition, no disallowability last year. Current year the liability has to be discharged, right? When you are paying that creditor, you made the payment through cash. So already that expense is allowed as deduction last year. Assuming what? You might pay in the specified modes only. So last year itself it is allowed as deduction. But current year when you are doing the actual payment, you made through cash. Then what happens? Current year it is disallowed. Current year it is disallowed. Sir, last year allowed. Last year you didn't did any adjustment. But current year you are doing what? Disallowed. So what you should do? You should add back. Sir, will there? But remember one thing. Okay, I think I wrote an example. Yes. Previous year 24-25. Rent debited to P&L how much? 10 lakhs. Okay, this rent 10 lakhs claimed as deduction or expense on what? Accrual basis, not yet paid. But 24-25 it is allowed as deduction. In 25-26, the rent 10 lakhs was paid in cash on a single day. Rent 10 lakhs was paid in cash on a single day. Now, in P&L of 25-26, will you see this rental expense? Sir, this is 24-25 rental expense, right? Already debited in P&L of what? 25-25. You will not see it in where? 25-26. But still, this is what? Sir, this particular point we didn't cover on our first, in the beginning of the chapter, we wrote certain points, when to add, when to subtract and all. But this is an exceptional point where it doesn't fit into the general conditions we wrote in the beginning. Understand? Last year, it was allowed. Assuming what? He may be paying the amounts within the specified modes only. So last year, nothing you did. But current year, what they are saying, like, he didn't fulfill the conditions. He made the payment through cash. What to be done now? Current year also it is disallowed. Sir, generally we disallow now. What we'll do? We'll add back if it is already debited in P&L. But in this case, current year P&L you will not see. In 25-26, you will not see rental expense. Why? Because that is a, see, rent 10 lakhs is related to which year expense? Previous year 24-25. Why it will be there in previous year 25-26 P&L? So it is not there. But the problem is what? When you are making the payment, you made it in cash. So it has to be disallowed in 25-26. Even though it is not debited here, still what you should do? We should add back. We should add back. We should add actually, not add back. Why? If it is subtracted first, then we have to do add back. It was not even debited in the current year P&L, but still we should add. See what we should do? Net profit 45 lakhs only, and we should add rent paid in cash 10 lakhs, which is 55 lakhs. Sir, are you able to understand, sir? Think of this logic once again, sir. Last year allowed as a deduction on accrual basis. But current year when you are making the payment, you made it in cash. So in P&L, it is shown in which year? Last year. Last year you didn't do anything. That expense will again not be reflected in the current year P&L. But what income tax provisions are saying, like, since the payment is not made through specified modes, current year you should disallow it. Okay, disallow now what? You should again add that expense. Since you cannot reopen last year, you are doing that addition what? Current year. So actually now you should go back to last year, and last year itself you should disallow. But again, you can't reopen last year return, right? That's why what they are saying, like, current year you add, even though in P&L that entry may not be there, but still what you should do? You should add. Okay. Then, sir, we'll discuss these exceptions and I'll give breaks, sir. Exceptions. Sometimes you can make more than 10,000 also in cash and it is allowed. The first exception is like, here only it is there, sir. If the payment is made to transporters, then up to 35, so he should pay me 5 lakhs, I also should pay him 5 lakhs. So there is no real payments here. What we adjusted, my payment 5 lakhs adjusted with his payment 5 lakhs. So it is a book entry. There is no real payment. For book entries, obviously this rule will not be applicable. Then payment is made for purchasing agri or forest produce, animal husbandry or dairy, horticulture or poultry related items. Payment is made in a village or town where there is no bank is served. Payment is made for purchase of handicraft goods. Handicraft goods now which are manufactured without the use of power, machines power. Okay, then payment by way of gratuity or compensation to employee or legal heirs where the amount is up to 50,000. Gratuity or compensation where the amount is up to 50,000. Payment to any authorized money dealer or foreign exchange dealer for purchase of foreign currency in the normal course of business. Payment made to his agent who is required to make payment in cash for goods and purchase services. Sir, I made payment to my agent. Why? Agent is buying agri produce. For agri produce, he has to pay in cash only, right? Most of the farmers will not have bank accounts or will not accept. That's why my agent has to pay in cash. That's why I given to agent also what? Cash. Then no problem. Then where the payment is made by way of salary to an employee, when it is paid, sir, he has been temporarily posted in a remote place. You watch Jalsa movie? Jalsa. Okay. There, if you remember second half, Prakash Raj will be posted for 1 year, 2 years in the jungle area. Okay. If you remember. He'll be posted in that Naxalite area only. He'll be there for 2 years. He'll be saying also, for 2 years I didn't even listen Telugu. Only those tribal songs and all only I listen. He'll be saying, right? So 2 years is there in such place. There no bank. Okay. So actually there are 2 years also there. But assume not even for 2 years. He is for only just 2 months he'll be posted there. 2 months only. For a specific camp he has been posted there. Now for 2 months he cannot open again a bank account there. He cannot transfer all the things again. But what happened? There is no bank account there. Where the payment is made by way of salary when such employee temporarily posted for more than 15 days at a place other than his normal place of business and does not maintain any bank account in such place, then it can be paid through cash. Sir, all these conditions mostly kept before introduction of UPI systems. But these days, we did not have bank account at any place. Okay, if you have UPI account now, they can transfer at any place and all. All this is like outdated points only, sir, but still they didn't remove. Okay, even for farmer also they are having UPI now. Okay, most of the people still doing online transfers only. Nobody is using cash even for farmers also. Okay, majority. If they sell rice, paddy also, the dealers are making through online payments only. For any fruits they supply also, they are getting through online payments only. After RTGS transfers only, they are getting most of them. But still these rules are little outdated. They have to be updated. Okay, so payment to RBI, payment to government, payment through book adjustment, payment for purchasing agri forest produce, animal husbandry, horticulture, payment in a village or town. No bank is there. Payment for handicraft goods. Payment for gratuity or compensation to employee or legal heirs where the amount is within 50,000. Payment to authorized dealer for money exchange and all. Payment made to his agent because agent has to make the payment again in cash. Where the payment is by way of salary, then he is temporarily posted and in that case he doesn't have a bank account. So these are the exceptions for cash payment. Okay. Payment to non-resident TDS. Then 100% of that expense is disallowed. Then second one we discussed is about resident related payment made TDS not deducted, then 30% is disallowed. Then third one, state government undertaking making payment to state government, then also disallowed. What payments? Royalty, privilege fee, license fee, service fee, like that if they are paying anything. Then fourth one is about what? Tax on non-monetary perquisite. Then fifth one is what? Income tax. Income tax related. All these are what? Disallowed. So 40 subsection A has total 5 disallowances. Then we went on to section 40 capital A. In that first one is what? Specified person, nothing but specified person or nothing but related person, payment made in excess of fair market value. Then that excess is disallowed. The next one is like cash payments in excess of 10,000. So these are what the disallowances we have discussed now. Okay. Then 40 subsection A clause 7 related to what? Gratuity. Sir, for gratuity, if any provisions created na, disallow. Gratuity provision disallowed. Actual contributions to any gratuity fund or actual gratuity paid. Either, sir, there is a separate gratuity fund kept. So you are making yearly gratuity contributions to that fund. That is allowed as deduction. You don't have any fund and all. You are creating provisions. That provisions created are not allowed. But finally, when you pay amount, right, that amount paid is allowed as deduction. So actually it should have been paid or actually contributed to the gratuity fund. If any provisions created, na, those provisions are, it is allowed. Then 40 subsection A clause 9. Employer making contribution to welfare fund of employees. What we said, sir, under 36, those are allowed only. We said like employer contributing to any welfare funds, now that has to be contributed by due date of filing of return of income, then they are allowed only, what we said. But here they are saying like what those contributions are disallowed when no genuine benefit is passing on to employees. When the no genuine benefit is passing on to employees. Sir, let's say, sir, a factory, industry, company said like, we'll construct houses for employees. Okay. For that, they are every year allocating employee house fund like that they created, and every year certain amount they have been contributing, and it is allowed as deduction. Later they constructed, sir, 5 houses they constructed. All these houses are like, one is owned by the director of the company. Okay, 3 directors, 3 houses has been constructed. Pakka duplex kind of houses has been constructed. Then to chairman 1 house, founder 1 house, like that they have constructed 5 houses. Saying like those are also employees of the company only. But the real workmen, the laborers, they didn't got any benefits. Our employee welfare fund, what it is like, it is a general overall benefit we thought. They are giving it to what? The owners only. Okay, the members of the company only, they are providing those kind of benefits. So the no genuine benefit is flowing to employees from that welfare fund. Then in such cases, what they can do, whatever the contributions made, even though they are allowed previously, now they can be what? Disallowed again. Disallowed. Now what do you have to do? Add back. Okay, even though they are not current year expenses, but still you will add them to the current year profit only. Just like as that cash related payment point I said, these contributions are made in last years. That time they are allowed as deduction because what? That time we assume like there will be a genuine benefit, so they are allowed. But current year you realize like no genuine benefit is not passing to employees. So what has to be done? It has to be disallowed. So okay, to the current year profit, all those expenses which were allowed till now has to be added. Okay, mark to market loss. I already explained, sir, what is called mark to market loss. You have some investments, you have some investments kind of, which are related to PGBP only. You didn't dispose them. You are holding them as investments only. You purchased for 5 lakhs, but current market value is only 4 lakhs. How much loss is there? 1 lakh. But is it realized loss or unrealized loss? Unrealized loss. Okay, so ICDS also will say the same thing. Since it is an unrealized loss, will not consider them, sir. Will not consider them. Okay, if at all ICDS says like you can consider them, then those losses are allowed. Otherwise, disallowed. Then we are discussing the next important section only, sir. 40B. Section 40B. Out of all the disallowances, this is only little big. The rest all are like simple only, sir. Okay, 40B is about interest remuneration paid by firm to partners. In beginning, at the time of charging section only, I was given explanation related to this point, sir. Why? Partnership firm, to avoid 30% taxability, it diverts profits to partners in the name of interest and salary, other than by way of distributing profit. Why it has to be done? Sir, in partner capacity, individual capacity, he can enjoy slab rate benefit. Whereas in firm capacity, it has to be taxed at a flat 30%. And then even when the total profits are more, then surcharge also applicable. But his share, one particular partner only, if you are diverting, then partner, his share will be less than 50 lakhs only, or within 50 lakhs only. So you may get a surcharge related benefit also, you'll get. That's why firm may be trying to divert the profits in the name of interest or salary to the partners. But to curb those kind of practices only, 40B has been introduced. What does 40B says? Like firm paying to partner interest or remuneration. So whether such interest is allowed as deduction or not, first one, it should be authorized by deed. In the partnership deed, it should be clearly written like firm can pay interest to the partners. Okay, from which day the deed is executed, from that day only the interest is allowed. For past days and all, retrospective effect we cannot give. Only prospective effect we can give. Let's say, sir, from 1st April 2025, deed executed. In deed, it is clearly said like interest can be paid. Then only from 1st April 2025, interest is only allowed. Prior interest and all are not allowed as deduction. Okay, even though it is mentioned in deed, the interest should be allowed only to the maximum of 12% only. In excess of 12%, if interest is being paid, such excess interest is disallowed. Understand, sir? Firm is paying 18% interest to the partner. Then that, how much it is, sir? In excess of 12%, the other 6% is disallowed. What we should do? Add back. And then, along with return of income, the partnership firm should even provide their partnership deed also, because to check whether actually in the deed that point is there or not. Okay. Otherwise, what happens? Disallowed. If it is not authorized by deed also, if it is more than 12%, then excess will be disallowed. If along with return, they have to provide even the partnership deed. If these are not satisfied, then the interest is what? Disallowed. Excess amount only disallowed, sir. If it is in case of 12%, not fully disallowed. Excess of 12% is only disallowed. Sir, this provision not applicable when interest paid to partner in a representative capacity. Sir, loan is given by HUF. This partner is Karta of HUF. This partner is what? Karta of HUF. So, firm paid interest to partner, but not for his capital. For whom HUF's loan, the firm has paid to partner in the representative capacity of HUF. Sir, are you able to understand, sir? Let's say I am a partner and I have a HUF also. Now, loan is given to the firm by my HUF, not by me, by my HUF. Now, firm is paying interest to me. Firm paying interest not because I am a partner, because I am HUF, I am a Karta of HUF, the firm is paying interest. So, here I am receiving interest not as a partner, as a Karta of HUF. In that case, this disallowability is not applicable. So if you receive interest as a partner, in a partner capacity only, then disallowability attracts. But you are receiving the interest in some other capacity, some other representative capacity, then this disallowability will not attract. Are you able to understand, sir? Mandeep, majhlo akkadiki vello. Vello majhlo కొన్ని seconds. Sir, yellottu. బొమ్మలు కనబడుతున్నాయి ఏంటి సార్? Okay. Firm paid interest and remuneration to partners. Interest authorized by deed, interest rate within 12% along with written off income, partnership deed also submitted. Then fine. Otherwise, disallowed. If it is in excess of 12%, no, not totally disallowed. That excess part is only disallowed. Okay. If partner receives such interest instead of partner capacity as a representative capacity like Karta of HUF and all, then disallowability will not attract. Then remuneration paid to partners. Again, it should be authorized by deed, paid to only working partners. So for sleeping partners, why remuneration has to be given, sir? Only for working partners, remuneration has to be given. Then along with written off income, even deed also has to be submitted. These three conditions has to be satisfied. And fourth one, they'll talk about the limit also. Up to this limit allowed. In excess of this limit, na, disallowed. Up to this limit allowed. In excess of limit. Sir, first three conditions not satisfied, na, then fully disallowed. Fourth condition, na, then up to that limit allowed. In excess of limit, disallowed. So what they are saying, like, they are using a new word here, sir, book profit. They are using a new word here, what? Book profit. On first 6 lakhs of book profit, you have 3 lakhs book profit, 4 lakhs, 5 lakhs, 6 lakhs. If you have book profit up to 6 lakhs only. Okay, then on 6 lakhs, what we should do? 90% of book profit or 3 lakhs, whichever is higher, is the remuneration that could be allowed. You have only 5 lakhs, sir, profit, book profit. Then how much is allowed? 5 lakhs into 90%. 4 lakh 50 or 3 lakhs, whichever is higher. 4 lakh 50. That 4 lakh 50,000 only maximum you can pay as remuneration to partners. Let's say, sir, you have above 6 lakhs. Let's say you have 20 lakhs. Then how to calculate? First 6 lakhs, 90%. 6 lakhs into 90%, na? 5 lakh 40,000. And on the balance 14 lakhs, 60%. So, okay, tell me, sir, quickly. So, we have 20 lakhs. On first 6 lakhs into 90%, it is how much? 5.4 lakhs. And the balance 14 lakhs into 60%, how much? 8.4 lakhs. So, total how much, sir? 13.8 lakhs is the maximum remuneration that can be paid. Able to understand? Okay. So, what if the firm does not have book profit, sir? It has loss. Loss also. 90% of profit or 3 lakhs, whichever is higher. Since there is no profit, 0 that one, or 3 lakhs, whichever is higher, what will be it is? 3 lakhs. So on book loss, maximum how much they can pay remuneration. If they are having loss, the maximum remuneration they can pay to partners is how much? 3 lakhs. Okay, so the fourth one talks about what? The remuneration that could be paid to partners, maximum, the limit calculation is there. Within that limit only, no problem. Above that limit, has to be disallowed. Excess has to be disallowed. Now the problem is, how do we compute this book profit? On discussing or to explain it, it is easy only. The problem is, what is this book profit? How do we calculate this book profit? Computation of book profit. We'll take net profit as per books of accounts. Just like as how we solve a PGBP question, we'll take net profit as per books of accounts. Then add the actual remuneration charged in books of accounts. Actual. They might have paid 10 lakhs or 12 lakhs, something, right? Add back that actual. Then plus or minus, you do all the regular adjustments which you do. All the regular adjustments, what we will do, plus or minus, all that. Disallowed now, we'll add back. Allowed now, we'll be ignoring. Then incomes not chargeable to tax under the head of PGBP now, we'll be subtracting. All those regular adjustments we'll do, including this interest adjustment. Including this 40B interest adjustment also we'll do. Only remuneration we are leaving. Actual remuneration you are adding back. Okay, that only you did. And rest all other adjustments also you are doing. Then you'll get what? Book profit. Then you'll get book profit. From that book profit, we need to calculate how much is the allowed. To that extent of allowed, fine. If it is in excess of that, disallow. Okay, let us look at these examples. SVM and Co. is a partnership firm. Has following information. Compute income under the head PGBP for previous year 25-26. Sales 130 lakhs. Closing stock 40 lakhs. Profit on sale of land 20 lakhs. Interest on FD 1 lakhs. Dividend received 2 lakhs. So what we should do here? This profit on sale of land, what we should do? Why? Some other head, not related to PGBP. So that's why what? We are excluding that. Nothing but we are subtracting. Interest on FD. Again what? It is taxable under IFOS. Sir, reason also important because you need to put the reason also, right? So if you just remember like minus plus, that it doesn't work. Why we are subtracting, why we are adding, the logic, the explanation you should understand. First one, why profit on sale of land we are subtracting? Because this income, taxable under that capital gain, not related to PGBP. So we are excluding, subtracting. Then interest on FD. Taxable under which head? Other sources. No, not related to PGBP. Subtract. Dividend received. Related to other IFOS head only, not related to PGBP. Subtract. Okay, these three we have to subtract from the net profit 59.6 lakhs. Okay, then. Opening stock related to PGBP, purchases PGBP, salary, rent paid, commission paid. Interest to partners, how much is there, sir? 18%. But how much is only allowed? So how much is disallowed? If 18% equals to 5.4 lakhs, how much is 6%? How do we calculate 5.4 into 6 by 18? 5.4 lakhs into 6 by 18. How much you got? 1 lakh 80,000. So how much is disallowed, sir? Here 1 lakh 80,000 is disallowed. 1 lakh 80,000 is disallowed. Okay, what we should do? Add back. Actual remuneration also what we should do? Add back. Actual remuneration also we should add back. So 5.4 add, 12 lakhs also add. Then additional information. TDS not deducted on commission paid. How much is the commission paid, sir? 2 lakhs. On the TDS not deducted. And he is a resident only, sir. 60,000 is disallow. Okay, so what we should do, 60,000 add back. Okay, then rent paid 4 lakhs. What they said, rent paid 4 lakhs is to a relative of partner. Rent paid 4 lakhs is to a relative of partner. What is the fair market value? 3 lakhs. But how much they paid? How much is disallowed? 1 lakh disallowed. Okay, then out of salary 25 lakhs, 2 lakhs is paid in a cash to an employee on a single day. Out of 25 lakhs salary paid, 2 lakhs is paid to an employee in cash on a single day. Then what happens, sir? 2 lakhs disallowed. So here 2 lakhs add back, here 1 lakh add back, here 60,000 we should add back, here 1 lakh 80,000 we should add back, here total 12 lakhs actual remuneration we need to add. Okay. Then closing stock undervalued by 10%, opening stock overvalued by 10%. Tell. Closing stock, opening stock is there. Closing stock undervalued, sir. Closing stock undervalued by 10%, opening stock overvalued by 10%. With respect to closing stock, how much? What we should do? Add. With respect to opening stock. Opening stock undervalued or overvalued? See. Opening stock overvalued. What we should do that? Add. We need to do add. Why? Opening stock increased, profit decreased. To make it normal again, we should add. Okay. Then closing stock undervalued. Closing stock reduced, profit also reduced. To make it normal again, we should add. Okay. So both things we need to add only. Right? Okay. So this adjustment also did. Then the next one. Partnership deed specifies about interest and remuneration to the partners. So this actual we are adding back. Rest all the complete PGBP kind of question we are solving. Then we'll get what? Book profit. See. Opening stock overvalued. How much is the amount, sir? 2,27,272. Opening stock related. Correct only, how much you got, sir? Same amount only, na? Then closing, how, sir? Here this 25 lakhs given is what? 110%. Overvalued, na? So we want what? 25 lakhs into 10 by 110 we should do. How much we got? 2,27,272. Closing stock undervalued. So this 40 lakhs is equivalent to 90%. So we want what? We should do what? 40 lakhs into 10 by 90. We'll get how much, sir? 4,44,444. Both has to be added only. So total stock related 6,71,716 we should add. So book profit, net profit as per P&L. First add remuneration to the partners, actual remuneration paid to the partners, add. Then expenses disallowed, stock adjustment, salary 2 lakhs because paid in cash, rent paid to specified persons in excess of fair market value 1 lakh, commission, TDS not deducted 30% 60,000, interest paid in excess of 12%, 5.4 lakhs into 6 by 18, 1 lakh 80. So total amounts to be added is 12 lakh 11,716. Then incomes exempted or taxable under other heads, profit on sale of land 20 lakhs, interest on FD 1 lakh, dividend 2 lakhs. So if you subtract, then you got total book profit how much, sir? 60 lakh 71,717. Okay, now we'll see. How much remuneration is allowed? What is the book profit, sir? 60 lakh 71,717. Now calculate, sir. If book profit is 60 lakh 71,717, how much remuneration can be paid? If book profit is 60 lakh 71,717, how much remuneration can be paid? First 6 lakhs 90%, 5 lakh 40. So in this subtract 6 lakhs and do 60%. Sir, everybody able to solve, sir? On this first 6 lakhs what we should do? 90%. And on balance amount what we should do? 60%. And if you do total, you will get the total remuneration that can be paid. How much? 38 lakh 23,030. But what is actually paid? 12 lakhs, which is allowed. 12 lakhs only allowed. You cannot again claim 38 lakh. Actually paid or the limit, whichever is lower, allowed as deduction. Okay, maximum up to 38 lakhs, 23,030 you could pay. If the actual amount is, let's say 45 lakhs, na, then the excess amount is disallowed. Here the actual amount paid is only how much? 12 lakhs only. So there is no disallowability. That actual remuneration only you subtract here, then you got the income under that PGBP only. So why? Because at the time of book profit only, you did all the adjustment PGBP except remuneration point. Now you subtract remuneration related also, then you got income under that PGBP. Understand, sir? Sir, why we subtracted here? Sir, here depreciation kind of. Actual depreciation will add back, income tax depreciation will subtract. Same way, actual remuneration we have added back. And whichever is allowed, that we have been subtracted. But in this case, actual also 12 lakhs, allowed also 12 lakhs. But in a different question, but in some other question, it may be different. Actually, you should add back, whichever is allowed. We need to subtract. Understand? This is about what, sir? 40B disallowance. Okay? So once again, sir, tell what are the disallowances we have discussed. First one. Non-resident. What are the payments? Interest, royalty, fee for technical service, salary, then one more point. Any other sum chargeable to tax. Made payment to TDS deducted or non-deducted. How much is this allowed? Subsequently paid. Then in that subsequently TDS deducted and paid. Then in that subsequent year it is allowed. Okay, na? Sir, I mean this for non-deduction or non-payment will wait till due date of filing return of income. By then it is paid, no problem. By that time also it is not deducted or not paid, na? Then it is allowed in the current previous year. And again they will be allowed in the previous year in which it is actually paid. Then next one, sir. Payment to resident. How much is this allowed? Same kind of. Subsequently again it gets allowed if it is paid. Then third one. What is the next disallowance we have discussed? Think. State government undertaking paying royalty, license fee, privilege fee, service fee to state government. Allowed or disallowed? Completely disallowed. Then tax on what? Not just non-monetary perquisite also. Tax paid on non-monetary perquisite by whom? Employer. Is disallowed to employer. Then next one. Income tax related surcharge, cess, okay. Interest on income tax, if anything is paid, that is also disallowed. Okay, that is under 40 subsection A. Then we came to what? 40A section. Okay, under 40A, what is the first disallowance? Payment to specified person. Okay, who is called specified person? Relatives if they are having substantial interest. Okay, specified person. What is the disallowance there? Paid in excess of fair market value, then the excess is disallowed. Then what else? Next, what we have discussed. Directly we said like cash payment. We said like other than specified payments. What are the specified payments? Specified modes, if you pay it is enough. What are those specified modes? Account pay check, account pay draft, electronic clearing system, or you pay debit and all. Those modes now fine. Other modes you are making payment for an expenditure in a single day to a single person in excess of 10,000. Then total amount disallowed. Transporters now. 30 or 35? 35,000. Okay. How many exceptions you remember? Try to recall. There we discussed exceptions also. In certain exceptional cases, that rule is not applicable. Agricultural, forest produce and all. Agree related, fine, accepted that point then. In a village where there is no bank, second one done. Temporarily recruited for 15 days and all, and there is no bank and all, then that is also fine. Book adjustment. You're talking about book adjustment, fine then. Payment to banks, governments, that is also fine. Payment to authorized dealers for foreign currency and all. Then payment to agent, which has to be again to be paid in cash by agent. Then next one more important points are there, which will come in questions also. Payment of gratuity and any other retirement amount with to employee or our legal heirs up to 50,000 allowed. Okay, those are the major points to be remembered. Then from then till, because all these are 2-3 times we revised, then also we discussed certain disallowances. Then that's what we discussed. Gratuity. Okay, gratuity when allowed, when disallowed? Provision for gratuity disallowed. What is allowed? Actual gratuity contribution or actual gratuity paid is allowed. Then next. Contributions made to employee welfare funds. If the benefit, the real benefit, genuine benefit is not passing on to employees, then it is disallowed. Then mark to market loss, that are under the 40A. Then we came to 40B. 40B. Okay, under 40B, what points are there? Interest and remuneration. Interest paid by partnership firm to partners. Remuneration paid by partnership firm to partners. So when interest is allowed? Authorized by deed. Okay, income deed has to be submitted. Then what is the amount of interest that could be paid? Up to 12% only. In excess of 12% na, disallowed. Then remuneration conditions. Again, authorized by deed. Sleeping partner, it can be paid. Only to working partner only. Written plus the deed has to be attached. That is fine. Then how much is allowed? Up to 6 lakhs of book profit. How much? 90% or 3 lakhs, whichever is higher. On excess of 6 lakhs, 60%. If it is loss, na, maximum 3 lakhs. 90% of profit, no profit at all. So it is 0 or 3 lakhs, whichever is higher, na, 3 lakhs. Okay. On what this 90%, 60% has to be calculated? Book profit. How do we compute book profit? As usual, P&L kind of only, sir. The only difference is like first we'll take net profit and add back actual remuneration. Then do the whole PGBP question only, except this remuneration related disallowability. You'll get book profit. Then you check whether book profit is with, whether the remuneration paid is within the limit or not. If it is not in the limit, then the excess will be disallowed. Up to limit, it is allowed. Subtract that remuneration also, you'll get the income under that PGBP also. This is what 40 subsection B. Now we are moving on to the next disallowance, sir, 43B. So this is the last disallowance. So okay, if we do this and if we complete depreciation, then most of the questions you can solve. Section 43B. Sir, 43B says like certain expenses are allowed as deduction only on payment. Okay, this section says like just because you pass a accrual entry, you cannot take it as deduction. Only actual payment is made, then you can claim them as deduction. Sir, I am following mercantile system. Yes, you may be following mercantile system only. Okay, there are two methods of allowed here. One is cash system you can follow, mercantile system you follow. Sir, in following mercantile system, sir, obviously I'll book expenses on accrual basis. So why this 43B? Still you, even though you are following mercantile system, the list of expenses mentioned here has to be paid by on or before the due date of filing of return of income. Sir, understand? 31st March you'll close books. 31st March they may be accrual only. I mean they are not yet paid. But by when they should have been paid? By the due date of filing of return of income. So on 31st March they can be outstanding. But they should have been paid by the due date of filing of return of income. So by then if they are paid, no problem, it is allowed as deduction. Even by the time of filing return of income also, if they are not paid, then they are disallowed. Understand, sir? Sir, year closing 31st March, I wrote a entry like bonus 30 lakhs yet to be paid to employees. Bonus not yet paid. I declared bonus. So I passed an expense entry in the books 30 lakhs, I debited to P&L also. Allowed as deduction only. But the point, this 43B comes and says what? That bonus you can claim as deduction only when you pay actually by due date of filing return of income. Sir, when I will file return of income? Assuming audit case, 31st October of assessment year. So on March 31st, no problem, it can be outstanding. But at least by 31st October, I should pay. If I don't pay by 31st October, then it will become disallowed. Okay, so we'll discuss what are the list of expenses we need to check like that. Okay, on 31st March, they could be outstanding, sir, no problem. But by when it has to be paid? By the time of filing of return of income, they should have been actually paid. Then only they are allowed as deduction. First, if it is any tax, duty, cess, fees. Sir, tax is already disallowed now, sir. Why again? Other than income tax. GST is also a tax, customs duty is also a tax, property tax, municipal taxes if they are related to office building, they are also tax. Any statutory dues, tax na here, any statutory dues, they are allowed as deduction only when they are actually paid. On 31st March, they can be outstanding, but by the time of filing return of income, they should have been actually paid. Otherwise, disallowed. Then, this we already discussed, sir. Employer contribution to PF or any other welfare scheme. Where we discussed this point? Near 36 only I said, employee's contribution, it has to be deposited within the due date of PF or respective welfare act. Whereas employer contribution, it has to be deposited within due date of filing return of income. Okay, that one done. Third point, sir. Bonus commission payable to employees. On 31st March, bonus and commission payable to employees can be outstanding. But by the due date of filing of return of income, they should have been paid. Otherwise, disallowed. 3. Then fourth one, interest on loan payable to public financial institutions, state financial corporations, investment corporations, bank, NBFC, cooperative bank. Sir, interest payable to friend or relative. That could be outstanding only. Even by due date also, don't pay it also, still you can claim it as what? Expense. But when the interest is payable to banks, NBFCs, cooperative banks, PFIs, state finance corporations or state investment banks, all these are government related, sir. Banks, okay, all these where government is regulating. So these people, for them you need to pay interest, and that interest is not actually paid. You just accrued, interest accrued, you passed an entry. Even by return filing date also, you didn't pay interest. Then such interest you can't claim it as deduction. Then leave salary. What is leave salary, sir? Salary chapter, there is something called leave encashment. Okay, sir. Every year, let's say for an employee, this year 20 leaves has been accumulated. Okay, he didn't use 20 leaves. What we can do, accumulate all those leaves, and at the time of retirement, they can make a lump sum payment for all the accumulated leaves. Or every year they can do leave encashment. Every year they can do the leave settlement and all. Okay, I mean, you didn't use your leave, sir. On a leave day also, actually you can use that leave, but that day also you have worked. So you have to get extra compensation, right? Such kind of leave salary, sir, you passed just an accrual entry, not actually paid. Sir, are you able to understand what is leave encashment? It's something you learned in inter-level, sir. What is called leave encashment? Sir, actually in a month, okay, in a year I can use 20 leaves. Okay, there's two people are there. That fellow used 20 leaves, same salary. I didn't use 20 leaves, still same salary. Will I get motivated or demotivated? Demotivated. Okay, then to stay motivated, what has to be done? For those 20 days which I worked, they have to pay me extra. But they didn't pay it actually. They just passed an entry like for 20 days they have to pay extra salary to me. They passed a accrual entry only. They didn't actually pay till due date of filing of return of income. Then company cannot claim it as expense. The last one, any sum payable to Indian Railways for use of their railway assets. Any sum payable to Indian Railways for use of their railway assets. So these 6 kind of expenses allowed as deduction only when they are paid by due date of filing of return of income. On 31st March, they could be outstanding, but by the time of filing return of income, they should have been actually paid. Then only they are allowed as deduction. So what are the 6 items, sir? Sir, out of this, government related only 4. Sorry, employee related, sir. First, employee related is there what? Employer PF fund contribution. Employer share of contribution to PF fund. Bonus and commission payable to employees. Then third one, leave salary. 3 are there which related to employee. Then government related, statutory dues. First one, tax, duty, cess, fees. Second ones are interest also. Most of these are what? Government related only. PFIs, scheduled banks, state government, state finance corporations, cooperative banks. Okay, 2 government related. One is banks. The second one is related to what? Interest to banks. First one is tax dues to government and all. Third one is related to, sir, any sum payable to Indian Railways for use of their assets. Out of 6, 3 are related to employees, 3 are related to government. Not directly, indirectly also they are related to government. What are those 3, sir? Once again this side. Employer share of PF contribution, bonus and commission, leave salary. Government related, taxes, duties, cess, fees, interest payable to banks. Fourth one, any amount payable to railways for usage of their assets. These 6 amounts, 31st March they could be outstanding, no question about it. But by the time of filing return of income, they should have been actually paid. They paid na, no problem. They didn't pay, disallowed. Okay, not it. Sir, current year not paid. Subsequent year it is paid. Then you can claim deduction in the subsequent year. Okay. All these expenses may be outstanding on 31st March of previous year, but they are allowed as deduction only when the payment is made by due date under section 139. However, allowed as deduction in previous year in which actual payment is made. They are allowed as deduction in previous year in which actual payment is made. Okay, then here, sir. Payment to small and micro enterprises. Sir, when a big person, when a big company or entity dealing with small and micro enterprises, they will not consider them more. Okay, let's say a big company has to do a 20 lakhs payment to the micro, small and enterprise. For this big company, 20 lakhs may feel like small amount only. Now we'll see. Afterwards also we can pay. What is big issue there? Anytime we can pay. And this micro small enterprise cannot even pressurize the big entity also because he slowly started. Okay, he's trying to get more orders. Okay, he's trying to get business from this big company or big entity. So he cannot demand them to pay the amount quickly also. So he'll be only requesting. Whereas this big company, they are overlooking since it is only 20 lakhs. For the big company, 20 lakhs is a small amount, not even material. But for this micro, small and medium enterprise, this 20 lakhs may become a big amount, which will impact their working capital. They need to go for short-term loans at higher interest rates, which will impact their profits and their survival also. That's why government understood their problem and said like what? Since this micro and small enterprises doesn't have voice to ask their money, government has came support for them and said like what? If you have to make a payment to micro, small and enterprise, check whether you have any agreements with the micro and small entities or not. If agreement is there, from that agreement, within 45 days, you should make the payment. If no agreement, from the date of completion of such good supply of good or date of completion of such provision of service, within 15 days, the payment has to be made. Otherwise, such expense is disallowed. And it is allowed only in the year of actual payment. Understand, sir? So, any company, if it has to make payment to MSE, micro, small enterprise, medium is not there, sir. Micro and small enterprises, then whether there is any contract between the one who has to make the payment and the micro small enterprises, there is a contract or agreement or not, we should check. If there is an agreement, from that, in agreement they'll put conditions, right? Within how many days the payment has to be made. From there, within 45 days maximum, the payment has to be made. No agreement at all. Then by the time they complete the supply of good or complete the service, from there within 15 days, the payment has to be made. Otherwise, 100% of such expense is disallowed and it can be re-availed in the year in which actual payment is made. If not, expense is disallowed and allowed as deduction only in the previous year in which actual payment is made. Got it, sir? 43B. Then here one more point, sir. But this will complete 43B. Sir, to bank, what we said, interest only if it is paid by due date, it is allowed as deduction. What you said? You have an interest on loan and advance. You didn't pay it. You converted this outstanding interest into a new loan or into debentures or any other liability. Sir, you have to pay 5 crores interest, which is outstanding. You didn't pay this interest. You converted this 5 crores into a new loan. Will it amount to payment? You didn't pay interest. You converted the interest into what? As a new loan or as a fresh loan. Will it amount to actual payment? So is it amounts to actual payment? No. 43B attracts. Still that interest is disallowed only. But what is allowed? Let's say, sir, in previous year 25-26, 5 lakhs interest, 500 lakhs, 5 crores interest payable to SBA. They restructured it into loan payable in 60 installments. Okay, 60 installments. First it is converted into loan. It is not. The interest paid is not allowed as deduction. It is disallowed. But out of those 60 installments, 7 installments are paid in the year 25-26. So what the provision said? It is allowed as deduction in the year of payment. So 500 lakhs divided by 60 into 7 now, how much they paid? 58.33 lakhs they paid in the current year, right? So to this extent it is allowed, not the total 500 lakhs. So reconverting the outstanding interest into a fresh loan or issuing debentures for it does not amount to actual payment. Okay? If it was restructured as a loan and in the new loan, if a part payment is made like installments and all, then to the extent of such loan paid, we'll consider as what? Interest paid, and it is allowed as deduction. So everybody are able to get the point, right? Okay? Out of this 5 crores, current year how much is paid, sir? 60 installments it has to be paid. Out of 67 installments paid. So 500 by 60 into 7, total current year how much is paid? 58. Depreciation. Sir, let's say in a year, I don't have much profits. Or else I don't have much profits. So I'm thinking like, since the profit is less, why to charge again depreciation and to make it into losses or to reduce to zero? Less amount only now I thought of paying taxes and not to claim depreciation in the current year. Okay, is that allowed? Sir, depreciation, if you don't avail this year, then obviously you can avail in the next year. Why? If you don't charge depreciation, the asset cost will not reduce. So next year you can claim the same amount of depreciation you can claim. Let's say first originally you plan to claim depreciation for 10 years. Okay, the asset life is 10 years. Let's say in first year you didn't claim. Then what? Then the balance depreciation you need to claim in the coming 9 years only. Right? So every year, instead of the normal depreciation which you would claim, will be increased. So depreciation, if you don't claim, it doesn't mean permanently you are not claiming. If you don't claim in the next year, if you don't claim in the current year, next year you will be claiming little more. Right? That's why what they are saying, depreciation is not optional. You have to claim mandatorily depreciation. So you cannot say like I won't claim depreciation expense this year. Every year you need to charge depreciation mandatorily. Okay. Then which method of depreciation has to be followed? There are 2 methods available, sir. SLM, WDV. But SLM is available only to SSEs engaged in generation, distribution, transmission of power. Okay. For them only SLM available. It is also, for them also SLM alone is not compulsory. They can follow either SLM or WDV basis. Whereas other people has to follow only WDV method. Okay. Sir, in SLM, asset wise followed, whereas in WDV, block wise system is followed. What is asset wise? What is block wise? Sir, you have 10 plant and machineries. Each plant and machinery you look at as a separate asset only under SLM. But under WDV, all these 10 plant and machineries you will think as a block. Let me give an example, sir. Sir, there are 10 plant and machineries, each 8 lakhs. So total how much, sir? 80 lakhs. Okay. Here, total 10 plant and machineries, everything has to be seen separately, 8 lakhs. So each plant and machinery, 8 lakhs, 8 lakhs, 8 lakhs. Out of, in block system, this total 80 lakhs will be considered as a single asset only, not like multiple assets, let's say. But out of this 10 plant and machineries, 2 plant and machineries. What is the cost of each plant and machinery, sir? 8 lakhs. But 2 plant and machineries sold for 20 lakhs. If you check individual plant and machinery revise, for every plant and machinery, 8 lakhs worth sold for 10 lakhs, there is 2 lakhs profit on each plant and machinery. But are we thinking like each plant and machinery as a single asset or as a block or as a block? So we will not calculate profit or gain. What we'll simply do, what is the sale value? Subtract from the block value. How much is there? 60 lakhs. Still the block value is positive only, na? So we think like block is continuing only. There is no gain or loss has been computed. Even certain assets are sold from the block. Okay. But whereas here, we are following what? SLM method. Every asset is separate. Every asset is separate. So 2 plant and machineries cost how much, sir? 8 lakhs. Are sold for how much? 20 lakhs. So how much is the gain they made? 4 lakhs. This 4 lakhs is chargeable to tax. The other 6 plant and machineries may be carrying out at what value? 6 into 8. How much value, sir? 48 lakhs. Still the asset value is being carried only. But here, since the 2 plant and machineries are sold, the related 4 lakhs will be chargeable to tax. Understand? So in SLM method, every asset will be taken or every asset will be treated as a separate asset. Whereas in WDV, instead of treating every asset as separate, we'll follow blockwise. What is called block? Assets with similar nature and which are chargeable to depreciation at a same rate are grouped, and such group is called as block. Then under WDV, which system has to be followed, sir? Block system has to be followed for computing depreciation. Block consists of what? Assets of similar nature and chargeable to depreciation at a similar rate. Then block. Sir, as we said, block means what? Assets with similar nature, chargeable to depreciation at similar rate are grouped, and such group is called block. So how do they can be blocked? They can be blocked as like intangible, within tangible we can block building separate block, furniture, plant and machinery, ships, and intangible separately. Then let me take you to the depreciation rates. Buildings, if they are used for residential purpose, 5%. But my question is, when buildings are used for residential purpose, why do we claim depreciation? Sir, depreciation will claim when they are used for business purpose only, right? But here they said what? Building used for residential purpose will claim depreciation at 5%. Or which scenarios or in which cases we can claim this depreciation? Office used as residence, huh? Rental purpose if you are using, then it will come under house property, right? Then under house property there is no concept of depreciation. Sir, you are giving these buildings as quarters accommodation to employees. Company constructed the building, and such buildings given as accommodation to employees are used as a guest house. Then the building used for what? Residential purpose only, but again it is related to business only. Okay, so then the depreciation can be claimed is how much? 5%. For installation of any building is constructed for installation of plant and machinery with respect to a water supply project, then also 40%. So nothing but a water tank has been constructed to provide water to the employees and to the nearby employee quarters and to the factory. And at the place of water tank only, to keep that bore and all, another building has been constructed. Maybe the water is getting purified there itself. To install those machines and all, buildings are constructed. Then on them, 40% is the depreciation rate. If they are temporary wooden structures, those are not permanent structures, are temporary wooden structures kind of, on them also depreciation can be claimed at 40%. If there are any other building, it could be office building, could be factory building, can be claimed at what rate? 10%. So okay, which are of, so mostly we'll get this other buildings only. Other buildings means what? Which are used for factory or office purposes, then their depreciation can be claimed on them at a rate of 10%. Then on furniture and fittings, electrical fittings means, okay, on them the depreciation rate is 10%. Then plant and machinery. Plant and machinery in general the depreciation rate is 15%. Computers including their softwares chargeable to depreciation at 40%. However, computer does not include mobile phones, sir. Mobiles are chargeable to depreciation at a rate of 15% only. Motor cars. You purchased a car and you are using the car for hire purpose, then the depreciation is 30%. Other than hire, for business purpose you are using, but you are not hiring it, then 15%. Aeroplanes and aero engines, 40%. Pollution control or medical equipment, 40%. Hospitals, sir, will buy certain costly medical equipments and all, on them they can claim 40%. And factories has to install certain pollution control equipments because of the laws and restrictions, then 40%. Any energy saving devices or windmills has been there, then on them also 40%, ships 20%, intangibles 25%. Okay. So does these rates will be given in the question? No, we only have to remember, but mostly buildings 10%, furniture and fittings 10%, plant and machinery in general 15%, computers 40%, motor car 15 generally, for hire 30%, intangibles 25%. These 7 are most frequently asked points. Okay, once again I'm repeating, sir. Buildings used for factory or for office buildings 10%, furniture and fittings whether they installed in office or factory 10%, plant and machinery 15%, then computers 40%, mobiles now 15 only again, then motor car for hire 30, other than hire 15%, intangibles 25%, then sometimes pollution control equipment, medical equipment, this windmills and all also 40%. Okay, sir, we already filtered. There are, if you go into the actual PGBP chapter na, institute material, we don't have PGBP chapter. Once again, so if you go to institute study mat, you will not find PGBP chapter, but the provisions are needed to do assessment of companies chapter, so that's why we are discussing PGBP. So if you go into CMA interbook also, you will find there are other assets also where depreciation rates are given, but out of them, which we feel completely irrelevant for us or no chance of asking, that I already filtered and I given only here important ones. Rates of depreciation. Then depreciation has to be computed only when the block continues to exist. Sir, on the last day of the previous year, you need to check whether block still continuing or not. If block continuing, sir, out of the block certain assets may be sold, not a problem. But if still block continuing, then you have to charge depreciation. If block itself is not continuing, total block ceases to exist, you will not charge depreciation for that year. Okay, now, what does it mean by block ceases to exist? Block ceases to exist means when all the assets in the block are sold or transferred, or when a single or multiple asset transferred and the sale value exceeds block value on closing date. Once again, sir, when all the assets in the block are sold or transferred, or when a single or multiple asset is transferred and the sale value exceeds total block value. See, sir, here, opening block consists of L, M, N, total 10 lakhs. Then additions made on 1st December 25, asset P. Total how much, sir? 5 lakhs. Now deletions, L, M, N, P, all the 4 assets are deleted. So for what value they were sold? So deleted nothing but they were transferred or sold. So we are taking 2 scenarios. Case 1, they are sold for 13 lakhs. So what is the combined assets value? But they are transferred or sold for how much? 13 lakhs. Gain or loss? Because all the assets in the block are sold. There are 4 assets, all the 4 are sold. So if all the 4 are sold, then there is no corresponding asset, right? That's why what is called this 2 lakhs is loss and it has to be treated as short-term capital loss. Okay, then case 2, 4 assets value how much, sir? 15 lakhs. But they are transferred for 20 lakhs. Now what? Gain. Okay, which gain? 5 lakhs gain, which is called as short-term capital gain. Because here 4 assets are in the block and all the 4 are sold. Then obviously block ceases to exist. When block ceases to exist, we need to compute gain or loss on sale of depreciable asset. The gain or loss on sale of depreciable assets will always be short-term, irrespective of the period of holding of asset. That depreciable asset may be held for more than 24 months. It might be long-term asset, but the resulting gain will always be called as what? Short-term capital gain or short-term capital loss only on depreciable assets. Then, when a single or multiple asset transferred and the sale value exceeds block value on closing date. Sir, not all the assets are sold now. Only few assets in the block are sold. Let's say, opening WDV, they have A, B, C assets, 10 lakhs. And addition, they made Z, 3 lakhs. When? 1st February 2026. And the deletions made, sir, how many assets are there totally? 4, A, B, C, Z. But they sold only A and B for how much? 11 lakhs. But look at the dates carefully, sir. When this addition is made? 1st February. When this deletion is made? 1st December. So this deletion is first, addition first. Deletion is first. So on the date of deletion, if you see, there are only 3 assets. 3 assets. A, B, C. Worth how much? 10 lakhs. But you sold for how much? 11 lakhs. So on 1st December, if you check the block ceases to exist only because out of 3, 2 assets sold and the total sale profits exceeds the whole block value, then also block ceases to exist. But one thing, sir, you need not to check whether block ceases to exist or not on the date of sale. You should check on the last day of previous year. On the last day of previous year, 31st March. By 31st March, how many assets are there? 4 assets are there. Total value how much? 13 lakhs. Out of 13, you sold 2 assets and how much is reduced? 11 lakhs. Still how much is there? 2 lakhs. So still positive balance is there, not 2 lakhs. So we'll say like what? Asset block continues to exist. Block continues to exist. Okay, sir, if there is no this addition now, if this addition is not made, then how much is the total value? 10 lakhs. Sold for how much? 11 lakhs. So then it is what? Negative 1 lakh. It's becoming negative 1 lakh, sir. And still there is asset C. Okay, even though asset C is there, the amount becoming negative. So block ceases to exist. Sir, 10 lakhs worth you sold for how much? 11 lakhs. 1 lakh you got what? Short-term capital gain. Okay, so to become, sir, let's say this side assets, this side amount. If amount column becomes 0, also block ceases to exist. Or number of assets becomes 0, also block ceases to exist. Sir, in first case, what is happening? Assets becoming 0. All the assets in the block are sold. Okay, then you may get gain or loss. This side, sir, you are not selling all the assets. 1 or 2 assets only you sold, but they cover the total asset value. They cover the total asset value, sir. Sir, in the second case, only gain will be there in the second case. In first case, now, There could be gain as well as loss. So are you able to understand why only gain will be there in the second case? Sale value shall exceed the total block value. That's what we are saying. When sale value exceeds block value, obviously there will be what? Gain. Okay. When a single or multiple asset transferred and the sale value exceeds block value, on which day we need to check, sir? Closing date. Closing date of which year? Previous year. Then to claim depreciation, SSE must be the owner. Only exception is like if SSE has a lease or other ownership right and incurred capital expenditure or construction or repairs of building, then depreciation is allowed. Sir, if you remember 31 and section 30, what we said, repairs, revenue repairs, capital repairs. Revenue repairs only allowed as deduction. Even SSE is a tenant also. Revenue repairs only allowed, capital expenditure not allowed. Now what here they are saying, since even though he is a tenant, if he has a lease or other ownership right, he can capitalize that capital expenditure and on that he can claim depreciation. Asset to claim depreciation should be used for what? Business or profession. The usage could be active or passive. What is active? What is passive? Active use, you are daily using that one. Passive use, you are not using, but it is kept ready for use. You don't know when the need arises. Okay, but when the need arises, it should be in a position to be usable. Then that is called. So all the maintenance has to be done, even though it is in passive use. That's why on them also we can claim depreciation. Then where there are additions made during the previous year. Additions means what? New asset purchases are made, additions, okay, in a block. Then for those additions alone, we should check whether they are used for more than or equal to 180 days or less than 180 days. Sir, sometimes they'll give in the question, asset forming part of opening block used for only 170 days. We don't bother about opening block. If some asset part of opening block, then we'll charge full depreciation only. Only if those were additions, then we'll check whether they are used for more than 180 days or equal to 180 days or less than 180 days. If they are used for more than or equal to 180 days, then full depreciation can be claimed. If they are used for less than 180 days, then the depreciation is restricted to 50% of the actual rate. Let's say, sir, it is a building, new building, used for less than 180 days. Then depreciation is restricted to 50% now of actual. Actual rate is how much? 10%. 10 into 50% now, 5%. Half of the original rates only you can claim. Plant and machinery now, used for less than 180 days, 7.5% only. Intangible assets, 12.5% only you can claim. Because originally 25, by half now, you'll get only 12.5%. Okay. Then increased rate of depreciation on plant and machinery. Increased rate of depreciation on plant and machinery. Sir, on plant and machinery, what is the actual rate? 15%. Okay. SSE is into manufacturing of any article or thing, using technology know-how developed in a lab owned by government, PSU or university. Sir, he is manufacturing an article or thing, a new kind of article or new technology, and such a technology came from where? From Indian laboratories or Indian PSUs or Indian universities only. Such a technology or know-how has been developed. By using the technology and know-how, you are manufacturing a product. So you are encouraging something Indian talent or Indian technology. So to encourage you, sir, first thing, you are into manufacturing and you are encouraging the Indian research and the Indian technology which was developed. So to encourage these kind of manufacturers, what government is saying, instead of 15%, they can claim 40% of depreciation on new plant and machinery installed. So instead of 15%, they can claim 40% depreciation rate also. But when they are into manufacturing, and that also not any routine manufacturing, they should be manufacturing any article or thing by using the technology or know-how which is developed from Indian laboratory or a PSU or Indian university. To claim this, sir, to claim this 40% depreciation, such a technology which is developed in Indian laboratory, PSU or university has been acquired by this SSE by paying royalty. Then along with return of income, he has to attach a certificate that article is manufactured using such a technology only. If these conditions are satisfied, instead of 15% on new plant and machineries, he can claim 40%. Then additional depreciation. We discussed till now about what, sir? Normal depreciation. Normal depreciation mandatory or voluntary? It's not optional, sir. It is mandatory. Okay. For power sector undertakings, what kind of depreciation method they can follow? They can follow SLM or WDV. In SLM, we'll follow block system. We'll follow asset wise. Under WDV system only, we have to follow block wise. Block means group of assets with similar nature and a similar rate of depreciation. Okay, they are grouped and such group is called as block. Okay, sir, in the middle of the year, I sold the whole block of assets. In the middle of the year, I sold whole block of assets. Do we need to charge depreciation for that year? If the assets are sold in the middle of the year, the whole block, do we charge depreciation? No, sir. Only when the block continues to exist, then only we'll charge depreciation. If it ceases to exist, then we are calculating gain or loss. Okay, so we'll not calculate again depreciation. Okay, and then on when the block ceases to exist, when all the assets are sold, that case sale value exceeds or not, block ceases to exist. When all the assets in the block are sold. Second one, sir, not all the assets are sold. Maybe one or two or a couple of assets has been sold, and the sale value exceeds total block value. Then also block ceases to exist. But this point we need to check on which day. Whether sale value exceeds block value or not, on the last day of previous year. Okay. Then what is the rate of depreciation on intangible assets? Plant and machinery. In general, only you tell. Okay, specific case, only in the question, if there is such specific scenario, we need to take 40. In general, 15%. Buildings. In general, 10% only. Furniture and fittings. Okay. Then pollution control equipment. Okay. Then we are about additional depreciation. Sorry, additional depreciation. Two reasons why additional depreciation has to be given. One reason. Compared to the traders and service sector, manufacturers will have more wear and tear. Manufacturers will have more wear and tear. That's why the government thought to provide little more depreciation extra for them. That's why they introduced additional depreciation. That is one kind of logic. The second logic is the government wants to encourage manufacturing sector. Why only manufacturing sector? Because compared to any other sector, manufacturing sector creates more employment. It creates more employment. Yes or no, sir? That's why government wants to encourage what? Manufacturing sector. Okay. So eligible additional depreciation. What is additional depreciation? Eligible SSE. SSE engaged in the business of manufacture, production of any article or thing, or generation, distribution, transmission of electricity. SSE engaged in the business of manufacture, production of any article or thing, or generation, distribution, or transmission of electricity. So if these kind of businesses he is doing, then he can claim additional depreciation at a rate of 20% irrespective of block of asset. Plant and machinery also 20. Okay, but plant and machinery actual rate is how much? 15 only. Sir, additional depreciation available only on plant and machinery. On others it is not available. Okay, additional depreciation is available only on new plant and machinery acquired. So only on plant and machinery it is available. Furniture and all not applicable. Only on plant and machinery we can claim additional depreciation. So general 15% also available. Extra additional depreciation how much we can claim? 20%. Sir, this 20% can we claim every year? This 20% can we claim every year, sir? Every year we cannot claim. Every year we cannot claim additional depreciation. Only in the first year you can claim additional depreciation, one time only. But normal depreciation continuing only every year 15 till the asset becomes zero, you'll be charging depreciation only. But additional depreciation only once. Okay. Additional depreciation is available only on new plant and machinery acquired and installed in a previous year after 31st March 2005. Okay. We need to check whether the plant and machinery is used for more than or equal to 180 days or less than 180 days. Sorry, additional depreciation also. If it is used for more than or equal to 180 days, full 20% can be claimed. If they are used for less than 180 days, then again it is also restricted to half of the actual. So you can claim only how much? 10%. Sir, additional depreciation will get every year or only once? Sir? Normal depreciation? Sir, normal depreciation, first year, instead of total 15%, even it restricted to 7.5% also, there is no big problem to you. Why? Next year you will claim. Because next year also normal depreciation can be claimed. Then after next year also it can be claimed. Whatever is the written down value, on that you will be claiming 15%. And it will be continuous to go. So there is no big problem, even if you claim 50% of the actual only under normal depreciation. But additional depreciation, it is allowed only for once only. So if you don't claim fully this year, then it's permanently gone. Okay, so that's why what they are saying here now, additional depreciation 20%, fine. Okay, that 20% you can take if you are a manufacturer, you are engaged, if you are a manufacturer on purchase of new plant and machinery. But if you used for less than 180 days, total 20% you cannot take in the first year. 10% take in the first year, balance 10% take in the second year. Understand, sir? If you are into a SSE engaged in manufacturing of any article or thing, you purchase new plant and machinery, you are eligible for additional depreciation. Additional depreciation is always 20%. But you use the asset, you acquired and used it for only less than 180 days. Then also 20% only. But in first year you can claim only 10%, balance in the subsequent year. Okay, then. But all the assets are not eligible for additional depreciation. What? You purchased used assets. You didn't purchase a new plant and machinery, sir. You used a second-hand used plant and machinery. Sir, even though it is used plant and machinery, you can claim normal depreciation. There is no restriction on normal depreciation with respect to used assets. We are giving restriction only with respect to what? Additional depreciation. Sir, you purchased a second-hand plant and machinery for 50 lakhs. Already used in Japan or Germany somewhere. And you imported that plant and machinery for how much? 50 lakhs. On that, normal depreciation can be claimed. How much rate? 15%. But additional depreciation not allowed. Why? Because it is not a brand new asset. Additional depreciation is not available. And if it is a plant and machinery installed in office premises or residential accommodations or guest houses, then not allowed. Sir, it has to be installed in your factory. Okay, not in your office premises, residential accommodation or guest house. Then, if they are road transport vehicles, if you have factory only, but you purchase the trucks for what? For transporting goods from your factory to the seller to the buyer place and all, you are using those trucks. On them also you cannot claim additional depreciation. And even any plant and machinery on which actual cost is allowed as deduction. 3580. 3580, what does it say? 100% of capital expenditure is allowed as deduction. 3580 is for specified businesses. If like that, if you already claimed 100% capital expenditure as deduction, then again you can't claim additional depreciation. You can't claim additional depreciation. Okay. Once again, what are the conditions of additional depreciation? Who is eligible? Any SSE engaged in only manufacturing, generation, distribution, transmission of electricity. Okay. How much is the additional depreciation rate? On what additional depreciation can be claimed? Only on new plant and machinery acquired. If they are used for more than 180 days, full 20%. Less than 180 days, half 10% in the year of purchase, balance. Next year they can claim the balance. Which assets are ineligible for additional depreciation? Used assets, if you have purchased any used assets, road transport vehicles, assets installed in office premises, residential accommodation or guest house. Last one, assets on which already 100% deduction availed under any other section. Okay, these are ineligible. Right. Now, Sir, till now in PGBP, we didn't discuss about old regime which deductions are available, new regime which deductions are available. So first thing to start is with additional depreciation. So additional depreciation allowed under old regime for individual HUF, AOP, BY, AJP, for companies and even for cooperative societies. Okay, under old regime for everyone it is allowed additional depreciation. But under new regime, either for individual HUF, AOP, BY, AJP, or for companies or even for cooperative societies. See, sir. Individual HUF, AOP, BY, AJP, new regime means what? 115 BAC. For companies, 115 BAA, BAB. For cooperative societies, BAD, BAE. Okay, if they opted for these new regimes, then additional depreciation is not available. Not available. So under PGBP, old versus new, the first point we discussed is about additional depreciation. Additional depreciation is available only under old regime, not under new regime for every type of SSC. Sir, I am not talking about default and optional. Because for companies, old is only default. For individuals, new is default, old is optional. Whereas for companies and cooperative societies, old one is default, new ones are optional. That's why I'm not confusing you, or I don't want to say which is default and which is optional also, because it changes from one person to another. So old, new only I'm still using. Old regime, additional depreciation you can claim. New regime, not available. Then format for computation of depreciation. Depreciation has to be computed block-wise. Block 1, block 2. First we'll take what? Opening block value. Then additions will differentiate them, which are used for more than or equal to 180 days, less than 180 days. Sir, why such separation? Because of rate difference. More than 180 days now, how much you can claim? Full depreciation, not 20. Okay. Additions used for more than 180 days now, you can claim full depreciation as per the rate. It could be 15%, it could be 10%, you can claim. When they are used for less than 180 days, restricted to half. Then deletions, assets which are transferred or disposed during the previous year. Okay, if you would subtract them, and if still the block is continuing, then you'll get closing WDV before depreciation. Okay, so you got closing values. But straight away on closing value, can we charge depreciation, sir? No. So again, depreciation also. First we'll calculate depreciation on opening block plus additions which are used for more than 180 days together. Why? On opening block also you'll get full depreciation. And on additions more than or equal to 180 days also you'll get full depreciation. So first you'll claim on them. Then depreciation on additions which are used for less than 180 days. Then additional depreciation. Additional depreciation can we claim on opening block? Additional depreciation available only on new plant and machinery. That means only on additions. Additions, two categories are there again. More than 180 days are equal, more than or equal to 180 days, less than 180 days. So additional depreciation on additions more than or equal to 180 days. Additional depreciations on additions less than 180 days. More than 180 days now how much? 20%. Less than 180 days now 10%. So if you claim, then you'll get closing WDV after depreciation. See. How to apportionment depreciation when there is succession. How to apportion depreciation when there is succession. Succession means what, sir? Okay, amalgamation, demerger, conversion. Nothing but the body which carries the business will change, but the soul remains same. Okay, Kanchana series is succession. Okay, the Raghava Lawrence body will remain same. But whenever they want, all those ghosts will come and take his body for rent. They'll use it for a few months and again they'll leave. Okay, as if he has kept two-let boat. And sometimes multiple tenants will come also, not a single tenant also. Apportionment of depreciation when there is a succession. In amalgamation, if amalgamation happened, the business still be continuing, but the one who runs the business will change. Demerger. Demerger, the classic amoeba example or amoeba structure, if you know, sir, that is demerger. If you know amoeba, how amoeba will reproduce, sir, the same amoeba will get split into two. Okay, that is called as demerger. So one existing entity will split into two or three, then that is called as demerger. Conversion, like sole proprietorship to company, firm to company, or company to LLP, all these will come under succession. Amalgamation, demerger, sole proprietorship to company, firm to company, company to LLP. Sir, this depreciation and apportionment of depreciation has extra weightage than that of PGBP because this concept even linked to business restructuring. So there is a chance of asking this part related question even under business restructuring quota. There is a 7 marks for business restructuring, sir, standardly. Okay, so this unabsorbed, this depreciation and depreciation related apportionment concept is under PGBP and even linked to the business restructuring chapter also. So it has extra weightage or extra probability of coming for more marks. Now, sir, in the year what happened? 1st April 2014. Sorry, 1st April, previous year starting. In between there is succession happened and closing. Now, all the assets in the block, part year they are used by predecessor. I mean, the one before amalgamation is called as predecessor. The one new company after amalgamation is called as successor. So part year those assets are used by predecessor. Part year they are used by successor. Now, how the depreciation has to be claimed? Will the total depreciation has to be claimed by successor only, or the total depreciation has to be claimed by predecessor only? What they said, both has to claim. in the ratio of number of days used by both of them. Okay, in the ratio of number of days used. Apportionment. Sir, actually, if you learn business restructuring chapter, there are certain conditions also. Okay, when this amalgamations happens, now all the assets and liabilities has to be transferred. At least 75% of shareholders shall continues to be shareholders even in the newly formed company also. Same way for demerger there are conditions. Same way for sole proprietorship to company, firm to company, company to LLP also there are certain conditions to be satisfied. If those conditions are satisfied, sir, understand, A Limited amalgamated into B Limited. It is nothing but A Limited selling over all its assets to B Limited. When it's sold, actually capital gain should arise. Understand? A Limited is running its business, but A Limited transferred its business completely to whom? B Limited. It is nothing but like what? Sold all its assets to B Limited. But we are calling it as what? Amalgamation. Sir, when the assets are sold, actually capital gains should come. Capital gains should come. But in business restructuring chapter, we'll learn if certain conditions are satisfied, then it need not to be treated as a transfer and capital gains will not arise. In all these cases, in all these 5 cases, if certain conditions are satisfied, the ownership of assets changing from one person to another, there is a transfer actually, capital gains should attract, but on satisfaction of certain conditions, there won't be any capital gains. If those conditions are satisfied, then only this apportionment of depreciation also applies. Understand, sir? Okay. So now apportionment, conditions to be satisfied, then capital gains also not applicable. We'll understand deeply when we refer business restructuring chapter. Okay. Apportionment. Opening block plus additions made before succession. Sir, with respect to what? The opening block related assets and additions which were made before succession. On them, depreciation. Sir, in this period, if any assets are purchased, those were used by predecessor as well as by successor. So the depreciation has to be apportioned between predecessor and successor in the ratio of number of days used. Whereas if any asset purchased here, used by whom only? It is used only by successor. So the whole depreciation goes to successor only. So we need to check whether asset purchased before succession or after succession. After succession means whole depreciation goes to successor only. Before succession means apportion between predecessor and successor. What basis? Ratio of number of days used. Okay, look at this example. A Limited engaged in manufacture of articles has the following blocks. Compute depreciation under section 32. It is opted for old regime. Plant and machinery value 40 lakhs, furniture 10 lakhs. Machine K acquired on 1st Jan for 5 lakhs. L 2nd February 8 lakhs. Acquired on 1st October, furniture 3 lakhs. And machine A is sold for 15 lakhs, which is part of opening block. Now we need to calculate depreciation first. So first we'll keep it in the format only. Opening block, additions more than 180 days, less than 180 days, subtract deletions. You'll get closing WDV before depreciation. So 40, 10 lakhs. Additions are, how many additions are there? 3 are there. 2 are related to plant and machinery. 1st June now more than 180 days. 2nd February now less than 180 days. More than 180 days 5 lakhs. Less than 180 days 8 lakhs. Then furniture 3 lakhs purchased when? 1st October. 1st October means how many days, sir? Less than 180. Count and tell. I did. You also check and tell. Okay. Dharmateja, check and tell. Whether they are 182 or not from 1st October. October how many days? 31. November 30. 31 plus 30 plus 31. Plus January 31 plus February 28 plus March 31. How many days? 182 days. So used for more than 180 days. So it is eligible for what? Full depreciation. Sir, again don't go to residential status and think like 182 days. Here under depreciation the number limit 180 days, not 182 days. Okay. So this is also used for more than 180 days. So if you subtract deletion 15 lakhs which is made, then the closing WDV before depreciation is how much? 38 lakhs. Okay. Now on this, compute first on this two. What is the depreciation on this two? Sir, we should straight away calculate depreciation on this. Think and tell. Think until, could we straight away apply depreciation on 45%? Sir, on this 8 lakhs, yes I know, restricted to 50%. On this full depreciation, can we claim 45 into 15%? That and all is not there. I didn't say about royalty, royalty know-how, developed in Indian lab, all those points I didn't say now, so don't think of 40. Sir, this deletions what to do? This deletions what to do? Sir, if you straight away claim on 45 lakhs, from where you will subtract these deletions then? Got my point, sir? See, you can claim maximum depreciation on how much? 38 lakhs only. If you claim here itself on 45 lakhs, then from where you subtract 15 lakhs? So this 15 lakhs was sold related to what? Opening value. Sir, see, machine is sold, which is part of what? Opening block value. So this 15 lakhs has to be adjusted from where? Opening. This 15 lakhs has to be subtracted from opening block value. Yes or no? Okay, 15 lakhs subtract from opening block value. Sir, let's say here it is not 15, sir. 5050. Then what to do? Still block continues to exist only because here 53, if you subtract 50, 3 lakhs is there. But how do you adjust that 50 lakhs? మీకు అర్థమవుతుందా నా ప్రాబ్లం? ఓకే సరే చెప్పండి ఏం చేస్తారా మీరు? Here the amount subtracted is 50 lakhs. Why? Because the deletion value is 50. Then closing value is 3 lakhs. Now tell me on this 3 lakhs how much depreciation will come? If you could tell this, then you understood depreciation and at least you can think something correctly with respect to depreciation. On this 3 lakhs, what will be the depreciation? Confidently చెప్పండి ఏదని చెప్తే. Why not full value? I mean, you said a point, give explanation. So you are adjusting in which order? FIFO order you are adjusting. Follow that order only, that is only correct. When the deletions value has to be adjusted from, if they are related to additions, then first with additions. Here what they are related to what? Opening. First adjust with opening. Opening completely utilized. Then come with what? Additions more than 180 days. After that come for additions less than 180 days. Still how much is there for us? 3 lakhs. Block ceases to exist or continues to exist? Continues to exist because 3 lakhs is there. On this 3 lakhs, we'll charge full depreciation or half depreciation only. Because this 3 lakhs we think like related to additions used for less than 180 days. On that we'll get only 7.5% depreciation only. Understand? Okay, so the point which I want to communicate here is when there are deletions, you need to adjust them on what basis? First adjust it to the specific asset. If they are opening, adjust to opening. If there are additions, adjust to addition. But still that is not enough. So where the balance you will be adjusting, FIFO order you will be adjusting. Okay, so now here on 45 lakhs we'll calculate depreciation straight away. Here on 45 lakhs we'll calculate depreciation straight away. What to do? 45 minus 15 lakhs. How much then? 30 lakhs. 30 lakhs into 15%. 4 lakh 50,000 is the depreciation. So deletions we should subtract here only because deletions are related to opening block. Then furniture. 13 lakhs into 10%. 1 lakh 30. Everybody having calculators? Huh? Okay, solve quickly. Solve this depreciation and tell. Quickly. Take a rough paper. Don't use only calculators. You are not Einsteins. Calculated, sir. So what is the total depreciation on plant and machinery? 5 lakh. Furniture. Additional depreciation also calculated. Huh? Calculate additional also because they are into what? Manufacture. So calculate additional depreciation also. So calculate total depreciation additional also and tell the total depreciation. Normal plus additional together. For plant and machinery how much? 6 lakh 90. 1 lakh 90. $6,90,000. Then tell both the total depreciations. No total answer చెప్పండి సార్ నేను రీజన్ అడగలేదు అడిగింది చెప్పండి వాట్ ఈస్ ద టోటల్ డిప్రిసియేషన్ ఆన్సర్ ఫర్ ప్లాంట్ అండ్ మెషినరీ అండ్ ఫర్నిచర్ ఐ నో రీజన్స్ మేబీ ఇట్ ఈస్ రాంగ్ ఆర్ మేబీ ఇట్ ఈస్ రైట్ యూ టెల్ వాట్ ఈస్ యువర్ ఆన్సర్ ఒరే నాయన నీకు ఆన్సర్ చెప్పంటున్నా ఆన్సర్ ఎలా వచ్చిందో చెప్పాను అట్లా నీకేం అర్థమైతే దాన్ని బట్టి ఆన్సర్ చేసి చెప్పు, తర్వాత నేను ఎక్స్ప్లెయిన్ చేస్తా. అర్థమైందా? ఇప్పుడు నువ్వు ఎక్స్ప్లెనేషన్ ఎక్కడికి చెవులో చెప్పడం అవుతా నాకు ఇక్కడి నుంచి అవదు. అందరు చేసే వాళ్ళందరూ ఆగిపోతున్నారా? హౌ మచ్ ఇయర్? దెన్ ఫర్నిచర్ 1,30,000. What you did mistake? That's what only you wanted to explain, right? What you wanted to explain now? Related to what? New plant and machinery. If it is addition, then it is obviously what? Addition means what? You purchased in the current year. If it is an addition, then what? Obviously, then nothing is mentioned. You don't think much. If nothing is mentioned, what will think? Generally, a manufacturing company will buy plant and machineries for what? See, the question you don't expect everything detail will be given. So, okay, examiner gives. So, based on that, what you should do? Generally, for a manufacturing company, what happens? Both will be related to manufacturing only. So, based on that, you will be calculating additional depreciation. ఓకే, సో నేను ఇప్పుడు డౌట్ అడగడం కాదు, నేను అడిగేది నేను అంటే ఏంటంటే, నువ్వు ఎక్కువ డౌట్ ఫస్ట్ క్వశ్చన్లో ఉన్న ఇన్ఫర్మేషన్తో మనం ఏం చేయగలం ఆలోచించు. బికాస్ ఎవ్రీ టైం ఎక్స్ట్రా ఇన్ఫర్మేషన్ నీకు ఎగ్జామ్లో ఎవరు ఇస్తారు? ఇక్కడ నేనున్నా, నీకు ఏదో ఎక్స్ట్రా ఇన్ఫర్మేషన్ ఇంకోటి తెలియాలనుకుంటున్నావు, నేను చెప్తా. మరి ఎగ్జామ్లో అయితే సేమ్ క్వశ్చన్ దేర్ ఇన్ ఎగ్జామ్, వాట్ అజంప్షన్ విల్ టేక్? ఆర్ యూ ఏబుల్ టు అండర్స్టాండ్ మై క్వశ్చన్, ధర్మతేజ? సేమ్ క్వశ్చన్ ఇన్ ఎగ్జామ్, వాట్ డూ థింక్, whom you will ask? Okay, if you ask the invigilator now, he don't even know what subject also that is, so you can't ask him. Okay, your next person also same like you only, he also doesn't know clarity. Okay, so then what you will do in exam? If you have doubt now, you will write a clear assumption. If you don't have, I mean, if you think like generally, since they are saying manufacturing, then both might be manufacturing only is the general assumption everybody think. If you think much more detailedly also, what you have to write? Again, clearly write an assumption like stating both are treated as used for manufacturing purpose only. That's what we can do, right? In tax questions always, not the examples we create, even in the exam questions also many times, every detail will not be there because there are several combinations and all. See, for every plant and machinery also, I said 15, somebody thought maybe it is 40% also. Okay, so we think of general points only normally. Specific points, only when they specify, we'll think of specific points. That's the basic rule. Get anywhere. If question does not specify anything, we'll go with the general things. Okay, if question talks about a specific point, then only we'll apply that specific provision or specific point related. Okay, so don't think of plant and machinery 40% rate always. Only if it is clearly said, we'll think of 40%. Understand, sir? Sir, but with respect to machine L, you claimed only how much, sir? Machine L, what happens, sir, of these editions, which is used for less than 180 days, you claimed only 10% additional depreciation. The other 10% can be claimed in next year. That's what I wrote. With respect to machine L, balance 80,000 can be claimed in the next year. Okay. Sir, in business restructuring chapter, open question number 6. Workbook. Question number 6. Aryan and Co. Same question only, right? Okay. Aryan and Co. A sole proprietorship was converted into Aryan Private Limited. Sir, what happened here? Company. It is called what? Succession. With effect from 1st January. The WDV of assets are like building 10%, furniture 10%, plant and machinery 15%. Okay. Then Aryan and Co. purchased a machine worth 1,20,000 on 1st September 2025. So these are opening, and this was again purchased on 1st September 2025. And Aryan Private Limited purchased another 80,000 on 15th January 2026. They're asking us to find out depreciation for what? Aryan and Co. So both are like what? Predecessor and successor. How do we compute depreciation? We'll compute depreciation normally only. Okay, with respect to the assets which are part of opening value and assets which are acquired before date of succession. I mean, leave only this 80,000, and for rest all the other assets, you should compute depreciation normally only, and such depreciation should be apportioned between predecessor and successor in the ratio of number of days used. Okay, na? Sir, don't look at the answers there. Again, take a rough page and quickly solve the total depreciation and apportionate it between predecessor and successor also. You will get so many doubts in the middle. Don't just look at the question, don't look for answer, and do whichever the way you can do. మీకు ఆ టైంకి ఏ అజంప్షన్ కరెక్ట్ అనిపిస్తుంది అనుకుంటే ఆ అజంప్షన్ తీసుకొని సమ్ చేసుకుంటే వెళ్ళిపోండి. ఆన్సర్ మాత్రం చూడొద్దు. How much you got till? Predecessor how much? Successor how much? Okay, you're telling separately for building, furniture and all. We didn't need for others? Then tell only plant and machinery. It's okay. So for predecessor, successor, how much plant and machinery? 42,461. Then You tell total also, it is fine. The total of predecessor and successor, right? Total predecessor depreciation. 82,001. Okay, successor? 26,877. This is for all the assets together, right? Predecessor. 22,437. Tell total. Total, not individual asset wise. All of them are telling total. For all the assets together, what is the depreciation for predecessor, what is the depreciation for successor? $77. Okay, Sai got there 88,211, 44,789. Navneet? Gone somewhere, or in space only. There the 37,872. 9. Vaishnavi? First one only, yeah? Okay, plus 1 I'll add. Second one wrong, huh? Okay. Tell. Okay, you said first one, huh? Okay. Then plus 1 removed here. It became Vaishnavi answer and your answer. 1 lakh? 32,790. You also dropped that? What? Okay, then what is your answer, final answer then? 1 second, okay. It is simple depreciation problem only. How much still? Huh? 86,562. 28,438. Okay. I want still, I think each one of you will get a different answer. What is your answer? Tell, no issues, like there are already so many answers. Students who are listening over online also, respond with your answers. Don't just sit and watch what we are doing. You also participate, practice question, and then post the answer also. Okay, sir. As of now, we got 5 different answers, but still, there is chance of getting another 5 different answers also. This is a clear-cut proof of what? When you don't practice, you will not get proper answers. So it's not just about learning the provision, you should apply it also. Sir, provision-wise, we discussed everything. How to calculate depreciation. Depreciation has to be between predecessor and successor. Depreciation has to be a portion between predecessor and successor in the ratio of number of days used. Okay, now see. Sir, first, opening 1st April. Sorry, everyone, please follow here. See, if you don't listen again, after you doing again, I can't explain once again. Still some people are doing only. Can I start? Okay. Okay. Opening 1st April 2025. See, అక్కడ దా చేసినారు చాలు. ఆ ప్రాసెస్ కరెక్ట్ అవుతుందంటే నువ్వు కరెక్ట్ అయినట్టే. ఇప్పుడు ఫైనల్ ఆన్సర్ దాకా కరెక్ట్ అవ్వక్కర్లేదు. ఫోకస్ ఆన్ దట్. ఓకే. 1st April 2025. 31st March 2026. Total number of days are how many? 365 days. When the succession happened, sir? 1st January 2026. Sir, before 1st January, how many days? After 1st January, how many days are there? After 1st January, sir, January, including 1st January, 31 days, February 28, March 31. Total 90 days. Predecessor, 275. It's okay. So, building, furniture, plant and machinery, we need to calculate depreciation. How much here? 40,000. Furniture, 6,000. Plant and machinery, 45,000. So, what ratio we need to apportionate here? 275 is to 90. This is the ratio we need to apportionate the depreciation between predecessor and successor. Then, Aryan purchased a machine worth 1,20,000 on 15th September 2025. Majority might have did mistake in apportionating this with respect to, this also might have been apportioned in ratio of 275 is to 90, which is wrong. Why? This was not there for full year. It is not there for 365 days. How you take the ratio? How can we take the ratio of 275 is to 90? If it is there for throughout the year, then we can take 275 is to 90. But this is not there for throughout the year. When it is purchased, it was purchased only on 1st September. So from 1st September to date of succession, it is 122 days. From date of succession, another 90 days. So it was used totally 212 days only. So it has to be a portion. Sir, on this 1,20,000, what is the depreciation? More than 180 days only. So full depreciation is available. 1,20,000 into 50% of how much? 18,000. But this 18,000 shall not be apportioned in the ratio of 275 is to 90. It has to be apportioned in the ratio of 122 is to 90. Okay, now tell the depreciations. 40,000, 275 is to 275 by 365, sir, how much? 40,000 into 275 by 365. How much? 130. Okay, 7. 40,000 into 90 by 365. 9? Okay. 6,000 into 275 by 365. 4520. 6,000 into 90 by 365. 1480. Then 45,000 into 275 by 365. 33,904. Then 45,000 into 90 by 365. 11,095. Okay, then this 18,000. 122 divided by 212. 18,000 into 10,000. 358. Then 18,000 into 90 by 212. 7,642. 7642. Now tell these totals also, sir. 3137, 4530, 33,904, 10,358. How much? 930. 919. Okay, sir. Okay, 920. Round it off. Then 9863, 1480, 11,095, 7,642. 30,080 plus there is one more thing for it. After succession also there is one more asset purchased by Aryan Private Limited. How much? 80,000 on 15th Jan. Is it used for full year? Less than for 180 days. So how much? 80,000 into 7.5%. 6,000. Add 6,000 also. So total 36,080. Here 78,920. 78,920. Okay, let us see. Does anybody got answer? So now, is it an easy question or tough question? It is an easy question only, sir. But exam also same thing happens. Okay? So the point to be understand is, it's not just about reading the theory. You have to practice the questions also. See, how do we compute it? Opening value 4 lakhs, 4 lakhs, 4 lakh 20, 60. Same format only I did, sir. But Aryan, here I took, sir. First we calculated normal depreciation also. I calculated 40,000 here, 45,000 here, 6,000 here, and here 18,000. Before succession, whatever are the assets are there, on that I have calculated depreciation. But I found out here the ratio also. Predecessor, how many days? 275. Successor, 90. And for this addition, 88,000, we cannot take the same ratio because this addition is not there for throughout the year to take that basis. So, how many days this is there totally? 212 days. Out of 212, how many days used by predecessor? 122. Successor, 90. So, based on that basis, if you apportion it, then you will get the total depreciation to Aryan and Co. 78,920. And then to Aryan Private Limited, we get 36,080. It's okay. Then, sir, same one more question will be there in business restructuring, which you can do on your own also. Not on your own, you try. What is the chapter number, sir? Business restructuring. 8 point. Okay. Question number 6, right? We solve now. Okay, 6 we did right. So 7 you try, sir, then. Not now. Question number 7 also same model. You try on your own and come. The only difference is like here holding and subsidiary companies. Okay, well, let me check, sir, once again whether it is same model or not. I need to check once. No, sir, no, not question number 7. 7, there is one more question with the same model. Let me check. Question number 16. Just numbers change, sir. Same model question only. Just numbers change. Question number 16, you try on your own. One correction, there take it as WDV as on, in the table, WDV as on 1st April 25, not 24. This one. Okay, then about terminal depreciation, sir. Sir, terminal depreciation concept I already explained at 41 only. What is terminal depreciation? When a power sector undertaking, power sector concerns can follow even what? SLM method. In case of SLM method, on every individual asset sale, we're going to compute gain or loss. Where such gain or loss is taxable. Sometimes it is taxable under PGBP only, sometimes it goes even under the capital gains also. See, applicable only to power sector undertakings which choose SLM for depreciation. What happened? Cost of plant and machinery is 10 lakhs, WDV 6 lakhs, you sold for 5 lakhs. What is the, whether here we are having gain or loss, sir? WDV 6 lakhs, sold for 5 lakhs. Loss, how much? That loss 1 lakh will not treat it as short-term capital loss. We'll consider it as terminal depreciation and charge it as a expense or deduction. Difference between WDV and sale value 5 lakhs, 1 lakh will charge as what? Terminal depreciation. Example 2, sir. WDV 6 lakhs, sold for 9 lakhs. Gain or loss? Gain only, sir. 6 lakhs worth, 6 lakhs WDV value, you sold for 9 lakhs. How much is the gain? 3 lakhs. But since it does not exceed at cost, the total 3 lakhs has to be treated as business income only. It was mentioned where? Section 41. Okay, selling price minus WDV, 9 minus 6, 3 lakhs has to be treated as deemed income as per section 41. Then example 3. Plant and machinery cost 10 lakhs. WDV 6, sold for how much? 12 lakhs. Now, how much is under PGBP? How much is under capital gains? The 4 lakhs gain, I mean the gain up to cost is taxable under the head PGBP only as per section 41 deemed income. In excess of cost, whatever the gain they made, 2 lakhs, that 2 lakhs is taxable under the head capital gains as a short-term capital gain. Understood, sir? Terminal depreciation done. Then unabsorbed and actual cost will complete after break, sir. So you can take break now, 10 minutes. We'll start again at 8:20. Additional depreciation is not available or not, you're asking. Sir, the point is, in the question, nowhere they mentioned that they are into manufacturing. If they are not into manufacturing, we'll not think of additional depreciation. So only if it is clearly said like manufacturing, then we'll go for additional depreciation. Sai, I think you got the answer. Sole proprietorship also eligible for additional depreciation. Nowhere we said, see, again, no, we didn't say like that. SSE should be eligible SSE. SSE engaged in business of manufacturing, production of article. See, here I said like what? Allowability of additional depreciation, old regime, new regime comparison also we did. And said like what? Individual HUF, AOP, BOI, AJP, old regime, it is applicable. So that means it is allowed. Okay? So for every, sir, unabsorbed depreciation means, sir, under income tax, while computing profit, first we should calculate profit before depreciation, then we should charge depreciation. Okay? It's not like first itself we can charge depreciation. Same, vertical P&L kind of. So how do we do, sir? EBITDA, earnings before interest, tax, depreciation and amortization. Same way, here we should calculate interest also you should charge. But before charging depreciation, we want the profit. Okay, how much is there? Let's say depreciation under section 32 is 50 lakhs. But they have profit before depreciation is only 30 lakhs. If you charge full depreciation, what happens? It will become loss 20 lakhs. So, because of depreciation, we shall not make the profit as a loss. So, what the provision says now, you charge depreciation to the extent of profit available. Only to the extent of profit available. So, how much depreciation you charge? 30. Balance how much is there? Sir, what to do with this 20 lakhs? Is it gone? No. This 20 lakhs, we call it as unabsorbed depreciation. The profit is not adequate to absorb depreciation. The profit is not enough or adequate to absorb depreciation. So, which cannot be absorbed, we call it as unabsorbed depreciation. Okay. So, what to do this? Sir, usually business loss can be carried forwarded for maximum of 8 assessment years. But whereas unabsorbed depreciation can be carried forwarded for any number of years. So it is better for us to make it as or keep it as unabsorbed depreciation only instead of making it as by charging full depreciation and making it as business loss. Okay, that's why we'll not charge full depreciation, sir. We'll charge depreciation only to the extent of profit available. The balance depreciation we call it as unabsorbed depreciation. Now case 2. Profit before depreciation itself is 20 lakhs. Sir, depreciation remains 50 lakhs only. But case 2, profit before depreciation, there is no profit at all. Before charging depreciation itself, it is a loss. Now, can we charge anything for depreciation? Already loss only. There is nothing to absorb. So, this 20 lakhs, we call it as what? Business loss. And the depreciation, nothing can be charged. So, the total 50 lakhs is called what? Unabsorbed depreciation. So, this business loss can be carried forward for 8 assessment years, whereas unabsorbed depreciation can be carried forward for any number of years. Any number of years. Same way, unabsorbed capital expenditure on scientific research. Sir, under section 35, where SSE is engaged into scientific research and you incur any capital expenditure, 100% of capital expenditure can be claimed as deduction. But that also we should not claim first. Like, first you claim all the general expenses and all, calculate profit before depreciation and this scientific research capital expenditure and all. Okay, so see, the profit before all these 60 lakhs, depreciation actually is how much? 90 lakhs. But how much you could charge? Can you charge total depreciation 90 lakhs a year? No, because profit is only 60 lakhs. Now you charge a year only to the extent of 60 lakhs restricted to profit. How much unabsorbed depreciation is there? 30 lakhs. Then capital expenditure on scientific research can be charged, sir. There is no profit to charge. And even capital expenditure on promotion of family planning. So all these are not chargeable because there is no profit enough. Sir, this also same as like unabsorbed depreciation only. Since the profit is not enough to charge this capital expenditure on scientific research, capital expenditure on promotion of family planning, those also will keep them separately as unabsorbed depreciation, unabsorbed capital expenditure on scientific research, and unabsorbed capital expenditure on promotion of family planning. Not only unabsorbed depreciation, all these three can be carried forwarded for any number of years, can be carried forwarded for any number of years. Here unabsorbed depreciation 30 lakhs, unabsorbed capital expenditure on scientific research, and unabsorbed capital expenditure on promotion of family planning. Why? So here 10 lakhs is there, unabsorbed scientific research, but the unabsorbed capital expenditure on scientific research 30 lakhs. But since there is no profit, we didn't charge. Capital expenditure on promotion of family planning, total 50 lakhs. But every year you can claim how much as deductions are capital expenditure on promotion of family planning, 1/5 only. So that year share how much? 10 lakhs. But to claim that 10 lakhs also there is no adequate profit. So here depreciation related 30, scientific research related 30, and family planning related 10. All this amount remains as what? Unabsorbed. These can be carried forwarded for any number of years, set off with any head income except with. Sir, understand? Normally, once a loss is brought forwarded loss, current year loss na inter-head adjustment is possible. Brought forward loss, inter-head adjustment is not possible. So generally you have business loss. You can adjust with what? Business loss can be adjusted with any other business income, with IFOS incomes, with the capital gain head related incomes, house property incomes you can adjust, except with the salaries, casual incomes, with other head incomes you can adjust business loss. If it is a current year loss, you can do that. It is not current year loss. Last year loss brought forwarded to current year. Once it is a brought forward loss, inter-head adjustment is not possible, only intra possible. Intra within the business side, PGBP head only, if any gain is there, you can adjust. With other heads, you cannot adjust. Okay? But unabsorbed depreciation is special. Unabsorbed depreciation, unabsorbed capital expenditure on promotion of family planning. These are, even though they are brought forward, they still has to be counted as current year loss only. If they are current year loss, they are eligible for even inter-head adjustments also. So unabsorbed depreciation, unabsorbed capex on scientific research, unabsorbed capex on promotion of family planning, even though they are related to past 5 years back, if they were brought forward to current year, they have to be treated as like current year loss only. If they are like current year loss now, they can be adjusted with business incomes or even with other head incomes also. But if it is a 5 years back related to business loss, brought forward to current year, it is eligible only for intra-head set-off, not eligible for inter-head set-off. Usually brought forward losses are eligible only for intra-head set-off, but these three can even be brought forwarded, treat them as current year expense, hence eligible for set-off with other heads also. Right? Then next one, sir, section 43, it is about actual cost. What does it mean by actual cost, sir? Actual cost means at what value we should recognize the asset cost. Because to charge depreciation, first we should know asset value. Okay, under different circumstances or situations, what will take it as asset value. General case, cost of the asset. If any taxes and duties on which ITC allowed, on which ITC not allowed, sir, not on which ITC allowed, not on which ITC not allowed. Tax and duties on which ITC not allowed. Sir, if ITC allowed na, you'll get input tax, so you'll not add to asset cost. If ITC not allowed na, then you'll add it to the asset cost. Loading charges, transportation charges, unloading, installation, borrowing cost. See, interest on borrowed capital. You can link it to where section 36 we have discussed this point. Interest on borrowed capital with respect to an asset. From the date of loan to till the date of asset put to use, we should capitalize to the asset that we need to add. If any subsidies and grants are received, then we should subtract. Okay, here correctly only kept, here I wrote wrongly. Subsidies and grants. I need to subtract. Subsidies and grants has to be subtracted. Then we'll get what? Cost of asset. If any trade discount is there, that also we should subtract. So this is normal accounting standard related concept only. Nothing is there. Even in accounts also we'll do the same thing. Asset. Taxes, refundable taxes now will not add. Non-refundable taxes any are there will add. Loading charges, PPE also says the same thing. How to do. Transportation charges, unloading, installation, interest on borrowed capital. You need to add. Subsidy, you should subtract. Trade discount if anything is also you should subtract. Then that is the cost of the asset. Okay. With respect to purchase of any, or with respect to acquisition of any asset, or with respect to capital expenditure, you incurred aggregate payment more than rupees 10,000 in a day to a person. Sir, it is linked to what? 40A subsection 3, disallowance. Revenue expenditure in excess of 10,000 in a day to a person is disallowed other than specified mode. Here it is talking about what? Capital expenditure. What we are saying, if any capital expenditure you made payment in a day to a person in excess of 10,000, other than through account to pay check, account to pay draft, or electronic clearing system, or any other mode prescribed, nothing but UPI, debit, credit cards, then such amount will not be part of your asset cost. I mean, nothing but that part you cannot capitalize, not eligible for depreciation. You constructed building for 50 lakhs, but out of building 50 lakhs, 40 lakhs you paid in cash. Then that 40 lakhs you cannot capitalize. Building cost, how much you should take? 10 lakhs only. On 10 lakhs only you can claim depreciation. Understand, sir? Okay. Then asset used for scientific research or specified business. Sir, asset used for scientific research, now 100% capex allowed as deduction in the first year itself. Specified business also 100% capex allowed as deduction in the first year itself. When 100% expense already claimed as deduction, then the cost will be zero only. So actual cost will take it as what? Nil. Actual cost will take it as nil. When a stock in trade converted into capital asset. Sir, if you remember in the charging section I said, what? A building will be there. Actually it is her stock in trade, but one block. Okay, she converted into what? Her office. Office is nothing but she converted into her asset. Okay. What we said, we need to realize income. What is the income? Because the relevant expenses we charge it to P&L. So I said like to you to create, recognize even the income also. Fair market value of the asset on the date of conversion will be considered as what? Income, and will be chargeable to tax. Now, sir, yes, expense booked, income claimed, done. But now you are considering it as what? It became your asset. So you should even recognize as an asset, and from now on you are eligible for even depreciation also. So how much value you should capitalize? Same, fair market value of stock in trade as on date of conversion will be taken as the actual cost of asset. Then asset acquired by way of gift, will, inheritance. You didn't purchase, you got by way of gift, you got by way of will, you got by way of inheritance. Then whatever is the cost to previous owner, that itself will be the cost to you also. Your father purchased, sir, and given it to you as gift. Then for what value your father purchased, that itself will be the actual cost to you also. Then purchase of used asset. SSE purchased used asset, second hand asset. So normally if it is a used asset also, what is the actual cost to be taken? Purchase price. However, if there is an intention, not a genuine case, there is an intention to claim enhanced depreciation, then actual cost equals to price fixed by AO. Sir, see, A Limited already in losses. It has block value 500 crores. Block value 500 crores. Sir, 500 crores block value is there. But if it charge depreciation, can they claim depreciation? No, because they are already into losses. If they are into losses, they can't claim depreciation. The total depreciation will still be carry forwarding as unabsorbed depreciation only. And they don't know when they'll get profit also. So like that every year it is continuing only, but they don't get, when they'll get profit, they doesn't even know. But same group related only, there is another company. Sir, understand? Or same sister concern, brother concern, another company is also there, which is into profits. So they have to pay more taxes. So what they are doing now? From A Limited, a machine P is sold. For what? Sir, its WDV is 10 crores only. Market value also 15 crores only. But you sold for how much? 100 crores. Sir, it doesn't mean 100 crores real money will come. In books only they'll record it as what? Sold for 100 crores. Sir, for A Limited nothing will happen. Why? Because they have block value of 500 crores. This 100 crores will not tax it. Individual asset wise will not follow under the income tax, will follow block system. So block value 500 crores, even if you subtract 100 crores, still closing block is how much? 400 crores. On that if you charge depreciation also, still it is in losses only, no problem. Okay, so nothing. Even block value reduces by 100 crores, A Limited will not have any much impact. But 10 crores worth asset, B Limited will purchase, or in its records it will show it for purchase of how much? 100 crores. Now they will claim depreciation on what? 100 crores. So they are claiming more depreciation, right? Originally, na 10 crore asset into 15%, na, they will claim only 1.5 crores. Now for buying at 100 crores, they are claiming 15 crores as depreciation instead of 1.5 crores. How much profit is reducing? 13.5 crores profit will reduce. So there is a tax saving to whom? B Limited. Okay. So here the transaction is arranged in such a way. They are buying used asset, but not for the actual value, for an enhanced value, so that their costs will increase and profit will come down. So if AO finds out the transaction was done in such a way, then he will not take the purchase price as actual cost. He will decide what price has to be taken as the actual cost. Okay. Repurchase of asset sold. Sir, actually an asset is there with A for how much? WDV 10 lakhs. A sold this to B for 10 lakhs. B sold this to C for 30 lakhs. C sold this to D for 50 lakhs. Again, D sold the same asset to A for 70 lakhs. Sir, in his books, so how much is there? Originally 10 lakhs. Again, he only repurchased it for how much? 70 lakhs. Why this kind of transactions? Again, to claim more depreciation and to reduce the tax expense only. So what has to be taken as actual cost? Actual cost equals to actual cost, how much? Initial purchase minus depreciation as if the asset is still in use. Sir, you repurchase it now. When you repurchase, you wanted to know how much you should recognize as the asset cost. What they are saying, originally, first time, what is your purchase price? Take it. From then, if you are using only for your benefit only, how much depreciation you might have claimed? Subtract that. You'll get some WDV value. Take it. Or repurchase price. Out of these two, whichever is lower will be taken as the actual cost. So this asset, A, purchased originally for 30 lakhs, 5 years back. Okay. Now, to do all this cycle, sir, Earth takes 1 year to revolve around it. So now for A also, he took 2 years to revolve. I mean, from A to B, it went B to C, C to D, D to E. Again, to came back to A, it took 2 years. So originally, here this is 2 years, and A purchased originally asset for 30 lakhs 5 years back. So this 5 years plus this 2 years, total how much? 7 years. So if asset purchased originally for 30 years and charged depreciation for all these 7 years as if A only used, now you'll get some closing WDV, right? That WDV you compare it with the 70 lakhs repurchase price. Whichever is lower, that would be taken as the actual cost. Building brought into business, earlier used for personal purpose. Building brought into business. Sir, till then building you are using for your residential purpose. Till now, you are using the building for your residential purpose. But now, once you qualified, you started your farm within your house only. You started your farm also within your house only. So now what you did, residential purpose building, now you started using it even for business purpose also. But is it a new building? So what cost you should recognize in your books to charge depreciation? Understand, sir? అసలు ఇక్కడ ఉంటే కదా అర్థమైందండి దానికి ఎక్కడో ఉన్నావు. ఓకే, బిల్డింగ్ బ్రాట్ ఇన్ టు బిజినెస్ ఎర్లియర్ యూజ్డ్ ఫర్ పర్సనల్ పర్పస్. సార్ బిల్డింగ్ పర్చేస్డ్, బిల్డింగ్ ఈజ్ యువర్ హౌస్ ఓన్లీ. From past 10 years, you are residing there only. But now, you started your own office there itself. Now what it became? Business purpose also. But did you purchase? No. So for what value you should recognize in the books to charge depreciation? That's the question. Okay, what they are saying. First to take the original purchase price. 10 years back you purchased for 50 lakhs. Take that. From there, subtract depreciation if it is used for business or profession from the beginning. From the last 10 years also, if it is used for business only, how much depreciation is there? Charge that. You will get WDV. That WDV you will recognize or you will take it into the books as actual cost. If there is any amalgamation or demerger, sir, amalgamation or demerger happened. Actual cost to successor. Sir, predecessor giving away all his assets to whom? Successor. The question is, for successor, at what value he should recognize those assets in his books? Post amalgamation. Post amalgamation, for what value successor has to take the books in his, take the assets in his books of accounts. What they are saying, WDV of predecessor on first day of previous year in which succession happened. In the year of amalgamation, first day, what is the WDV in the hands of predecessor? Take that. From there, subtract the depreciation that is apportioned to successor, not full depreciation of the year, sir. Only successor share of depreciation is there. That you subtract. Then, sir, we solve a question also. Let me show you. This is the question we solve, right? Here, what the successor books, what value they need to take. What we are saying, like, sir, what is the WDV before charging depreciation? 4 lakhs. From this 4 lakhs, you subtract depreciation which is related to predecessor. So 4 lakh minus 30,137 if you do, you will get a value, right? For this value, this is the value to be taken as cost by successor. Understand, sir? First opening value as on first day of previous year in which amalgamation happened. Okay, plus additions if any made also add. Okay, then you should subtract depreciation. You should subtract depreciation, not the whole depreciation, sir. Only predecessor's share of depreciation you have to subtract, because successor will charge his depreciation when once he recognizes the assets in his books, then he will charge depreciation. Understand? Then asset transferred from holding to subsidiary. Asset transferred from holding to subsidiary or subsidiary to holding. That's why two sides arrows are there. Holding to subsidiary and even subsidiary to holding. Both way, if any asset is transferred. Okay, a portion for predecessor, not successor. Minus depreciation apportion for predecessor in the year of succession. Correct it, sir, in your notes also. Depreciation apportion for predecessor. అక్కడ పల్స్లో ఉండదు, అంత క్లియర్గా ఉండదు ఆ పాయింట్. సో నో వరీ. హియర్ ఇన్ హ్యాండ్ రిటన్ నోట్స్లో అయితే యూ నీడ్ టు కరెక్ట్ ఇట్. No, with salary except house property loss, nothing can be adjusted. His question is, can unabsorbed depreciation be adjusted against salary income? With the salary income, the only loss that can be set off is house property loss. Other than house property loss, no other loss can be set off, including unabsorbed depreciation. Then, asset transfer from holding to subsidiary or subsidiary to holding. First thing, we need to check. Subsidiary, is it a 100% owned subsidiary? I mean, wholly owned subsidiary. And whichever is the company receiving, it should be an Indian company. Sir, holding to subsidiary or subsidiary to holding. Whichever the company receiving, it should be Indian company. And the subsidiary should be a wholly owned, I mean 100% owned subsidiary. Then, actual cost to the recipient will be the WDV of transfer or company only, not the original purchase price under. Okay, whatever is the price to previous owner, that only will be taken as the price to new owner also. But the conditions to be satisfied or what? Recipient company should be Indian company. Such subsidiary should be a wholly owned subsidiary. Important one, sir. There's a question on this also. Actually, we need to solve question number 7, right? In business restructuring, we solve question number 6. Question number 7, I said like it is of different model. Link it to this point only. Okay, holding subsidiary related only. When asset transferred from holding to subsidiary. Subsidiary should be what? Wholly owned subsidiary. And receiving company should be what? Indian company. Then, what is the value at which the receiving company should recognize the asset? The WDV value of the transferor will be the WDV of transferee. Then, asset acquired where part of the cost is met by someone else. So, when someone else meeting the part of the cost net is nothing but subsidy. Sir, out of 10 lakhs, you paid only 5 lakhs. The other 5 lakhs is paid by someone else. What we call it as? Subsidy. If any such kind of subsidies are there, what we have to do? Subtract it from the asset cost. Net amount you paid only is chargeable, allowable for depreciation. Actual cost minus part of cost met by someone else. Then, asset acquired by non-resident outside India and brought to India for business or profession. Sir, you used to do CA practice in UK, London. Then after 2-3 years, you thought it's not good, it is better to come to India only. But there for practice, you purchase 5 laptops. and some other office equipment and all you have purchased. Now all that you have brought to India. What is the actual cost? Actual cost means, I mean the original purchase price minus depreciation that might be allowed if it is used from day one only in India. That you subtract. So 3 years done. If those assets, laptops, if they were purchased in India only, for the last 3 years, how much ever depreciation you claim, that adjusts. Whatever is the balancing figure or the written on value is there, that you recognize as actual cost. Okay. So this is the concept of what? Actual cost. So with this, 32 also done. Now we are having only 33, 35. Okay. No, 33, sir. 33 simple only, sir. 35 only. We have quite a few points. AB, 33 ABA. It's about tea, coffee, rubber development accounts. Sir, this tea, coffee, rubber plantations. For every 20 years, the plantations has to be changed. 20 or 30 years, it depends on them. Let's say I'm taking 20 years, the plantations has to be changed. Once the plantations are changed, you have to plant new plants now then. For 5 years at least, you will not have any income, but you need to incur so much of expense. For that, you need to create a reserve fund. That itself is called as tea, coffee, rubber development fund. Understand, sir? Sir, when you need to plant or when you need to change the plantations, you incur so much of cost. Then to maintain those plantations, to let them grow, to take care of all of them, initially for the 3-4 years, you will not get any income once you start with new plantations. All that year, you have to incur expenses, right? For that, certain reserves or funds will be kept. How that money, every year, out of your income, a part will be transferred to the fund, which can be used when the plantations has been changed. So how much deduction is available with respect to the transfers you made for every year. So for that separate fund, it's not a real expense, sir. It is an appropriation. You're just creating a separate reserve. But that also, for that also, what 33AB is saying, like expense or deduction is allowed only. It's not a real expense. No money went outside. You're just transferring money into a separate fund. But still, that also can be claimed as an expense. That also can be claimed as a deduction. How much? The actual deposit made or 40% of profits from such business in the previous year, whichever is lower. Deposit actually made 40% of profit, whichever is lower. 33ABA. It is about site restoration fund if SSE is into prospecting, extraction, production of petroleum and natural gas. Sir, you extracted petroleum, you extracted gas, and do you leave that area as it is, right? You cannot, sir. You need to, again, fill it. You need to, sir, 100% subsidiary. Don't we need to deduct depreciation up to date of transfer? No. We need not to apportionate in that case because there is no succession happened there. See, his question is what? In succession cases, we are apportioning depreciation, right? Same way when an asset is transferred from holding to subsidiary, in that case also, first apportionment of depreciation applicable or not? No apportionment of depreciation is not applicable because that is not a succession case. You transferred asset from one company to another company. They both are not merging. So there is no succession happened. Since there is no succession, you will not even apportionate depreciation. If let's say holding transferred to successor, holding will not claim depreciation on those assets. Okay, but successor can claim depreciation because that also has what? As a new addition made in the during previous year. It depends on how many days they have used. Whether they used for more than 180 days or within 180 days. Based on that, it will be decided whether they can claim full depreciation or half depreciation. Sai, do you got the answer for your point? Okay, so now see. Site restoration fund for SSE into prospecting, extraction or production of petroleum and natural gas. Sir, for 30 years you extracted oil and gas from there. Then the reserve got exhausted. There is nothing there. So you wanted to go for a different site or different fund. Now do you leave that place as it is? You need to fill that with the required, usually coal miner, you will fill it with again sand and all, okay, to make it normal. Otherwise, they do underground mining and all. The earth surface will not be so strong. So when any little earth, when a smaller magnitude of earthquake comes also, there it will have much more impact because there is no strong base there. Because underground you dig the total coal available. So once a small magnitude of earthquake comes also, the outer cluster will again breaks and it creates a lot of damage. So that's why once they complete their extraction and all, they need to fill it. Okay. For the same way for petroleum and gas also, after their process of extraction, they need to again make sure that they restore it to normal. Sometimes they need to do plantations also. Okay. They need to fill the whole complete area and they need to put some plantations. Okay. All that. For that, from now itself, during the extraction stage itself, they start creating a reserve. And whatever they will transfer it to the reserve, that is allowable for deduction. Can be claimed as an expense if it is within the limits. How much is allowed? Actual deposit in special account or 20% of profits from such business in previous year. Deposit in special account or 20% of profits from such business in previous year. Out of these two, whichever is lower. So tea, coffee, rubber na 40% or actual, whichever is lower. Site restoration fund na 20% or actual, whichever is lower. Then if you are claiming deduction under these two sections, tax audit is mandatory. Tax audit is mandatory. Then amount withdrawn from this special account. If it is used for the specified purpose only, for the fund there is a specified purpose, right? For that purpose only it is used, then no action. But the asset purchased should be kept for a lock-in period of 8 years. For asset, machine meant for, sir, you purchased an asset, but that asset is meant for what? Office use, not for the real plantations related or site restoration related. Then amount utilized is taxable as what? Profit. Which section said? 41. Section 41 says it as what? Deemed profit. Then for any other business purpose the money has been used, then such expense is not allowed. Such expense is what? Disallowed. Then non-utilized or withdrawn, then also it has to be treated as what? Deemed profit under section 41. Okay, so if it is used for any other expense, such expense is disallowed. If it is used for purchase of an asset, then that amount has to be treated as income. Used, not used or withdrawn money itself, then also you should claim it as what? Deemed profit under section 41. Okay, if it is used for specified purpose, then no problem. So this is about section 35, expenditure on scientific research. Expenditure on scientific research. Sir, can explain once 33AB. Sir, 33AB is what? You are keeping a fund or an amount separately when you are into the business of tea, coffee, rubber. Okay, you have tea estate, coffee estate, rubber estate, and with the plantations, whatever the output you will come, you will only manufacture your tea powder, coffee powder, or rubber, and you're going to sell. Now the problem is what? For every 20 years or 30 years, the plantations has to be changed. Once the plantations are changed, for the coming 5 years, 6 years, you will not have any income, but you have to incur expense. For that, you are keeping some amount aside. Okay, you are creating a reserve for that side. So whatever the amount every year you are transferring to that reserve is also eligible for deduction, is also can be claimed as expense. How much can be claimed as expense? 40% of the profit or actual amount contributed, whichever is lower. Okay, now expenditure on scientific research. Sir, there are here two types, sir. One is scientific research related to your business only. You only doing scientific research which is needed for your business. Sir, you are a mobile company. Are you required to do research or not? Sir, Apple company without innovation, can it survive? Every year, okay, they have a research and development team, then they'll be spending majority of their, okay, not majority, most of the, okay, a significant share even on research and development also, because if they miss innovation, then they'll become outdated, the company cannot survive. Not only mobile, sir, pharmaceutical companies will be doing research and development for a new drug or for a better drug. Pharma companies will be doing research. These electronics related companies will be doing scientific research. Okay, car companies are into scientific research, new technology, new suspension, new braking systems. Okay, new technology in tires. So almost majority of goods related there will be scientific research. So you are having your own scientific research which is related to your business. That is one thing. Second one, you don't need to do any scientific research, sir. Let's say BCCA is there. What research BCCA has to do? No scientific research. Yes, we do research. Maybe we may give some much more better quality materials and all. But there is no research here. We need not to develop altogether a new kind of product here, right? So what is happening here, sir? But still BCCA wants to encourage scientific research. What we can do? Sir, why not? Let's say, not only we say any person engaged in business, but they wanted to encourage they wanted to encourage someone who is into scientific research. Any university or any lab or any other college, they are doing scientific researches. To encourage them, certain donations, kind of grants, contributions might be given. So here scientific research related 2 points we are discussing. One is in-house scientific research expenditure. Second one is like donation kind of has been made to someone else. That may not be related to your business. Sir, not related to your business, but still you did. Sir, someone went to Akhirin Nagarjuna and asked like, we are from a college, we are doing research on robotics and all, sir. You do some donation. He did some 50 lakhs as donation. Is it related to him? That donation? No. But still he can claim as deduction with respect to his business or professional receipts under section 35. Understand? Let's say they came to me also. I given some 10,000 as donation. Then the 10,000 also I can claim as expense under section 35. One part is related to your own business related research and expenditure. The other part is, no, it need not to be related to your business, but for general scientific and research upgradation, you are contributing. Okay. So in those two scenarios, how deduction is available, we need to discuss. Okay. Expenditure incurred in-house research. SSE is a company, SSE is any person. SSE is company, not SSE is other than company. Here what they are saying, sir, SSE is any person. That means here also company can be covered. But this is again for separately for companies. SSE is into business of biotech, manufacturing of any article or thing. Revenue expenditure, capital expenditure. Revenue expenditure, 100%, either revenue or capital expenditure, 100% of such is allowed as deduction in the year of expense itself. Understand, sir? SSE is a company. Business what? Biotechnology, manufacturing of any article or thing. Revenue expenditure or capital expenditure. What business, sir? Business of biotechnology or into manufacturing of any article or thing. What deduction you'll get? Capital expenditure also 100% deduction. Revenue expenditure also 100% deduction. Everybody, sir. 35. You are incurring research and development related expenditure. How much ever expenditure you incur, whether it is capital or revenue. Total expenditure you can claim as deduction in the first year itself. Okay, and even, but here capital expenditure excludes what? Land and building. Then SSE is any person. Here also who is covered? Company is covered. They also carrying scientific research related to business. Revenue expenditure 100% allowed. Capital expenditure also 100% allowed. Here capital expenditure excludes only land. That means building related also they can claim 100%. Here for building also they cannot claim deduction. Here building also they can claim deduction. Then which section is useful? This is useful. This is useful. This one only much more better, right? So even though it is for specific to companies, company can also come here, and for companies also this is only better. So in another way, the first one is completely irrelevant only, no. So then why in the first place they kept in such a way? Sir, previously these percentages used to be 200%, 150%, 175%, but later on they brought them to 100% only. That's why you feel like this part is useless. Okay? So now if you want to claim deduction for a company also, where it is better, the second branch related is only better. Okay? Why? Because except land, on all the other capital expenditure you can claim 100% capital expenditure as deduction, revenue expenditure also 100% deduction in the year of expense itself. Sir, next one. Sir, you do research before starting business or after starting business? Sir? Elon Musk doing research related to space technology, a rocket which has to be travel to space, and again it has to be landed safely so that passengers can travel safely. Now he'll do research first and then do business, or first he'll start business, booking tickets, everything he'll do, then he'll go for research. First research only, right? So research expenditure already incurred before commencement of business. That's why what this section says means even research expenditure on capex or revenue incurred prior to commencement of business also can be claimed as deduction in the year of commencement of business. Sir, but 10 years back, 20 years back, you cannot claim. Okay? It should be within 3 years. Within 3 years from the date of commencement of business. That 3 years past expenses alone you can claim as deduction. Before 3 years now you cannot claim them as deduction. Then contribution, nothing but donations made. If the donation is made to a research association, university, college, which is engaged in scientific research or social and statistical research. Sir, scientific research now we understood. What is social and statistical research? Surveys they will do. Okay, what are the public trends? What are the age trends? Okay, what products Gen Z is like? Okay, then on them only they're gonna focus. Let's say textile industry. Okay, the long back, 30 years back, they used to wear baggy pants. Again, that is a trend. So now a textile company used how to know that. Okay, the current trend or the current people are liking those products only. Otherwise, if they're still producing the same pencil cut kind of pants only, nobody will buy them. They'll be surveying losses. So okay, understanding those trends, understanding the demographics, understanding the patterns, comes under social and statistical research. So contribution made to a person engaged in scientific research, 100% deduction. Social and statistical research also 100% deduction. Or you made donation to a company, but that company is registered in India and the company main object itself is doing research and development, then also 100% deduction is allowed. Or you made contribution to a national laboratory, IIT, or a college or university which is carrying notified research. Sir, what is difference here? Here any scientific research, here notified research. Then government may say like, you do research with respect to defense items, you do research related to pharma items, then on the such notified research only they do, then also 100% deduction is allowed. Okay, so donations or contributions you made always 100% only. In-house also 100% only, both on revenue as well as capex. Capex excludes what? Land. Capital expenditure excludes land. Then here two things are there, sir, mainly in-house expenditure, donations made. Under old regime both are allowed as deduction, whereas under new regime only in-house research expenditure is allowed. If it is like contributions or donations made, it is not allowed. See, in-house research expenditure and contributions to others, old regime both are allowed. In new regime, in-house allowed, contributions to others not allowed. Sir, applicable for all the type of individuals. For companies, what is the new regime, sir? 115 BA, BAA, BAB. Cooperative societies 115 BAD, BAE, and for individuals 115 BAC. Individual HUF, AOP, BYHP. For all of them in new regime, these contributions to others is not allowed. But old regime, sir, both are allowed. Understood, sir? So, okay. So tomorrow we'll be completing this section 35 part and we'll be even solving the consolidated questions on PGBP also. Okay. But understand, you incurred certain capital expenditure with respect to scientific research, and on that you availed section 35 deduction. 35 deduction. But such capital assets, sir, you have been sold before the expiry of lock-in period. Then what happens? To the extent of deduction availed under 35, it is taxable under the head PGBP. Then in excess of 35 deduction, if anything is there, that is taxable under short-term capital gain. See, sir, same as like terminal depreciation kind of. Plant and machinery originally purchased for 10 lakhs. Section 35D deduction also how much? 100% of capex, 10 lakhs availed. So asset cost became nil. Now the plant and machinery is sold for 9 lakhs. Sir, 9 lakhs above the cost or within the cost? What is the original cost, sir? 10 lakhs. So the plant and machinery is sold for how much? 9 lakhs only. So that is total 9 lakhs you need to consider as business income. 9 lakhs within the deduction allowed. So recognize as what? Business income. If it is sold for 15 lakhs, sir, you claimed deduction 10 lakhs. But now the sale proceeds are how much? 15 lakhs. Up to the extent of deduction, business income. How much? Nothing but up to the amount of cost, it is business income. So up to 10 lakhs, it is what? Business income. Extra 5 lakhs is what? Short-term capital gain. So now we are moving on to section 35A, AB, expense for obtaining right to use of spectrum or telecom license. 35A or AB, expense for obtaining right to use of spectrum or telecom license. Spectrum fee before commencement of business. Before commencement of business. Then, Sir, to operate as a telecom company, you will buy spectrum, 2G spectrum, 3G, 4G, 5G. The spectrum license has to be taken from the government. It will be a lump sum amount, sir, bulk amount, like 50,000 crores, 70,000 crores, 1 lakh crores. That much big amounts will be there. So all that amount they cannot claim as, sir, that is also an intangible asset kind of. All that cost they cannot amortize in a single year. That would be amortized over a period of time. So what period they are saying? Take the total fee. From previous year of commencement of business to the previous year of expiry. From the date of commencement of business to the, sir, the license is taken before commencement of business. After you getting the license, you started business. After you getting the license, you started business. So not from the date of license, you'll start amortizing. You'll start amortizing, sir, you got license before commencement of business. So you'll not start amortizing immediately. Only from business is started. From that year, you'll start amortizing till which year? To the year of expiry, till which time the license or the spectrum is valid. Let's say it is valid for 10 years total. Then total divided by 10 years. Every year that part can be taken as deduction. If it is after commencement of business, then what? From the date of license, from the year of license to the year of expiry, check how many years. That has to be divided by, on total fee, this number of years has to be divided. Every year that amount has to be considered as, has to be counted as deduction. So part year, if any part years are there, that part years also has to be counted as full year. Sir, if the spectrum is sold, sir, this is what spectrum, just like as depreciation, you are taking what? Amortization. But here they are not giving any rate. Sir, actually this is intangible asset. You may think depreciation under 25%. No, there is a separate section for it. So 35A, AB. So telecom spectrum will not consider them as intangible asset and will not depreciate there. We'll be following this section only. What this section says? The cost of such license or spectrum has to be amortized over the tenure of license. Okay, generally it has to be taken from year of issue of license to the year of expiry. However, if it is taken before commencement of business, then year of commencement of business to the year of expiry, how many number of years are there? To that many years it has to be apportionated. If the spectrum is sold, let's say whole spectrum is sold. Sir, again, like terminal depreciation, you remember, right? Within cost, above cost, that one. Alarm 7 o'clock. When whole spectrum is sold, the total spectrum, sale price is less than unamortized amount. So let's say total 1 lakh crores spectrum. It is for 10 years. So every year how much will be claiming deductions are 10,000. Now the unamortized value is 70,000 crores. 3 years you claimed a deduction. Now WDV kind of only. Okay, how much is there? 70,000. So you sold this 70,000 for 60,000 only. The unamortized value is like 70, but you sold the whole spectrum for how much? 60,000 only. Loss again. Loss. Under where? PGBP only. That loss also PGBP. Where the sale price is more than unamortized. Sir, how much it is? 70,000. But you sold for 80,000. How much is the gain? The 10,000 where? PGBP. The 10,000 has to be treated as income under that PGBP. Okay. But you sold for 1,20,000. What to do, sir? Up to the extent of cost. How much? 30,000 crores has to be treated as business income. Above that 1,20,000 is there. That to be treated as what? Short-term capital gain. Understood, sir? Same examples, sir. Just like as what we discussed under terminal depreciation, same logic only. See, first case, 70,000 crores is the WDV kind of for the spectrum fee. You sold for 60. 70,000 value, you sold only for 60,000. Loss again. 10,000 loss. You have to charge it as deduction only, expense only under the business income, that loss. Sold for 80,000. 70,000 worth, sold for 80. How much is the gain? 10,000. The gain recognized as business income. Assume sold for 1 lakh. Up to the amount of cost only. Still that 30,000 we need to recognize as what? Business income only. But if it is sold for 1,20,000. Up to 1 lakh business income, above 1 lakh gain is there, na? That is short-term capital gain. Then if part of spectrum is only sold, sir, even if part of spectrum is sold also, you will calculate the same way, but proportionately you will do. That's what. Okay, 50% of the spectrum sold. Then compare with 50% of WDV. Okay, whether the amount is, you are getting loss or gain, you need to calculate, and the same treatment, proportionately you will do. That's what. Only a part is sold, you will do proportionately. So see here. Spectrum fee how much? 10,000 crores. Amortized 3,000. Unamortized WDV is how much? 7,000. Now, if it is sold for 12,000 crores, tell how much is taxable under PGBP, how much under capital gain? 3,000 taxable under PGBP, the balance 2,000 taxable under short-term capital gains. Okay, so then we are moving on to section 35 AD. Deduction on capital expenditure on specified businesses. There. Light Section 35 AD. Deduction on capital expenditure of specified business. Sir, 35 AD is available only in old regime. In new regime, it is not available. So as of now, additional depreciation not available in new regime. 35 contributions part not available in old new regime. Then 35 AD also not available in new regime. Okay. Sir, actually, this section was introduced. The government thought certain businesses are most needed for India to support the economic growth of country. Okay. The problem with these businesses are like, these businesses cannot be started with low investments. All these businesses require huge capital cost. They need to invest a lump sum amount. Okay, so since they need to invest lump sum amount, many are not coming into these kind of businesses. But if these kind of businesses are not there or not encouraged, then the country will not develop or country will not grow quickly. So government only took initiative and thought of giving some incentive or giving some kind of benefit to the ones who started these kind of businesses. Okay, so what is the incentive government is giving? They are saying like 100% of capital expenditure is allowed as deduction. Sir, even if this section is not there, every year they'll claim depreciation, right? Instead of claiming that expense in first year, they may claim it in 10 years. Sir, you purchased a building for 5 crores. What this section says, 5 crores you claim as expense in the first year only. But otherwise what you will do generally? 5 crores you'll claim depreciation every year. So roughly, even if you claim depreciation also, the total expenditure you'll claim it over a period of 10 years, 12 years, you'll claim the total capital expenditure as expense only in the name of depreciation. Here instead of depreciation, what they are saying like everything you claim as expense in the first year. So what is the real benefit, sir? Understand? So most of the businesses will have problem in the initial periods only. For the first 3-4 periods only is the most struggling period. Once they survive that struggling period, revenues will get stabilized, they'll get revenues. So okay, even the costs increase also they can survive. So this section is giving the initial benefit. Why? Sir, first year itself you claim 5 crores as an expense. You don't have obviously that much profit to charge all that expense. So you'll be in losses. These losses will be useful for set off even in the coming year profits also. So effectively, in the first 3 or 4 years, you will not pay tax because 100% capital expenditures you claimed first years itself. So because of that, you will be into losses. That losses are eligible for set off in the coming 2-3 years also. So initial period, you don't have tax cost. Okay, later on, whatever you saved in first 4 years, that will be again you paying in the you'll be paying from 5th year, 6th year onwards. But by that time, you'll already get stabilized. Okay, your revenues are stabilized. You're getting more revenue, so tax cost will not be something high for you. So initial years you'll get that benefit by availing this section. Okay, so what this section says, sir, 100% of the capital expenditure can be availed as deduction in the year of expense itself. Sir, what about revenue expenditure? Sir, revenue expenditure anyhow allowed as deduction. If it is covered under 30, 31 or 36, 37, all those covers revenue expenditures only, right? So generally also revenue expenditures allowed. So capital expenditure only usually we'll claim it as depreciation. But here instead of depreciation, what they are saying, 100% you claim in the year 1 itself. So that year 1 all your profits is eaten away by this capital expenditure and you will be almost entering into losses also. And that loss will even be set off with the second year profits, third year profits also most of the cases. So that in the first 2-3 years, you are not paying taxes. So which is a advantage for you by claiming this deduction. Okay. So 100% of deduction, capital expenditure allowed as deduction in the year of expense itself. However, capex excludes land, goodwill, financial assets. Land, goodwill, financial assets are building covered, which is not covered. Land, goodwill, financial assets. Okay. Conditions, sir. If you are incurring this capital expenditure above 10,000, then that has to be incurred through specified modes only. What are specified modes? Account pay check, account pay draft, electronic clearing system. Only those through those specified modes only you have to incur. Violation of lock-in period. We already discussed at the place of charging section only, sir. When 3580 deduction is away, the last point in charging section. When you fails to follow 3580 deduction, then whatever the sale proceeds are there, that has to be considered as income. But because of 3580, you lost one thing. By getting 3580 deduction, you lost one benefit. Which benefit you lost? Depreciation you lost. Why? 100, sir, again, link it to 41 actual cost also. Sorry, 43 actual cost also. There, if already 100% expenditure is claimed, for that asset, actual cost will take it as 0. So if it's 0 now, will not claim again depreciation. So by claiming 3580, you are losing depreciation. But the 3580 asset violated lock-in period and sold. So the proceeds has to be recognized as income. But after providing the depreciation, which they can avail, if from the beginning that asset is if the beginning the asset doesn't have any 3580, how much depreciation they might have claimed? Such depreciation you should have to subtract. Balance profit only you should tax. I mean balance receipts only you should tax. Eligible businesses. What are the eligible businesses, sir? Setting up and operating warehouse for agri produce, cold chain facilities for specified products, warehouse for sugar, beekeeping and production of honey, production of fertilizers. The first 5 or 2 support agriculture sector only, because even till more than 50% of Indian population is dependent on agriculture. Since majority is dependent on agriculture, first to support them, India have to bring certain facilities which will improve their economy, I mean, their agricultural business income, their agricultural income, or to support their basic agricultural activities. Warehouse for agri produce. Sir, what is the benefit of warehousing, sir? Sir, majority farmers will sell their crop instantly, even for a lesser price also, because they don't have the place to store. That's why they'll sell immediately. But if warehousing facilities are available easily, then they also may come and store them in the warehouse. Once the prices stabilizes, once the price increases, then they have the chance to sell them. Okay? Or sometimes, forget about price also. They thought of keeping them for some 3-4 days only because of non-availability of seller. But within that time only, there may be some rain or something and these food grains getting damaged. That's why warehouses should be freely available at every place. So they wanted to encourage warehouses. Then cold chain facilities. Sir, certain items can't be stored in the general warehouse. They have to be stored in a cold storage. Michi. Okay? Then apples, they'll keep it in cold storage, and also these kind of things has to be kept in cold storage. So cold storage facilities also. Then warehousing of sugar, beekeeping and production of honey. Honey is related. Production of fertilizers, because only when fertilizers are available adequately. So even in 2-3-4 months also in Telangana we have seen there is urea crisis. Okay, so people has been fighting, or people has been coming on roads that there is no adequate fertilizers availability also. So only when the fertilizers are available freely, Sir, and even 10, 15 years back also, there is so much scarcity regarding the fertilizers, because in June, July, everybody starts the crops. Okay, that time everybody wants to put those fertilizers and all, but the stock may not be available. So that's why more fertilizers companies should be there. With competition, fertilizers costs also will come down, and then they are easily available to the farmers also, that one. And then building and operating 2-star and above hotels to encourage tourism, sir. If any tourist comes now, they cannot usually stay in the normal hotels, so they want minimum 2-star and above hotels for that one. Then hospitals. Why hospitals, sir? Again, for the basic healthcare facilities. A country will be considered as grown only when the healthcare facilities are good. That's why they thought of providing better healthcare facilities. So they want to encourage hospitals which are having seating capacity of more than or equal to 100 beds. Sir, 100 beds now, how? It's not like the normal Amirpet hostels will be there, sir. Okay, 100 beds now, like bed after bed, bed after bed, bed after bed will be there. Not like that, sir. Capacity. It's not just you can fit 100 beds or not like the sleeper. In bus we'll see, right, sleeper coaches. Double decker kind of there. Okay, not such kind of capacity, sir. The capacity is like general as per the norms. Then developing and building houses. You are a contractor, you'll build houses. Under which scheme? Slum redevelopment or rehabilitation scheme. Okay, slum redevelopment or rehabilitation scheme, or under a notified scheme for affordable housing. So government has introduced this double bedroom houses being given. Okay, so they will only construct apartments kind of. In that, the flat has been allocated for ones who are not having house or underprivileged who need them. Their governments are giving. So if you are a contractor constructing such kind of projects, then you are also eligible for 35% reduction. Laying of cross-country pipelines for oil and gas. Why these pipelines are important, sir? Now Iran is, so at a sea place, sir, they are actually for the sea ships to transport. The sea becomes, or the place becomes narrow. So through that narrow place only the ships has to sail, or ships has to come. Now Iran has blocked that way. So they are allowing only China ships to go, other country ships, because China given them oral support. Not actually, they didn't send any war-related items also, war-related help also, they didn't did oral help. We are extending our support to Iran publicly, they said that one. So that's why they are allowing only China ships. So other Arab or other Middle East related ships are not able to come. So crude oil is not coming. But that's why, sir, cross-country pipelines are also there. Sir, now even some petrol is coming now. How it is coming? There are already pipelines, but only 30-40% of the total petrols will be exported through pipelines. Balance will be still transported through ships only. Now, laying of cross-country pipelines for oil and gas. So if anyone is engaged in laying these pipelines for oil and gas, they are also eligible for 100% deduction. Sir, it doesn't mean connecting different countries only. Within the country, if they lay pipelines also, that comes under cross-country only. Sir, we have pipelines connecting from here, Kakinada, KG Basin to Gujarat. We have gas pipeline. Okay, many times we'll see even here in the Godavari districts, we'll see, sir, the gas will be emitting. There'll be fire will be coming like, okay. So there is a ONGC pipeline which is going on from Kakinada, because there is a Reliance has a gas extraction basin there in the sea. From there is a pipeline connected till Gujarat. The pipeline went, sir. ONGC has laid that pipeline, so that is eligible for 35% deduction. So, okay, and we have even pipelines with other countries also to export petrol and all. They all come under cross-country pipelines. Then laying of slurry pipeline for transportation of iron ore. So slurry iron ore, now we think iron is like a metal. It will be hard substance. How it can be transported in pipeline? So iron will be collected in small particles which gets mixed with mud and water. Okay, so it's not like directly we'll see iron rods and all. Or else like rocks kind of, it won't be there. It will be in small particles, they'll get filtered it, and then we'll be getting the iron ore. So through slurry pipelines, it gets mixed with water, and then the iron particles are being transported along with them. So for that transportation, slurry pipelines will be used. Those pipelines are also eligible for 35% deduction. Then setting up of an inland container depots. So inland container depots are nothing but, if you are even simultaneously listening IDT class, customs warehouses. Under customs we see warehouses, right? So those warehouses only we are calling them as inland container depots. Warehouses for keeping the export goods and import goods. Why? Again, they are needed to encourage our import and export. The last one, sir, setting up and operating a semiconductor wafer fabrication units. Sir, the semiconductor wafer fabrication units, the electronic chips we use in different gadgets, motherboards, processors, all these will come under the semiconductor wafer fabrication units. So to encourage such businesses, okay, these are called as what? Specified businesses. It's okay, no, sir? Specified businesses, what is the benefit, sir? 100% of the expenditure can be claimed as deduction in the year of expense itself. Yes or no, sir? Which are excluded from capital expenditure here? Land, goodwill, financial assets, shares, debentures, other investments made, they are not covered. Okay. Capital expenditure should be incurred only in specified modes in excess of 10,000. Otherwise, they are not eligible for this deduction. Then, sir, actually here, 2-3 sections missed, sir. Let me open in the pulse and I'll explain there. There will be preliminary expenditure and VRS expenditure also. Okay, let me first explain these three, sir, then we'll go to them. Contribution to rural development fund. It may be a national rural development fund or notified urban poverty eradication fund. To what fund, sir? Rural development fund. Okay, you are like Mahesh Babu in Srimantudu. Okay, you wanted to develop. Okay, sir, Mahesh Babu spent so much money. Okay, he adopted a village there. Okay, I also want to adopt, but the only problem is like my father is not. Okay. So understand, sir. So even the Jagapati Babu has businesses, right? So whatever the money spent by Mahesh Babu in that village, they might have claimed as deduction under 35 CCA. Why? Because they are contributing. Okay, so even though in movie they shown like such a way, but actually in real sense, if you see, actually also Mahesh Babu adopted 2-3 villages like in 2014 something. Many celebrities has adopted villages that time. The whole that movie period, this adoption concept went viral. Okay, Sachin came and adopted a village even in Andhra Pradesh only. So many villages has been adopted by celebrities. They try to develop those villages under. So how do they develop? They'll not directly give the fund. Okay, they may be contributing to those notified rural development funds. Through those funds only the money will be spent there. So then they can claim that money as what? Expense or deduction. Okay, at least 30% tax saving will be there. You spend 1 lakh. Otherwise on that 1 lakh, anyhow tax you need to pay 30 to 40%. If such charge all those are there, 40% will go for tax only. So effectively you are spending only how much? 60,000, but you are getting the recognition for spending of 1 lakh. Okay, so that's why, sir, contribution to rural development, if any contribution is made to national notified rural development fund or notified urban poverty eradication fund, then that is eligible for deduction irrespective of any SSE. Then expenditure on notified agri extension project. Sir, agri extension project now, sir, these companies are closely allied with agri produce. I mean, for them the major raw material is agri produce only. Sugar factory. What is the raw material, sir? Sugar cane, right? So such kind of allied industries where the immediate raw material source is nothing but agri produce. So those companies or those businesses may have this agri extension project. And agri extension project, they'll educate farmers. Like how crops has to be made or what kind of, sir, within sugarcane also there may be different varieties. Okay, so which variety has to be used considering the local and soil conditions, how the fertilizers has to be used, okay, and doing the soil testing and suggesting them the right crop, okay, helping them in fixing the spot for borewell and all, or fixing the point for borewell and all this, and even in the growth stage of the crop also, those people will help them in, if any insect are there, then they'll be helping them in suggesting the pesticides to be used and all. So all these come under agri extension project. So the amount spent on agri extension projects is eligible for deduction 100%, but only under old regime, not under new regime. So contributions to agri extension projects or amount spent on agri extension projects is eligible for deduction only where, sir? Old regime. Then expenditure on notified skill development project. So notified skill development project na certain skill development programs and all will be there, sir, to give training, okay, by the manufacturing industries and all. That is also eligible only to company, and that also only in old regime only. So two sections are here. Notified agri extension project and notified skill development project related contributions are made. 100% deductions allowed, but only under old regime. And this notified skill development project related deduction is available only to companies. Here, sir, for notified skill development project, capital expenditure also allowed as deduction, but capital expenditure excludes land and building. So actually, these sections are missed in handwritten, so we'll be discussing in the material only. 35, amortization of preliminary expenditure, amortization for expenses for amalgamation and demerger, 35DD, 35DD a VRS expenditure, 35E expense incurred for prospecting and development of certain minerals, page number 3.32. Preliminary expenditure. Preliminary expenditure means what? The expenditure incurred prior to commencement of business. The expenditure incurred prior to commencement of business is called as what? Preliminary expenditure. 35DC is for what? For new undertaking. Sir, this expenditure is allowed as deduction for a new undertaking because before commencement it might incur some preliminary expenditure. Or in existing undertaking only, it was expanding. So in the process of expansion, again it incurred certain preliminary expenditure. So preliminary expenditure now, that prospectus for bringing share capital, prospectus fee, MOA charges, AOA charges, and legal related approvals if they need, now those legal charges, the drafting related charges, prospectus issue charges, all those will come under the preliminary expenditure. Whether they are allowed or not, if so, how much is allowed? Company, only if it is an Indian company, preliminary expenditure is allowed as deduction. How much is allowed, sir? Cost of the project, or 5% of the cost of the project, or 5% of capital employed, whichever is higher, we should calculate first. 5% of the cost of the project. I mean, how much investment you gonna make? The total of your fixed assets, cost of the project, or 5% of capital employed. What is capital employed, sir? Equity share capital plus reserves and surplus plus long-term borrowings together will be called as what? Capital employed. So 5% of capital employed, 5% of cost of the project, whichever is higher. Compare it with the actual preliminary expenditure. First you should do whichever is higher. Whichever is higher of what? 5% of cost of the project or 5% of capital employed. Whichever is higher. Okay, step one. Then that has to be compared with actual preliminary expenditure, actual expenditure. Out of these two, whichever is lower is the allowable preliminary expenditure. See, actual preliminary expenditure or step 1, whichever is lower. So the answer in step 2 is only called as what? Allowable preliminary expenditure. This allowable expenditure is not allowed in the same year. It is allowed in 5 equal annual installments starting from the year of commencement of business. Okay, so preliminary expenditure can be claimed as deduction in the same year of 5 installments. 5 installments. That also not the actual. First we should compare 5% of cost of the project, 5% of capital employed, whichever is higher. Then compare it with actual, whichever is lower is called as the allowable preliminary expenditure, which has to be taken as deduction in 5 equal annual installments. This is for whom? Company. This is for company. Any other SSE if he is resident. Any other SSE if he is resident. Okay. How much is allowed? Actual or 5% of cost of the project, whichever is lower straight away. And that has to be taken as deduction in 5 equal annual installments. Actual or 5% of cost of the project, whichever is lower is allowable. That allowable you can claim as deduction in 5 equal annual installments. 35 DD. Okay, this we'll discuss even in business restructuring chapter also, because amalgamation, demerger points and all we'll be discussing again in business restructuring, but simple section only, sir. If SSE is an Indian company, he incurs any expense with respect to amalgamation or demerger, such expense, instead of claiming as deduction in the year of expense, it has to be claimed as deduction over 5 equal installments. So let's say 5 lakhs incurred. First year 1 lakh, second year 1 lakh, third year 1 lakh, fourth year 1 lakh, fifth year 1 lakh. Like that they can claim deduction. It should be exclusively for amalgamation or demerger, and at no other place such expense is allowed as deduction. Then such expense can be claimed as deduction here. Then VRS expenditure. If employees are going on VRS, you made a VRS settlement. Okay, they for retiring or for taking VRS, you are making a settlement VRS. Sir, you understand? Sir, what is the settlement? Why we need to do settlement, sir? Whatever the PF statutory funds are there, that only they'll take now. Why again settlement, sir? Understand? Most of the companies, especially public sector companies, will introduce VRS programs. Why VRS programs now? These people are in government companies, they might have joined 30, 40 years back. They were outdated. Okay, they doesn't give any value addition to the company in the current situations, because they don't know how to use technology and all. But they are getting high salaries like 3 lakhs and 4 lakhs. So it's already a burden to the company. Now what companies feel like, instead of carrying them every year, we'll settle them once and will recognize as a cost, and then from next year onwards they can check their real profit or how they are performing under. Okay, SBI has did that. Okay, some 4 or 5 years back, SBI has identified in their manager kind of, I mean most of the employees who are at the branch level manager kind of, or people with an age of 45 to 53, 54, those age people, they have joined 20 years back before this IT revolution, and they cannot cope up with this IT revolution. Okay, they cannot perform well, they cannot cope up with the technology which was there in the bank systems now. So they were not useful to the banks anymore. So what they thought, they are okay with paying lump sum amount now. Okay, because they'll take it as like one-time cost, and from next year onwards, they can check their efficiency properly. Okay, that's why they'll encourage employees sometimes to take the VRS also. So they'll incur lump sum amount in a year, because sir, SBI, it has lakhs of employees. Out of those employees, 1,000 employees, the scheme, VRS scheme was launched, and 1,000 employees has been taken VRS in the same year. Then it would be a bulk or lump sum amount, sir. It would be somewhere like, for each employee, almost 1 crore rupees paid as VRS amount also. 1,000 into 1 crore, 1,000 crores expense they have incurred. All the 1,000 crores, they cannot claim as deduction in the single year. It has to be apportioned over 5 equal installments. And only when it is paid, it is allowed as deduction, not on accrual basis or only on cash basis. Amortization of expense incurred for prospecting and developing of certain minerals. So this prospecting and development, this expense they'll incur before they start extraction. They found out there is a mineral reserve there which is capable of being explored. But to make the site ready for exploration, before commencement of business only, they might be incurring certain preliminary kind of expenses only. All that expenses are captured here. That expenses can be claimed as deduction, not in 5 installments, or in 10 equal annual installments if SSE is an Indian company or any SSE who is a resident. Okay, so what are all these sections, sir? Preliminary expenditure, how many installments? 5 installments. Then amalgamation or demerger expense, 5 installments. Then VRS expenditure, 5 equal annual installments. Whereas expense related to prospecting and development of minerals, 10 years or in 10 equal annual installments. Sir, asset was acquired in foreign country by taking a loan in foreign currency. Okay, you purchased for some $10,000. By taking $10,000 foreign currency loan, you purchased an asset. At the time you purchased, the dollar value is 90. So 10,000 into 90 now how much? 9 lakhs. But later on, the dollar value, when you are repaying the loan, the dollar value has came down to 85. So you had an exchange gain of how much? 5 lakhs. Actually, you thought your liability will be 9 lakhs, and recognized asset cost also 9 lakhs, liability 9 lakhs. But at the time of settlement, what happens, sir? 85 only foreign currency. So the liability was settled for 8,50,000 only instead of 9 lakhs. So what that 50,000 has to be done? That 50,000, since it is related to capital asset, reduced from block value. reduce from asset value, sir. In simple, whatever the gain related, that you have to subtract from asset. Sorry, gain you have to subtract from asset value, sir. But instead of 85, it became 95. Then what? Instead of 9 lakhs, the liability became 9 lakh 50. You paid extra 50,000. That extra 50,000 also add to asset cost. Okay. Then 43A not we should treat as per ICDS 6. Okay. Let me show you ICDS 6 also. Sir, what they are saying, like foreign currency transactions. If it is a monetary item, initially we'll recognize at what? Actual rate. At the year end, make it to market by using what? Closing rate. Sir, you purchased raw material. Creditor is there. Okay, how much is the creditor? $10,000. You recognize that 90. This is the initial recognition. 9 lakhs you have to pay. Year end, you need to do it for mark to market. I mean on 31st March, whatever is the closing rate is there, with that rate again, you re-arrive your liability. That time it is 92, sir. $10,000 at a 92. So how much you have to pay, sir? 9 lakh 20. So extra 20,000. So there is loss of 20,000. That loss, you can claim it as what? Expense. If it became 88, so how much it is there, sir? Gain 20,000. That gain you will charge to P&L. It is what? Taxable. Okay. So initially mark to market this is. Then again at the time of settlement, again at the time of, sir, now what? So the foreign currency transaction, you will recognize at the actual price on the date of transaction. On the year end, again you recompute them with the closing price and you will recognize mark to market loss. Sir, on year end, whatever the gain or loss you are, you are calculating, that's not realized gain or loss because you didn't make the payment. You just reframe the transaction or revise that, shuffle the transaction by taking the new values on the closing day. So that is called as what? Mark to market loss, not the real loss or gain. But still, that expense loss, we can take it as expense, gain is taxable. On settlement, again by the time of settlement, sir, on 31st March, this is the rate. They are settling it in May. At the time of May, again it may go to 93 or again come back to 90, 89 also. So again, if it is gain, charge to P&L taxable. If it is loss, again claim it as an expense. Okay. So in simple, sir, foreign currency transactions, if they are related to other than capital expenditure and if they are monetary items, they can be easily identifiable in monetary terms. Then what to do? We need to do mark to market on closing day. We need to revalue the assets by using the closing rate. The gain, taxable, loss, chargeable as expense. And again at the time of actual settlement also, again you recompute the gain or loss. Okay, that gain again, taxable, loss, allowed as expense. If these are like non-monetary items, initially recognized as actual rate, but at the year end you need not to market them. Sir, actually, okay, now let me correct my example, sir. Creditor is not a monetary item. If you have any foreign exchange instruments, like foreign exchange swap, or any option, or any derivative, or any future, which is designated in foreign currency, then they'll come under monetary items. If you have a creditor, sir, creditor is not a monetary item, it's a non-monetary item. So for non-monetary item, what they are saying, recognize initially at actual rate. Year end you need not to again compare or recognize the profit or loss based on mark to market. See, mark to market not applicable. Directly at the time of settlement only you have to calculate gain na taxable, loss na allowed. So you need to check whether that foreign currency related transaction is with respect to monetary items or non-monetary items. Monetary item na year end mark to market also you have to do. Non-monetary items means year end mark to market you need not to do. Directly at the time of settlement only you have to do gain or loss. So see 43A and 43. Asset acquired from foreign country using foreign currency loan. 43A, asset, capital expenditure. 43A, all other foreign exchange differences. Under 43A, if there is any forex difference, what we are doing, either adding to asset value or subtracting from asset value. Under 43A, what we are doing, treated as income or loss. Loss, we are adding to block. Here loss, no loss, allowed as loss expense. Gain, reduced from block. Here taxable as income. Here items covered. What are covered? Capital items, capital assets. Whereas here monetary and non-monetary items, foreign operations, forward contracts, and foreign currency translation reserves. All these are covered. Okay. There is no relation between 43A and 43A, sir. This is for capital items. These are other than for capital assets. So then, sir, this is a section. Similar section will be there even in capital gains also. Section 43 CA. Consideration on transfer of immovable property. Consideration on transfer of immovable property. SSE. Transfers land, building or both. Sir, immovable property na capital asset. It's not always capital asset, sir. This SSE is into real estate business. Then land building will become his what? Stock in trade. For normal businesses now, land and building will become capital asset. For a real estate person, construction business, for them, land and building will become their stock in trade. So those people transfers land, building or both. Sir, if you are, for you land building is stock in trade, na, then 43 CA will come. For you land building is capital asset, na, then 50 C will come. Both sections same logic. Okay? Sir, you are selling a immobile property. Whether that immobile property is stock in trade or capital asset, when will become stock in trade to you? If your business itself is buying and selling properties, nothing but real estate, then for you selling immobile property will come under business. It is a stock in trade. 43 CA is applicable. When you are selling immovable property, which is your house or which is your office building or factory building, then it is not a stock in trade, it is a capital asset. Then which section applicable, sir? 50C. 50C. So 50C provision, 43CA provision, both same only. Okay, but 50C will come under capital gains head, 43CA will come under PGBP head. Are you able to understand, sir? Okay. Now, you got some consideration. On sale of immovable property, you got some consideration. Let's say how much? 105 lakhs is the consideration you got. But the stamp duty value is 130 lakhs. So, immovable property you transferred, you sold for a price less than stamp duty value. What is stamp duty value? 130. You sold for 105 lakhs only. So, consideration less than stamp duty value. Sir, consideration more than stamp duty value. Then no problem. This section doesn't have any relevance. This section has relevance only when consideration is less than stamp duty value. Okay. If not less than stamp duty value, no. Take actual sale value only, no problem. Yes. Check whether 110% of sale consideration is greater than STV, actual sale consideration. So, how much? 105 into 110% do. 105 into 110% because the consideration is 105 here. 115.5. Still, consideration is more, stamp duty value is more. Still, even on comparing, sir, they given even 10% variance also. So, okay, stamp duty may be higher. Still, if it is within 10% range, they want to excuse that one. They don't want to invoke 43CA. But the problem is what? The stamp duty value is more than that of 10% difference also. So you compared with 110% of sale consideration, still which is higher? Stamp duty value is only higher. Okay, check 110% of actual sale consideration with stamp duty value. If then actual sale consideration is greater than STV, sorry, even then actual sale consideration is less than stamp duty value. Yes, then stamp duty value only you have to take as sale consideration. No, then original sale consideration only the sale consideration. Okay, sir, this section talks about deemed sale consideration. What is deemed sale consideration? Stamp duty value can be taken as deemed sale consideration. In which situations? When an immovable property like land, building or both is transferred, stock in trade na 43CA section will come, capital asset na 50C section will come. Okay. Straight away, just because the consideration is less than stamp duty value, will not take stamp duty value. We need to compare again 110% of the sale consideration with stamp duty value. Even then, stamp duty value is only higher. Then no other option. You have to take stamp duty value as the deemed sale consideration. But still, you are not giving up. You are still arguing like stamp duty value. You are still arguing like what? Stamp duty value does not reflecting the market price is your question. Okay, you are saying like what? Sir, stamp duty values were not updated. They were kept at higher prices, just like as Amravati boom. Okay, 2014 to 2018, sir, the land rates were increased drastically. So the stamp duty rates also increased. But when in 2019 the government changed and they introduced about this three capitals concept, then the total prices in Amravati fell down. But the stamp duty value didn't fall down. So stamp duty value is at a higher place only, but the original market rates are below stamp duty value. That is a genuine concern there. So when they sell any land, obviously stamp duty value will only be more than that of actual sale consideration. So if you take stamp duty value as actual sale consideration, you need to pay more tax, more capital gain. That's why what you can do, you can appeal directly. Okay, what assessing officer doing? Taking stamp duty value as sale consideration is wrong. You can go for an appeal. Or else you can ask the AO. AO may refer the case to a valuation officer. Now valuation officer will come into picture. Okay, he is a man who came for settlement. Where SSC contents fair market value is less than stamp duty value. Appeal, consider, you can go for appeal. One option. Consideration is nothing but as determined by the authorities in appeal. Otherwise, AO may even refer the case to valuation officer. Now who will fix the price? Valuation officer. Sir, what is your actual sale consideration? 105 lakhs. Stamp duty value is how much? 130 lakhs. This man, valuation officer, came for what? To resolving the dispute only, right? He came and said like, stamp duty value 130 lakhs is also wrong. Market value is 200 lakhs. Valuation officer coming and saying like what? Market value 200 lakhs. But you are saying like for what value sold? 105 lakhs. Whereas stamp duty value is how much? 130 lakhs. Now the question is, since valuation officer is saying 200 lakhs, can we take 200 lakhs as sale consideration? Are you able to understand my point, sir? Okay, let me show you. What is the value you are saying? You claimed 105 lakhs is the sale consideration. What stamp duty value is? 130 lakhs. Now valuation officer coming and saying like what is the value? 200 lakhs. Sir, he came for settlement to increase the issue. Settlement. So one, sir, how do settlement works generally? If two parties are fighting, he'll take it much more. He's not even taking to the other side also. He's like far beyond he's taking. That's not advisable, right? So if valuation officer says beyond SDV also, this is not applicable. Maximum SDV only can be taken. Even though he says 200 lakhs, the consideration will be only 130 lakhs, only to the extent of 130. Or another extreme. Okay, you've given him some gift and something. So he's saying like 50 lakhs is only the market value. Now this extreme also we cannot take. Minimum we should take as what? 105 lakhs as sale consideration. So if valuation officer says below the actual sale consideration, then take actual sale consideration as the sale value. If valuation officer says beyond stamp duty value, then stamp duty. So the valuation officer, even though he fixes bigger prices, stamp duty value is the upper cap, lower cap is what? Actual sale consideration. Okay. If he comes here and says like 120 lakhs is the market value, then he has some importance. So this 120 lakhs will be taken as what? Sale consideration. So nothing but valuation officer has to fix something in between actual consideration and stamp duty value. If he fix beyond stamp duty value also, stamp duty value only will take as sale consideration. Below market value, below actual consideration also, actual consideration is only the minimum sale consideration to be taken. So this is the minimum to be taken. This is the maximum to be taken. Even if valuation officer says beyond this, this is only the max. Even if valuation officer says less than this, this is the minimum. If something is in between these two, then only valuation officer price will be considered. See, VO fixed value is greater than stamp duty value. He fixed value greater than stamp duty value. 200 lakhs example. What he will do? Take stamp duty value only will take. Here, VO price less than actual sale consideration. Actual sale consideration 105 is saying 50. Then what will take? Consideration equals to actual sale consideration. Between actual sale consideration and SDV, then consideration equals to price fixed by AO, or price fixed by VO. Okay. Here, there will be one more point also, sir. If there are two stamp duty values available, which stamp duty value has to be considered? On date of agreement, one stamp duty value is there. Date of registration, another stamp duty value is there. Which stamp duty value has to be considered? The stamp duty value as on date of agreement can be considered. On that day, there should be a written agreement, and consideration should be paid wholly or partly, that also through specified modes. Sir, they may be simply saying like there is a date of agreement. There should be some proof that, right, that there is a real agreement is there. So there should be a proof of agreement, that stamp paper or something might have been written. Second one, the consideration either wholly or partly paid through specified modes. Paid through specified modes. It's okay, sir. We'll solve a question now. Open workbooks. Sir, this also same question only, sir. We already solved yesterday. QQ trading company, proprietorship converted into a company. Okay, at least today. Okay, right now. In business restructuring, I given one question. And this one, QQ trading company also, you need to solve on your own. This question number 2 also, same thing, sir, actually. In restructuring, this is the same question, is there, right? Okay. So if you do the business restructuring question or this question number 2, both are same only. The same question is there in 2 chapters. Okay, question 1 and 2. Done. Then. Okay, we'll solve this question, sir. Question number 5. So first read the question, sir. The statement of P&L of Radhe Private Limited, which is a closely held company, which is engaged in manufacturing and trading of FMCG goods, fast moving consumer goods, show a net profit of how much, sir? 10,40,000 for the financial year under 31st March 2026 after charging the following items. So we are having items which are debited to statement of P&L, and we are having even additional information also. First one, interest amounting to rupees 35,000 for short payment of advance tax paid as per section 234B related to assessment year 26-27. Allowed or disallowed? Sir, normal interest allowed only, but this is what? Income tax related interest. So originally it is allowed, but as per 40 subsection A, there is a point related to income tax paid, cess paid, surcharges paid, interest paid, all these are, it is allowed. So the disallowance is under section 40 subsection A, there is a disallowance for it. Then cash payment 78,000 made on 1st October. It includes 46,000 paid to farmers. Sir, what is the provisions are there, sir? In excess of 10,000, we should make through specified modes. But there are certain exceptions there. What are those exceptions? One among them is like agriculture, horticulture, if you make any payment. That's why this 46,000 is what? Fine. Then, and 32,000 for transporters. Sir, for transporters, what is the limit? 35,000. So this is also within the limit. So 46 to 32, both are within the limit. So no disallowance at all. It is allowed. So since it is allowed, nothing to be done. Sir, already these items are what? Debited. Already debited, they already claimed them as expense. So what we have to do? We also have to check whether it is an expense as per income tax or not. If it is an expense as per income tax, no problem. If it is not an expense as per income tax, then we need to reverse it. To reverse, we'll do add back. So first point, what we should do, sir, 48 is allowed. We should do what? Add back. Second point, nothing to be done. Nothing to be done. No adjustment at all. Third one, depreciation as per Companies Act. Depreciation as per Companies Act, we should add back. And this depreciation as per income tax, we should subtract. Provision for income tax. Okay, that is not allowed as a deduction. Then contribution to electoral trust. Political parties and electoral trust. Sir, it is allowed under 80 GGB, since it is a company. Under PGBP head, it is not allowed. So what we should do here? Under 37 explanations, we wrote this point, sir. Then, interest on term loans obtained from cooperative bank, not paid by the due date. Which section? So we have hardly 4 sections for disallowances. This is one among them. Which section? 43B. So what are the items that are there under 43B? If the class goes the same way like this, then from next class onwards, immediately I cancel the session and I'll go. I'll take live class. What's the purpose of you coming to the face-to-face class? I don't understand when you don't revise. Why I have to revise every day 10 minutes? Why I have to tell everything 2 times, 3 times when you don't revise and come? I have explained, I have revised the same disallowances 4 or 5 times in a fast-track batch. And you guys don't even have time to revise also. Why you are coming, I don't understand. You think you will clear easily? A simple disallowance also, you cannot connect it. And it's not surprisingly I'm solving problems also. Yesterday also I said tomorrow we're going to solve questions. So what's the purpose of you going to come to solve the questions? If I need to explain, why you have to be here? If you cannot reconnect a point, if you cannot connect it, see, what theory if you discuss, at least by the problem time, you have to connect the point at least. So that comes when you listen 10 times, will you do that? If you don't put effort, how do you get? Okay, it's not about this chapter. Then there comes some other tough chapters also. NR taxation will come. I'll devise the whole provisions and all. But still, by the time we go into the questions, you cannot connect one point also. Now, what's the point? When you will clear? Interest on term loans. Interest on term loans obtained from cooperative banks, sir, 43B, if you could refer here. Deductions allowed on payment basis. So, okay, under 43B, there are certain expenses which are allowed only on payment basis. What are those? Tax, duty, cess fee, employer contribution to PF, bonus commission payable to employees, interest on loan paid to public financial institutions, state finance corporation, investment corporation, scheduled bank, NBFCs, cooperative societies. If any interest is being paid and on 31st March it could be outstanding, but by the time you file written off income, it should have been actually paid, then only it is allowed as deduction. What is happening here? Interest on term loans obtained from cooperative banks not paid before the due date. Then, sir, interest paid by the time of due date, not paid. Not paid. So is it allowed or disallowed? 37 allowed only. Sir, once again I'll explain from each and every point. How to solve. First, every expense, check whether it covers under 32, 37 or not. Then think of disallowances. First point, interest 35,000. As per 37, it meets all the conditions. What are the 37 conditions? Not covered under 32, 36. Interest not specifically covered. Not a personal expenditure. Not a capital expenditure. After commencement of business. Okay, not a violation of law. Interest is not violation of law, sir. Penalties are only violation of law. And even in 36 also there is one interest. Borrowed capital, asset related, now you should capitalize other interest and all. Revenue expenditure allowed. So this also can be revenue expenditure. So either under 36 or 37 it is allowed only. But why this expense we are reversing, we are adding back? Disallowances. What are the disallowances we have under section 40? First 40 subsection A clause 1 and clause 3, sir. Where an SSE is making payment to a non-resident or to a foreign company. Okay. Interest, royalty, fee for technical service, salary. Those 4 amounts. And then any other income which is chargeable to tax in India. On them if TDS is not deducted or deducted but not paid, then how much of the expense is disallowed? 100% is disallowed. Okay. When subsequently it is paid, again it is re-allowed as deduction. Then 40 subsection A clause 1A, it is about SSE making a payment to resident and such incomes are chargeable to tax to the recipient. Then on them TDS has to be deducted. If TDS non-deducted or not remitted to government by the due dates of written off income, then 30% of such expense will be disallowed. Then state government corporations paying any royalty fee, license fee, privilege fee or any other name to state governments, then such expense is disallowed. Then expenses like income tax, any tax leviable on profits like income tax, surcharge, cess or any interest leviable on them, all those are not allowed as, or all those are disallowed. Then last one we discussed about tax paid on non-monetary perquisites provided to employee. The tax element again is not allowed as a deduction, nothing but it is disallowed. Then we went to section 40 capital A. 40A is about what? When a payment is made to specified person in excess of fair market value, then such excess is disallowed. Then 40A3, cash payments related, where a SSE is incurred any expenditure and for such expenditure is making payment in excess of rupees 10,000 to a person in a single day in any mode other than specified, disallowed. What are specified modes? Account pay check, account pay draft, electronic clearing system, done. Then if any provision for gratuities are there, disallowed. Actual contributions or actual gratuity paid is only allowed. Any contributions to employee welfare funds, if the real or genuine benefit is not passing on to employees, then such expense is also disallowed. Mark to market loss, allowed by ICDC, fine, otherwise disallowed. Okay. Then we came to 43B. 43B talks about the list of expenses which are allowed as deduction only on payment basis. Only on payment basis. There, employee related 3 points are there. Leave salary, contribution to employer share of contribution to PF account, then bonus or commission paid to employees. These three expenses allowed as deduction only when they are paid, actually paid by on or before the due date of return of income. And the other three are related to government related. One thing is like statutory dues, any tax, duty, cess fee payable to government. The next one is like interest payable to banks, PFIs, cooperative societies, scheduled banks, state financial corporations, that one. The last one, any amount payable to Indian Railways for usage of their assets. Okay, then micro small enterprises, MSE. Okay, when the payment is to micro and small enterprises, we need to check whether there is an agreement or not. If there is an agreement within 45 days, the payment has to be made from the date of completion of service or good. Then no agreement within 15 days. That is 43B. Then the last dissolvency is about 40B. 40B is about what? Interest and remuneration. Interest in excess of what percentage is disallowed? 12%. Remuneration also there is a limit. What is the limit, sir? First 6 lakhs of book profit, 90% or 3 lakhs, whichever is higher. On excess of 6 lakhs, 60% of book profit is allowed. In case of book loss, 3 lakhs is allowed. Okay, no? So all these provisions, when I revise, then you answer, it's of no use. You need to get those points when you are solving a question. Exam బయటకు వచ్చాక నాకు తెలిసి అంటే ఏం ప్రశ్న సార్, ఎగ్జామ్ లోపల ఉన్నప్పుడు రావాలి. Okay, the statement of P&L of Radhe Private Limited, which is a closely held company which is engaged in the manufacturing and trading of FMCG goods, shows a net profit of 10,40,000 for the financial year ended 31st March after the charge of following items. Now, interest. It is covered under what? It is allowed under 3237. Fine, first check done. But it is disallowed under 40A. So what we should do? What? Add back. Then, sir, they paid 46,000 to farmers and 32,000 to transporters. This is allowed under 3237. Which section? 37. It is a business related expense only. But, and even as per 40, capital A also it is what? Allowed only because it is within the limits. So no problem, sir. We need not to do anything. Then depreciation, sir. As per 32, this is not allowed. So what we should do? Add back. And as per 32, this is allowed. That's why what we are doing? Subtracting. Then provision for income tax. Sir, provision for income tax, sir. Okay, let's say in 3237, nowhere it is said that it is disallowed. So let's say it is allowed. But under 40 subsection A, what they are saying, sir, provisions or income tax is completely disallowed. Since it is disallowed, what we should do? Add back. Contribution to political parties. Is it related to business expenditure? Is it related to your business? No. So 37 itself not allows. So that's why what we have to do? Add back. Interest on term loans obtained from cooperative bank. Sir, interest is covered under 36, allowable only. But the problem comes with what? 43B, it is disallowed. So what we should do? Add back. Bonus paid in excess of retirement requirement to relative of director. First, bonus paid is an expense. Okay, allowable under 3237. But the problem comes where? 40A subsection 2, sir, relative of director, specified person. Bonus paid in excess of requirement. So this requirement is what? Fair market value. So he is paying in excess of fair market value how much? 25,000. So under 40A subsection 2, this 25,000 is what? Disallowed. Disallowed. Then the business loss of 3,40,000 was carried forwarded and unabsorbed depreciation of 2,20,000. The return of income was filed within the due date. Sir, business loss 3,40,000 is there and unabsorbed depreciation 2,20,000 is there. Okay. First we should set off business loss, sir. Why? Business loss can be carried forwarded maximum for 8 years only. But unabsorbed depreciation unlimited. So since it exhausts first we need to utilize this. Okay. So now let me show you the answer also, sir, which I computed. See, 10,40,000, interest added, depreciation added, provision for income tax added, contribution to that electoral trust added, interest on loan added, bonus added, depreciation as per income tax act subtracted. Then what is the PGBP income, sir? 13,45,000. Okay, so there is one more point, sir, this question has. This point actually in our material we'll discuss in business restructuring chapter, sorry. Assessment of companies, we'll get this point, sir. Okay, I'll explain now. Okay, or else I'll take you to that place and explain. In our concept book only. See this one, page number 4.8 you will find. 4.8. Section 79. Set off and carry forward of losses in case of certain companies. Which companies? Closely held companies. Sir, what is called closely held company? Private limited company. And in that there is a change in shareholding. In that company there is a change in shareholding. What? In the year of loss, let's say there are certain shareholders, but now in the year you need to set off those losses, the shareholding has been changed. Sir, let's say in 21-22 previous year there is loss. That time there are 4 shareholders, A, B, C, D, each has 25%. Okay, so at that year of loss, who are the shareholders, sir? A, B, C, D. Okay, now in previous year 25-26 you have profit, so in 25-26 you can set off that loss. But what happened? In 25-26 there is a change in shareholding. what? In the place of CD, CD left company, and in the place of CD, XY joined. So how much is the percentage of change in shareholding? 50%, because CD holds 25 and 25, 50%. So together the change in percentage of shareholding is how much? 50%. Now what the provision says? Such losses of the previous year shall be allowed if at least shareholders holding at least 51% of the voting power on the last day in which loss was incurred continue to hold at least 51% on the last day of the current previous year. So year of loss last day, current year last day. How much is the change in shareholding? Whether the same shareholders are there, changed. Okay, even if change is also okay, but at least how much percentage should retain? 51% retain. But in the example I gave, only 50% is there, other 50% gone, change. So they are not satisfying which condition, sir? 51% condition. So that year business loss is not eligible for set-off. Sir, only business loss. Unabsorbed depreciation is eligible for set-off only. Because unabsorbed depreciation nowhere mentioned here. They said about only what? Loss. They said about loss. And another logic also we can apply. Sir, unabsorbed depreciation will think like what? Every year it has a current year expense. So since it is a current year expense, we cannot apply this provision also. So this provision applies only for losses, and that also only to closely held companies, not to any other individual firms also, or to public limited companies also, only to closely held companies. So here, sir, in the question, how much loss these people are having? Business loss 3,40,000, this can't be set off, but depreciation 2,20,000 can be set off. So okay, then what is the final income under that PGBP? 11,25,000. So look at question number 6, page number 3.6. Devi Private Limited is engaged in the business of manufacturing leather goods and articles. Its net profit as per statement of pre-P&L was how much? 43,45,000. So we'll start with what? 43,45,000. Considering the following items. Raw material purchase includes, sir, they didn't said like which are debited and all. So the basic accounting knowledge you should have. Expenses and all they might have already debited. Incomes they have created to P&L. So based on that we have to treat. First one, what they are saying, sir? Raw material purchase made. Out of that, a purchase was to purchase is from WS & Co. LLP for 15 lakhs on 12th March. It is a micro enterprise as per MSMED Act. A sum of 8 lakhs was paid on 20th March and the balance is paid on 10th July. There is no agreement or a valid reason for delayed payment made. Sir, what is the condition? Within how many days the payment has to be made? 15 days. Sir, when it is like from 12th March, within 15 days they have to make the payment. That means by 27th March. So how much is made? 8 lakhs. So this is fine. But whereas the balance 7 lakhs is paid only in 10th July, not within 15 days. So 7 lakhs allowed or disallowed? Disallowed. What we should do that 7 lakhs? Add back. 7 lakhs we need to add back. Then, one senior manager of the company, Atul, went on a business trip to foreign country and he died there in a road accident. The gratuity paid to his dependent amounting to 10 lakhs. Gratuity paid. Allowed or disallowed? Provision for gratuity only disallowed. Gratuity contributions and actual amount of gratuity paid is allowed only, and it is incurred in relation to business only, because he's in a business trip. In respect to business trip only, the expense is incurred, so it is what? Allowed only. So nothing. No adjustment then. Advertisement expenditure paid 2.5 lakhs to whom? Surya LLP, in which one of its directors is a designated partner. Similar advertisement expenditure was incurred for 1,90,000 to Moon LLP, an unrelated party. Sir, what is the point here? Excess of fair market value to a specified person. So how much is disallowed? 60,000 disallowed. That means what we should do? Add back. So here no adjustment. First 7 lakhs we should add back. Third point, how much we should add back? 60,000 for what? 40A subsection 2. Payment made to specified person in excess of fair market value. Then late fee for delayed filing of TDS quarterly statement under 234E 10,000. And interest 25,000 debited as general expense. Sir, once again I'll show you. Income tax related 40 subsection A. See, any tax on profit and gains or business or profession is what? Disallowed. Income tax, surcharge, cess, interest on delayed payment. Okay, interest on delayed payment or remittance of TDS is also what? Disallowed. Interest on delayed payment or remittance of TDS related to TDS also disallowed. But if you see, late fee is not equal to penalty, so there is no provision mentioned here about late fees. So look at the question here. Late fee is also there, interest is also there. So now what does it did see? Late fee is allowed since it is not in the nature of penalty, whereas interest on late payment of TDS is not allowed. That means here what is disallowed and what is allowed, sir? Out of this 10,000 is allowed, so no adjustment to be done, whereas for the 25,000 interest disallowed. So what we should do? Then read fifth and sixth points and tell sir what has to be done. Read fifth and sixth point. Read fifth and sixth points. Sir, what happened? Employee Provident Fund recovered from salary of the month of August 60,000 was remitted on 16th August, 16th October, and March remitted on 20th August. Sir, such recovery is shown as credit in P&L. I mean, they are recognized as income. The question is about, can they be claimed as expense or not? Yes, sir. Did they deposit within the respective PF Act due dates? I said 2 times, 3 times that point came in exam also, important also. We revised so many times, again doing the same mistake. See, employee PF recovered from salary of the month. That means whose share it is? Employee share. Employee share has to be deposited by when? Respect to PF Act due dates. Next month 15th is the PF Act due dates. Sir, for August month, by when it has to be deposited? Okay, August 2025, it has to be deposited by when? September. But they deposited in. So it is what? Disallowed. And then March month to be deposited by April. But they deposited in August. So total 1 lakh is what? Disallowed. For what is the reason, sir? For not depositing within the due dates of PF Act. Then next point, sixth point. Sixth point, allowed or not allowed? Allowed. Employer contribution was also remitted on the same dates. Sir, employee's contribution only problem. Employer contribution has to be deposited by when? Due date of filing return of income. Due date of filing return of income will be 31st October. Sir, why not 31st July? Because it is a company. It is a company. It's okay. Devi Private Limited. It's a company. So what is the due date? 31st October. By 31st October, already employer contribution is paid. So it is what? Allowed only. So no adjustment has to be done. Okay. So out of here, sir, if you do this late fee or a TDS related point mistake, then that is some point which has little complicated. You may think how to be solved under. But other points in this question, sir. First point, you should have answer. Second point, you should answer. Third point also, you should answer clearly. And then this fifth and sixth point also, in class also we have discussed it clearly. So you should be able to in a position to answer this correctly also. Then seventh point, read and tell. ఫస్ట్ ప్రొవిజన్ ఏం చెప్పాను ఆ రోజు క్లాస్కి వచ్చావా సో వెళ్ళి ఆ నోట్స్ వెళ్ళి ప్రొవిజన్ దగ్గర వెళ్ళి చూడు నీకు అర్థమవుతుంది జస్ట్ ఓపెన్ ద ప్రొవిజన్ అండ్ సి క్లియర్గా కూడా రాసి ఉంటాం అక్కడ క్లియర్లీ వి రోట్ వై ఇట్ హాస్ టు బి క్రియేటెడ్ ఇంటూ P&L ఆల్సో చెప్పండి ఎవరన్నా వై ఇట్ హాస్ టు బి క్రియేటెడ్ ఇంటూ P&L దెన్ ఇఫ్ యూ రికగ్నైజ్ వేర్ ఇట్ విల్ బి దర్ దట్స్ వై ఈజ్ ఇట్ యువర్ రియల్ ఇన్కమ్ దట్ ఈస్ హూజ్ మనీ ఎంప్లాయీ మనీ వై యూ ఆర్ రికగ్నైజింగ్ ఇట్ యాజ్ ఇన్కమ్ Can anyone, I explained it clearly, the concept, why we credit, why we debit, everything logic also explained. Can anyone remember the logic? Yes. It acts as a counter mechanism. So first you recognize as income. Only when he pays on time, he can claim expense. Otherwise, unnecessarily he is paying tax. Okay. So that's why he recognized as income, even he recognized as expense. Sir, where it is recognized as expense? Here see, these amounts are even debited in the statement of P&L. So they're recognized as an income and recognized as also an expense. So recognizing as income, no problem at all. But to claim as an expense, they should have satisfied the conditions. Did they satisfied? No. Then to be claimed as what? Expense. Okay, మొన్న ఏం చెప్పావు 3 days back I said. You remember whatever I say. They given together only. As stated in 5 above, these amounts are debited in the statement of P&L. And when I am saying also, I asked you to read both the points. Okay? On the occasion of New Year, sir, read the 7th point and tell. Yes, sir, you are correct. Seventh point, sir. Allowed or not allowed? Sir, okay, the basic doubt which you should come is like they are not paying monetarily. They're given laptops, but that is non-monetary. So the basic, see, if they said like paid in money, na, then obviously you might have, without any second thought also, clearly you can say what 30% of the expense is disallowed. The doubt comes when, since they paid in non-monetary form, they given, on the occasion the company gave one laptop instead of money. Sir, this one laptop is nothing but like commission only they given, but they given in the form of what? Laptops. Okay, but they deducted any TDS, sir? No. Okay, but even if when they pay non-monetary thing also, they have to deduct what? TDS. Since they fail to deduct TDS, how much is disallowed? 30%. So what? How many laptops given, sir? 10 into 60, 6 lakhs. 6 lakhs into 30%. 1,80,000 is disallowed. What we should do? Add back. Then. Next point, 8th point, sir. Everybody read 8th point. Yes, we need not to add back totally, sir. 30% only we need to add back. 8th point. Next one, sir. What? One machinery acquired on 10th September for 15.5 lakhs, which was made through banking channels, incurred by way of, and 1,50,000 was incurred by way of expenses for installation through UPI. UPI is also allowed. So total how much is the cost, sir? 17 lakhs. The said machine was previously used by a foreign company outside India. The machine was put to use and the company has claimed normal depreciation 15% and additional depreciation 20%. Sir, normal depreciation can be claimed, no problem. But which cannot be claimed? Why? Because it is a used asset. We cannot claim additional depreciation. So how much they have claimed additional depreciation? 20% amount. 3,40,000 they claimed as additional depreciation. Can they claim? So what we should do? Add back. Then annual bonus debited to statement of P&L is how much? 15 lakhs. The same was unpaid till the date of filing of ITR. Which section? 43B. So what, sir, for this, it's not just about you finding out add back or not. You need to write an explanation also. So, okay, think of the sentence also, what you'll write. Certain expenses are allowed as deduction only on payment by the due date of filing, written off income as per 43B. If you don't remember section number also fine, but you should at least able to write that line. Okay. Here how much is disallowed, sir? 15 lakhs add back. Then donation to registered political party by net banking 1,80,000 and by cash 20,000 debited to P&L. How much? Sir, again, for every expense, what is our step? Sir, even if it takes time also, when you're practicing at least, every expense, first check. It will take time, sir, only 3 or 4 questions. If you spend time and practice, then only you will get. Whether it meets at any place under 30 to 37. If you couldn't remember, then again read from every time. For every point, again, what you should do? Read 30, 31, 33, 36, 37. Nowhere is there, then not allowed, right? So like that, if you do for every point, then it will register and you can easily say, is it allowed under 30 to 37? First, tell me that one. Donation to political parties, it is allowed. No, sir, total 2 lakhs is not allowed. 37, what we have said, should be related to business. Is it related to business? No, there itself, not allowed. Even in explanation also, we clearly wrote, donation to political parties are not allowed. You may claim deduction under where? 80 GGB. Sir, let's say if it is a total income also, you need to calculate. PGBP will add back total 2 lakhs. But again, under chapter 6A deductions, you can claim 80 GGB to an extent of 1,80,000 because under 80 GGB, we have said like other than cash. Okay, first for PGBP only, I'm thinking, what we have to do? Total 2 lakhs, we need to add back. Okay, then the last provisions are here. Okay, out of, in this sum, sir, if the points are of complicated, one is like that late fee related TDS point is a complicated point, and then the last point is also something. If with the medium level preparation, at least with practice, you can crack this, but this point, sir, you should have a proper thorough understanding, then you could have, logically, you should have been thorough understanding, then you can crack. Tell. You read and tell and find out whether you could crack it or not. Sir, what is the point here? A sum of 5 lakhs was waived by an NBFC comprising 3.8 lakhs towards principal and 1.2 lakhs for interest. And the waived amount is credited to statement of P&L, whereas the principal amount waived was credited to capital reserve. The said loan was originally obtained for obtaining a vacant site. Okay, can you connect it to which provision it can be related? Sir, it could be first linked to remission or cessation of trading liability under section 41. 41, there is a section we discussed initially. Incomes related, 2 sections only there. 28, 41. This is income related only, right? They credited to P&L. We have 2 sections, 28 and 41. In 41, the first point is what? Remission or cessation of a trading liability. It is a liability, and thereafter it was remitted. You need not to pay it, but it should be of revenue nature only. Then only it is allowed as deduction. Sir, here first. So you have 2 remissions: interest part remissions, and you have even principal part remission also. Sir, principal part is of capital nature. So that remission we need not to consider as what? Income. So 3.8 lakhs ignore. No treatment for it. Okay. Why? Because the principal amount they also didn't create it. Principal amount was created directly to what? Capital reserve. Okay. But interest amount, what they did? They credited it to statement of P&L. Sir, interest element, they are claiming it as income now. But if previously it is claimed as an expense, and later on if it is there is no need to pay that amount, then you will claim it as, sir, what is remission of cessation of trading liability? In a past year you claimed it as an expense, but later on because of some adjustments you need not to pay it. That's why you are reversing the expense by way of claiming it as an income. But here interest, in the first place itself it is not allowed as expense. Why? Interest is allowed as deduction only on payment basis, where it is said 43B. So in this 1.2 lakhs, first originally it is not allowed as expense. Since originally it is not allowed as expense, again you cannot, on remission again you need not to claim it as an income. So what they did? They claimed it as an income, which is wrong. Sir, understand, sir? If this interest is, sir, interest point only this way happen, because interest now 43B gives the restrictions like what? Interest can be claimed as an expense only on payment basis. Okay, so first this is not even claimed as an expense, but still it is what? Remitted. So if it is first an expense, you claimed as an expense. Later if it is remitted, you need to claim as income. Sir, normal creditor kind of, now what happens? You purchase raw material. Purchases you are claiming as an expense. Later on the creditor is reducing his liability. Remission is there. Since you claimed as an expense first, later on whatever the amount of reduction of liability you have, you will be claiming as income. But here what happening? First interest is not even claimed as an expense because of 43B. So subsequently even if it is remitted, you need not to recognize as an income. But what they did? They already recognized it as an income. Yes or no? Credited to P&L, they already recognized it as an income, but it shouldn't be recognized as an income. What to do? Okay, it is not an income at all, but they already recognized as an income. Sir, in P&L credit side means what happened? Add. Okay, incomes, all the incomes were added. So now what? We shouldn't consider it as income. So to reverse that, what we have to do? Subtract. Okay, so for principal, no adjustments, sir. For waiver of interest on bank loan, you do. Now you got the PGBP income as 73,30,000. From there, deduction under 80 GGB, if you do 1,80,000, then the total income come to 71,50,000. Then sir, we'll solve question number 10, sir. This is June 2025 question. It has some unorthodox kind of assumptions has been taken. I mean, orthodox now, which we think usually the common trend kind of amendments. Common kind of assumptions we'll take. Sir, when any question in tax, there will be certain assumptions we need to take. But here in this question, they took assumptions in a way which we won't usually think of also. Okay, you'll understand while we're doing the question, sir. Sir, again, in any question, sir, you could get easily 8 marks. See, in the previous question also, you may do last point wrong, tedious point wrong, but rest all the points you could do correctly, you could write explanations correctly. 2 points wrong, 2 marks gone, and the total also will go another 2-3 marks you lost. So out of 14 marks question, minimum 8 is safe, right? So, okay, that's what I said even in the first class also. In a PGBP question, you doing 2 points wrong is not a problem. Out of 10-12 adjustments, okay, you focus on how many adjustments you are doing correctly. Sir, every time they'll ask some kind of new question, 1 or 2 new points will come, okay, where you get confused. Okay, that is absolutely fine. If sometimes we may think in the correct way only, the full question may get correct also. Sometimes you may think in the alternative way, 1 or 2 points may be wrong also. So don't expect much from this question. Why we are doing this question? For question number 2, we are targeting 8 marks only. But 3 we can get full marks by learning PGBP. Understand, sir? Question number 3 also will have PGBP adjustments. But basic PGBP adjustments will be there in question number 3, tax planning related. Okay. Question number 10, sir, now. DEC Private, this is also an exam question, sir. June 2025 term. Okay. DEC Private Limited, Kolkata reports a net profit of 22,75,000. So we should start with what, sir? 22,75,000. Okay. Interest on loan from NBFC. The amount remained unpaid till the due date of filing of return. Interest on loan from NBFC. So check once again. 43B. Okay. I also have to check whether I written it clearly or not. 43B. NBFC also I mentioned there or not. I have a doubt. But NBFC is also disallowed only. But we need to check under 43B. Even NBFC also mentioned or not. Mentioned? Huh? Yes, NBFC. That is also what? Has to be paid by when? On or before the due date of filing written off income. Here paid a? No. So what we should do? Add back. Depreciation as per Companies Act. What we should subtract then? As per income tax. Did we have anything as per income tax? Yes, 4 lakhs is there. That's why we should do what? Subtract. Okay, then. Penalty for infraction of law. Penalty for infraction are nothing but what? Violation of law. Allowed under 32, 37. What is 37 conditions? Not covered under 32, 36. Not of personal nature, not of capital nature. Incurred after commencement of business, not a violation of law. Violation of law, no, nothing but not an infraction of law. But it is what? Infraction of law. So what we should do? Add back. Then next D point, sir. So we discussed this one, but where you need to identify. Under 37, the last note point we discussed is about this only. With respect to any issue of shares, issue of debentures, if any capital related expenditures, then they are disallowed. Memorandum of MOA changes, AOA changes, or authorized share capital increase, then all those will come under capital nature. Sir, first simple thing. All these expenses you are incurring for what? Change in capital. See? Change in payment of fee to ROC for change in AOA, change in MOA. Why you are changing MOA, AOA? Because you wanted to change authorized share capital. All these items are related to what? Capital nature. So capital receipts are not allowed under, or capital expenses are not allowed under 32, 37. So what we should do? Add back. We should add back. Then company made following provisions. Deferred tax, add back. Provision for doubtful debts, add back. Provision for loss of wholly owned subsidiary, add back. Retrenchment compensations are nowhere it said like disallowed. Do we wrote, sir, retrenchment compensation, you are removing an employee. So when you remove employee on your own, then what do you have to do? Compensation has to be paid. Now again 37. Is it business related or not? Personal nature? No. Capital nature? No. Is it violation of law? No. So then obviously it is allowed under what? 37. Any disallowance is there? They didn't said like cash payment. They didn't said like TDS not deducted. They didn't said like anything such. So there is no disallowance also. So no problem. For this, no adjustment. Okay, na sir? Then items credited to statement of P&L. Profit from unit established in SEZ. Sir, 10A. But still it is business income or not? 10A talks about a deduction. 100% of their export profits are eligible for deduction. 50% of their export profits are eligible for deduction. But first, is it an income or not? Okay, it is a income, sir. It may be in SEZ or normal place. They got profit from where? Business only. So it is correct only to get credited under the P&L. No problem, because it is related to business or not. Sir, it may be eligible for deduction or not is a secondary. But first, it is a business related profit or not? Yes. So it is correct only to be under the PGBP head. So this, no adjustment. Now for this point, sir, again. Income from growing and manufacturing of tea in Darjeeling. Sir, tea related. 60% agri income, 40% business income. But they created total 1 lakh to P&L. How much? Sir, exempted income we shall not create to P&L. Okay, only the taxable income we should create to P&L. How much is exempted income? 60,000. So 60,000 already created to P&L, but not to be created. So what to do? 60,000 we need to subtract. Sir, debit side reversal, we'll add. Credit side reversal, we are subtracting. 60,000 we need to subtract. Then, sir, this other information means what? Sir, they clearly said items debited and items credited. When they are giving something in other information, we should be clear. Okay, they may not be debited and credited to P&L also unless they clearly mention it. Company received a refund of income tax. Sir, refund of income tax, is it an income? Refund of income tax paid, is it an income? What is income then? See, here in this statement, read this point, and in this point, what is income, what is not income? Okay, we'll subtract. But my question is, out of the 47,000, does the total 47,000 is income only? Yeah? So the tax refund is not an income. You paid tax and you are getting back your tax. What is income there? Interest on refund element is income. Okay, but that also taxable under which head? IFOS head. Whereas refund element not even an income also, but credited to P&L. So both are wrong only. 47,000 credit is wrong only. So 47,000 what we should do? Subtract. But under IFOS head you should again include how much? 7,000 you should include under IFOS head. Sir, able to understand, sir? Total 47,000 is not income. Sorry, 40,000 is not even income at all. 7,000 income only, but under IFOS. So, but we are calculating first for what? PGBP head. That's why 40,000 also we have to subtract. 7,000 also we should subtract here. But 7,000 separately you should take under other sources. Depreciation we already did. Then business loss brought forward from assessment year 24-25, 3,75,000. So business loss can be set off. Business loss brought forward from assessment year 23-24. Speculative. Sir, speculative loss can be set off only with speculative gain. Here we don't have any speculative gain, so it remains like that only. It is not eligible for set off. Whereas non-speculative loss, we can set off. Then unabsorbed depreciation brought forward is there how much? 3,50,000. Okay, which is related to 12-13. But still, it has to be treated as what? Current year depreciation only. Here, there is one tremendous adjustment, sir. Sir, same kind of point we have seen in December 23 exam also. The first point we saw, like change in shareholding pattern happened. That question also we have unabsorbed depreciation. What we did, first we calculated profit, then again we reduced what? Unabsorbed depreciation. But in this June 2025 suggested answer, sir, for this point they given a unorthodox explanation. I'll show you, See, unabsorbed depreciation, what is it? Any brought forward depreciation of an earlier year will be added to current year depreciation. I mean that will be treated as current year expense only. So they're saying like what? It is also part of current year depreciation and will be treated as current depreciation. Since the depreciation of income tax, what they are saying now, for current year they said the depreciation as how much? 4 lakhs, right? So they are saying like this 4 lakhs even includes 3,50,000 also. So again we need not to subtract 3,50,000. Okay, but a normal student, sir, he'll subtract this 4 lakhs and even unabsorbed depreciation 3,50,000 also will do, because till that point of time, whatever the institute sources questions are there, they also did the same way. But in this question only, what they said, unabsorbed depreciation is like a current year depreciation only. Since you already subtracting income tax current year depreciation 4 lakhs, it is assumed like what? That 4 lakhs is inclusive of this 3,50,000 also. So we need not to again subtract this 3,50,000. So are you able to understand, sir, this concept? Okay. Then next point. During the year, the company purchased raw materials from micro enterprises for 45 lakhs and paid 37.5 lakhs by the end of the year. It settled the balance on 25th May. It settled the balance when, sir? 25th May. So is it allowed or not allowed? Sir, micro enterprise. Which section? 43B. How many days it has to be paid? With agreement na 45, without agreement na 15. Here the question is not clear about agreement. Let's say even if there is agreement also, maximum how much? 45 days. But they paid on 25th May. Sir, the year, let's say it happened on, sir, they didn't even say when the transaction happened also. Assume on 31st March only it happened. Okay? But by when it has to be paid? 45 days also, at least by 15th May it should have been paid. But they paid on when? 25th May. So in any assumption you take, the other 7.5 lakhs is not paid within the time. So what happens to that? Disallowed. Okay, they already said that entire amount is debited to the P&L. So the 7.5 lakhs, what we should do? Add back. Then advance tax paid by the company during the year, 5 lakhs. You think like we need to add back. But understand, sir, they didn't mention like it is debited to P&L. If it is already debited, since they claimed as an expense, to reverse will add back. They just said like they paid advance tax 5 lakhs. They are not claiming like it was debited to P&L. So nothing to be done. So now all these adjustments, sir, they take 22,75,000. Interest 1,85,000 not paid, NBFC added back. Depreciation added back. Penalty added back. ROC related, authorized share capital related, MOA related, AOA related, all these has been added. Provision for deferred tax added back. Doubtful debts added back. Loss of subsidiary also added back. So total how much? 3,75,000. Retrenchment compensation is related to business only, so nothing to be added, nil. Then delayed payment to micro enterprise. How much has to be added back, sir? 7,50,000. Then items credited to P&L. Sir, profit from SEZD, they are subtracting. Okay, you can do without subtraction also, answer will remain same. But they are considering it as a different business and doing separately. See, here what they are doing, profit from SEZ, they are subtracting and considering it as a separate business and as a separate income. Even if you don't subtract also, final answer will remain same only, it's not a big problem. Okay, then income from growing and manufacturing of tea. Sir, again, this also they are treating it as a separate business. Okay, but even if you do just 60,000, if you subtract also, you'll get the same answer only. Income tax refund, total 47,000 was subtracted. Total how much, sir? 4,22,000. The items is what? 36,98,000. Then the items to be subtracted. Depreciation, 4 lakhs. Unabsorbed depreciation not to be subtracted. So the total income is how much? 32,98,000. Then again, profit from SEZ separately taken, 2,75,000. Income from growing and manufacturing of tea, 40. Total how much? 36,13,000. Sir, if you don't do this adjustment, here 60,000 only if you subtract also, straight away you will get what answer? This 36,13,000 will get. Okay? Even if you show these two lines separately or directly also, it's not a big concern. Then loss from non-speculative 3,75,000 can be set off, but brought forward loss from speculative can't be set off. So we got income from PGBP 32,38,000. Interest on income tax refund. Why? Because it has to be claimed under IFOS 7,000. So total income is how much? 32,45,000. Then deduction under 10A. SEZ related 100% eligible for deduction 2,75,000. Then you got total income 29,70,000. Then tax 25%. So again, company applicable tax rate is how much? 25%. They only said. So that's why here took what? 25%. Cess 4%, total 7,22,000. Advance tax already paid how much? 5 lakhs. Then you'll get 2,72,200. Sir, out of all the PGBP questions asked in exam till date, this is the toughest question asked in the exam. Okay. So what are the toughest points, or which points we might have did mistakes also? I'll see. Let's see. Unabsorbed depreciation point, yes, you might have did mistake. Conceptually, if you are correct also, still unabsorbed depreciation point, we have chance of doing mistake. Then retrenchment compensation, since it is not clear, retrenchment compensation and this payment to ROC points, okay, these 3 points, and here also with respect to this SEZ also, this 1.4. So, okay, there are chances of doing, this is one of the complicated question. Even in this tough question also, 4 points only where you can do mistake. The other 8-9 adjustments you can do correctly only, sir. Simply only you said, okay, interest has to be disallowed, depreciation add back, penalty for infraction of law, you only said add back, deferred tax, you only said add back, provision for loss, add back, provision for subsidiary, you only said, then even in this T related also, you may do adjustment wrongly. But explanation again you can do correctly only. 60% is agree income, 40% business income, that one. Then this refund point also again, you are clear only 40,000 is only, 7,000 is only income, 40,000 is not even an income. So total 47,000 has to be subtracted. Then this loss points also you are clear. Brought forward business loss can be adjusted, non-speculative can't be set off. This unabsorbed depreciation, because of their assumption, we also might get defeated, there we may lose mark. And again MSME point, you could answer correctly only. Okay, so in this question also minimum you can get 7 to 8 marks easily. Okay na? So the point is not about you getting each and every point correctly, sir. There may be a chance of doing 1 or 2 adjustments, so don't get afraid of. And in tax, how many are getting 50s, sir? First think that many times many students are not getting 50s in DD itself. Okay, so to get 50 now you'll get what 50% of marks in a question. If you are getting that, then you'll get what 50 marks. Most of the cases MCQs itself you'll get 9 MCQs minimum out of 15, 9 to 10. So 18 to 20 marks you are getting MCQs only. Rest 30 marks now, every question if you wrote averagely you are getting half marks also, it is fine. You'll easily cross 50 marks. So in PGBP question, if you get 7 or 8 marks now, then it is absolutely fine. That is a question which you could pick. Okay, you may think of 1 or 2 adjustments you don't know, and you'll completely leave the question, sir. So don't do that. PGBP is a safe bet in my perception, sir, because 7, 8, and this question, sir, this chapter, you need not to revise much on the day before exam, because most of the points you, okay, 40 minutes you give on day before exam for the handwritten notes you have, you can easily revise those points. With that, in the exam hall also, you can able to revise, able to correctly do most of the points. 1 or 2 points only you're going to do mistake or some kind of wrong things. Okay, so easily you can get 8 marks. Okay, and it will not strain you much also in exam. Transfer pricing is one chapter, sir, which is easy only, but your brain gets strained so much. Even with a lot of practice also, when you open a question, again every question looks like a new question only. You'll again get the confusion whether how to do this, whether to add or whether to subtract. It strains you so much. Okay, but this chapter PGBP, once you do or once you practice properly, it will not strain you much. So don't leave the chapter, sir. NR taxation chapter, sir, tough chapters, they are asking easy questions. Easy chapters, they are asking tough questions. Everybody in India who are writing CMA exams target transfer pricing chapter. So they are asking complicated questions where transfer pricing only. Everybody, including CFL students also, they will not focus more on NR taxation. NR taxation, they are asking plain easy questions only. Okay, NR taxation, business restructuring, okay, those areas. Okay, so which you usually leave, they are asking easy questions. Okay, so that's why, sir, don't do selective study. Selective study, na, almost I said like the C category chapters. The C category chapters, if you leave, fine, because you are not getting a 7 marks question, 1 or 2 MCQs, you lose also, not a big thing. Okay, but the other chapters, again within these chapters, don't go for selective study. And tax requires time. If you put a time target, within this time only, I need to remember na, that in such a way brain does not work, because it's not about only applying logic. Applying logic, na, once you get the logic, you'll remember it forever. It's not about applying logic also, you need to remember the conditions, points, those you'll remember only when you revise frequently. So it happens, sir. Okay. Revise thoroughly, sir. So tomorrow, maybe I solve question number 11. Maybe another one question I'll solve from PGBP, sir. We don't have much time also to solve all these questions, because every question will take more than 30 to 40 minutes, sir. We already did 3 questions. We'll solve another 4th question tomorrow. Rest of the questions are for your practice only. Okay? Sir, in chapters like DTA and transfer pricing, mostly I'll solve each and every question. But here, these are lengthy questions, sir. The concept, the application remains same in each and every question. You just sit, spend time, think of each and every provision. You just, so when you're learning PGBP for the first time also, for every point you read and you yourself confirm where it is allowed. 30, 31, 32, 33, 35, 37. Have that clarity. Then again, check where it is disallowed clearly. 40 in 40 subsection in 40 in 40 b 43 b. So for every point, if you have that clarity, then slowly you'll get, okay, since you do number of revisions, every revision you do the same thing. You don't take it for granted. Every point, identify which section it is allowed, which section it is disallowed.
Maintenance of books of accounts. SSE carrying notified profession. What are called notified professions, sir? AMLET. It means accounting, medical, legal, engineering, interior decoration, technical, and others. Others means film artists. So these are called notified professions, where SSE is carrying notified professions, and his gross receipts exceeds 1.5 lakhs in all the 3 preceding previous years. I mean, let's say is carrying this profession from past 10 years. Then last 3 preceding years, every year the gross receipt should exceed 1.5 lakhs. If he newly commenced the profession, then gross receipt should exceed 1.5 lakhs in current previous year. Then he has to maintain books of accounts as per Rule 6. What are the books to be maintained, sir? Cash book, journal, ledger, bills na, original bills for the purchases he has made, and the duplicate copy in case of sales made, case register in case of medical profession, and inventory of stock. Okay, so all these has to be maintained if he is carrying out notified profession and his gross receipts in all the 3 preceding previous years exceeds 1.5 crores. If not, here all only, correct it to all. It is like here for profession it is like all only. Her profession, it is like in all the 3 preceding previous years only. Maintain books of accounts as per rule 6. Sir, let's say his gross receipts didn't exceed 1.5 lakhs. Still, he has to maintain books of accounts, sir, but they didn't specify what. They said like, which will enable AO to compute his total income. Okay, the minimum documents anyhow has to be maintained. So if he is a professional, notified professional, all this has to be maintained. Other than, notified professional and gross receipts exceeds 1.5 lakhs, he has to maintain all this. If it does not exceed 1.5 lakhs, then minimum books he has to maintain, which were needed to compute his total income. Now, SSE is like other than notified profession or carrying business. So maintain books of accounts if satisfies the following conditions. Individual or HUF, others. For individual and HUF, one kind of conditions, others another conditions. Okay. Income greater than or equal to 2.5 lakhs in any of the 3 preceding previous years. Gross receipts greater than 25 lakhs in any of the 3 preceding previous years. Then he has to maintain books of accounts. Or if he has newly commenced the business, sir, then instead of 2.5 lakhs, okay, here individual and HUF, his income should be more than or equal to 2.5 lakhs in any of the 3 preceding previous years. Turnover should be more than 25 lakhs in any of the 3 preceding previous years. Then books of accounts has to be maintained. New business also same, sir. Instead of 3 previous years, we'll check only the current previous year. In current previous year, if it is more than 2.5 lakhs or gross receipts more than 25 lakhs. Others, sir, others na income greater than 1.2 lakhs or turnover greater than 10 lakhs. Sir, this also has to be checked in any of 3 preceding previous years only. Any of 3 preceding previous years, his income exceeds 1.2 lakhs or turnover exceeds greater than 10 lakhs in any of 3 preceding previous years. Income exceeds 1.2 lakhs or turnover exceeds 10 lakhs in any of the 3 preceding previous years. So section 44AA is about what? Maintenance of books of accounts. SSE carrying notified profession, SSE carrying non-notified profession. What are called notified professions? Accounting, medical, legal, engineering, interior decoration, technical and other film artists. Okay. When they are carrying notified profession, we need to check turnover, gross receipts in excess of 1.5 lakhs in all the 3 preceding previous years. Then he has to maintain books of accounts as mentioned in rule 6. If not, the minimum books which are required to AO to compute his total income, that has to be maintained. What are the books mentioned under rule 6? Cash book, journal, ledger, bills, case register only in case of medical profession, sir, and then inventory of the stock if they are having, that also has to be maintained. SSE carrying non-notified profession or business. We need to check whether it is individual and HUF or others. Individual and HUF, total income should be more than 2.5 lakhs, turnover should be more than 25 lakhs in any of the 3 preceding previous years. Then books of accounts has to be maintained mandatory. Others, when income exceeds 1.2 lakhs or turnover exceeds 10 lakhs in any of the 3 preceding previous years. New business now, you'll check only the current previous year. Then books of accounts has to be maintained. Understand, sir? Okay. 44A, books of accounts has to be maintained. Now, where the books has to be maintained? The books has to be maintained at the place where SSE carries business or profession. Where he carries business or profession. If there are multiple places of businesses, then they have to be maintained at principal place of business. Okay, they have to be kept at the place of business. If multiple places of businesses are there, then they have to be kept at principal place of business. And they have to be maintained for 8 assessment years from end of relevant assessment year. How long the books of accounts has to be maintained, sir? 8 assessment years from end of relevant assessment year. Sir, let's say, sir, previous year 25-26. That means assessment year what? Then how long the books of accounts has to be maintained? Count until. Assessment year 34-35. Till then, the books related to previous year 25-26 has to be maintained. Why? How, sir? 27-28, 28-29, 29-30, 30-31, 31-32, 32-33, 33-34, and 8th year is 34-35. So till 34-35, 8 assessment years, books of accounts has to be maintained. In simple, sir, notified profession, when they have to maintain, when gross receipts exceeds 1.5 lakhs. Non-notified professions or business, individual and HUF, turnover exceeds 25 lakhs or income exceeds 2.5 lakhs. Others, turnover exceeds 10 lakhs, income exceeds 1.2 lakhs in any of the 3 preceding previous years. For notified professions, in all the 3 preceding previous years, then books of accounts has to be maintained. Where? At the principal place of business. How long they has to be maintained? 8 assessment years from the end of relevant assessment year. Penalty for non-maintenance of books of accounts. Up to 25,000 penalty will be there. Then, sir, we are moving on to presumptive taxation schemes. Sir, presumptive taxation schemes are introduced, again, considering small and medium-sized business persons. They cannot do all these allowances, disallowances, calculation and all. It is tough for them. To make it easy, to relieve compliances a bit from them, these presumptive taxation schemes are introduced. These are simple. You need to find out your turnover into some percentage they'll give, that if you apply, that is only your deemed profit. That will be considered as deemed profit. So what are the benefits? You need not to maintain books of accounts. So usually, if you need to do a P&L now, you need to maintain books of accounts. Okay, majority businesses, sir, they have a track of their sales, but they'll not record what is the total income of it is coming, expenses that is coming, no. So even if you go to a small kirana store guy and ask also how much sales you made, he'll have a track of how much sale he did that day. In any business, they'll have a track of how much sale they did in a day. Okay, you go for a small business, or this is for small and medium sized only. So all these small and medium sized business persons, they may not track each and every expense, or they may not record. But every day they'll have sales. Okay, today 3,000 sales. Okay, or else yesterday only 2,000 sales, but today 4,000 sales. Like that they'll have track. So turnover they can maintain easily only without the help of accountant. But normal P&L journals, if all these has to be maintained, again they need to hire a accountant. Then again to compute this profits and all, they need to consult a consultant. So accountant na monthly part-time accountant also they need to pay 6,000-7,000. So yearly monthly 6,000-7,000 into 12 months if you do, that is 80,000. And for tax auditor or for the tax consultant another 20,000 also. Now 1 lakh they are spending only for tax compliances. 1 lakh is a high cost for small and medium sized persons to ensure or to make sure tax compliances only they are incurring 1 lakh. So to avoid those things, they introduce what? Presumptive taxation schemes. Just to find out their turnover into some percentage will be considered as what? Deemed profit. They'll not ask your actual profit. They'll calculate tax only on what? Deemed profit. Okay. So 44AD, ADA, 44AE. But there are other presumptive schemes also, sir. 44B, BB, BBB, PBA, BBC, like that. There are other presumptive schemes also, but they are related to non-resident. Those non-resident related presumptive schemes we'll discuss in the non-resident chapter. Here we are, these three only we're discussing which are related to residents. Okay. 44AD, ADA, AE. First, eligible businesses. Any business other than goods, transport and commission businesses are eligible for 44AD. Who are, sir? Any businesses other than goods transport and carrying commission business are eligible for 44AD. Which are not eligible? Goods transport. Why goods transport? It is covered under 44A. Commission business, na, the total commission itself is income. Okay, sir, in commission what expense they'll have, sir? If your business itself is getting commission, you will not have much expenses. Normal goods sales traders, na, they'll have purchases and sales. So they will give some percentage. For you, commission means 100% is what? Profit only, income only. That's why commission business not covered here. Transport, GTA not covered here because GTA covered separately under 44AB. Any other business if he is carrying covered under 44AD. ADA, he should have been carrying out notified profession. What are notified professions, sir? Accounting, medical, legal, engineering, interior decoration, technical and other film artists. Notified professions are covered under 44ADA. 44AE is for transporters who are in plying, hiring, leasing of goods carriage. Not any transportation, sir, only goods carriage is covered here. Okay. So 44AD is for normal businesses. ADA is for notified professions. AE is for GTA, goods transport agencies. Okay. Then eligible SSE. Sir, what we discussed is eligible business. Now we are discussing eligible SSE. For 44AD, resident individual, HUFs and firms are eligible. Resident individual, HUF and firms are eligible who have not claimed 10AA or Chapter 6A 80I series deductions. If these deductions are being claimed, then they are not eligible for 44AD. What deductions? 10AA or under Chapter 6A 80I series, I, IA, IAB, IAC, IAD. Those deductions if they are claiming, then also they are not eligible for 44AD. Then 44ADA is for resident individuals and firms. Why not HUF, sir? For professions, it's not generally possible to create a HUF. Okay. But these days, sir, even family HUFs or family professions are also being happening. Example, movies and all, na? Hero, father, son also hero, daughter also heroine, niece also heroine. So family becoming, it's not one particular family. In every, if one hero comes out, then his whole family, his brother will become hero. Vijay Devarkonda came, then Anand Devarkonda became hero. Obviously, when they have a son again, they'll make him what? Hero only. Okay, that happened with Chiranjeevi, that happened with Nagarjuna, that happens with even Balakrishna. He's already a son of hero. His brothers are there. Then, so the same things are here. So HUFs also may be there, but as of now, 44ADA is for resident individual and firms other than LLP. And 44AE, sir, it is applicable to any SSE. Okay, sir, understand here. GTA, they said any SSE. He could be resident or even non-resident. But here they said what? Resident individual and resident firm. Here resident individual, resident HUF and resident firm. Okay. Sir, 44AD is applicable to whom? Individual, HUF, firm. What business they should be carrying out? Any business other than transport and commission. 44ADA, notified profession. 44AE, goods transportation. 44AE, who is eligible? Any SSE. 44ADA, who is eligible? Resident individuals and firms other than LLPs only eligible. Okay. Now, how do we decide whether they are small and medium sized businesses? For that, they kept turnover thresholds. Okay. Turnover within less than or equal to turnover less than or equal to 2 crores in the previous year. However, if the aggregate cash receipts in relevant previous year are less than 5% of total receipts, then there is an extended limit also applicable up to 3 crores. I mean, what should happen, sir? Out of your turnover, total cash receipts should be within 5%. Let's say your turnover is 2.5 crores and your cash receipts are 10 lakhs. Your cash receipts are 10 lakhs only. The balance 2.4 crores is Balance 2.4 crores is through what? Account pay check, account pay draft only 10 lakhs cash. Now found out 10 lakhs means how much percentage, sir? 10 by 250. 10 by 250 into 100. 10 lakhs, sir, 2.5 crores means 250 lakhs. 10 by 250. How much, sir? 4%, which is within 5%. So even 2.5 crores also they are eligible for what? 4480. So turnover should be within 2 crores in general. Even if it is more than 2 crores and up to 3 crores also eligible, but in that case, the total cash receipt should be within 5%. Okay, then they are eligible even up to a higher threshold of 3 crores. Okay. So let's say his turnover through cash is 15 lakhs, then eligible. 15 lakhs through cash. 15 by 250. Eligible or not eligible? Because his turnover, his cash receipts exceeds 5%. So for him, the turnover limit is 2 crores only. Because cash receipts exceeded 5%, na, so enhanced 3 crores threshold is not applicable, only 2 crores threshold is only applicable. So that's why he'll become ineligible for presumptive scheme. In general, 2 crores. However, if your cash receipts are within 5% only out of your total receipts, then you have an enhanced limit up to 3 crores. Then notified profession. For them, the turnover should be within 50 lakhs. Turnover should be within 50 lakhs. Then for goods carriages, sir, they didn't set turnover, they set limit based on number of vehicles. How many vehicles they should have? Less than or equal to 10 goods carriages in any day during previous year. Not even on a single day, you should not own more than 10 vehicles. In any day you check in previous year, you should have 10 or less than 10. Then only is eligible for 44AE. So once again, sir, 44AE is applicable for whom? Goods transporters. Eligible SSE. Any SSE. Okay, then what is the threshold? You should own less than or equal to 10 goods carriages. Then 44ADA. Notified profession. Okay, who is the eligible SSE? Resident, individual and firm excluding LLP. Turnover should be within 50 lakhs. Then 44AD. Any business other than commission and GTA. Then who are eligible? Resident, individual, HUF, firm. And if they are claiming 10A deductions or Chapter 6A 8I series deductions, then they are not eligible. Threshold is how much, sir? 2 crores generally. The turnover in the current previous year should be within 2 crores. However, if their aggregate cash receipts in that year are within 5% of the total receipts, then enhance the threshold of 3 crores is applicable. Then presumptive income. Presumptive income, no, nothing but the deemed profit we're going to calculate is how much. For 4480, sir, it is 8% of turnover which is received in cash and 6% of turnover which is non-cash. So, sir, cash, now even though I wrote cash, sir, actually we need to check specified mode or not. If the turnover is through specified mode, what are called specified modes? Account pay check, account pay draft, electronic clearing system. Through those specified modes, whatever the turnover received, on that we should apply only 6%. If it is other than through those specified modes, then we should apply 8%. Let's say, sir, this person is having 1.5 crores turnover. He has 90 lakhs turnover through cash, 60 lakhs through specified mode. So 60 lakhs into 6% is 3.6 lakhs, 90 lakhs into 8% 7.2 lakhs. Total is how much? 10.8 lakhs is his deemed profit or presumptive income. Presumptive income. Okay, then. For profession, sir, what is the presumptive income? 50% of gross receipts will be taken as presumptive income. Sir, here 8 or 6, but here 50%. Then for goods carriages, sir, normal vehicles, sir, for every vehicle 7,500 per month per vehicle will be taken as the presumptive income. Okay, so how do we calculate? Number of vehicles, how many months they have been owned? Okay, we need to calculate. And for every month, how much we should apply, sir? 7,500. Then the total will get, which is called what? Presumptive income. If they are having heavy goods vehicles, what are called heavy goods vehicles? Then the empty weight of the vehicle, empty weight, sir, not like loaded. Empty weight of the vehicle is more than or equal to 12 tons. Empty weight, sir. So normally we'll see 6 tires lorries. Their weight is 6 tons. Then we see 10 tires. Backside another set of 4 tires will get added. Their weight will be usually 8.5 to 9 tons. Okay, here we are referring to heavy goods vehicles as what? Which empty weight is more than or equal to 12 tons. I mean, those vehicles will be having minimum of 20 tires. Okay, much more lengthier than what we see. Then those will come under what? Heavy goods vehicles. For heavy goods vehicles, how do we calculate, sir, presumptive income? For every ton, 1,000 rupees per month. Sir, if the vehicle weight is 12 tons, minimum to call it as heavy goods vehicle, its capacity should be, weight should be how much? 12 tons. So 1,000 per month into 12 tons, how much, sir? 12,000 per month into number of months you'll get. If the heavy goods vehicle weight is 15 tons, then what we should do, sir? 1,000 per month into 15 tons into number of, okay, 1,000 per month or part month into gross vehicle weight. Then you'll get the heavy goods vehicles related presumptive income. So let me give you an example, sir. Okay, in April, 5 vehicles he is having, sir. In April, he has 5 vehicles, May 5 vehicles, June 5 vehicles, July 5 vehicles. In August 6, September 6, October 6. And again in November, he sold 1 more vehicle. So 5, 5, 5, 5. These are the number of vehicles we have. Okay. Number of vehicles we have. So now, 5 into 7,500 will do. Here also 5 into 7,500. Then here again, 6 into 7,500. Again here 5 into 7,500. You do the totals. Here you'll get what? Presumed to income. Okay, this is what normal vehicles. Heavy goods vehicles also, yes. Each heavy goods vehicles 15,000 tons each. 2 vehicles are there throughout the year. 2 vehicles are there throughout the year, whereas 1 vehicle purchased and put to use from December 1st. From December 1st, okay, in the previous year. Now 15 tons means each vehicle, how much will be there, sir? 15,000 into, 15 into 1,000. So per vehicle, how much, sir? It is like 15,000. So now 2 vehicles are there throughout the year. Throughout the year. So throughout the year means 12 months. How many vehicles are there, sir? 2 vehicles are there. So for 24 into 15,000, how much? 3,60,000. And then 1 vehicle purchased from when? December 1st. How many months? December, Jan, Feb, March, 4 months only. So 4 months into 1. That equals to 4 into 15,000, which equals to another 60,000. So here with respect to heavy goods vehicle, what is the presumptive income? 4,20,000. Okay. So normal vehicle na, each vehicle into 7,500 per month. How many months it is there? That many 7,500. Then with respect to heavy goods vehicles, sir, per ton 1,000. That vehicle capacity we should to check what? Empty vehicle weight capacity. If it is vehicle weight, if it is more than or equal to 12,000 kgs or 12 tons, then it is called as what? Heavy goods vehicle. Per every ton, we need to take 1,000 rupees as the presumptive income. So number of tons into 1,000. Here since it is 15,000 kgs, it comes as what? 15,000 rupees. Because, sir, you know 1 ton equals to 1,000 kgs. That's why 15,000. How many months are there? That many months if you multiply, we got how much? 4,20,000 as the presumptive income. Then from these incomes, are there any expenses again can be claimed? Which expenses? 30 to 37 we have discussed expenses, right? What are 30 to 37 expenses we have discussed, sir? Rent, repairs with respect to building, plant and machinery, depreciation. 33 those site restoration fund, tea, coffee, rubber development fund. 35 scientific research expenditure. Then specified businesses, telecom license related. Then VRS compensation, preliminary expenditure, amalgamation, demerger related expenses. All those. And then 36 we have list of. 37 general. All those expenses are not deductible. Again, because you are straight away calculating profit after allowing those deductions only. Sir, out of 100 rupees, you are taking only 8% as profit. Why the other 92% you are leaving? Considering all those expenses only, you are leaving the other 92%. In case of provision, you are leaving 50%. Considering what? The other 50% is only those deductions. So all those expenses are not deductible and they are considered as deemed to be provided already. They are considered as deemed to be already provided. Only after providing only you got that presumptive income. Okay. Then 40B deduction. Section 40B deduction, sir. 40B is what? Interest and remuneration paid to partners. Interest, how much is allowed, sir? Up to 12% is allowed, authorized by deed. Remuneration, sir? 6 lakhs. 3 lakhs or 90% of book profit. In excess of 6 lakhs, 60% of the book profit. So that interest remuneration is also not deductible. But for GTA related 44AE, rest all the other expenses are considered as allowed. But that interest and remuneration paid to partners can be again taken as deduction extra. That alone can be taken as extra deduction within the limits of 40B. That also for whom? Only for the transporters. For normal 44AD and 44ADA people, those two are also not eligible. Then advance tax installments. Sir, advance tax. Here you are doing what? Turnover into percentage. So you need to have your turnover clarity, then only you can pay advance tax. That's why, sir, for them, first, second, third installments of advance tax are not applicable. Sir, advance tax actually has to be paid in 4 installments. 15th June, 15th September, 15th December, 15th March. Out of 4 installments, only 4th installment is only applicable in case of 44AD and 44ADA. But in case of 44AE, all the 4 installments are applicable. Why? Because, sir, mostly you know how many vehicles you are going to be there throughout the year. Only in an exceptional case you'll buy extra vehicle. Even if you buy extra vehicle also, on that income, from that quarter only it increases. So you'll pay advance tax whenever it increases, right? So first, second, third quarters also you can identify or you can calculate the tax properly only because number of vehicles is certain here. It is easy only to compute. But whereas here turnover can't be found out. That's why first, second, third quarters, you don't know how the business is going to grow or whether it is going to decline. You don't know. That's why turnover can't be estimated reliably. So first, second, third quarters, advance tax is not applicable. Only 4th installment alone, they need to pay advance tax under 44AD and 44ADA. Whereas for 44AE, all the 4 installments are applicable. Then from other business, you have loss. Whether that loss can be adjusted with presumptive business income. Yes. Set off of losses of other business incomes are also possible. Okay. So these are the main conditions of what? Presumptive scheme. Okay. So now we'll go one by one, sir. 44AD. Applicable for resident individual, HUF, firm who are not claiming 10A deductions and Chapter 6A, 80 I series deductions. Then what business they should do? Any business other than goods transportation and commission. What should be their turnover? Within 2 crores. In case when the total receipts are in cash are within 5% of total receipts, then the limit is 3 crores instead of 2 crores. What is the presumptive income? 8% of turnover when the turnover is through, on the part of the turnover which is through cash. 6% on the turnover which is through specified mode. Okay, then Whether any expenses are deductible again from that presumptive income, all the expenses are deemed to be allowed. Then even 40B, interest remuneration paid to partners, is also not allowed extra. That also will be considered as deemed to be allowed. Then advance tax, 4 installments applicable for them. No sir, not applicable. Only 1 installment is applicable. Set off of losses can be made. One more point, sir, they need not to maintain books of accounts also. And for them, tax audit also not applicable. If you are under 44AD, books of accounts also not applicable. Tax audit also not applicable. Then 44ADA. 44ADA applicable to whom, sir? Notified professionals, and then they should be individuals or firms other than LLP. What is their turnover limit? 50 lakhs. What is their presumptive income? 50%. All the other expenses and deductions including 40B are considered as already allowed only within that presumptive income. You need not to extra subtract them. Then advance tax installments, 4 applicable. Only last installment is applicable. If you have loss from other business, that loss can be adjusted with this presumptive income also. Here also books of accounts are not required to be maintained, and tax audit also not required. Then last 44A. 44A applicable to whom? Any SSE engaged in the business of goods transportation, flying, hiring, leasing of goods transportation. What is the number of vehicles you should have? Less than or equal to 10 vehicles, not on the closing day, sir. In any day during the previous year. What is their presumptive income? Normal vehicles, heavy goods vehicle. Normal vehicle, 7,500 per month. Heavy goods vehicle, 1,000 per ton will be per month will be considered as the income. But ton, how will get, sir? For vehicle, how many tons? How do we understand? Heavy goods vehicle means minimum 12,000 kgs. I mean 12 tons. It could be more than that also, but minimum 12 tons. That means from a heavy goods vehicle, minimum income will be 12,000. If the weight is more, then there will be more income also. Okay. Then all the other expenses are 30 to 37 are considered as allowed only. Again, you cannot subtract them. But 40B, interest remuneration, again can be allowed as deductions are even from this presumptive income also. Then advance tax, 4 installments are applicable. Loss from other business can be set off with this business also. Passenger transport like private travels covered under 44AD, no. Sir, actually here also there is a limit which I didn't mention here. Like what? Just like as goods, profession also there is a limit when the aggregate cash receipts are within 5%. Write down, sir. Okay. Even in material also, if it is not there, right? When the aggregate cash receipts in relevant previous year is less than 5% of total receipts, then turnover limit equals to 75 lakhs. That we want to discuss now, Sai. Wait. Okay. Then (44AD) subsection 4C, sir, where SSE carrying on business and his turnover is within 44AD limit. Sir, one thing you should understand here. At his option, SSE can declare even higher profit than presumptive profit also, no problem. 8% minimum to be declared. Leased vehicles are not covered, Sai. SSE should be the owner. Okay. SSE at his option declare higher income than presumptive income at his option. SSE at his option declare higher income than presumptive income at his option. So why leased vehicles are not covered now? If leased vehicles, okay, leased vehicles are not covered. SSE at his option declare higher income than presumptive income. He can even declare higher income also. Then SSE carrying on business and his turnover is within 44AD limit. I mean what? His turnover is within 2 crores only. But he didn't opted 44AD. Sorry, his turnover is, let me give you an example. His turnover is 1.8 crores. Okay. And didn't opted 4480. Sir, if he opted 4480, minimum profit, how much he should have declared? How much is the amount? 1.8 crores into, let's assume everything is through cash only. 14 lakh. So presumed to profit he need to declare equals to 14.4 lakhs. 14.4 lakhs. But he didn't opt at 4480. And then what he's doing? He has reported loss or profit is less than the presumed to income to be declared. He has to declare minimum profit as how much? 14.4. But he has declared as per P&L only 10 lakhs as his profit. So that means what? He is within the threshold of presumptive scheme, but he is declaring lower profit than that of the minimum profit to be declared under presumptive scheme. Lower profit than that of the minimum profit to be declared under presumptive scheme. Then for him, then he is not eligible for presumptive scheme, sir, for the coming 5 preceding previous years, and even he is eligible, he has to get his books of accounts audited also. Why? Sir, because with careful analysis and study, they thought like 8% profit will come in this businesses. But this fellow is saying like what? He is not even getting 8% also. Then they are having a doubt. Why you are not getting 8% when majority of are getting 8% in the same businesses? Or else they want to know how he can survive without getting even 8% of profits also. That's why, irrespective of the turnover, he has to get his books of accounts audited. Okay, let's say. Normally, sir, tax audit applicable when turnover exceeds 1 crore. Turnover exceeds 1 crore. Here SSE turnover is 75 lakhs only. Is he eligible for presumptive scheme? Turnover 75 lakhs. Yes, turnover 75 lakhs is eligible for presumptive scheme. 8%, what is the presumptive profit? 6 lakhs. But he declared his income as only 5 lakhs, which is less than the minimum profit to be declared under presumptive scheme. Okay, so since he violated the presumptive scheme condition, for the coming 5 years again he cannot come back to presumptive scheme, and then for him tax audit also applicable. So okay, if you declare lower profits than that of to be declared under the presumptive scheme, then you are under suspicion. Okay, they are doubting you. Why he is not even getting minimum 8% profit also. That's why what they are saying like, for you tax audit applicable, and since you came out or you opted out from presumptive scheme, for the next 5 years you cannot even come back to presumptive scheme also. In any of the 5 consecutive previous years, then not eligible to 4480 for another 5 succeeding assessment years. See, Vamshi traders previous year 25-26 turnover equals to 90 lakhs in cash, which is less than 4480 limit. Actual profit is how much, sir? 5 lakhs. If opted 4480, minimum profit to be declared is how much? 7.2. Shown 5 lakhs only, which is less than minimum to be declared under 4480. So he is ineligible for the next 5 consecutive previous years also for 4480. Then 4480 subsection 5. If 4480 subsection 4 applies and SSE's net total income is greater than basic exemption limit, then tax audit also applicable. Sir, he should have shown less than 8% or 6%, and that profit should be more than basic exemption limit also. Both has to be satisfied. More than basic exemption limit and less than 8 or 6%. In such case, tax audit is applicable for him. Then here what, sir? Agricultural income is also exempted. Sir, why na? I'll discuss 44AB afterwards, sir. That's why I discussed this agriculture income point also. Agriculture income is what? Usually exempted when the land situated in India. Income of nursery from sale of seedlings and saplings is also exempted. Then income from sale of rubber, 35% is business income, 65% is agri income. Sale of coffee grown, cured, roasted and grinded by seller, then 40% is business income, 60% agricultural income. Sale of coffee grown, cured, okay, sir, coffee from the coffee plants, okay, they'll come something like cherries, okay, from them they'll peel the outer layer and the coffee seeds will be first cured. I mean, they'll be cleaned. That's called cured, means only cleaning process is done. Grown and cured. They just did grown and cured. Then 25% is only business income. 75% is what? Agri income. Then those seeds, they are roasted, grinded into powder, and they may add for flavor some other extra powders also they'll add. When they did, then 40% is the business income, 60% is the agri income. Because from grown cured to extra year, what they did even roasting and grinding also. Business activity increase. That's why business income 40, agri income 60. Only coffee just grown and cured, na 25 business income, 75 agri income. Tea always, sir, grown and manufactured, how much? 40% agri business, 60% agri. Then rubber, sir, 35% business income and 65%, sorry, 35% business income, 65% agri income. Okay, then. Sir, see how to calculate. Sale of tea powder, 50 lakhs, sir. From there, cultivation cost, how much is that? That has to be subtracted. Processing cost is there subtracted. Then how much is the profit? 20 lakhs. Out of this 20 lakhs, 60%, 12 lakhs is what? Agri income. 40%, 8 lakhs is what? Business income. Sir, we have seen in a question where they have credited total 20 lakhs into the P&L. Okay, total 20 lakhs they have credited. But out of 20 lakhs, how much is exempted? 12 lakhs is exempted. So they should have credited only how much? 8 lakhs. But they credited how much? 20 lakhs. So 12 lakhs, what we should do? Subtract. 12 lakhs we should exclude. So we should what? Subtract. Okay, in June 2025 exam question, this point we have seen. Yesterday also we have did. Okay, now sir, the next one is in
So then we are having concept of tax audit. Okay, you all know tax audit is additionally introduced from December 2025 exams also. So now we'll discuss what is called tax audit, when tax audit is applicable, and then what has to be reported in the tax audit report also. Okay, sir, if you remember the whole PGBP, allowances, disallowances and all, then tax audit report is very easy. Okay, first we cannot complete everything now, sir. We just discuss tax audit conditions, then the clauses and all we're going to discuss tomorrow only. Tax audit has to be carried out. Okay, first applicability of tax audit. Okay, tax audit has to be carried out by a practicing chartered accountant only. Our problem is what even institute is expecting CMAs also has to be added. But why they are not adding now? Institute has identified one problem, like tax audit is not there in our curriculum now, so they wanted to add tax audit. But still, all the audit standards are not there for us. Even cost audit is there, but only it does not cover all the auditing standards. So to get the tax audit right, we not only learn the tax audit. So tax audit now here only some clauses PGBP wise we are mentioning, but we need to learn even what the audit standards also. Then will be suitable to do the audit. Okay, we need to understand what is the concept of materiality, how to do sampling, how to get the confirmations, evidences, all those things, right? Okay, so we should have clarity first. So in cost audit syllabus, what they have to do? Auditing standards also has to be included. At least some important audit standards has to be included. And in tax, they have included already tax audit. Then we are ready for doing audit. Actually, tax audit also shall not be here. This should be also in which chapter, which subject? Audit subject only, it should be there. In CMA, tax audit will not be there in direct tax. It will be there in auditing only. Audit has to be carried out by whom, sir? Practicing CA. Audit report has to be submitted in Form 3CA and Form 3CB or 3CD. You'll understand when 3CA, when 3CB also. Audit report has to be submitted 1 month prior to the due date of filing of return of income. Sir, when the return has to be filed? 31st October in audit case. Then audit report has to be submitted 1 month prior to that. That means by 30th September of assessment year. Applicability, business. If SSE is carrying out a business, sir, then his total sales, turnover, gross receipts, if they are more than 1 crore in the relevant previous year, if they are more than 1 crore in the relevance previous year. So now you have a question. Let's say, sir, his turnover is 1.9 crores. He is eligible for presumptive scheme. If presumptive scheme opted not, tax audit not applicable, I said. But here what we said, 1 crore in excess of turnover, tax audit is applicable. Now which section we have to follow? By applying presumptive scheme, no tax auditor, or by applying 44AB, we need to get tax auditor. So what is the point, sir? See, here given a note. If opted for presumptive taxation scheme 44AD, AE, then tax audit is not applicable. For you, if presumptive scheme applicable, then you are not required to get your books of accounts audited. Tax audit not applicable. So usually what is the tax audit turnover limit, sir? 1 crore. But however, if the aggregate of cash receipts are within 5% of total receipts and aggregate of cash payments are within 5% of total payments, both, sir, receipts in cash also should be within 5% of total receipts. Payments in cash also should be within 5% of total payments. Then the tax audit turnover will be 10 crores instead of 1 crore. Normally the threshold is how much, sir? 1 crore. But it will be 10 crores when the cash receipts are within 5% and the cash payments also within 5%. Then when section 4484 or 4485 is applicable, that means what? SSE declared lower profit than that of be declared under section 44AD. Then when SSE opts for section 44AE and income declared in the relevant previous year is less than presumptive profit under 44AE. Sir, for under 44AE, how much minimum profit he has to show? 7,500 per vehicle. Heavy goods vehicle, 1,000 per ton. Okay, he declaring lower profits than that of the profit to be shown under the presumptive scheme. For him, 44AE applicable. I mean, his vehicles are less than 10 only. So, but he is declaring lower profit than that of to be declared under 44AE. Same as like 44AD only, sir. Minimum 8% to be shown, but he's not showing even 8%. There also minimum some profit has to be shown. If he's not showing, then they have a doubt towards him. So they're asking him to get his books of accounts audited. So when SC opts 44AE and income declared in the relevant previous year is less than presumptive profit under 44AE, then also tax audit applicable. Then professional, sir. For profession, when tax audit is applicable, when his gross receipts or turnover from profession is more than 50 lakhs, or for SSE covered under 44ADA. Okay, if income declared is less than presumptive profit under 44 ADA, then also again what? Tax audit applicable. Okay, sir, either 44 AD, ADA, AE, 3. Minimum profits to be declared. You are eligible for those sections, but you are declaring less profits than that of the minimum profits to be shown under those sections. Then for you also, tax audit applicable. In general, profession when turnover exceeds 50 lakhs, tax audit applicable. Business when turnover exceeds 1 crore, tax audit applicable. But for business, sir, 10 crores of separate limit also there. When the aggregate of cash receipts are within 5% and aggregate of cash payments are also within 5%, then the tax audit result is 10 crores instead of 1 crore. Assessment of companies. So under assessment of companies, we have, sir, already companies related tax rates, surcharge rates, all those we have discussed in the first chapter basics only. It's okay, once again, quickly, if you wanted. See, what are the tax rates applicable to companies generally? When the turnover in previous year, 23-24 is within 400 crores, 25%. Otherwise, 30%. Foreign company, 35%. What are the surcharge rates applicable? Domestic company, total income up to 1 crore, nil. 1 crore to 10 crores, 7%, above 10 crores, 12%. Foreign company, up to 1 crore, total income, no such charge. 1 crore to 10 crores, 2%, above 10 crores, 5%. Okay, these are the tax rates applicable to normal, default tax rates applicable to companies. These are the default rates. Okay, sir, once again, turnover of which year we need to check? Previous year, 23-24, within 400 crores, then the tax rate is 25%. Turnover is more than 400 crores, then the tax rate is 30%. Okay, total income up to 1 crore, such as rate, sir, then the total income up to 1 crore, nil, 1 crore to 10 crores, 7%, above 10 crores, 12%. Okay, optional, okay, now we're going to go on top the optional regime, sir. Sir, all these new regimes are optional to companies, but under individual HUF, AOP, POI, new regime is the default regime. Okay, so first, 115BA, sir, we'll go section by section. Domestic company, to get 115BA, I mean to be eligible under 115BA, it should be a domestic company manufacturing set up on or after 1st April 2016. Domestic manufacturing on or after 1st April 2016. Okay. Then what is the tax rate? Sir, here incomes are segregated. Based on those incomes, rates are applicable. See, business income, tax rate 25%, surcharge normal only 7 or 12, depending on total income 1 crore, 1 crore to 10 crores, so that way. If there are special rate incomes, what are called special rate incomes are long-term capital gain, 112A, 112 and 112A. Short-term capital gain, 111A. Okay, and casual incomes, all these are what? Special rate incomes. They are taxable at special rate only. Surcharge also normal kind of surcharge only. Up to 1 crore, nil. 1 crore to 10 crores of total income, 7%. Above 10 crores, 12%. Then, if there is any short-term capital gain on sale of depreciable asset, that is same as like normal incomes, like 25% is the tax rate. Surcharge, common thing only. If any other incomes are there, IFOS, house property, or other short-term capital gains under 111. Sir, other short-term capital gain, okay, that also what? 25% is the tax rate, generally only. Applicable surcharge plus 4% cess. Sir, here under 115BA, even though I wrote 4 different categories, but effectively 2 only. Special rate incomes, special tax rates only. Surcharge, depending on total income, how much it is. Whereas normal incomes, other than special rate incomes, normal incomes are taxable at 25% tax rate. Surcharge, common only. Up to 1 crore total income, nil. 1 crore to 10 crores, 7%. Above 10 crores, 12%. Cess 4%. Okay. 115BA, applicable to domestic manufacturing on or after 1st April 2016. Then, tax rates. Generally under 115BA, what is the tax rate, sir? 25%. Surcharge, normal surcharge only. Cess also normal only. But if they are having special incomes, what are special incomes? 112A, 112, 111A and casual incomes. On them, special tax rates only. Whatever are the special tax rates we discussed in the first chapter, like long-term capital gain under 112, 12.5%. Long-term capital gain under 112A, 12.5% in excess of 1,25,000. 111A, 20%. Those special rates only applicable on special rate incomes. Casual income, na 30%. Surcharge also commonly only. Okay, this is under what? 115BA. Then 115BAA. 115BAA is applicable only to any domestic company. It may be manufacturing or not. Still, 115BAA is applicable. Tax rate is how much, sir? 22%. Surcharge fixedly 10%. Sir, under 115BA, not surcharge fixed. Generally, when total income exceeds 1 crore only, surcharge comes. But here, surcharge fixedly 10%. How much ever is your tax? How much ever is your total income? Fixedly, you should charge surcharge of how much? 10%. 22% tax, surcharge 10%, plus cess at a rate of 4%. Sir, here also, even though I given 4 classifications, effectively 2 classifications only applicable. What are those? Special incomes, na, taxable at special rates. Surcharge again fixed, 10% only, cess at a rate of 4%. Whereas normal incomes, na, other than special rate incomes, na, tax rate 22%, surcharge fixedly 10%, cess at a rate of 4%. So what is the difference between BA and BAA? Here surcharge is fixed 10%, whereas there surcharge in general, how do we charge? Up to 1 crore, nil, 1 crore to 10 crores, 7, about 10 crores, 12, that only applicable. Then the other difference between BA and BAA is like BA manufacturing company only, BAA it could be any company. Then another thing, sir, BA the tax rate on general incomes is like 25%, BAA the tax rate is 22% only. Now the third one, BAB. Domestic company, manufacturing company, set up on or after 1st April 2019 to 31st March 2024. Domestic manufacturing company set up on or after 19 to 24. In this period, it should have been set up. Then they are eligible for what, sir? 115 BAB. Domestic manufacturing on or before first, I mean in that 5-year period only, sir. To 1st April 2019 to 31st March 2024. In that 5 years, it have been started. Then the tax rate, sir. On business income tax rate, 15%, 10%. Surcharge fixed here also, cess 4%. Business income tax rate how much? 15%, surcharge 10, cess 4%. Special rate incomes are there, then tax, special rate, surcharge 10% fixed, cess at a rate of 4%. If they have any short-term capital gain on sale of depreciable assets, these also has to be treated as like business income only. Short-term capital gain on sale of depreciable assets also has to be treated as like business income only. And taxable at what? 15%, surcharge 10%, cess 4%. If they have other incomes like IFOS, house property, and other short-term capital gains, then they are taxable at 22%, surcharge 10%, cess 4%. So here it is complicated, sir. We need to be clear about the tax rates. Okay. So where there is more complications, that is only important. This, sir. This one, 22 only. Okay, come from 22 only. It's not 15. Okay, that's the difference there. Business income and short-term capital gains arising on transfer of depreciable assets. I mean, business-related incomes taxable at 15%. Special incomes taxable at special rates only. Normal incomes, other normal incomes taxable at 22%. 3 rates. Business income. But normally business now will take only PGBP income. But since depreciable assets are also somehow related to business only now, so what they are saying, short-term capital gains arising on depreciable assets are also taxable at 15% only. Special rate incomes, normally is like special rate only. Other incomes, house property income is there, IFOS income is there, other short-term capital gains are there, taxable at 22%. So 3 rates. For normal 115 BA and BAA, sir, 2 rates only. 25% special rate, 22% special rate. Here, 15% on business income and short-term capital gain and depreciable assets, special rate income, special rate, and then 20%, 22% on other incomes. What are other incomes? House property, IFOs, and all. Sir, for company, salary will not be there. Yes or no? Company will get salary. Yeah? It cannot be employee, right? Can company be employee? Only natural persons can be employees. So company cannot get salary. House property covered under other income, 22%. Then business income, PGBP, covered under 15%. Capital gain, long-term and short-term under 111A, covered under special rates, so special rate income, and that there only short-term capital gain under depreciable asset, again 15%. Now in capital gain, other short-term capital gain is pending, which is covered under 111. That other short-term capital gain also again taxable as normal income only 22%. Last fifth head is what? IFOS, that is also taxable at what? 22%. All the 5 heads related tax rates we have set. Okay, sir, clear, sir? 115 BA, to whom it is applicable? Domestic manufacturing on or after 2016. BAA, domestic. BAB, domestic manufacturing 2019 to 2024. Tax rates. BA, sir, 25 special rates. Surcharge rates also normal only, no fixed surcharge rate. BAA, 22% special rate, surcharge fixed rate of 10%. BAB, 15% business income, other incomes 22%, special rate incomes, special rates, surcharge 10% fixed, and cess at a rate of 4%. MAT, except under BA. BAA and BAB, MAT concept is not applicable. If you have opted for 115 BAA or BAB, for you MAT provisions are not applicable. Even though past MAT credit, if anything is there. If any past MAT credit is there, so you may not understand what is called MAT credit. MAT is an alternate way of tax computation. Normal computation, MAT computation. If any year, if you need to pay because of MAT, then how much you paid excess compared to the normal? So normal provisions, now you need to pay 10 lakhs as tax. By applying MAT provisions, you need to pay 15. Now what to be paid? MAT only to be paid 15 lakhs you have to pay. How much excess you paid? 5 lakhs. That 5 lakhs will be given as MAT credit to you, which can be adjusted where normal tax is higher than that of the MAT tax. In any year where normal tax is higher than that of MAT tax, that year you can adjust MAT credit. So even if you don't understand now, no problem, because we want to discuss it clearly how MAT has to be computed. What is MAT credit again once again? Okay. MAT credit also cannot be set off. The past MAT credits also can't be set off under 115 BAA, BAB. But MAT is allowed under 115 BA. I mean MAT applicable under 115 BA. Even past MAT credits also can be set off under 115 BA. Then what are the deductions not available if you opt for new regime? You will not get additional depreciation. Under PGBP, sir, if you opt for 115 BA, you will not get what? Additional depreciation. Then 33 AB, 33 ABA. What are 33 AB and ABA? Tea, coffee, rubber development fund and site restoration funds. 35 related contributions, not in-house research and development expenditure. Contributions made. 35 AD, specified businesses. 35 CCC, sir. No. CCA is rural development. CCC is about agricultural extension. CCD is about notified skill development project. CCA is about rural development. So rural development is allowed even under the new regime also, which is not allowed. Agricultural extension projects related, skill development projects related is not allowed under new regime. And then 10A deduction is also not available if you have opted for new regime. Okay, any of these 3 sections, sir. Any of these 3 sections you opted, you will not get additional depreciation. 33 AB and ABA. Tea, coffee, rubber development fund, site restoration fund, contributions made with respect to scientific research. In-house research and development allowable, but contributions made are not allowed. 35 AD, specified businesses, 100% capex is allowed as deduction. That is not available. CCC, agricultural extension project related, if you spend 100% allowed. 35 CCD, notified skill development project, that is also not available. And last 10A deduction, these are not available under the new regime. Then chapter 6A deductions. Generally, chapter 6A deductions are not available, sir, but 80JJAA is available. 80JJAA. What is 80JJAA, sir? Additional employee cost. 30% of the additional employee cost can be availed as deduction. Okay, so try to, tell me, sir, how much you can recall from additional 80JJAA? Emolument should be equal to how much you said? Correct only. Minimum they should work for 240 days. Their total emoluments in a month should be within 25,000. 1, 2 points correct. For leather apparel industries, 150 days. That come under the second point only still. They should be participating in the PF. Okay, recognize the provident fund participation should be there. Third point. Must be. That already said first point. 25,000. From where you got 10,000? Fourth one, it shouldn't be paid through cash. Only paid through specified modes only. Fourth one. Fifth one, the increase should be an overall increase. I mean, it's not just new employees being recruited. When you compare it with the opening to the closing, there should be a overall increase in the employees. These are the 5 conditions. And eligible for any SSE, individual and HF, for them tax, I mean, if you claim 80 JJ deduction, tax audit is applicable to you. Okay, so you'll calculate additional employee cost. Additional employee cost into 30% can be claimed as deduction for how many years, sir? 3 years. Okay, if a new employee has been taken on his employee cost, first year 30%, second year cost 30%, third year cost also can be claimed as 30%. Assam. Okay. So go back and refer, sir, 80 JJ once again, because the next question we solve has 80 JJ points. Okay, refer all these 3 deductions once again: 80 JJAA, 80 LA, 80 M. 80 LA is about banks related, sir. When they have a offshore bank unit, IFSC unit, from that if they are earning any revenue, that is eligible for deduction, 80 LA. 80 M is about intercorporate dividends. Dividend received or dividend paid, whichever is lower, can be claimed as deduction. Got it? Varsaga. You may start with from 3rd year also, but from once you start, you have to claim consecutively. Which section it is? Okay, so out of those 3 sections, 80 LA is only the most useless section for us. Okay, because 80 JJAA, sir, LA na only specific to what? Sir, any provision, sir, if you remember here, for us, specific to one industry are not important. In general, if they are applicable, then they have more importance, right? ETJJ is what? Additional employee cost. In any type of industry, there will be additional employee cost. ETM is about what? Intercorporate dividend. In any companies, any business, there will be again dividend received and dividend payable. But 80LA, why I am saying now? Because 80LA is specific to one particular segment only, banks related. That also banks, when they are having offshore banking units or IFSC units, then only that is applicable. Okay? So most of the time, sir, at least in our CMA final, they are not targeting us that you know specific about one particular industry. Mostly the examiner frames regarding the general business related applicable points only. That's why even like 33 and 35, I said like they are of less importance now. Why? Because 33 and 35 sections cover more about specific businesses or specific segments only. Whereas 36, 37, 32, 30, 31, those are not specific to one particular segment of business or one particular industry of business. They are common to each and every business. Okay. Even for practicing also. Okay, so sir, if you go even to a practicing chartered accountant and ask also, he may not know about this 33AB, 33A and this 35 related 35A and all, because those are specific to one industry. So only if you go for that industry, then he'll think of the relevant section. Otherwise, those are irrelevant only. Na? Okay. So then, what deductions are available, sir? Chapter 60 deductions are not available. What are only available? 80 JJA, here 80 JJA, 80 LA, 80 M, under what? 115 BA, 115 BAB, 80 JJA and 80 M is available, sir. Why here only LA? If you see, sir, applicability, you can easily remember only. 115 BA is for manufacturing. Bank is a service sector. That's why 80 LA is not covered there. Okay, even 80M also not there. But if you look at BA and BAB, BA, there could be any company. That's why banks also can come. 180 LA is also covered. Whereas under 115 BAB, manufacturing sector only. So banks cannot come. That's why only 80M and 80 JJA. Then exercising the option. How do you exercise the option, sir? For exercising the option, 10 IB under 115 BA, 10 IC, 10 ID. These forms has to be filled and has to be filed before the due date under section 139 subsection 1. Withdrawal of option. From once you opt for 115 BA, you cannot opt out, sir. The only way is you can go to 115 BA. BA to BA you can go, but there is no other option for you. Okay, once you be under 115 BA, you continues to be under 115 BA only. The only option is like if you want, you can go to BAA, because BAA was introduced later to that of BA, and BAA is much more beneficial because 22% only, whereas in BA 25%. So the option is like from BA you can come to BA. Whereas under BAA and BAB, no option to shift. Okay, once exercise can't be withdrawn in same or next assessment years. If any brought forward losses and unabsorbed depreciation are there, from current year you are into new regime. Till last year you are under old regime only. That time you have brought forward losses and unabsorbed depreciation. Only under 115 BA, both brought forward loss and unabsorbed depreciation are eligible for, brought forward loss is deemed to be set off only. 115 BA also, I mean you cannot set off anymore. That brought forward loss, whatever is there, that is gone. You cannot set off anymore. But unabsorbed depreciation is eligible for set off even if you opt for 115 BA. But whereas under BAA and BAB, both brought forward loss and unabsorbed depreciation both are gone, deemed to be set off. You cannot set off them once again. I mean you cannot set off anymore. Depreciation, normal rate only sir, only under 115A. If at any case you are claiming more than 40% depreciation, then such depreciation rate is restricted to 40. But most of the depreciation rates we see how much sir? 40 only. There is nothing more than 40, so there is no importance of this provision. If any conditions are not satisfied, if any of the conditions are not satisfied, then option becomes invalid from that year and he has to pay normal tax rates. Then additional conditions for 115 BAB. What? Following business activities cannot be called as manufacturing. What? If you are a developer of computer software, you cannot be called as manufacturer. If you are into mining companies can't be called as manufacturing companies. Your conversion of marble blocks into slabs. So big marble blocks, okay, stones will be there, then they'll be divided into slabs kind of. That business you are there, that won't be counted as manufacturing. Bottling of gas into cylinders, okay, they just refill the gas into cylinders. They are not manufacturing. Printing of books, production of films, or any other business notified by central government, these are not manufacturing activities. What are those, sir? Computer software development, mining, then marble blocks into slabs, printing of books, bottling gas cylinders, and then production of films. These are not manufacturing. However, sir, under 115 BAB, what is the condition? The business should be newly formed from 1st April 2019 to 31st March 2024. Okay, it should have been actually newly started. You cannot just you cannot change the name of an existing unit and call it as a new unit. So business shouldn't be formed by way of splitting up or transfer of existing business. However, out of total plant and machinery they have, 20% can be used ones, 80% has to be new ones. If they are imported plant and machinery, irrespective of whether they are used or not used, they will be counted as new ones only. Sir, for additional depreciation, what we said, imported, okay, imported or not, only new machines are counted. But here for this 80%, sir, imported ones, even though they are used, counted as what? New machines only. Okay. Now we'll go and start a question on this, sir. Question number 15, page number 4.24. Okay. Question answer together, it's spread across 5 pages, sir. It's okay. So be little quick, sir, and you need to tell adjustments also little quick, then we can solve quickly. Once we are reading the question itself, we can identify whether it is allowed or disallowed, what to be done and all. Sir, which section it is? 115 BAB. What are the tax rates for 115 BAB? Business income 15. Short-term capital gain on depreciable asset 15. Special incomes, special rates. Other incomes, surcharge 10% fixed. Cess 4%. Okay, who are eligible? Domestic plus manufacturing commenced on or after? So okay. Shivam, manufacturing company, done. Leather products, done. 1st November 2022, within the slot. Okay, as per statement of P&L, their profit is how much, sir? 1 crore 20 lakhs. Our starting point is what? 1 crore 20 lakhs after debiting or crediting the following items. Then, first one, sir. Opening stock and closing stock are undervalued by 10%. Opening stock is how much, sir? 55 lakhs. This 55 lakhs is undervalued. Okay, so this is equivalent to 90% only. 55. Opening stock undervalued. So what we have to do? Sir, when opening stock was undervalued, what happened to the profit? Profit increased. Huh? Okay, sorry. I checked only this one. Opening stock is overvalued, closing stock is undervalued. Okay, I checked only this undervalued. Opening stock is overvalued. So that means what? This 55 lakhs is 110%. So how much, when opening stock overvalued, profit, what happened to profit? Decreased. So to make it normal, what we should do? Add. How much amount? 5 lakhs we should add. Then closing stock 54 lakhs is what? Undervalued by 10%. So this 54 lakhs is how much? 90% only. So 54 into 10 by 90, if you do how much? 6 lakhs. Sir, closing stock undervalued. Profit also reduced. To make it normal, what we should do? Add. So 5 lakhs also we should add, 6 lakhs also we should add. Total how much we should add? 11 lakhs we should add with respect to stock adjustment. Then second one. Second points are important. Okay, we'll see how many of you know. Second point, read and tell. Yes, Subhasri, you're correct. 100% disallowed. Okay, which section it is? 40 subsection A, first provision. Open it and read and again confirm. Open the provision, read and again confirm. In notes, if you follow, it will be much more clear also, if you have already notes. Sir, what are covered there? Huh? Here it is what? Means, out of those, which category it is? Fourth means what? So you need to find out what here. Is it chargeable to tax or not? First tell that. Okay, you are straight away non-resident when you saw, you are saying like what, 100% disallow. I clearly said when I explaining the provisions also, interest, royalty, fee for technical service, salary, you need not to check anything. If TD is not deducted, straight away disallow. But for other incomes, you need to put extras and even need to check whether they are taxable or not. Whether they are taxable or not. For a non-resident, when an income is taxable in India? When it is accrued in India. Now decide and tell whether that commission accrued to him in India. Accrued in India now. Read the sentence once again. Where he is getting orders? Outside India. Where he is doing his total work? Outside India. That means where it is accrued? Outside India. Is it taxable in India? No. So that income is not even taxable in India. If it is not taxable in India, does TDS has to be deducted? No. Since TDS is not required to be deducted, no problem. They didn't even deducted. So is it allowed or disallowed? Allowed only. Okay. So understood this one? Why it is allowed? Because commission, to earn commission, he is procuring orders from where? Outside India. So that means income accrued in India, no? Outside India. No? For non-residents, income accrued outside India, taxable or not taxable? Not taxable. If it is not taxable, why TDS has to be deducted? That's why they didn't deduct it. What it is? Correct only. Okay, why we have to disallow it? So it is correct. Yes or no, sir? Then third one, sir. 45,000 paid in cash to Mr. Raj, employee of the company at the time of his retirement. Allowed or disallowed? What is the cash limit, sir? Normally how much? 10,000. But there are exceptions. In that exceptions, when it is paid to any employee at the time of retirement to a employee or his family, up to 50,000 it is fine. Okay, that's why it is what allowed, no problem. So this only 11 lakhs we should add. Rest all, second and third, nothing to be added. But you need to write explanation. Fourth point, sir. Profit on sale of shares of a listed company. These were sold on. Okay, so whatever is the profit on sale, sir, 3,50,000, this was credited to P&L. But the profit on sale of shares not taxable under which head? Capital gains head. So this income already credited to P&L, but it is taxable under which head? Capital gain. So what we should do? We need to subtract. So 3.5 lakhs we need to subtract because it is credited to P&L, not related to PGBP. Okay. Then short-term capital gain on transfer of a capital asset on which no depreciation is allowable. Sir, again, this is also what? Short-term capital gain. Taxable under which head? Capital gain head. Not related to PGBP, not related to PGBP. But already credited to what? P&L. So what we have to do? Sir, how do we know it is credited to P&L, sir? Here, after debiting or crediting the following item. So it was already what? Income nature, now so it is already credited to P&L. So tell, what we have to do this short-term capital gain, sir? Minus, okay? 75,000 we should subtract. Then, profit of 6 lakhs on sale of plot of land. The entire share of which are held by SSE company. The plot was acquired by Shivam Limited. Sir, again, this profit also related to PGBP. Yeah? Profit on sale of plot of land, sir. Again, capital asset related to capital gain only. Is it related to PGBP? No. So what we have to do? 6 lakhs also subtract. Because all these three are related to which head? Capital gains head only. Then, credit of statement of P&L account include 50,000 dividend received from a domestic company. What we should do this? 50,000 dividend, sir, it is there, credited to P&L. It is taxable under which head? IFOS. So what we should do? This also we should sub minus when we are calculating income under the head PGBP. Then 20,000 paid for expenses in connection with inauguration of a new branch. Sir, it is related to business only. Okay. So inauguration expenditure is not capital expenditure. It is like, sir, inauguration, decoration, sweets you will do now. That is what? Revenue kind of expenditure only. It is what? Allowed. Because nowhere it is said like disallowed. 37 it qualifies. Not of personal nature, not of capital nature, incurred in the current year only, not a violation of law, and no specific disallowance also. So what it is? Allowed. The ninth point, sir, again, read and tell. $20,000 as paid as penalty to government for company's failure in performance of a contract. There was a delay of 4 months. The company had to pay a penalty of 5,000 per month. Allowed or disallowed? Why? Violation of? Okay, where is there is a law? If you don't perform a contract, sir, let's say, if I don't complete, I promised you to complete the classes by 31st March. If I don't complete, is it a violation of law? Is it a violation of law? What law we both have? Sir, anyway, I'm just asking you, is it a violation of law? Or else I promised to construct the road within 3 months. There is a cyclone, I cannot complete the road within 3 months. Is it a violation of law? So this is for delay in payment of, delay in completion of contract, we are paying penalty. There is no violation of law. So penalties which are for violation of law are disallowed. Other than if there is violation of law, no, sir, here it's like compensation. Even though they use the word penalty. Penalty, When it is disallowed, when it is related to violation of law or infraction of law, then only it is disallowed. Okay, you only said you know that penalty, violation of law only disallowed, but you couldn't understand or you couldn't connect it that that is not a violation of law. There is no violation of law there. Sir, in any business there will be delays in the contract's execution, but that doesn't mean violation of law. So since there is no violation of law, such penalties are not disallowed. So what? Allowed only. Then 10th point, sir. 10th point. Allowed only, huh? 5 equal installments. So how much allowed, how much disallowed? 1 lakh only allowed. But how much they allowed? 5 lakhs. So what you should do now? 4 lakhs add back. Because VRS expenditure is allowed only in 5 equal installments. But they claim total 5 lakhs in the P&L. So this current year installment 1 lakh only allowed. The balance 4 lakhs we need to add back. Then interest 75,000 paid to bank remittance on deposits made by non-resident buyers. Okay, read and tell, sir. Question number 11. Disallowed. Why? Payment to non-resident. What point it is? Interest. Interest now we did not check anything. Straight away. On interest TDS not deducted, na? Disallowed. Or interest, royalty, FTS, salary. Those nature. If not, you need not check accrued in India or not. For interest, royalty, FTS and salary. They are deemed to be accrued in India. So that's why straight away non-deduction of TDS, na? Disallowed. But for any other income only we should check what? Whether such incomes are accrued in India or not. Okay. Then what year? 75,000. What we should do? Add back. Then mark to market loss amounting 6 lakhs in respect of an unsettled derivative. Sir, with respect to this market to market loss, sir, mark to market loss are not allowed. So the 6 lakhs loss, what we should do? Add back only. Mark to market losses are not allowed only. Okay, I can confirm you also here. See, mark to market loss 6 lakhs added back. Mark to market loss will not consider. Then contribution of 2,50,000 to a scientific laboratory functioning at the national level with a specific direction for use of amount for scientific research program approved by prescribed authority. Allowed or not allowed? Allowed. Which section, sir? 35. Allowed. Pakka. Go and read the first line of question. Okay, or else. Okay, go and read the first line of the question and even, if not, last lines of the question also. Last line of the question. If not first line, then last line of the question. Last line of the question. Not that point. Last line of the question. E point. What they did? They applied under what? 115 BAB. Under 115 BAB, which expenses are not allowed? 33 AB not allowed, 33 ABA not allowed, 35 contribution side not allowed. This is what? Contribution side only, na? In-house research and expenditure allowed. But this is contribution made to someone, so it is what? Disallowed. Normally it is allowed only, sir. But here under 115 BAB, na, this is what? Disallowed. So what we should do? 2.5 lakhs. Add back. Then depreciation, sir. Depreciation on tangible fixed assets, how much, sir? 2,20,000. Additional information is there. Depreciation on tangible fixed assets as per income tax rules is 2,60,000. Company has acquired on 15th November 2025 new machinery and put to use the same. Depreciation on such machinery is not included, sir. Depreciation as per books of accounts is how much? 2.2 lakhs. What we should do this 2.2 lakhs? Add back. And then we should subtract this 2.6. But what they said extra point, they purchased the machinery for 20 lakhs and on that no depreciation is claimed. How much depreciation you'll get on that 20 lakhs? Company is into manufacturing also, sir. 115 BAB they opted, then they are not eligible for additional depreciation. So only normal depreciation. 20 lakhs into 7.5%. How much? 1 lakh? 1 lakh 50 and that 2 lakh 60. Total how much depreciation? 4 lakh 10,000 depreciation we need to subtract and we need to add back how much? 2 lakh 20,000. Clear, sir, this point also? Then during the financial year, they had total how many employees, sir? Additionally, 56 additional employees. 56 additional employees. All these employees contribute to RPF. 39 out of 56 employees joined on 1st June for 15,000 salary. 14 joined for on 1st July for 45,700. Sir, are these eligible? These 14 people are not eligible. Why? Because their total salary is in excess of 25,000. Then on 1st November, another 3 joined for a salary of how much? 22,000. Okay, but out of the first joined 39 employees, for 9 employees, it was paid through bearer checks. The payments has to be made through what? Specified modes. What are specified modes means? Account to pay check, account to pay draft, electronic clearing system. But here they paid through bearer checks. So these 9 people are not eligible. These 14 people are not eligible. So how much total, sir? If you could see, 56 employees total. Out of 56, 39 joined on 1st June. Each salary is how much? 15,000. Okay. Out of 39, sir, 9 employees are not eligible. Okay. Balance, how many employees are there, sir? 30 employees are there. How much is paid? 15,000 into 10. Total how much, sir? 45 lakhs is here. We are calculating additional employee cost, sir, to get the deduction. Understand? Under 115 BAB also 80 JJ deduction is allowed. Understand? Here there is a disallowance point also. For those 9 employees, how the salary is paid? bearer check. How much is the amount? Each salary, how much, sir? First joined set of people, 15,000. So, for those 9 employees, they made a payment in excess of rupees 10,000 in a day. Which disallowance will attract? 40A subsection 3. Okay, sir, that salary expense they might have already debited to P&L, right? Out of the salary, 9 employees, they paid in bearer check, other than specified modes. Then 100% of such expenditure is what? Disallowed. So how much is that? 9 into 15,000 is how much? 1,35,000. How many months? 10 months. Total 13,50,000 is also disallowed. Here we should add back another 13,15,000 also. So usually what we'll forget now, we'll think of 80 JJ deduction only and we'll forget about this disallowance. 80 JJ point is there and even inherently there is a disallowance point also there with respect to cash payment. 13,50,000 disallowed. Then out of 39 employees, sir, how many are eligible? 30. 30 members' salary is 45 lakhs. Then second set of people, 45,700, not eligible. Third set, sir, how much? 22,000 only, 3 employees. Each salary, 22 into 3 into 5 months. Total how much? 3.3. 45 plus 3.3. Total employee cost is how much? 48.3. Out of that, how much is eligible as deduction? 30%. So total is how much? 14.49 lakhs is eligible for 80 JJAA deduction. Understand? Okay. Then the company has paid through bank 1,20,000. Sir, if you see here, this is additional information. That means they are not saying like these are already debited or credited to P&L. The above points are already debited and credited to P&L, but these are not already debited or credited. So what they are saying, company has paid through 1,20,000 to National Fund for Rural Development. Sir, I already said, under new regime, skill development project related contributions ineligible. Agri extension project related ineligible. But rural development related are eligible only. Since this 1,20,000 is a eligible deduction, but did they debited to P&L? No. It is eligible only, but not debited to P&L. So what we should do? Now we should allow. Now what we should do, sir? We should subtract now. Okay, sir. Now we got PGBP related adjustments, but not at all the question is completed because there are 3 points related to capital gains. 3 points related to capital gains. So we should do what? Capital gain computation also, sir. Let me take you back there. Second point, simple only, sir. 3 capital gain points are there. 1, 2, 3, 5, 6, 4, 5, 6 points. Fifth point, straight away they given short-term capital gain. Okay, you will take directly short-term capital gain. Sir, is it depreciable asset other than depreciable asset? No depreciation. So it is not a depreciable asset. So taxable at what rate? 22% only. Other income. Business income and short-term capital gain on depreciable assets are taxable at 15%. Other incomes are taxable at 22%. So this comes under other income. This 75,000 taxable at what rate? 22% tax rate. Then sixth point C. Profit on sale of plot of land. Sir, the plot was sold by whom? Domestic company to an entity in which SSE has the entire shares. When you hold 100% shares in a company, then both are called what? Holding and subsidiary. That also wholly owned subsidiary. So there is a point in capital gains where any asset transfer is made by holding company to wholly owned subsidiary. And if the recipient company is a domestic company, then capital gains will not attract. It is not even a transfer. So the 6 lakhs is not even taxable. Simply ignore. That is not even a real gain. Then fourth point, sir. This is again important. This is related to listed equity shares. Capital gains on sale of listed equity shares. So what is the price they sold ultimately? The highest price, 250. The said shares were acquired for 75 per share. STD paid. Sir, ultimately, how many shares he has? 2,000 shares. Okay. 2,000 shares are there. Sir, read this point clearly. Profit on sale of 2,000 shares. So he's having how much? 2,000 shares. Okay. This profit we ignore. These were sold at how much, sir? 250 per share. Roughly calculate, sir. 2,000 into 250. 5 lakhs is the sale consideration. Now we know what? Cost of acquisition. So the cost of acquisition for these shares will be little different. See, this is the point. Profit on sale of listed company shares. Okay. The cost of acquisition, we cannot directly take the purchase price for these shares. The cost of acquisition is fair market value as on 31st January. Okay, fair market value as on 31st January 2018. Sir, what is this now? I'll tell you the background also. Till 31st January 2018, long-term gains on listed equity shares are completely exempted. But that was the Finance Act which made long-term capital gains are taxable. Sir, understand the point, sir. Sir, I purchased in 2005 for 100 rupees, 1 share. By 2018, here, listed equity shares, from 31st March 2018, from 31st March 2018 only, there was a amendment. Till then, sir, now listed equity shares are taxable at what rate? 12.5% in excess of 1,25,000. But till 31st Jan 2018, they were exempted completely. On 31st Jan, they introduced a budget. In that budget, they announced like what? From 1st April onwards. Budget came on 31st Jan, but from 1st April onwards, no more exemption on long-term capital gain. They were also taxable at a rate of 10% that time introduced. But then it was changed to 12.5. That time they said like 10% is taxable. But the problem is, sir, I purchased in 2005 for 100 rupees. By 2018, already the share has become 500. Already I made gain of how much? 400. So that 400 also now becoming taxable. So if they made a change in law, they cannot tax retrospectively. All the gain I made from 2005 to 18 also being taxed when they tax at a rate of 10%. So now what they said, okay, we introduced amendment only from 31st Jan 2018, right? They wanted to ensure that the gains made till Jan 18 are not taxable. Only the gains made after Jan 18 has to be taxed. Here, sir, The share sold for ultimately how much? 250. Originally purchased for how much? 75. Whereas 31st Jan 2018, how much is there? 175. So 75 to 175, whatever is the gain is there, that shouldn't be taxed. The gain made from 175 to 250 alone has to be taxed. Okay, but they need to put it as like a provision. So what they said, cost of acquisition, for computing cost of acquisition, they given two steps. First, take fair market value as on 31st Jan 2018. How much? 175. Or what is the actual sale consideration? 250. 175 or 250, whichever is lower. How much is lower, sir, than 175? Then step 2, you take this step 1 or original purchase price, whichever is higher. Sir, understand simple provision, sir. Step 1, fair market value as on 31st Jan 2018 or actual sale consideration, whichever is lower. Step 2, step 1 or actual cost of acquisition, whichever is higher. In our provisions, sir, fair market value here it is how much? 175. Actual sale consideration is how much? 250, which is lower. So you'll take here 175. Now step 2, what do you have to take? Step 1 is how much? 175. Or actual cost of acquisition is 75. Whichever is higher, na? 175. So the cost of acquisition to be taken is how much? 175. So you already got sale consideration as 5 lakhs. 2000 into 250 minus 175 into 2000 subtract. 1 lakh? 3 lakh 50,000. So what is the long term capital gain? 1.5 lakhs. Okay. And PGBP we already did. Capital gains also we did. And there is some dividend income also yes, which has to be taken under IFRS. Now we'll get what? Total income. You have to claim what? 80 JJAA deduction. Then tax calculation also you must be clear because not a single rate. Business income 15%. Special incomes, special rates. Other income like dividend and other short-term capital gain are taxable at 22%, sir. So what I'm going to tell you is like resolve the question once again, evening. Okay, every step including tax rate calculation also redo. We have only one question on this particular concept. But if you do this now, you'll get clarity about PGBP provisions also. You are able to understand majority of provisions. 115 BAB also you want to understand the tax calculation also clearly you want to understand. Now, so all this we want to discuss now is base for MAT. Okay, these are certain terminologies which are needed for MAT, minimum alternative tax. That's why I'm discussing. Tax on royalty income from patent. Tax on royalty income from patent. Resident SSE, if he transfers or permits to usage any person, what he transfers or permits to usage? A patent which is developed by him either wholly or partly and such patent is registered in India. Okay, you are a resident SSE, you have developed a patent and such a patent you are giving to any other person for what? Transfer or usage. Then such any other person is paying royalty. Now this royalty is taxable at a rate of only 10%. Why sir this concession? Because to sir patent if someone develop now he's like into science and research, right? So to encourage those scientists to register patents in India, when they register their patents in India, their incomes from giving that patent, whatever the royalty they earn is taxable only at a rate of 10%. Okay, to encourage them, to encourage more research and to get more patents. Sir, okay, in US there are more people with patents. That's why more companies can form, more business can be created. First, the starting point to create anything or to start a business is like patent. Some technology has to be invented. Once it is invented, then the companies will grow, businesses will grow. That's what, right, sir? Okay. See, Facebook was invented. That's why it became a global business. First such technology was brought. Microsoft. You see all these big names are started from where, sir? US only. Google. Okay, it's a web where we can search different things. Now, OpenAI, ChatGPT. The other way, SpaceX. So all these innovative ideas are mostly from where? US. That's why US is dominating. Okay. So, but any other country also to grow now. So next, how can China grow rapidly? Now, it's not just because of the other things, sir. They came, okay, they come up with so many new technologies. After US, the next option where we see there are new technologies or technologies which can compete with US or we can see only in China. Okay, that's why we are using so many Chinese products now. Why we are using? Because they are innovative, they got so many technological advances. So to do all that, first there, the native scientists has to be encouraged who are into those researches. That's why what Indian government is saying, if you are a resident SSE, if you develop a patent either wholly or partly and registered in India, by giving that patent someone to manufacture, you are earning what? Royalty. Such royalty is taxable only at a rate of 10%. Okay, under which section, sir? 115 BBF. 115 BBF. This is also a special rate. Then business trust. Concept of business trust. Sir, sir, this is the business trust. It could be a real estate investment trust, or it could be a business trust. Real estate investment trust, business trust. Sir, these trusts will pool money first. Okay, just like as how mutual fund will pool money, same way these trusts also will pool money. From whom? Whoever invests in this trust are called as what? Unit holders. So okay, they invest in the trust and for that they'll get what? Units. Since they got units, they are called as what? Unit holders. Okay, and they can be any SSE. This unit holder can be an individual, company, firm, AOP, or any person they could be. Okay, so if you invest in a real estate investment trust or a business trust, then you will be allocated what? Units. Now this trust has money. What trust will do with that money? Sir, this is not a charitable trust. This is a business trust. Okay. Now these trusts, sir, they'll create SPVs. SPVs, not special purpose vehicle. Okay, I mean nothing but they'll create companies. See, SPVs means these are companies formed for a specific purpose. Okay, and they can have multiple SPVs also. Sir, let's say, sir, this particular real estate trust now by name itself it is suggesting what? They're going to develop real estate properties. For every property they develop, they create a separate SPV. For every property they collect. Let's say, sir, it could be a shopping mall. It could be a commercial complex. Okay, so several properties they might have developed. All those one are under the one trust only. But for every project they did, there will be a separate SPV, special purpose vehicle to look after that project only, that project related only, they'll create a SPV. So there can be what? Multiple SPVs also. Now, SPV, sir. So the funds will be given to SPV. Now SPV will develop a commercial project. I mean, let's say, sir, if you go to Hyderabad or Bangalore, we'll see so many software companies, all that infrastructure they didn't build. These kind of real estate investment trusts and all, they built all these towers kind of 15 floors, 20 floors, 25 floors, 30 floors. All those individual people will not construct. These real estate trusts, investment trusts, business trusts will construct those kind of buildings. And then those buildings will be given as rent, whoever is needed. Okay. So now the special purpose vehicle owns a commercial building, okay, which consists of some 20 floors, 25 floors, where multinational companies can do their operations. Now what? They will construct a project, construct a road, and get a toll license. They can lay road, national highways and all. Okay, then when they lay national highways, what is the income for them? Government will pay part amount, and the other part amount will be given as like toll license. They can collect a toll, and that money is their consideration. Or for this real estate projects and all, they'll construct the project and they'll give it on rent. So monthly rent they earn is called as their income. So from these projects, SPP will earn what? Toll, rent, okay, etc. will be earned. Yes or no, sir? These are example. SPVs can invest even in other projects also, some other projects also. Okay, earns toll, rent, etc. So now SPV earns this income. Now on this SPV will pay tax because SPV constructed a building, on that it is getting rental income. SPV laid a road, and on that it is getting toll income. So whatever is the income to SPV, that is taxable. Right? Till now, are you able to understand, sir? From where originally the money came, sir? Unit holder. Unit holder invested in trust. Trust again invested in SPV. Now SPV is the one who actually did a project. From that project, who got money? SPV got money. Okay, now SPV will pay taxes. After payment of taxes, it again pays dividend, interest or rent to whom? Trust. Real estate trust or investment trust or business trust. Now again, trust has to pay to whom? Dividend, rent, etc. Now the problem is, SPV had to pay tax one time, same income. The same income when it is given to trust here, second time, and then to the unit holder when it gets it as dividend, third time they need to pay tax. Here 30%, here 30%, here 30%, total 90% gone. Now, what income is there still? If this SPV could earn 1 lakh, here only 30% gone. Then 70,000 given here. On this minus again 30%. How much, sir? 49,000 came. And this 49,000 when it came to him, again he has to pay 30%. 30% now another 15,000 if you do, roughly some 44,000 is there, roughly. Out of 1 lakh. And so when the stages of taxation increases, just like as indirect taxation, what happening, sir? Double taxation is happening. That's why, sir, normally in company case also 2 times taxation is happening. Company has to pay tax, and shareholder on his dividend again he has to pay tax. That anyhow is there. Same way here also, that 2 taxation is okay. But here what is happening? 3 times it is getting tax. So to avoid that, for real estate trust and investment trust, business trust, they are getting pass-through status. Pass-through status. I mean, they are just acting as a medium. If from SPV they'll get money, and again they'll give it to whom? Unit holders. So SPV will enjoy a pass-through status. Nothing but SPV is exempted. So it receives income and again gives it to unit holders. Whatever it is received by SPV, it is what? Sorry, not SPV. Whatever is received by business trust, it is completely exempted. Understand, sir? Now how many times it is taxed? 2 times only. At SPV once, and at the unit holders 1 more time. Okay? So this third taxation has been exempted. SPV earns income, taxable. SPV gives dividend, interest, rent to trust. For trust, what it is? Exempted. Because pass-through status available to trust. Then business trust pays the dividend, rent and other income comes to unit holders. To unit holders, it is again what? Taxable. This is the concept of what, sir? Business trust. Okay, business trust, real estate investment trust will have pass-through status. Pass-through status, na? They receive income and again they'll pay the income. So whatever they are enjoying the pass-through status means all the interest or dividend or rent they received is exempted. Sir, here SPV means necessarily need not to be a company. They may create an AOP also. They may create some other kind of organization also, okay? But mostly common thing is what? They can create companies. Then you know deferred tax, right? Deferred tax. Tell what is deferred tax? Deferred tax. India is completed, deferred tax, okay. Sir, one more thing, sir. MAT with India's adjustments is also there. But luckily in CMA syllabus that is not there. Okay, in CA final syllabus actually MAT with India's adjustments is there. Okay, so that part we don't have, sir. We have only MAT with the Schedule 3 accounting standards related to our part only we are discussing. Okay? Tell what is called deferred tax. It's okay, sir. So I need not to explain, sir, but in regular class I explain. That's why that only I'll give you a quick recap. When there is a difference in tax computed based on accounting profit and income tax profit. Okay, see. There is a difference, sir. We already did in PGBP. Tax profit, accounting profit, both are not same. That everybody agrees, right? Now, on accounting profit, you'll calculate tax in P&L. In tax, you'll calculate profit based on tax profit. I mean, PGBP or total income. So there is always a difference between accounting tax, the tax computed as per accounting profit, and tax computed as per the normal total income. So, okay, that difference, we need to identify whether it is a temporary difference or permanent difference. What is permanent difference? the difference is not going to be reversed or set off. Okay, I mean that difference is going to be permanent. It's not going to be reversed also even in some time. So let's say VRS expenditure is there. VRS expenditure in accounting, what we'll do? At a time we'll take. But whereas in income tax, 5 installments we'll take. Now current year there may be difference. But if you look after 5 years time, both has claimed the same amount of expenditure. That is a temporary difference. In the first year, accounting you claimed 5 lakhs as expense. But income tax you claimed only 1 lakh as expense. So there is a 4 lakhs difference there. 4 lakhs related tax impact difference is there. But that's going to reverse slowly in the coming 4 years. Since it is going to reverse slowly, that is called as what? Temporary difference. Permanent difference, now it is not going to be reversed in any way. Okay, never it's going to be reversed. One among them is what, sir? CSR expenditure. Corporate social responsibility expenditure. CSR expenditure. That will charge us or any penalties. Or any penalties paid. Okay, that you'll claim as expense where? In accounting. But in income tax, they are never allowed as deduction. Not now, even in the future also, they are not allowed as deduction. So that difference is permanent difference. Never they're going to be reversed. Since they're never going to be reversed, those are called as what? Permanent differences. Permanent differences now we cannot do anything, simply ignore. Okay. Then temporary differences. Temporary differences may come because of this VRS expenditure, preliminary expenditure 5 installments, and then depreciation. There is a difference in accounting and here. Okay. So because of all this, there will be what? Timing differences, where the difference is going to be reversed in coming years. Difference because of depreciation, VRS expenditure, preliminary expenditure, etc. That is called as what? Temporary difference. Now see, year 1, accounting profit 8 lakhs, IT profit 6 lakhs. Okay, assume this difference is because of depreciation only. Now difference 2 lakhs is what? Timing difference. Why? Because in income tax maybe you claimed more depreciation, that's why less profit. Accounting, you claimed little less depreciation. But over a period of time, it's going to be reversed. Okay, so difference 2 lakhs is what? Timing difference. Into 30%, how much? 60,000. 60,000. This has to be treated as deferred tax liability. Sir, why liability? As per accounting, actually you should pay more tax. As per accounting, actually you should pay how much tax, sir? 8 lakhs into 30%. Now, as per accounting, how much you should pay? 2,40,000 you should pay. But how much you are actually paid? Because as per IT profit only, we'll pay real tax, right? So as per accounting, the actual liability for you is how much? 2,40,000. But the real liability you paid now is only how much? 1,80,000. This 60, maybe you need not to pay now. But because of adjustment of these timing differences and all, in future also anyhow you need to pay. Okay, that's why they are asking you to what? Create that liability now itself as what? Deferred tax liability. Okay, when there is a timing difference, and that timing difference is because of the tax is more in accounts and tax is less in accounting, tax is less in tax profits, then for such a difference will create what? Deferred tax liability. As per accounting now you should pay how much tax? 2,40,000. But how much you really paid? So how much had to pay as per accounting? So create what? Liability, because you had to pay now. So create what? Deferred tax liability. Then, sir, if it is another way now, let's say if IT profit is more than that of the accounting profit, then we'll create what? Deferred tax asset. This is the beginning. For the first time when you identify difference, you will do this. Then in the coming years, when this difference is going to be reversed, sir, in subsequent year, okay, the accounting profit became 6 lakhs, IT profit became 8 lakhs. So 2 lakhs into 30%, 60,000. You will not again create assets, sir. This is a reversal of the previous transaction. So what you will do, this is DTL reversal. Difference is because of reversal of impact of years. So what is the entry? DTL account debit. So the deferred tax liability, see first when DTL created, what is the entry? Deferred tax expense account debit 60,000 to DTL 60,000. Sir, why deferred tax 60,000 you did? Sir, as per accounting, how much is the tax? 2,40,000. You paid actual tax how much? 1,80,000. But then other 60, what we have to do? You'll create it as what? Deferred tax expense. Since not yet paid, you are creating a liability called deferred tax liability. So deferred tax expense account debit to deferred tax liability is 60,000. Then subsequent years, when it is going to be reversed, what we'll do, sir? This DTL which is created, we're gonna set off. DTL account debit 60 to deferred tax account 60,000. We are paying 60,000 tax more, but for this extra already liability created. So this is a reversal of DTL. So now we are going into minimum alternate tax. So MAT is a long story, sir. Okay. So it's not exaggeration. 40% of income tax which we are studying is currently only because of Reliance. Only because of Reliance. Because Reliance is so efficient in tax planning. Okay, that for the first 30 to 35 years from its forming as a company, it paid zero tax. For the first 30-35 years, it paid zero tax. But every year it declared dividend to shareholders. It's shown tremendous profit to the shareholders. The company share prices is going on only, but to the income tax, it paid zero tax. Okay, so their tax team is so efficient. They found out every loophole in the income tax and did the tax planning. Okay, actually that's not called as when you exploit a loophole. It's not tax planning. It's so there are three things, sir. Tax planning, tax avoidance, tax evasion. That comes under tax avoidance, not evasion also. Evasion now you are simply doing fraud, then evasion. Tax planning means we claiming these ATC deductions and all, which commonly everybody know. Okay, even following the true sense of the department also. With what sense they have framed a law, the same sense we also carry now, then that is tax planning. Okay, you don't believe in the sense which they have framed. You just interpret the words. If there is something there to exploit it, now then you'll take an opportunity and you'll use it in a better possible way. Then that is called as a tax avoidance. Okay, you are not completely evading, you are avoiding the tax. Third one, sir, tax evasion. Tax evasion is completely wrong. Tax planning is legally correct, ethically, morally is also correct. tax avoidance, legally correct, but ethically you are doing something, exploiting something, and then getting the tax advantage. Tax management, evasion. Tax evasion is legally correct, morally, ethically also correct. Okay, na sir? But if you say morally, ethically correct things, and if you don't do tax avoidance, then there is no job for CS and CMS. We are hired not to do tax planning. Tax planning, why we have to do, sir? That was there in the act. Everybody reading that act can tell. Okay, you are, or the CA will be hired only to do what? Tax avoidance. Even in our act or in our syllabus, there is clearly mentioned like what? We cannot encourage tax avoidance. That is ethically not correct. But still, client will think of what? He has to get his tax saved and he shouldn't be caught. That's what, right? So then you can do what? Tax avoidance only. If any provision is weakly framed, you can exploit it. Okay? But that couldn't be there permanently, sir. You can do it for 2 years, 3 years, then department will find out that there is a loophole. Then they're going to cover up with some other provisions and all. Then the chance is gone. Okay? Now, MAT. So what Reliance is to do now? There are tax profit is different, accounting profit is different, right? And for tax block system is followed, right? Reliance is a company where they do huge capital investments. CapEx still every year, if how much ever they earn, that much amount they'll be again spending on CapEx only. So tax they claim more depreciations. So obviously their profits will be less, almost zero only. Almost zero only. But for accounting and all, they'll show more profit so that they need to get the trust of shareholders. So for the investors or for the shareholders, they show good profit only. But for the taxation purpose, they show some other, by using the income tax methods and all, they showed a different version of profit because that time ICDS is not there. There is no compulsion of ICDS. Whatever they showed, that only. So for tax purpose, they used to show zero only. Then, sir, in 1988-89, then Prime Minister and Finance Minister thought that how can Reliance escape like this? They targeted specifically for Reliance only and introduced MAT. Okay, but that is a poorly framed MAT. Okay, all these 3 years, MAT versus Reliance, Reliance only won. Okay, even after introduction of MAT also, 3 years consecutively, they can even defeat MAT provisions also, and again they paid zero tax only for all these 3 years. Then vexed with this, okay, even with this MAT concept also, since they cannot recover tax from Reliance, they got vexed and they thought this is a useless thing we did because ultimately what they want they cannot do that. So they revoked MAT provisions. But then again, sir, in 97-98, that time Finance Minister Chidambaram, he took it as a challenge and then he reintroduced MAT. Okay, then also, sir, again in 97-98 also, again Reliance only can beat MAT provisions. Okay, actually he said in the budget speech also. Okay, now MAT is such a way that nobody can escape from the MAT provisions. So proudly those dialogues and all said. But for one last time again, Reliance can still pay zero tax only even with introduction of MAT in 97-98. But then by 98-99 they did some other counter adjustments in MAT. Then Reliance started paying taxes only from 99 and 2000. Assessment year 99 and 2000 is the first year from where Reliance started paying income tax. All those years, we know Reliance, Dhirubhai Ambani started long back. From then never they paid income tax. MAT applicable to both domestic companies, foreign companies, whether they are closely held companies or widely held companies. What does it mean by closely held companies, sir? Private limited companies. Widely held companies, public limited companies. MAT not applicable to companies opted for 115 BAA, BAB, companies into life insurance business and foreign companies. MAT applicable to whom? Domestic company and foreign company. Not applicable to companies opted for 115 BAA, BAB, which are into life insurance business. Sir, to whom it is applicable, you have clarity, right? Domestic company or foreign company, public or private, but not applicable to which opted for 115 BAA, BAB. We already said that. Under the assessment, the company's taxation when we are discussing, then only I said. Then companies which are into life insurance business, for them, MAT provisions not applicable. Then foreign company, sir, foreign company, that company may be from US or UK, some country, right? With that country, India has DTA, but such company has no PE in India. PE means permanent establishment in India. Permanent establishment means there should be some physical location here, a factory, an outlet, okay? Something should be there for that company. If there is no such PE, with the foreign country, India has DTA, but such company has no permanent establishment without any physical location in India, if it is operating, then for such companies, MAT provisions are not applicable. Then such company opted for presumptive schemes under 44B, BB, BBA, BBB, BBC. Foreign company opted for presumptive schemes. And with that foreign country, India doesn't have DTA, but such company has no Companies Act requirement to register in India. It's a foreign company. It's not required to register in India. And with that country where that company is located, India doesn't have any DTA. So foreign companies, presumptive scheme opted, no DTA. No MAT applicability. Second one, with the country in which foreign company is there, India has DTA, but such company has no PE in India. India has no DTA with that country, but such company is not required to register in India also. Then all these three types of foreign companies, MAT is not applicable. Okay, sir? So how to check that MAT has to be paid? So why MAT concept? As I already said, since there are two types of profit computations, they are always doing for tax purpose. Tax purpose, they are trying to minimize the profits. But for shareholders, because shareholders are ultimately the owners, they will question the management. That's why for shareholders, they are showing The normal or good profits only, the company is good only, but for the income tax authorities, they are showing like as if company is poor. Okay, so two set of books they are maintaining. So now what? Okay, you are showing as a second kind of balance sheet on P&L, right? Forget about this. Bring what you are shown to your shareholders. On that apply this percentage and compare with the normal tax. Whichever is higher, that only pay. Whichever is higher, that only you have to pay. See, sir, book profit. Book profit is nothing but the profit which was shown to shareholders. Okay, which was presented before the shareholders in the AGM. That is called book profit. Again, for this book profit also we'll do certain adjustments. So for the accounting profit, we do certain adjustments, then we'll get what? Book profit. That book profit into MAT rate is how much? 15% plus surcharge applicable. Sir, surcharge when it is applicable, sir, for companies? Domestic company. More than 1 crore, how much? 1 to 10 crores, 7%, about 10 crores. Okay, that surcharge only we have to levy. But once MAT applies, then what total income we need to take? This book profit only becomes total income. If book profit is above 1 crore, surcharge applicable. Sir, understand, sir? Because for the purpose of computation of MAT, on what 15% we are levying? Book profit, right? So if you are levying tax on something, that itself will become what? Total income, right? So for the purpose of MAT computation on book profit, the book profit itself has to be assumed as what? Total income. On the tax rate 15% and surcharge. Depending on the how much is book profit, surcharge rate we need to take, and that has to be applied, and cessate rate of 4%. We got a total rate, which we call it as A. And then here tax profit. Tax profit now, how we solved in the PGBP chapter with all those plus or minus adjustments and all, that is called as what? Tax profit. After adding all the other incomes, we'll get what? Total income. So on the total income, apply normal tax 30% or 25%, foreign company even 35%. Then the normal surcharge applicable, cess applicable, you got B. Sir, if B only higher, now which is higher? Tax related, normal provisions related tax only is higher. Since normal provisions only higher, then pay this only, MAT does not apply. If at all book profit into 15% is higher, then you pay what? Book profit into 15% only you have to pay, MAT applies. Okay, see. If A is higher, A means what, sir? Tax computed on book profit. So if A is higher, MAT applicable, pay MAT computed. If B is higher, B means what, sir? Normal tax. If normal tax is only higher, MAT not applies, you should pay what? Normal tax only. Understand, sir, here? When MAT applies, book profit into 15% plus surcharge plus cess you do, you'll get a total. Then normal total income into applicable tax rate, sir. It's not like always 30 and 25. Special rate incomes are there, apply special rate. Okay, generally how you calculate tax like that you do. Plus surcharge, plus cess. You'll get the normal tax and the MAT tax. Check which is higher. MAT tax only higher, then MAT applicable, pay MAT only. Normal tax only higher, pay normal tax only, MAT does not applies. Okay. So what is the MAT rate, sir? MAT rate is how much? Book profit into 15%. However, if such unit is located in IFSC, International Finance Service Center, and it derives income solely in convertible foreign exchange, then the MAT rate is only 9% instead of 15%. Sir, this can be asked as only MCQ, sir. Question they may not ask. Okay. General MAT rate is how much? 15%. If it is a unit located in IFSC, 9%. Okay then. How do we compute book profit? Sir, book profit has to be computed as per the statement of P&L prepared as per Schedule 3 of Companies Act 2013. As per Schedule 3 of Companies Act 2013, you have to prepare book profit. Insurance, banking and electricity companies, sir, for these, Schedule 3 is not applicable, if you know. Okay, that's why they'll prepare their statement of P&L as per their respective acts. While preparing annual accounts, accounting policies, accounting standards, depreciation methods and rates shall be same as that have been adopted for preparing accounts as laid down before shareholders in AGM. I mean, you cannot prepare a third set. For shareholders, one more set, and for accounting, one more set, and all you cannot do. Whatever you presented to the shareholder, same set you have to consider for the purpose of MAT. Okay, straight away that you will not take. Again, for that also you have to do certain adjustments, sir. For the accounting profit presented before shareholders, for that you need to do certain adjustments, then it will become book profit. That book profit into 15% has to be compared with normal tax. Whichever is higher, we need to check. If book profit into 15% plus surcharge cess is higher, MAT applies. Otherwise, normal tax only applicable. Okay, na, sir? So these items, sir, we need to remember. Yes, YBM, AMT is also there, but they are not asking much about AMT. AMT is also there. In this chapter only, after MAT, we are going to discuss also, theoretically, a bit about AMT. Sir, so MAT related, they are given certain adjustments. Sir, first time we said like 3 years, even though MAT introduced, Reliance can only beat, because that time these adjustments were not there. They just said like pay tax on accounting profit and compare it with the normal tax. Okay, then they can easily defeat. Then in this, certain points were introduced. When originally again in 1998 was introduced. Then also it tried to avoid in some other ways, sir. But finally, this is the final set of MAT adjustments to be done, which currently working without any tax avoidances. Okay. There are 14 items to be added and 11 items to be subtracted. It doesn't mean every question will have 14 items to be added and 11 items to be subtracted. Depends. But overall, these 14 adjustments only will do for addition. And this 11 adjustments only we have to do for subtraction. You cannot do any other thing. First one, sir. add items, less items. Depreciation, if it is debited to P&L, add back. Then subtract. Sir, we are not calculating tax profit. Remember, here only most of the people will do mistakes. Tax profit is different, book profit is different. This is still accounting related only. Okay, but in accounting itself, if they are doing some gimmicks, they want to correct that part only. Okay, see, depreciation you reversed and you subtracting what? Again, depreciation as per books only, but just ignoring the revaluation related depreciation. Okay, na? So total depreciation is 5 lakhs. Because of revaluation, 1 lakh is there. So now what you will do? 5 lakhs you will add back and subtract 4 lakhs. Revaluation impact related depreciation you want to ignore. Okay, that's why depreciation you will add back and you will subtract depreciation ignoring revaluation. This is the first entry, sir. Add less, both ways it is covered. Depreciation add back and depreciation subtract. What? Full depreciation add back and subtract depreciation without revaluation adjustment. Without revaluation adjustment. Okay, then second one. All the exempted incomes subtract except 10AA. All the exempted incomes you should subtract except 10AA. Why, sir? 10AA is not exempted income. It's like a deduction kind of. I said so many times. So 10AA you need not to subtract. Rest all the exempted incomes like section 10, 11, 12 related you need to what? Subtract. When the relevant income is subtracted, the relevant expense also has to be reversed. Sir, income if you are income will be there on which side, sir? Credit side. So okay, that's why you are subtracting. Expense will be on debit side. To reverse that, what you have to do? Add. Understand? So you are removing those two items from P&L. Originally in P&L when income is credited, it got added. Originally when expense is debited, it got subtracted. Now you want to reverse the impact. So the item added in the P&L credit side as income, you have to subtract. So incomes exempted under section 10, 11, 12 has to be subtracted. Relevant expenses has to be added back. Understand, sir? Normally, sir, this one we learned even in normal PGBP adjustments also. Incomes which are chargeable, exempted or taxable under other rates. What we are doing? Subtracting only, right? Relevant expenses we are adding back. Same thing here also. Okay, but only exempted incomes. If they are taxable under other rates and all, we don't consider. If they are exempted incomes created to P&L, subtract. Relevant expenses debited to P&L, add back. Clear, sir? What is the first point? Depreciation, what we have to do? Original depreciation, add back. Then which we have to subtract? Except revaluation, subtract. Then income exempted under section 10, 11, 12, subtract. Then the relevant expenses, add back. Then share of income from AOP. This is also exempted, sir, actually. Share of income from AOP. So share of income from AOP, what we have to do? Subtract. And the relevant expenses, add back. See, share of income from AOP, subtract. Relevant expenses, add back. Then deferred tax. It depends, sir, whether we are creating deferred tax asset or deferred tax liability. It can be on both the sides. Whatever the side it is. If it is on credit side, deferred tax, subtract. If it is on debit side, deferred tax, add back. Simply reverse, sir. You in the P&L, you see deferred tax. Reverse. Credit side reversal, na, subtract. Debit side reversal, na, add back. 4 points done, sir. What are the 4 once again? Depreciation, original depreciation, add back. Depreciation ignoring revaluation, subtract. Then second point. Exempted income, subtract. 10, 11, 12. Relevant expenses, add back. Third one, sir. Share of income from AOP, P&L credit side, subtract. Relevant expenses, add back. Deferred tax. Credit side is there, subtract. Debit side is there, add back. Then notional gain on units of business trust. Sir, what is notional gain? On the 31st March, you didn't sold actually, but you are marking them to market. You purchased for 80 rupees. On that day, on the 31st March, it is 70 rupees only. So you have a loss of how much? 10. But that is not realized loss, it's just a notional loss. Such notional loss, if you already debited to P&L, add back. Okay, you purchased for 80. 31st March, it became 100. Okay, how much gain you have? 20 rupees. That also not realized. It's a notional gain. If such notional gain created to P&L, that also what you do? Subtract. So any notional gain on units of business trust, subtract. Notional loss on units of business trust, add back. Royalty income from patent under 115 BBF. Royalty income from patent under 115 BBF. You remember, sir, what is 115 BBF? We discussed. 10%. Sir, if they include this into MAT, this get taxed at 15%. Originally, this is taxable at what rate? 10%. Sir, if they didn't subtract this, it also will be part of book profit, right? When it is part of book profit, it is also taxable at what rate? 15%. But already they got a benefit of getting 10% to encourage them. So they don't want to tax in an indirect way also with an increased rate. That's why what they are saying, okay, you got the benefit, right? Continue with that benefit only. You are not included in the MAT. Royalty income from patent, 115 BBF, subtract. Relevant expenses, add back. When we don't consider income, relevant expense also we don't consider. Okay? First 6 points, sir. First 6 points. Depreciation. Okay. Original depreciation, add back. Ignoring revaluation, subtract. Next one. Exempted income, subtract. 10, 11, 12. Relevant expenses, add back. Share of income from AOP, created, subtract. Relevant expenses, add back. Fourth one. Notional gain on deferred tax, created, subtract, debited, add back. Notional gain on units of business trust. Has to be what? Okay. Gain, created P&L, subtract. Loss, debited to P&L, add back. Royalty income, created, so subtract. Expense, debited, so add back. Then, sir, we want the real current year profit only. We don't want any amount brought from reserve to P&L or transferred from P&L to reserve. We want current year actual profit. Sir, if any amount withdrawn from P&L, that might be credited to P&L. So such any amounts withdrawn also reverse because we want current year to profit. Same way, if any amount transferred to reserve also add back. Understand, sir? Any amount withdrawn from reserve, subtract. Because we want current year profit only, sir. No past year related and all. So amount withdrawn from reserves, subtract. Amount transferred to reserve from current year profit, if anything is there, add back. Okay, first 7 points clear, sir, now. withdrawn from reserve. You got some revaluation reserve, you got some capital reserve, you got securities premium, so many other reserves are there. From that reserve, because of any reason, you brought some amount to P&L in the current year. Transfer from reserve to current year P&L. Such transfer will not to consider. So since transfer is credited, what do you do? Reverse, subtract. Any profit, any amount transferred from current year profit to reserve, that also ignore. So current year transfer made na debit side, it will be there. So what you have to do? Add back. First 7 points this. Okay, then 8th point, sir, will explain. 8th point has a lot of background to be discussed, sir. So 8th point we'll discuss separately. Then income of foreign companies from capital gain on securities, interest, royalty, dividend, FTS, if they are taxable at a rate of less than 15%. Sir, these are foreign companies. Sir, we know all our chief ministers are going across these foreign companies and asking them to start a business in our state, start a business in our state. Yes or no? Okay, why Chandrababu Naidu or Ravant Reddy go to US always? They go, they meet Microsoft CEO or some other company CEOs and they'll always be asking. Startups also. Yesterday also, like Netflix has opened there some office in Hyderabad. So okay, then CMA is saying like Hollywood will come into Hyderabad sooner. Okay, see why we are attracting, because foreign companies has money. Okay, they do investments here, they put money here, they create opportunities here, or people will get employment, revenues will be generated, government will get taxes. That's right. But to call them here, some incentives has to be given, right? Some incentives has to be given. Why? Because foreign companies, they say it's simple. See, for us, dollar is safe, US is safe, nobody can attack us. That's what they feel, right? That's why they're asking like what in India, if you do any investment now, how it is safe. Okay, so Indian government is trying to make it as safe. Okay, so for them, instead of investing in US, to invest in India, it is little more risky. Why risky? Because India is not safer than that compared to US. Okay, sir, can any drone fly into US? Other country drone? No. Okay, so that much security because it has a strong military force and all. US not only controlling their country, even the whole world they are trying to control. So such companies, if they want to come and invest in India, they feel like what? Our country is so safe. If we invest money in your country and some war comes, some internal rebellion groups came, then our money will get lost. What is our security? Okay, so there is a high chance of risk there. So to cover the risk, what Indian governments are saying, like we give you tax benefits. Normally our people has to pay 30%, you pay just 15%, it is enough. So with, not even 15, you pay 10%, it is enough. You pay 5%, it is enough. With that concessions, foreign companies are brought. Now once they brought with those concessions, even with an indirect way of using MAT also, we cannot tax at a higher rate. That's why foreign companies, when they are getting capital gain on securities, interest, royalty, dividend, fee for technical services, and their tax is less than 15%, they shouldn't be pulled into MAT. Understand, sir? Because once they pulled into MAT, indirectly they are paying 15%, which is a higher rate. Okay, government, what promise made? You will be taxed at 10% only or 5% only. Come and invest here. They believed the promise and came. Now we cannot use the tax gimmicks and say like, no, that is normal profit. For you, MAT applies, you have to pay 15%. Now they feel like cheated. So that's why what we are saying like, okay, for you, we only called and asked you to come here, right? For you, you can enjoy the 5% tax rate or 10% tax rate benefit only. So you are not even included in MAT. So such companies, whatever the incomes they get on capital gains, interest, royalty, dividend, FTS, if the tax rate on them is within 15%, those incomes need not to be included in the book profit. So what do you have to do? Subtract. Relevant expenses also add back. Understand, sir, this point also? Income of foreign companies, not income from foreign company. If it is a foreign company and it has incomes like what? Capital gain on securities in India, interest, royalty, dividend, FTS in India. They have concessional rates. You'll understand them in NR taxation rate, NR taxation chapter. Mostly they have 10% tax rate, 12.5% tax rates. Okay, so they are getting a concessional benefit. Now if they were pulled into MAT, if that income also included in book profit, then book profit what rate will apply? 15. So instead of 10 and 12.5, they'll be taxed at 15%. So they don't want to do that. Government don't want to do that. That's why they have been excluded from, their incomes has been excluded from MAT computation. So subtract. The relevant expenses also what we have to do? Add back. Sir, online students are able to follow, sir? So these are only the common points, sir. I mean, the revaluation reserve point is there. First 9 will have common points. Here we'll have a income side now, we'll subtract, expense side now, we'll add back. But from now on, sir, different points only. There may not be a corresponding debit and credit. First one. If a sick industrial company has profit, sir, after so many years, it was sick. Just now it got profit. Once it got profit, now you cannot say immediately, you got profit now, okay, come on. Pay tax by applying MAT provisions and all, you cannot say. So profit from sick industrial undertaking. Just now it came revived. Now, in the year of revival itself, if you go and start eating with your tax now, then again it will become sick. Okay, the government wants to give it some space for it to recover. That's why if you are a sick, if it is classified as a sick industrial company and then it got profit, for that companies also MAT provisions will not apply. I mean, not completely MAT, not saying like MAT does not apply. That profit don't bring into book profit for applying MAT. So profit from sick industrial undertakings, ignore. Okay, then, sir, normally under income tax, if you have current year some taxable profit is there. As per normal provisions, you got PGBP income. With that PGBP income, you can set off brought forward losses and you can even set off unabsorbed depreciation. You have mad profit now. Lower of brought forward loss as per books of accounts or unabsorbed depreciation as per books of accounts. Out of these two, only one can be adjusted. Both cannot be adjusted from book profit. Sir, current year you have book profit. Last year you have losses and unabsorbed depreciation as per books of accounts, not IT. As per books of accounts. As per IT, now you can apply both. But for math purpose, whichever is lower only you can adjust. Both you cannot adjust. What are those two, sir? Brought forward loss or unabsorbed depreciation. Out of these two, whichever is lower, only one can be adjusted. Both cannot be adjusted. However, if it is a company which is already into insolvency, then it can adjust both. Normal company, surviving company only, it can adjust only brought forward loss or unabsorbed depreciation. Cumulative, sir. They may give 4 or 5 years later losses. 4 or 5 years later unabsorbed depreciation. You check cumulatively. If brought forward loss is less, adjust brought forward loss. Unabsorbed depreciation is less, then adjust unabsorbed depreciation here. Okay, now this side, sir. If any income tax paid or payable, provision for income tax is debited to P&L, including interest, surcharge, cess, has to be what? Added back. But penalties, securities, transaction tax, wealth tax, these need not to be added back, sir. Only income tax provisions related, provision for income taxes, if any debited to P&L, all those has to be what? Added back. All those has to be added back. Then, if any dividend paid or proposed is debited to P&L, that also add back. If any provision for unascertained liabilities or contingent liabilities, all those what we have to do, sir? Add back. Provision for unascertained liabilities or contingent liabilities, we need to add back. Provision for diminution of value of assets, provision for bad debts created, such provisions also add back. And loss or provision for subsidiary also we need to add back. Okay, so once again I'm repeating, sir, except revaluation, rest all we try to understand. Okay. Sir, this set of points, sir, 11, 12, 13, 14, okay, then 10, 11, 12, 13, 14. Just because these are discussed towards the end, you think these are not important, sir. These are only most important. This will come frequently in the questions. These 5 points. Once again, see. If any income tax paid or payable debited to P&L, what we should do? Dividend paid or proposed, add back, debited to P&L. Then, if any provision for unascertained liability or contingent liability is there, add back. What is called unascertained liability, sir? You don't know how much you have to pay. Ascertained, you know how much to be paid. Unascertained, you don't know. You're just making a guess. Then that is called as what? Unascertained liabilities. For them, if you create any provision, that has to be what? Added back. Provision for diminution in value of assets. Diminution in value of assets, now the asset may reduce its value, bad debt kind of, add back. The last one, for loss of subsidiary if you are creating any provision, or loss of subsidiary if you are debiting to P&L, all that also add back. Okay, but understand, sir, if there is a provision for gratuity, provision for leave salary or warranty, these three, if they are computed based on actuarial valuations, there is something called actuarial science. Okay, there is a profession called actuarians. Okay, they do those statistics and all, they are good at so much in statistics. They do all this realistic, scientific way of how much gratuity you need to pay. They ascertain how much leave salary you need to pay, how much warranty you need to pay, okay, how many warranty claims will get mobilized or will get materialized, that they will do and find out the liability in a scientific way. Once they do in such a way, they are not unascertained liabilities, they are called as what? Ascertained liabilities. Provision for gratuity, provision for leave salary, warranty, provision for warranty. If those are decided by actuarials, they were computed based on actuarial valuations, then they are not unascertained, they have to be treated as what? Ascertained liabilities only. Okay, no, sir. So once again, sir, depreciation, add back, subtract excluding revaluation. Exempted incomes, subtract. Related expenses, add back. Exempted under 10, 11, 12. Share of income from AOP, subtract. Relevant expenses, add back. So all these if they are credited to P&L only. Fourth one, deferred tax credited to P&L, subtract. Deferred tax debited, add back. Notional gain credited, subtract. Loss, add back. On what? Notional gain or loss or gain on business trust, units of business trust. Then any amount withdrawn from reserve and credited to P&L, subtract. Any amount transferred to reserve and debited to P&L, add back. Then 115 BBF income, royalty. If any royalty income created to P&L, subtract. Relevant expense, add back. So here we have 6 or 7 points. Then revaluation reserve points, sir, I said like keep it on hold. Then we went to income of foreign companies, not, sir, again I'm saying, sir, income of foreign company, not income from foreign company. So income of foreign company, SSC itself is a foreign company there. SSC himself, we are doing math for foreign company. And such foreign company is having what incomes? Capital gain, interest, royalty, fee for technical service or dividend, this kind of incomes. On them, if the tax rate is less than 15%, those incomes, subtract. Relevant expenses, add back. Right? Then any profit from sick industrial undertaking, subtract. Then brought forward loss or unabsorbed depreciation as per books of accounts, both cannot be subtracted. Whichever is lower, only one thing can be subtracted. Unless it is a company which is into insolvency, only one can be subtracted. Otherwise, both can be, into insolvency now, both can be subtracted. Then coming to add side, sir, we have another 5 items. If any income tax debited, provision for income tax debited, including interest, cess, surcharge, except penalty, securities, transaction tax, wealth tax, has to be what? Add back. If any dividend paid or payable, proposed dividend debited to P&L, add back. Then if any provision for unascertained liabilities, add back. If any provision for diminution in value of assets, nothing but doubtful assets, add back. Then the last one, sir, provision or actual loss of subsidiary, if any debited, that also add back. So now we are having pending with only what, sir? The revaluation reserve point. Okay. transfer from any revaluation reserve to P&L to the extent of depreciation on revaluation assets, what we should do? Subtract. Whereas balance in revaluation reserve on retirement or, sir, these two items, even though we kept on the same footage, but this two does not happen simultaneously or in the same year. This happens every year. This happens only when the asset ultimately retires. The debit side entry is there, right, which we have to add back. It happens only when the asset ultimately retires. Okay, so now, simple thing, revaluation impact, they don't want to be impacting the book profit. Whatever is the revaluation, they completely want to ignore the revaluation. So clearly understand the example. This example will go for 2 pages, but then it will give you the clarity about why the revaluation thing is being eliminated. So they want to completely eliminate the revaluation impact on book profit. And the revaluation profit, if any is there, that they're gonna recognize only when the asset is actually sold. Till then, revaluation impact they don't want to bring into P&L. Why? This is also, again, this revaluation adjustment was brought because of Reliance only. What Reliance did now, after so much of, in 97, 98 when they introduced, I said first year also it has defeated, right? What it did, it has revalued their assets. Sir, what is matter calculation? Accounting profit into 15%. So what they did now, they revalued. Sir, Reliance has so many capital assets, machines, industries and all. So they revalued their assets. Once they revalued, their asset block values has increased. And they claimed more depreciation. Once they claimed more depreciation, their accounting profit came down. And again, they paid. Accounting profit also they almost brought to losses, but they already informed to the shareholders. What they did? We did revaluation. Because of revaluation, we are claiming more depreciation. Okay, if you look at EBITDA, earnings before interest and depreciation, see how much profit we are having. Only because of this revaluation and claiming more depreciation only, we have lost. Like that they said and communicated to the shareholders, convinced the shareholders and claimed more depreciation even in the accounting P&L. So once they claim more depreciation, their accounting profit also became zero and paid. And based on accounting profit, if you apply MAT also, it became zero. They didn't pay any tax. Okay, to counter that only, in MAT they introduced this provision saying what? Whatever is the impact of revaluation, that revaluation impact you shouldn't be there in the P&L unless asset is sold. When asset is sold, it's not revaluation, it's the realized profit or loss. That time you can bring it to the P&L, no problem. But until asset is sold, you cannot bring the impact of revaluation. For that only, we'll see how it has been totally given. See, example, sir. Original cost of the asset is 10 lakhs. Revalued to 15 lakhs. How much revaluation reserve will be created? 5 lakhs. Okay. So now what is the entry, sir, when they revalued? They'll write asset account to debit 5 lakhs because asset value increasing. Credit, no money is going out. So they are crediting to what? Revaluation reserve. Now assume, sir, as per accounting, they are following 10% depreciation and SLM method. Okay. Year 1. If there is no revaluation, every year how much depreciation they'll charge? 1 lakh, 1 lakh, 1 lakh, 1 lakh, right? Because original on this 10 lakhs only they'll claim. But with the revaluation, how much depreciation they are claiming? 1 lakh 50, 1 lakh 50, 1 lakh 50, 1 lakh 50. Understood? Okay. Now, in accounting P&L every year, what they do, sir, to minimize this, they charge depreciation 1 lakh 50,000. But they'll credit revaluation reserve also 50,000. Why, sir? Sir, revaluation reserve is a reserve which is not created out of profit. It was created directly since there is an assetting. Sir, usually reserves will be created like how? From profits, the surplus profit, you will transfer and you will create it as a reserve. But revaluation reserve is something exceptional. You will straight away create a reserve without that money being brought to P&L. So now every year what you are doing? You are claiming more depreciation because of revaluation to offset the extra thing. What you are doing? From revaluation reserves also every year you are bringing 50,000 to P&L. Sir, every gain you have has to be brought to P&L, right? మనకి accounting logic, basic logic. నీకు ఏ gain వచ్చినా అది ఎక్కడ ఉండాలి? P&L లోకి రావాల్సిందే. But revaluation reserve you created 5 lakhs. But did it came to P&L? No. So what you planned? Every year you will bring some amount to the P&L in corresponding to that of increased depreciation. So what is the entry pass? Depreciation 1,50,000 you claim, revaluation reserve 50,000. Okay, now leave aside for some time about revaluation reserve. For this 1,50,000 we already discussed the entry. Adjustment. What we have to do? This 1,50,000 we should add back. First line item. Depreciation originally charged, what we should do? Add back. And we should subtract what? So that means what we have to do? 1,50,000 we will add back and we'll subtract how much? 1 lakh. Okay? We subtracted 1 lakh. But actually, when they credited revaluation reserve 50,000 here, they are also actually charging how much? 1 lakh only on accounting. But with the first entry, what we did? We claimed only the original depreciation, revaluation related part we have reversed. Now, every year what is the adjustment? See, add back depreciation debited 1,50,000 less depreciation excluding revaluation impact 1 lakh. Okay, okay, and then extra thing, sir. Whatever the money you brought from revaluation, reserve, this also don't consider, sir. From revaluation reserve, if you brought any amount to P&L, what you have to do? It was what? Added to your profit. So to reverse this, what you have to do? Subtract. Understand, sir? In this depreciation, 50,000 extra is there because of revaluation. What we are asking to do? This 50,000 first we are asking to subtract. Yes, see, sorry, 50,000 we are asking to add back. Sir, understand first. Depreciation, originally how much you should claim? How much you claim? 50,000 extra you claim, right? But 50,000 what you have to do? Add back. That only happening here. 1,50,000 you added back, 1 lakh you subtract. Effectively what is happening? 50,000 you are adding back. This depreciation part clear, right? Now, this revaluation reserve, it is not yet realized. So that's why don't bring into P&L, because we assume there is no revaluation at all. If there is no revaluation at all, how can some amount come from revaluation reserve to P&L? So whatever is credited from revaluation reserve to P&L, that also reverse. How much? 50,000 you should reverse. But let's say, if this revaluation reserve credited is instead of 50, 70,000, then also do we need to reverse total 70,000? No. Revaluation reserve withdrawals to the extent of revaluation related depreciation only you should subtract. Because of revaluation, what is the extra depreciation? So from this reserve, up to 50,000 you subtract, no problem. 70,000 withdrawn from revaluation reserve, but still you have to reverse only how much? 50,000 only, revaluation reserve, see. Transfer of revaluation reserve to P&L, we need to what? Subtract. But only to the extent of depreciation on revaluation of assets. If it is related to some other thing, we don't have any problem. We have only revaluation related problem. That's why, if sir, mostly revaluation related only they'll bring. So total what we have to do, whatever amount bought from revaluation, that reverse it have to be subtracted. But some exceptional cases, they may bring more amount than that of the depreciation they have claimed, revaluation related depreciation. So example, 70,000 they withdraw. But revaluation related depreciation is how much? 50,000 only, so you should subtract only 50,000. The other 20,000 can be there in the book profit only. If they withdrawn only 50,000 from revaluation, they withdrawn and created to P&L only 50,000. Then what total 50,000 you should subtract. See. Since from revaluation reserve 50,000 transferred to P&L, this we don't want, subtract this 50,000 also. So total 1,50,000 we added back, 1 lakh we subtracted, and this revaluation impact also we have been subtracting. So completely our agenda is what? Revaluation impact. And the revaluation impact of depreciation should not be there on the book profit, because revaluation has been used as a tool to reduce the book profit. Okay, because of revaluation they can claim more depreciation, and by claiming more depreciation they can reduce the book profit and pay less MAT tax also. So since revaluation is used as a tool to curb that practice, what I said, revaluation impact shall not be there on the book profit. So completely revaluation impact we are nullifying. But ultimately when asset is sold, now the last fourth climax, sir, ultimately when the asset is sold, see, asset actually sold for 9 lakhs. Asset book value, sir, asset already revalued to what? 15 lakhs. With the revaluation, 1.5 lakhs into 4 every year depreciation, revaluation. 6 lakhs depreciation. How much is the total WDV, sir? 9 lakhs. And they sold also for 9 lakhs. No profit or loss on sale of asset, nothing will be there. Okay. No profit or loss on sale of asset. But revaluation reserve, how much is there, sir? 5 lakhs. Every year transfer to P&L, how much? 2 lakhs. Now, after this 2 lakhs, still there is balance in revaluation reserve, how much? 3 lakhs. Sorry, another way. Original without revaluation, what is the asset value? 10 lakhs. 10 lakhs, right? Every year, how much you are charging depreciation without revaluation? 1 lakh, 1 lakh, 1 lakh, minus 1 lakh, minus 1 lakh, minus 1 lakh, minus 1 lakh. Without revaluation, what is the WDV? 6 lakhs. For what value you sold asset? 9 lakhs. 3 lakhs profit is there, right? This 3 lakhs realized profit only, na? Asset sold, this 3 lakhs realized profit only, na? This has to be brought to P&L, right? This has to be brought to P&L. If brought, no problem. If it was not brought to P&L, you should bring them. Okay, to bring it to P&L, what we have to do? Add. See, look at this entry now. Balance in revaluation reserve on retirement or disposal of asset has to be added if not credited to P&L. If it is already credited, then right thing only did it. Okay, I'll show you that one also. Sir, asset increased revalue to how much? 15 lakhs. On 15 lakhs, you are claiming increased depreciation also. 1.5 into 4, how much? 6 lakhs. Now what? 9 lakhs is the written down value. Asset sold also for 9 lakhs. Here asset wise 0. But revaluation reserve, one more account is there. In revaluation reserve 5 lakhs. Every year you withdrawn from revaluation reserve how much? 2 lakhs only. Still there is balance in revaluation reserve how much? 3 lakhs. This 3 lakhs, what do you have to do? You have to bring it to P&L, right? Till now what you did, every year 50-50 you brought. But now no more there is asset. Asset is sold. So since asset is sold, the total revaluation reserve in the same year you have to bring to what? P&L. Whatever the revaluation reserves created, when the asset is disposed, that amount has to be brought to P&L. So this 3 lakhs has to be brought to P&L. If already created, fine. Otherwise what we have to do? Add to book profit. Add to book profit. So in simple, the total one line summary of all these revaluation adjustments is, revaluation gains we will not bring or consider into book profits until the asset is actually sold. Okay, since it is sold, once it is sold, that is a realized gain. Then you can bring it to P&L. Till that point of time, whatever revaluation you did, that is a notional gain only, not real gain. That's why to counter, to reduce or to remove the impact of revaluation on book profit, they have suggested us total 4 entries. First what? Original depreciation, whatever is debited to P&L, add back. Then subtract depreciation with ignoring revaluation. Something. Then from revaluation reserve, if any amount is brought to P&L, any amount withdrawn from revaluation reserve and created to P&L, that amount subtract, that amount has to be subtract, but only to the extent of depreciation on revaluation, not full amount to be reversed, only to the extent of increased depreciation because of revaluation. Then this corresponding add side is there, sir, but it will not come every year. The 3 items which I have discussed till now will come every year. But this one, the 4th one will come only when the disposal of asset. And the asset is ultimately disposed. There is a balance in revaluation reserve. Such a balance in revaluation reserve has to be created to P&L. If not created, then you should add. If already created, then nothing to be done. Okay, sir. So now we can solve the questions. Okay, so we'll start with questions in maths, sir. Small Private Limited is engaged in various activities, reports a net profit of 20,60,000 after debit credit of following items in the statement of P&L account. Interest paid to non-resident without deduction of TDS, proposed dividend, bank interest unpaid, provision for bad and doubtful debts, depreciation includes 40,000 on account of revaluation assets, 1,70,000. Incomes credited to statement of P&L agricultural income, 60,000. Long-term capital gain on sale of vacant land, 2,10,000. Long-term capital gain on sale of shares, 95,000. Okay, then we got additional information, depreciation allowable as per Income Tax Act, 2,40,000. Brought forward business loss, 1,10,000 as per IT, 1,30,000. Brought forward depreciation, 90, 1,50,000. We need to compute income from business as per normal provisions and even book profit under 115 JB. So both we need to do. We need to do PGBP adjustments and calculate normal profit, and we need to do MAT adjustments, and we need to do book profit computation also. Sir, everybody. First we will do normal provisions. We have to start with what, sir? 20,60,000. Yes or no? 20,60,000 after debit and credit of following items in the statement of P&L. Then interest paid to non-resident without TDS. You couldn't find the question number, huh? 4.8, question number 7, you got it right. Okay. So what is the P&L profit given, sir? 20,60,000. Interest paid to non-resident with TDS or without TDS? Then what happens to it? Sir, we are not talking about MAT, normal provisions, normal PGBP. Interest paid without deduction of TDS. Allowed or disallowed? How much disallowed? 100% disallowed. So what we should do this, then disallowed na 8 lakhs. 8 lakhs what to do? Add back. So add 8 lakhs. Then proposed dividend. Add back. For income tax only we are doing, sir. For normal provisions only we are doing. Even in normal provisions also, proposed dividend is not a allowable expense. Then bank term loan interest unpaid because of dispute regarding rate of interest, which was paid only after the due date. Sir, interest unpaid till due date. Allowed or disallowed? Disallowed. Which section? 43B. So 1,20,000 we need to add back. Then provision for bad and doubtful debts. No provisions are allowed, sir. Only actual bad debts written off are allowed. So add back 2 lakhs. Then depreciation includes, so total depreciation we need to add back, and income tax depreciation we need to subtract. Sir, don't say like excluding revaluation will subtract. That is where under book profit computation. So first we should add total depreciation. How much, sir? 1,70,000. Then we should subtract. What? 2,40,000 is the as per books depreciation. 2,40,000 we should subtract. Then this also done. Then items credited to P&L. Sir, agricultural income exempted. So we need to subtract. Capital gain, taxable under capital gain, we need to subtract. Long-term capital gain, 95,000. This also what we need to do. We need to subtract. So 60, 2,10,000 and 95,000. All the three we need to subtract. 60,000, 2,10,000, and then even 95,000 we should subtract. Okay, after doing all this, what is the answer we got, sir? How much? 28,45,000. How we came, sir? For 20,60,000, we add back 8 lakhs. Why? TDS non-deducted to non-resident. We add back 1 lakh. Why? Because proposed dividend is not an allowable expense. Then we add back 1,20,000 because 43B says like an interest remains unpaid by due date, not allowed. Then 1,70,000 actual depreciation we add back, and then actual depreciation, I mean as per income tax 2,40,000 has been allowed. Then 2 lakhs provision for bad debts also disallowed, add back. Then these three taxable under other heads are exempted. So that also we have been subtracted. We got 28,45,000. Now there is brought forward loss and unabsorbed depreciation. Both can be set off as per the normal provisions. So total 2,80,000 if you subtract. What is the tax profit, sir? How much? 25,65,000 is the tax profit. Okay. See, 28,45,000 minus 2,80,000. If you got how much we got, sir? 25,65,000 is what the the tax related profit. But we want what? Total income. To get total income, sir, again these two incomes we need to consider where under the capital gain head. Long-term capital gain on sale of vacant land, 2,10,000. Long-term capital gain on sale of shares, 95,000. If you take the total of those two, you'll get 3,05,000. Then the total income is how much? 28,70,000. This is as per normal provisions. Normal provisions. Then again we need to do what? MAT. Sir, again for MAT also. We'll start with what? First, 20,60,000. Then, first adjustment is about what? Depreciation. Depreciation, what we have to do? Original depreciation, we should add back 1,70,000. Okay, and we should subtract what? Depreciation excluding revaluation. How much is the revaluation impact? 40. So, if we exclude revaluation, how much has to be subtracted? 1,30,000 has to be subtracted. Okay, done. Depreciation point done. Then, sir, this interest, proposed dividend, those points are not there in MAT adjustments. Then, interest also not there. But provision for bad and doubtful debts is there, sir. Provision for unascertained liabilities or provision for diminution in value of assets, if any are there, we need to add back 13th entry or 12th entry, sir, in our table. So that we need to do what? Add back 2 lakhs. So, okay, this 2. Okay. Then Exempted income, if anything is there, agriculture income is an exempted income. What we have to do, sir? Subtract 60,000. Relevant expense is not there, so we need not do anything. Add back. Capital gain, all this is not relevant for us. Sir, left side, what we have, sir? Depreciation, excluding revaluation, exempted incomes, share of AOP, deferred tax, okay, notional gain on business trust, then transferred withdrawals from reserve, withdrawal from revaluation reserves, then 115 BB of royalty income, if any received, foreign companies, interest royalty, capital gains, those incomes, or else profit of sick industrial company, those only are there, right? So, agriculture income is there. Agriculture income is what? Exempted. Specifically, agriculture is not there. It is covered under exemption under section 10, 11, 12. So, this has to be what? Subtracted. So, 60,000 subtract. Capital gains, long-term capital gains, nowhere mentioned that to be subtracted. So, simply ignore. Then, last point in subtraction side, sir. What? We need to subtract brought forward business loss or brought forward depreciation. Both are, or whichever is lower. Whichever is lower. So, 90,000 we can subtract. Those are only the items, sir. So, if you do, how much is the book profit? 20 lakh 60 plus 1 lakh 70 plus 2 lakhs minus 1 lakh 30, 60, 90. How much? 21 lakh 50,000. Proposed dividend we already added back, right? See, 2 lakhs. Okay, and then 1 lakh 70,000 depreciation also we added back. Excluding revaluation we have subtracted. 60,000 agri income we have subtracted. 90,000 brought forward loss or depreciation, whichever is lower, subtracted. Then we got how much? 21 lakh. Okay, 1 lakh only, proposed dividend. Okay. 2 lakhs I subtracted is what? Okay, provision for bad debts, sorry. Proposed dividend 1 lakh also what we have to do? Add back. Then it will become how much? 22 lakh 50,000. Okay, then we got the answer. Okay, sir, now if you need to compute tax also, they didn't ask tax, but see. Book profit is how much? 22 lakh 50,000. On that MAT rate 15% is 3 lakh 37,500. Surcharge not applicable because within 1 crore. So cessation rate of 4%, total tax is 3 lakh 50,000. Whereas for normal provisions, total income is how much? 28 lakh 70. But on this special income is there, sir. Long-term capital gains are there. Long-term capital gain on land, how much is there? 2 lakh 10,000 into 12.5%, which is how much? 26,250. And then long-term capital gains on shares is there, how much? 95,000, which is how much? 95,000. Long-term capital gain on listed shares up to 1 lakh 25,000, zero tax. In excess only 12.5, so that's why no tax. Then on the balance income, balance how much is there, sir? 25 lakh 65,000 into assumed 30%, sir. Because we are not sure whether company is into 30% or 25. We assumed it as what? 30% and calculate as what? 7 lakh 69,500. So total tax is 7 lakh 95,750. Cess 31,830. Total is how much? 8 lakh 27,580. Which is higher? MAT higher or normal tax higher? Normal tax only higher. So what we have to follow? Normal tax only. MAT does not apply. MAT does not apply. Then we'll go to our book and we'll solve some other questions also, sir. Sir, this question number 16 will solve. The answer in the material is wrong, sir. This is the recent exam question. The answer in the material is wrong. Okay, we'll solve it once again. Page number 4.30 we'll see. Last question. The recent exam question it is. XYZ Limited, Surat is a domestic company, furnishes you the following information for the year ended 31st March. Net profit as per statement of P&L is 126 lakhs. Okay, net profit as per statement of P&L is how much? 126 lakhs. Then items to be debited to statement of P&L. CSR expenditure, provision for doubtful debts, depreciation debited includes revaluation 2 lakhs, loss on sale of fixed assets 2 lakhs, deferred tax liability 6 lakhs, provision for GST 7 lakhs. Incomes credited to P&L, agricultural income 6, profit from unit in SEZ 10AA deduction, then royalty income 15, dividend received 1 lakh 50, and then additional information, depreciation as per Income Tax Act 15 lakhs, brought forward loss 8, unabsorbed depreciation 12. Okay, there is unabsorbed depreciation 704 lakhs with respect to Income Tax Act. They asked us to compute book profit under section 115 JB, not normal profit, only book profit we need to calculate, and it is asked for 7 marks. Okay, now again we'll see. Sir, we should start with what? Net profit 1 crore 26 lakhs. Okay. We want only 14 items to be added, 11 items to be subtracted. There it is there or not, we need to be checked. CSR point, anywhere it is there, ignore. Provision for doubtful debts, yes, provision for diminution in value of assets, sir. So what we should do? Add. Depreciation debited, what we should do, sir? Original depreciation add. Excluding revaluation, what we'll do? Subtract. Depreciation total, original 12 lakhs added. Excluding revaluation at 10 lakhs, we have been subtracted. Okay, done. Loss on sale of fixed assets, not there, sir. It's there. Deferred tax. Deferred tax, debited or credited? Debited. Debited means what we should do? Add back. Provision for GST. See, GST is an ascertained liability, unascertained liability. ascertained only. You know how much GST has to be paid. There is no estimations to be made. How much every sale you made into the tax rate you have to apply. So it is the ascertained liability only, not unascertained. Unascertained, now what we have to do? Add back. This is not an. This is an ascertained liability only. We need not to add, simply what? Ignore. So this add back. Depreciation will add back and will subtract also. This deferred tax liability, what we have to do? Add back. Then income from agricultural income in Andhra Pradesh. Agri income, sir. Exempted income. We should include or exclude? Exclude. Subtract 6 lakhs. Then profit from unit in SCZ, 10A deduction. Nothing to be done, sir. Why? Because if you remember, 10, 11, 12, we need to subtract except 10A. So that's why we will ignore this. Ignore this, we need to subtract. Royalty income by patent. Subtract, na, sir. 115 BB of royalty income. So how much it is? 15 lakhs we need to subtract. Then dividend received from foreign companies. Is there anywhere adjust? Foreign company dividend. Dividend of foreign company. Okay, dividend of. Here it is what? From. So, I mean, I already said SSC itself should be foreign company to get that dividend, interest, royalty, and if the tax rate is within 15%, we need to subtract. Okay, dividend of foreign company. But here it is what? Dividend received from foreign company. So, nothing, no adjustment is there. Right. Depreciation, income tax act not required, sir. We already did depreciation adjustment also. Nothing. Then this one we subtract. Brought forward loss is 8 lakhs. Unabsorbed depreciation is 10. Whichever is lower. Lower now what? 8 lakhs. Subtract. Yes or no? If you subtract, you'll get book profit. 1 crore 26 lakhs plus 3 plus 12 minus 10 plus 6 minus 6 minus 15 minus 8. 1 crore 8 lakhs. అంతేనమ్మా రాంగ్ అయితే ఉరిశిక్షణ లేదు మనకి చెప్పేవచ్చు చేద్దాం రాంగ్ ఆన్సర్ అవుతుందేమో అని ఇట్స్ నాట్ స్క్విడ్ గేమ్ రాంగ్ ఆన్సర్ చెప్పగానే గన్ తీసుకొని తప్పమని కాల్చండి క్లియర్ సార్ ఇట్ ఈస్ అన్ ఈజీ క్వశ్చన్ ఓన్లీ ఓకే ఇట్ ఈస్ ఆస్క్డ్ ఇన్ లాస్ట్ టైం ఫర్ 7 marks but in exam you will not feel it as easy, that's what. Okay, so generally it is easy, sir, but I'll tell you where you might have did mistakes also. This provision for GST will take it as unascertained. You think, okay, you may think, sir, it doesn't mean everybody, they may think it as unascertained liability because provision only they'll remember, next part they may not remember properly and they may do what? Add back. So this point they may do mistake. SCZ point may not be striken. Then this is a dividend point. Dividend, you'll remember dividend, foreign company, these two you'll interlink. But in between off from, okay, whether foreign company received or foreign company, Indian company received that basic logic we will forget. And you do this adjustment also, you'll subtract there. You'll do mistakes, sir. So, tax requires clarity. Sometimes you need to understand the essence of the provision. Then, based on that logic, you can do whether plus or minus correct only. So, once again, I'm saying why foreign companies, such dividend has to be reduced. Because Indian government wants to encourage foreign companies to come and invest here. When they invest, they'll get dividend income, interest income, capital gain income. Those incomes, if you tax it normally, they are not ready to invest. That's why we are doing what? Come here, invest. We'll tax you at a lesser rate only, 10%, 12.5% only. That's why they came. Now with MAT and all, we cannot indirectly tax again at a higher rate. That's why if it is a foreign company and it has incomes like interest, royalty, dividend, which are capital gains, which are taxable at a rate less than 15%, then those incomes you need not to add from book profit. If already created, also subtract. Relevant expenses also add back. Clear, sir, this point? Okay. 16 also done. Then this 15th question we already solved, sir, if you remember. In last class we solved 15th question only. Okay, I asked you to solve but you didn't try it. Sir, when you are free, sometimes you will not get sleep, right? Night you will be struggling to get sleep and you will not be able to sleep. Some things will be reminding. Okay, you will be thinking of something. Then that time, instead of thinking about that random thing, wake up and do this question number 13 and question number 14, sir. Both these two questions are about salaries. Income from salaries. Okay, na? So, it's like a basic revision. You need to again put ChatGPT one inside of you, beside you, and then do what is HRA allowance. I know you don't remember what is HRA allowance, no. But then there is a point related to HRA. You do ChatGPT, then, okay, this only. Then they'll talk about rent-free accommodation. Again, you will not recall. So again, do ChatGPT, rent-free accommodation. What is the salary for the purpose of rent-free accommodation? Do all that and do. Okay, immediately you'll get sleep and you can peacefully sleep. Okay. Sir, this question number 12, this topic we already discussed, sir. See, a private limited has share capital in the form of equity share capital. The shares were held by 4 members, A, B, C, D. The company made losses in the past 3 years like this. Loss, nil, in 25-26, it has made a loss of 9 lakhs. Depreciations unabsorbed are these amounts. Okay, now. The above figures have been accepted by the income tax department also. But during the previous year, 31st March 2025, A sold his shares to Y, and during the previous year, 31st March 26, B sold his shares to Z. Okay, the profits for the past 2 years are as follows. On 2025, 18 lakhs, 2026, 45 lakhs, compute taxable income. Sir, where in PGBP only I explained this provision. When there is a change in shareholding with respect to closely held companies, these are closely held companies or not? Yes, it is what? Private limited company. Private limited companies are only called as what? Closely held companies. Private limited companies are only called as closely held companies. Okay, what is the provision I said? If at least minimum 51% of share capital is continuing, there is no change, then the losses can be set off. If it is more than 51%, then, okay, sir, first, when the first change happened? During the previous year, 31st March 2025. So actually, I think we need to change year number, I think. It's okay, sir. Keep it here like. This assessment years change by 1 year, 23, 24, 24, 25, and then 25, 20. Sorry. Correct only there, no? 1 second, let me check the answer and tell you. For 25, 26, what is there? 18. This is what assessment year 26, 27. This is what assessment year 27, 28. Sir, these 2 dates alone change, sir. Here, during the previous year, it is mentioned as 31st March 2025. Na? Make it as 31st March 2024. A sold his shares to Y. And during the previous year, 31st March 2020. Wait, sir. 1 second. Don't change also. Lost that year. Okay. Sir, understand. Let me tell you, explain you. Sir, we need to check what? Last day of the year in which loss is there. Sir, assessment year 25, 26 means previous year what? 24, 25. So we want 31st March 2020. Correct only, right? 2025. And we want what? 31st March. Okay, here, sir, if you see, this is also previous year 24, 25. This is what? The profits for past 2 years. Here also they are saying what? 31st March 2020, 25. So here it has to be corrected. The correct thing is like, it is not 22, 23 correct only, 23, 24 correct only, but here it should be what? 24, 25. Correct it. 20, 24, 20, 25. This alone, if you correct, we'll get the answer. See, sir, assessment year 24, 25, na, previous year is what? 31st March 2024. So on 31st March 2024, there is no change in shareholding. In that year, we have a business loss of how much, sir? 9 lakhs business loss is there. Then, in which year it is going to be set off? In the immediate next year, they are having a profit of how much? 18 lakhs. And after adjusting that year depreciation, they have a profit of how much? 9 lakhs for that year. In that year, I mean, in previous year, ending 31st March 2025, we can set off. Okay? But in 31st March 2025, what happened? A sold his shares to Y. Sir, A, B, C, D are what? Equal partners. So here A, B, C, D, 4 are there. A has 25%, B has 25%, C has 25%, D also has 25%. But whereas on 31st March 2025, A is not there because A sold his shares to whom? Y. So who came, sir, in the place of A? Y came. Y, B, C, D. So D has 25%, C has 25%, B has 25%, and Y has another 25%. So from here to here, there is a change in shareholding or not? Yes. In the place of A, who came? Y came. But how much is the change? 25%. That means still 75% is there. For us, 51% is enough. If 51% shareholding remains same, then you can adjust the business loss. So in 31st March 2025, they have profit of how much? 18 lakhs. See, where it is mentioned as 18 lakhs. Look at here. 18 lakhs. The next year. Okay, that I didn't came till there. Profit 18 lakhs. Then from there, depreciation is there how much? 9 lakhs. Current year depreciation. Still there is profit of how much? 9 lakhs. With this 9 lakhs can be set off or not is the question. Yes, we can set off, sir, because still 75% shareholding is continuing only. So 9 lakhs can be set off. It became 0. Okay, now we'll come to 31st March 2026. How much is there? 45 lakhs is the profit. See, 45 lakhs is the profit. But the problem is what? Y came. What percentage? 25%. In the place of B, Z came, Z also got 25%. Now who under there? C is there 25%, D is there 25%. Now if you compare, sir, 50% changed and 50% is only there. So now with 45 lakhs, no loss is there to be adjusted because this 9 lakhs already adjusted. What we have to be adjusted is only what? Unabsorbed depreciation. Can we adjust that? Yes, we can adjust because the restriction is only to loss, not to depreciation. So all the unabsorbed depreciation together, how much, sir? 27 plus 9, 36 lakhs. If you adjust, it will still there be a profit of how much? 9 lakhs. Understood, sir? So that 51% minimum shareholding has to be continued from year of loss, even in the year of set off. That rule applicable only for set off of business loss, not for unabsorbed depreciation. Okay, so here, okay, that current year depreciation also there. I didn't forget. Okay, first we should subtract what? Current year depreciation 7.5. Then subtract this 36 lakhs also. Then you will get how much? 1,50,000. That's what we have here also. Right? Okay, this is question number 12. Then all these questions are related to MAT only, sir. Okay, I'll do one question regarding MAT, one more question. Question number 8. Sir, this question is a MQP question, sir. And this question is framed a little vague at points. Okay, that's why I already, sir, these assumptions are not given in the question. We took certain assumptions because based on that assumptions only that institute answer came. Okay, that's why I even mentioned in the note the assumption which we has to be assumed also. Okay. Given below is the P&L of Mitra Limited. Gross profit, withdrawal from reserve fund, revaluation fund, equity income, short-term capital gain, dividend, miscellaneous income. Expenses are like what? Donation, contributions, staff welfare fund, proposed dividend, bad debts, provision for bad debts, provision for GST, provision for ascertained liability, income tax, penalty, depreciation, cultivation expenses, general reserves, transfer, long-term capital loss, net profit. Other income, depreciation includes 20,000 on revaluation, dividend paid on 30th September, GST 30,000 paid on 31st October, brought forward items. All these are there. We need to compute tax liability applying MAT. Okay? Tax liability there, sir. So we need to check both. Normal also we need to check, MAT also we need to check. And if MAT tax is only higher, then we need to pay MAT. Understand? Okay? Now, sir, I'll do only as per MAT, sir, because normal PGBP, I hope you know already. We'll start with what? Net profit. Right? Always we'll start with what? Net profit, 4,88,000. We'll start with net profit 4,88,000. Okay. First we'll look after credit side, sir. Credit sides. Credit sides, if anything are there, we need to subtract MAT, credit side items. Withdrawal from reserve fund. Withdrawal from revaluation reserve. We need to subtract, but only to the extent of increase the depreciation. Here they given a point. Depreciation includes 20,000 on account of revaluation. I mean, revaluation related depreciation is only 20,000. But total withdrawal from revaluation fund is how much? 25,000. So we need not to subtract total 25,000. How much we should subtract? 20,000 only enough. Equity income. Exempted income, sir. So what we should do? Subtract. Short-term capital gain nowhere mentioned under subtract. Dividend not mentioned. Miscellaneous income not mentioned. So subtract. Here subtract only to the extent of 20,000. Done. Dividend, sir. Dividend for whom it has to be subtracted? Foreign companies. If there is dividend, we need to subtract. Then donation to charitable trust. Is there any point in the list to be added? Donation to charitable trust? No. Ignore. Contribution to scientific research? No. Staff welfare fund actually. Not mentioned, sir. But they took it as an assumption. Okay. They have added it actually. Even in MAT computation. If they added, there should be some assumption, right? So assumption for staff welfare fund. It is assumed that it is just an amount set aside like a provision, not portion, sir. Provision which is not actually spent. Okay. Just amount set aside like a provision, not actually spent. Okay, sir, it is not mentioned, sir. How in exam we can find out? In exam, not only you, even me also will assume it as not mentioned in the MAT, so I'll completely ignore. But since we have answer, okay, in answer, if you see, sir, for the purpose of book profit, staff welfare fund, you see what they have did, they have added. Why they have added? They didn't give any explanation or note point. So when they didn't give any explanation or note point and it is nowhere mentioned in the provision, then we only have to create some assumption and assuming like what? That staff welfare fund, they didn't make real payments. They just created provisions for staff welfare and all. Okay, that's why with that assumption we are adding back. 25,000. Sir, proposed dividend, add back. Staff welfare fund, add back. Proposed dividend, how much? 75,000. Bad debt, we need not to add back. Provision for bad debt only, we need to add back. So provision for bad debt, how much? 15,000. Provision for GST, we need to add back. Huh? No, because GST is a ascertained liability, we need not to add back. But provision for unascertained liability, add back. How much? Sorry, this is also ascertained liability, now need not to add back. Provision for GST also not required. Provision for ascertained liability also not required. Then income tax, add back. Income tax, provision for income tax, add back. Sir, penalty, ignore because income tax, three items we wrote to be ignored. Penalty, STT, wealth tax to be ignored only. Then depreciation, sir, original depreciation we should add back and we should subtract what? Ignoring revaluation. If we ignore revaluation, how much? 65,000. Then cultivation expenses. Cultivation expenses are related to agricultural income. So relevant expense, what we have to do? Add back. Okay, this sir, this minus item I'm writing separately here only, because otherwise we'll get minus 65,000. This is what? Depreciation. Then again we are adding back what? Cultivation expense. How much is the cultivation expense, sir? 12,000. Then amount of transfer to reserve. If any amount to transfer to reserve also what? Add back 2,000. If you do all, okay, then dividend not required, GST. We have brought forward loss and unabsorbed depreciation, accounting purpose. Whichever is lower. Lower is how much? 20,000. This 20,000 what we have to do, sir? Subtract. Other information, sir, if it is debited to P&L, then we need to add. So this is other information, not debited to P&L, so we will ignore that. Okay. So now if you do all this, sir, from 4,88,000, subtract 24,000, 20,000, 65,000, 60, 40, 20. And if you add all these items, how much we will getting? How much? 5,83,000. Okay, let us check. Yes, same. 5,83,000. Okay, na, sir? Sir, in this question, actually, there is no chance of doing mistake, except we not understanding staff welfare fund, because that point is not even clear. Okay, even if you do this kind of mistake, na, conceptually you didn't do anything wrong. That's poor framing of questions, sir. Those kind of limitations will always be there. అర్థమవుతుందా సార్? మనం ఎంత కేర్ఫుల్గా డ్రైవ్ చేసుకుంటే వెళ్ళినా అవతలవాడు నవనీత్ లాగా కొంచెం కూలింగ్ వాటర్ ఎక్కువ తాగి చిల్లి వాటర్ తాగి అలా స్ట్రైట్గా అని చెప్పి ఇలా వస్తున్నాడు అనుకో, అప్పుడు వచ్చి గుద్దితే మనం ఏం చేయలేం కదా. సో ఓకే, దట్ లిమిటేషన్ ఆల్వేస్ విల్ బి దేర్ వెన్ యూ ఆర్ గోయింగ్ ఆన్ ఏ రోడ్. ఓకేనా? సో ఆల్ దోస్ థింగ్స్ వీ కెనాట్ థింక్ ఆఫ్ దమ్. సో ఓకే, దిస్ ఈస్ ఆల్సో వన్ కైండ్ ఆఫ్ పాయింట్ విచ్ యూ షుడ్ నాట్ థింక్ ఆఫ్ ఇట్ మచ్. దోస్ థింగ్స్ విల్ హ్యాపెన్, యూ కెనాట్ అవాయిడ్ దట్. ఓకే, ఒకవేళ అలాంటి పాయింట్ వస్తే ఏంటి అని మీరు ఆలోచిస్తారు కదా, వస్తే ఏం చేయలేం మనం, రాకుండా ఆపలేం మనం. ఓకేనా? ద ఓన్లీ థింగ్ విచ్ కెన్ స్టాప్ ఇస్ ఇన్స్టిట్యూట్. ఓకే, and I don't think they'll immediately do such kind of reforms in the examination department and make questions so clear, the textbooks so clear without any mistakes and all. I don't think it's going to happen in the near future also. Okay, so that's why what we have to do, if any such kind of things are there, you need to take your own assumption and do. Okay, one question, if at one point, if you think it as wrongly also, and if you did all these corrections, adjustments correctly, means you will not lose full marks, right? You may lose 2 or 3 marks. Okay, sir, understood now math calculations? Okay, all the questions are of same model only, sir. You have to practice. If you don't practice, then gone. Okay, soon into assembly. Okay. So now see, sir, MAT credit. We'll talk about MAT credit. If MAT is greater than normal tax, then excess, difference between MAT and normal tax shall be treated as what? MAT. MAT credit. MAT credit can be set off and carry forward for 15 years. MAT credit can be set off in the year in which normal income tax is payable. Okay, in any year. Sir, this year MAT you paid, na? Then the difference between MAT and normal tax, you will take it as credit. And this can be set off in which year? When you are paying normal tax. Okay, that also to what extent you can set off? Normal tax in the year, it cannot fall below MAT. So normal tax and the difference between MAT for that year, to that extent only you can adjust. Okay, I'll give you an example also, sir. See, year 1, 40 lakhs. Sir, AB both calculation, total income 40 lakhs. Loss 40 lakhs. Nothing to be set off. Since loss, no tax at all. So as per income tax normal provisions, the tax payable is what? 0. But book profit for that year is how much? 20 lakhs. As per PGBP provisions, you have 40 lakhs loss. Book profit, you are having how much? 20 lakhs profit. So, since it is loss, no tax. But as per book profit, 20 lakhs into 15% na 3 lakhs. Surcharge not applicable. Society rate of 4%. So, total tax is how much? 3,12,000. So, this year, which is applicable? Normal provisions or MAT provisions? MAT provisions only. Sir, A is normal provision, B is what? MAT provision. Which is applicable? Normal or MAT? MAT applicable. So, what is the difference between normal tax and MAT tax? 3,12,000. So, this 3,12,000 we can take as what? MAT credit. We can take as MAT credit. Okay. Then, second year. Second year also in tax, what is there? Loss only. Here there is a profit of how much? 30 lakhs. So 30 lakhs related how much? 4,50,000 on that cess 4%. Total how much, sir? 4,68,000 is MAT tax. Normal tax is how much? 0. Which is higher? MAT is only higher, right? MAT is only higher. Even in second year also, which is higher? MAT is only higher. So again, second year also you'll get what? MAT grade. How much you'll get? 4,68,000, because 0, 4,68,000. Total 4,68,000 you'll get MAT grade. So cumulatively you have how much MAT grade by now? 7,80,000 cumulative MAT grade we are having as of now. See, which tax has to be paid? MAT credit. First year 3,12,000, second year 4,68,000. Cumulatively also 3,12,000, and here cumulative MAT credit is how much? 7,80,000. Now third year. Third year income tax, there is profits, sir. How much? 70 lakhs. But you'll set off the brought forward losses, right? How much is the brought forward loss? First year 40, second year 10. If you set off brought forward loss, how much is the income? 20. On the 20, if you levy tax, 6 lakhs. Cess 24,000. Total how much? 6,24,000. Now book profit 35 lakhs. On the tax 5,25,000. Cess 21. Total is how much? 5,46,000. So now tell. Normal tax is how much? 6,24,000. Book MAT is how much? 5,46,000. Which is higher? Normal is only higher. So we should pay what? Normal provisions only we should pay. Okay. But since you are paying normal tax, you can adjust what? MAT credit. Okay. How much MAT credit we are having? 7,80,000. But 7,80,000 you cannot adjust. Okay. How much you can adjust, sir? This 6,24,000 until the extent it reach 5,46,000. This difference only you can adjust as MAT credit. How much you can adjust? 78,000 adjusted. Okay. So balance how much has to be paid? 5,46,000 has to be paid. So in other way, government securing minimum MAT as their tax. Okay, if normal provisions are higher, then they'll get more tax. Okay, but minimum they'll get every year how much as tax? MAT minimum they'll get. That's why it is called as minimum alternative tax. That is the minimum tax government will get every year from such company in any circumstances. Okay. Then fourth year. Fourth year, it has loss of profit of how much? 60 lakhs. No brought forward losses, sir, because all these losses adjusted in year 3 only. Year 4, nothing to be adjusted. So now on 60 lakhs tax, how much? 18 lakhs. Plus cess, 72,000. So total tax is how much? 18 lakhs, 72,000. That year book profit is how much? 40 lakhs. 40 lakhs into tax rate, 15%. Now how much is there, sir? 6 lakhs. Okay. Plus cess at a rate of 24,000. So total how much is there, sir? 6 lakh 24,000. Now tell. 18 lakh 72,000. 6 lakh 24,000. Which is higher? 18 lakh 72,000 is only higher. Yes or no? Now again, MAT applicable or normal tax applicable? Normal tax only applicable. Okay. Now can we adjust MAT credit? Yes. What to what extent? The difference between these two. The difference between these two is roughly 12 lakhs. We have MAT credit only 7 lakhs. So full MAT credit can be adjusted. The balance 11 lakh 70,000 will pay it as tax. Okay. With this example, we understood how to take MAT credit and how do we adjust MAT credit also. Okay, and in case conversion of company into LLP, then MAT credit cannot be transferred. So look at this point, what they are saying. In case of conversion of company into LLP, MAT credit of company cannot be transferred to LLP. Then foreign tax credit. See, A Limited incorporated in India. It has a branch in USA. How much is its income? Okay, let's say its income is how much, sir? 75 lakhs income. On this income, India also it is taxable, foreign also it is taxable. Why? Sir, because it is a domestic resident company, India you need to pay tax. But this is from where? Branch in USA. So in USA also they are taxing. Everybody understands, sir? We have an Indian company. It has income from foreign source. Since it is resident, global incomes are taxable. That's why foreign income also being taxed. But since it is from branch in USA also it has to be taxed. How much is taxable in US? 15 lakhs. This 15 lakhs paid in tax paid in USA will be given as a tax credit. Under DTA chapters and all, we have credit available. The tax paid in foreign country will be given as credit, which can be adjusted here. So the 15 lakhs tax paid in USA will be given as foreign tax rate, which could be adjusted with the tax payable in India. Now, the amount of MAT credit will be reduced by foreign tax rate allowed against MAT minus foreign tax rate allowed under normal tax. Sir, look at this example once again. Normally, this person has tax of 2,50,000. How much? 2,50,000. Normal tax he has 2,20,000. MAT applicable or normal tax applicable? MAT applicable. Okay. Then let's say he has foreign tax credit available is how much? 2,30,000. 2,30,000. So foreign tax credit here is how much, sir? 2,30,000. But here normal tax, sir, when they are giving tax credit, what they will say now? The tax paid in foreign country or the tax payable in Indian country, whichever is lower will be given as credit. Otherwise, if you give 2,30,000 as credit, reverse department only has to pay you extra 10,000. That's why what limitation they'll give? The tax paid you already in foreign country or the tax payable in India, whichever is lower, you can take it as credit and adjust that. Balance only you pay. Here, 2,30,000 is there. Whereas normal tax is how much? 2,20,000. So whichever is lower, 2,20,000. So how much is there? 2,20,000. If you adjust normal tax became 0. Okay. But under MAT, how much you are claiming? 2,30,000. Sir, as per normal provisions, you can adjust foreign tax rate only to the extent of how much? 2,20,000. But as per MAT, you can adjusting still 2,30,000, right? Now, MAT credit. Sir, usually MAT credit, what will say? 20,000 and this normal tax. The difference between the MAT tax 2,50,000 and normal tax 2,20,000, 30,000 will take it as MAT credit. What adjustment they are saying? MAT credit 30,000 is not available here. Why not available? Because foreign tax credit, even though they claimed under MAT 2,30,000, but originally it is available only to the extent of how much? 2,20,000. So as per MAT, they claimed extra 10,000 benefit. So that 10,000 benefit reduced from the MAT credit. So MAT credit 2.5 lakhs minus normal tax. Originally how much MAT credit? 30. But FTC against MAT. How much is the foreign tax rate against MAT? 2,30,000. What is the foreign tax rate against normal tax? 2,20,000. That difference 10,000 you have to subtract, and the MAT credit available is only 20,000. Sir, simple, sir. Foreign tax rate you will get is tax payable or tax paid in foreign country, whichever is lower. If there is no MAT now, how much foreign tax rate you should get? 2,20,000. But for MAT purpose, you are adjusting 2,20,000 or 2,30,000? 2,30,000. I mean, extra benefit, how much you got? 10,000 extra benefit you got now. The 10,000 reduced from MAT credit. How much is your MAT credit? Normal tax minus and MAT tax difference 30,000. But from the 30,000, you reduce the benefit you got from foreign tax credit under MAT 10,000. Then the balance 20,000 only you can take it as MAT credit. This is about foreign tax credit adjustment. Then, where the statement of P&L is prepared as per Schedule 3 and certified by statutory auditors, AO has no power to scrutinize net profit. Sir, as per Schedule 3, company already prepared P&L. It was already certified by auditors also. Except the 14 addition items and except the 11 subtractions to be done, AO has no authority to do any other adjustment because it is prepared as per Schedule 3, certified by a auditor. He can do only those book profit 14 adjustments or the 11 adjustments on the credit side. Except them, he cannot do any other adjustment. Okay. Then this point we already discussed, sir. What? Closely held companies, when there is a change in shareholding, what? Minimum 51% of shareholding if it is continuing, then, okay, brought forward loss can be set off. Otherwise, the brought forward losses cannot be set off. However, the restriction is not up. Okay, this point important, sir. that restriction of brought forward losses to be set off unless minimum 51% shareholding has to be there, na, that restriction not applicable to eligible startups under 80 IAC. Such startups, na, I have an idea only, sir. I don't have money. So to increase the company or to make the company, I need to bring investors into me. So slowly, maybe first I have some 1 crore money with me. I have an idea. With 1 crore and with the idea, I started a company and doing marginally a business. But I know this idea has potential. Let's say Rapido kind of. This idea has potential. But to expand, I need money. Okay, I'll go for first round of investment. Then whose share capital, whose percentage has to be sacrificed? Mine only, right? So my 100% now came to 50%. Other 50% I given to investors. Now second round. Again, cumulatively, everybody has to sacrifice and next round of money will be brought. So like that, initial years I have lost. Only me is there. But I'm a startup. To expand my operations, I need to bring share capital so that I'm losing my percentage of shareholding. I'm continuing only, sir, but my percentage of shareholding is losing. Okay. Now they cannot put this kind of restriction and deny my losses to be set up. There is no change in shareholder. My percentage is coming down. Because what? Because the company has to grow. I need to bring back I need to pull the money. To pull the money, I need to sacrifice my shareholding. Sir, percentage I'm sacrificing. Wealth-wise, maximizing only because if for every round of investment, my share price will increase only, right? So that's why wealth-wise, even though share percentage, first I have 100%, now it may came to 20%, but still, percentage-wise it came down. But wealth-wise, this 20% share only now worth of some millions or billions, okay? That's why for eligible startups, if they sacrifice the shareholding, the initial promoters, if they are sacrificing their shareholdings and all, then this restriction will not apply for eligible startups. Then, sir, due to search and requisition, they found any undisclosed incomes. On undisclosed incomes, tax has to be computed, right? On the tax, with the tax, you cannot set off or carry forward losses. With undisclosed income, you cannot set off brought forward losses and unabsorbed depreciation. Both cannot be set off with undisclosed incomes if any found. See, brought forward loss or unabsorbed depreciation, both shall not be set off with undisclosed income while computing total income in the previous year, where such undisclosed income is consequent to such or requisition or survey. Okay.